They've done this about a month ago, puts out these letters discouraging use of the H20 chip. So we're going to see how that all shakes out for the likes of ASML and company. Miners as well, very much on our radar. We've got a gold tariff story to factor in, Guy, plus some moves in iron ore, some of the other metals. We'll see how it shakes out at the open.
Okay, all of that to come. Let's get you to this market open. The Tuesday open is upon us. It is time for the opening trade. Let's figure out exactly what Europe is doing, what all those managers out there are seeing in these markets this morning. The FTSE 100 flat out of the open. We'll see how the miners trade in just a moment. We're going to tell on what is happening there. You've got the gold trade, you've got the iron ore trade to fold into that narrative as well. We're going to watch and see exactly how some of the chip numbers perform in Europe as well this morning. We'll see how they perform. Critically, I think as well, we want to watch what is happening with the defence names. All of that needs to be factored into the DAX in particular this morning, but the FTSE 100 as well. Names like BAE Systems, an early tell maybe on what the sentiment is surrounding this sector that has been dinged up pretty well over the last few days. The CAC is open. It's up by 0.4%. Maybe we were underestimating this open a little bit better, up 0.4%. The DAX is open as well, up by 0.3%. The IBEX by 0.3%. So as Val says, not a bad open. We'll take a little bit of positivity first thing this morning, but where is it showing up, Valerie? Which sector story are we watching carefully this morning?
Well, nearly all sectors are in the red. There's only one, all sectors in the green. There's only one that's in the red, and that is technology. So it does seem to be there is a negative read-through from these European chip makers on this China news that they are basically speaking very negatively about NVIDIA's H20 chip. But when it comes to the sectors that are performing very well, basic resources is at the top of the basket, Critty. That's due to the rise in iron ore prices, which is extended into second sessions. That is definitely helping out the basic resources types of names. I'm not seeing defense stocks jumping out at me at the moment. I'll have to dig into there deeper, but we are seeing Vestas Wind Systems, one of the best performing stocks. I think that's interesting because yesterday we had the Danish wind company Ørsted drop some 30% after announcing that rights issue, essentially getting a bailout by the Danish government, who owns 50% of the company. So it does seem like to be that alternative energy at least is having a bit of a bounce back after yesterday's quite gigantic slide in Ørsted.
I'll mention the defense names here now that we're getting a little bit of a read. I'm looking at Saab here, higher by about 1.2%. Rheinmetall, though, also bouncing back, higher by about 1%. So again, not a massive jump into defense stocks this morning, but certainly one that I think tests our theory that we've had around this table, which is that the defense story, the defense unwind, is very much related to the ceasefire talks. It's not just a valuation story, as we were suspecting from last week's trade.
If you look at the points gains that are coming through this morning, Rheinmetall is the second biggest points gain in Europe in terms of the upside for the stock 600, and you're seeing that with some of the other defense names as well. I guess we could lump Airbus maybe into that story as well. But you do have some of the other defence names moving too. It is the chips names that are acting as the drag this morning. So technology is under pressure. In terms of points, we're talking here, this is not percentage. SAP, ASML, two of the biggest drops that we're seeing first thing this morning. We are also seeing some of the pharma names actually under pressure, which is interesting too. So you've got names like Roche, Astra, GSK, all under a little bit of pressure. So that's where the negativity is coming through this morning. So we do see some bounce back in luxury. You've got some bounce back in some of the defence names as well. And energy picking up a little bit as well, which I think is interesting. How would you... Is that part of the Russia trade? I don't know.
I think it's more down to the Ørsted slide yesterday and rebounding after that, because we are seeing a lot of the more alternative energy names trade strongly. The more traditional ones like BP are trading flat this morning.
Yeah, Shell's up by 0.4%.
Yeah,
like it's adding to the upside, but not by much.
We got to mention the luxury names as well. Hermes and LVMH are moving the entire benchmark up, and that has nothing to do with France. It has nothing to do with Cristiano Ronaldo's engagement, which I think is important. Just saying.
Tell me more, Critty.
I would love to. It has to do with the U.S.-China trade truce. Maybe at the end of the show we'll give it a minute. But I think it's another crucial one because it is moving the benchmark as a whole to the upside.
All right, well, let's bring all of this to our markets guest sitting
question.
around the table. Christian, I had no idea he was engaged. Tell me more, Critty. I'm really interested. Joining us now is Lucy Baldwin to discuss these market topics, Global Head of Research at Citi. Obviously, one topic we didn't talk about there is CPI. Big data print today. And I know we were talking about before whether this reallocation trade into Europe with U.S. stocks lagging is something that could potentially come to an end, given the U.S. has had such a great earnings season, especially when it comes to those tech names.
Yeah, it's very topical at the moment. As you say, a lot of emphasis today on what's going to happen with the CPI print. I think, as we know, the Fed has a bit of a tightrope to walk here. If that print today, from the CPI perspective, given obviously the read-through into PCE, ultimately is too strong, if it's too hot, everybody's going to be very nervous that if you get more inflation coming through earlier than expected from tariffs, that could be seen further in furniture, toys, all those sorts of imported products into the US, then that's going to put the Fed in a bit of a bind. They're not going to be able to put through, we're expecting 3 cuts, the market's expecting at least 2 this year. And I think if you can't get those cuts through, that's not great news for equities. Similarly, of course, if we go the other way and we end up, as we go through over the course of the next few weeks, getting poor data in terms of underlying health of the labour market, which obviously we were all very nervous about given the revisions in the recent payrolls report, then I think that is also clearly going to be problematic, because although you might then see a lot more cuts than the 2 or 3 that we and others are looking for, that's not a great read on the health of the US economy. And I do think that is going to be a massive debate as we go into next year. I know there's other economists out there away from us. Some are suggesting that you could be in a sort of debate about a recession next year for the US, right, given we've managed to sort of hold it off in many ways. And then there's others out there saying very clearly it's going to be a very stimulative year next year from a fiscal perspective with one big beautiful bill. And that's going to be a credit cycle. It's going to go gangbusters. And i.e., if the Fed don't get the cuts in now, they won't get them in next year. So there's a massive debate, I think, about the health of the US economy into next year, and therefore the read into markets. We're still risk on in US equities. And as you suggested, this earnings season has been incredibly strong, like particularly driven by the tech names, right? We came into Q2, most people had 5% expected US earnings growth, and it's probably going to be more like 11%. I know we haven't totally finished. We've got people like Nvidia to report at the end of August. But ultimately, it's been a much stronger earnings season. We and others are raising the expectation for this year. So we've just raised again our S&P price target for the end of the year. And, it's on the back of strong fundamentals, which is what gives a lot of conviction that it's resilience rather than any kind of irrational exuberance in the US.
All right, Lucy, you sound quite bullish on the AI trade, at least, and U.S. markets generally. Are you laughing at her bullish sentiment?
Yeah, no, I'd love to get your reaction to the bullish sentiment.
Very welcomed. But is there any, risks on the horizon for this AI trade? A lot of people have talked about this ginormous capex spending that they've begun or have continued to do. Where do you start to see red flags? What would start to change your mind about the AI trade?
Yeah, and I think, again, as you say, right, at the moment it is essentially underpinned with great earnings expectations. So again, like second quarter, a lot of it was driven by Mag 7 in terms of where we saw strong numbers, where we've seen the upgrades. We're now expecting around 11% earnings growth for the full year in the US, and half of that is Mag 7, right? So again, we've kind of gone back to the dominant group of tech names rather than the sort of broadening thesis that many of us, including many of our investor fund manager clients, had been expecting / hoping to see, and we've come back to that. I think there's a lot of risks in terms of obviously the returns on that capex on a multi-year view, but ultimately AI is going to be probably a decade-long story, and we are pretty excited about what it might mean in terms of the health of the overall earnings picture across the US market. I think, you were asking me earlier about Europe, right? And again, I think if I had our European tech analyst sat here next to me, he would be saying, look, without the sort of AI trade coming to save us all, I would have a pretty lackluster sector, right? With a lot of product, a lot of inventory waiting to sell it through, industrial cycle not super strong, and there would be many more concerns and overhangs, right, in terms of the underlying health of the sector if you could kind of strip that out. And that's sort of how I would frame it, right?
What multiple on the S&P would make you uncomfortable?
Look, I think, guys, you and I have talked about before, like valuation is not great in terms of predicting the next sort of 6 to 12 months performance. It's better at predicting the next 10 years. I mean, I agree with you. When you're at 23 times earnings or in that ballpark, you're right up there, right, versus history. And I think what's interesting is it's very difficult to build a case that it should be trading on much more, right, which is why it has to be earnings doing all the legwork and giving you all the upside from here. I think what's interesting is once you get under the hood, there's an awful lot of dispersion there in the market. And a lot of those smaller companies are actually not kind of at their 52-week highs, right? And a lot of those names are struggling a little bit more. And that's where you're seeing things like the impact of tariffs come through already and start to squeeze margins, right? We've had this big debate about who's going to bear the tariff brunt. Is it the consumer, which is obviously not great for GDP, or is it going to be corporates? Are they going to have to take the hit because they can't pass the cost on?
Lucy, we are 3 days away from a summit in Alaska between Donald Trump and Vladimir Putin. We've tested the theory of whether or not that's something that's getting priced into defense stocks that saw quite the unwind last week. It kind of seems to be. Play the hypothetical for us here. Is a ceasefire agreement or progress towards one, is that a win for European stocks as kind of a removal of the geopolitical overhang, or is this a negative given that defense is such a big piece of it?
Yeah, I think so. Clearly, obviously the big picture from an energy perspective would be if you could get a ceasefire, you could see some movement in terms of lower energy costs, and all of those things would be hugely positive, right? And obviously we could talk there about manufacturing or the impact on sectors like travel and leisure and chemicals that are super exposed. So there's some positives in that sense. I think what I would say is obviously there's an awful lot that's got to play out in terms of this potential for a ceasefire, given it's about territory, but it's also about the security deal and the backstop Ukraine's going to get. So I don't think this feels like it's going to be a sort of quick resolution. I think this linked to other things is a multi-year journey for defence, right? And there's the broader geopolitical landscape. I think what I would say is that when we talk to clients, what's really evident is there's an awful lot of longer-term money managers out there who have only relatively recently started to be able to buy the defence names, right, literally within the last few months. And so I think there is demand on a long-term structural basis to see that interest back in the defence sector. And I say that because of obviously some of what we would term like the ESG sustainability constraints.
So Guy asked you what valuation would make you uncomfortable with the S&P. What valuation would make you uncomfortable with defense stocks?
I think, again, you have to look at it in the framing of like growth returns and at a sort of sector level, right? Again, I think, I suppose to nail Guy's question a bit more fully, right? I think we're sort of there in valuation terms. It can't go much further. I don't think, again, with the defence names from a multiple perspective, you have to see this earnings growth on a multi-year journey. I think the broader, bigger debate for that sector ultimately is what is that growth rate? And I think the things that have really made people question it is when you see some of the technology at relatively low price points that is more sort of like drone, etc., more kind of like AI-driven tech, doing more of the heavy lifting in some of these hot wars around the world, whether that's Russia or Ukraine or in other places. And I think that is clearly what is making people think, is it all about just the big name defence stocks, or is that growth going to ultimately slow and get replaced by a different type of defence growth over the course of the next, 5 years or so?
Lucy, great to see you. Thanks for stopping by. Nice and bullish. Lucy Baldwin, Global Head of Research, joining us from Citi. Let's talk about some of the single stocks we're watching so carefully this morning. This is what the Core 6 looks like first thing this Tuesday. As you can see, a fairly mixed picture. You've actually got some of the pharma names. Actually, the pharma names are generally down. Novo's on that list as well. ASML is also giving back some ground. The chip space under a little bit of pressure. Luxury is up, maybe on the extension of the tariff deal with China. One name that is not on that list is Vestas. That stock has been climbing this morning. It's off its earlier peak, but up on the fact that it looks like it's won some orders over in the United States. This looks like an issue that is related to Vestas rather than it being a holdover from Ørsted yesterday. We're going to have the company on set a little bit later on this week. Looking forward to that. So we'll come back to that story in just a moment and show you some numbers. Elsewhere, we've just been talking about it with Lucy. Let's talk about some of the defence names. Chloe's here with all the details.
Good morning. So, yeah, let's start with defense. Yesterday, we saw defense names go down on news of potential truce, and today, because Trump downplayed the expectations for his meeting with Putin over the end of the Ukraine war, we see some upward movements across that defense sector. Hensel, Rheinmetall, and BAE Systems are all up a little bit, not massively, but a little bit. Moving on to Rio Tinto, the miner is also up this morning, up 1.25% on the back of Trump saying that there will be no tariffs on gold. So it's driving up this miner today. Moving on to another sector that is also moving on Trump news is the luxury sector. So MS and Kering are also up because Trump extended a pause on tariffs on Chinese goods for another 90 days. So that is providing a little bit of relief across that sector. Again, not massive moves, but a little bit in the green as well. And then finally, finishing on Sartorius, we've got an upgrade there from Jefferies, upgraded to buy, and that is getting the stock to rise, almost up 4% this morning there for Sartorius.
All right, Chloe Melly from our equities team walking us through some of those early movers. We thank you so much. Coming up, we come right back to the tech story. China has urged local companies to avoid using NVIDIA's H20 processors. We'll dive more into the details and the ripple effect next. Stick with us. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Aqua in Sintra, Portugal, and this is Bloomberg. Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hardern in Alberta, Canada, and this is Bloomberg.
Welcome back to the opening trade. Just about 18 minutes into today's session. Green on the screen across the board, but all that excitement in the DAX features that we saw completely paired its gain. We're now flat on that index, but the CAC 40 seems to be picking up momentum. A lot of that seems to be perhaps a read-through from some of the luxury names reacting to that U.S.-China trade truce. But there's another component to the China story we need to be paying attention to, especially when it comes to the tech component. China has urged local companies to avoid using NVIDIA's H20 processors, particularly for government-related purposes. Bloomberg Technology co-host Ed Ludlow hot-footed it over here from San Francisco just to tell us what's going on.
Sure.
This is something that predated the 15% revenue story. Walk us through the significance of this. Is there a viable alternative to NVIDIA's H20?
In recent weeks, so you're right, it predates the last 24 hours of news flow, various watchdogs and regulators in China have sent advisories. It's just guidance. It's non-binding. It includes a number of chips, but sources confirm specifically the H20, which is completely in line with what China does in technology anyway. It's very normal for watchdogs to say to a government-backed enterprise or even just a government entity, don't use foreign technology where there's a security concern. But your question is the right one. Right now, H20 is the only chip that NVIDIA will be allowed to sell into the Chinese market. But it is not the only chip that's available to Chinese technology companies. Huawei, their domestic champion, has various generations of chip that are not just better than H20, they're better than H200, which until very recently was NVIDIA's cutting-edge chip. So there's a national security element from China's perspective, but there's also actually, there was an opportunity here for our national champion to take some market share in the vacuum. Why would we now want NVIDIA to be allowed to come back into that market? Especially if its tech is obsolete for the purposes of what's available.
Could this show up in NVIDIA's numbers?
Yeah, so I'd imagine that on the sell side, there's a bit of a scramble this morning somewhere on the East Coast to start to remodel, because when the revenue split story came out, the simple arrangement being a quid pro quo where if the US government allows NVIDIA and AMD to sell to China, they take 15% cut. And that gave a lot of confidence that even as soon as the next fiscal quarter, it would start showing up. Actually, NVIDIA was very clear. We haven't sent any H20s to China, so that might have been a bit premature. But this would signal, and indeed, there's quite a few notes out already, that in the context of trade talks between the US and China, there's an issue here. And NVIDIA is quite clearly willing to play by the president's rules. And one point I'd make very quickly is NVIDIA always says that it's an American company and it plays by American rules.
Well, I guess the relationship with President Trump is really key in that relationship. And we did hear from Trump yesterday saying that he was open to NVIDIA selling a scaled-back version of the Blackwell chip. This is their most advanced AI chip. Do you think that's something that's viable? Is that something that Jensen Huang has begun already to develop?
It's something that NVIDIA has never discussed, on the record at least. Good spot. It was a critically important moment because the president showed command of technology. He understands that actually the market has really wanted NVIDIA to talk about a new chip for the Chinese market. So whatever the future of H20, the idea was on a completely different architecture, NVIDIA would do a new chip from the ground up for the Chinese market that would be more performant than H20, but not as good as the cutting-edge Blackwell chip. They've never discussed it. The market has speculated it is called B30. Indeed, on the show, Bloomberg Tech and at Bloomberg events, we've had big investors come on and go, we want to know about the B30 as if it's real, but NVIDIA's never commented. And the president, in summary, said, Jensen wants to come and talk to me about a sort of less powered variant of Blackwell, and the market paid close attention to that. But it, again, would be subject to the same issues we're discussing in the context of H20.
Well, Ed, talk to us about some of the other chips players, not just NVIDIA, but AMD as well, Micron, Intel, et cetera, that maybe don't all have that exposure to China, but are trying to invest heavily over in the States.
Oh, gosh. Well, in AI accelerators, GPUs are going to data centers. NVIDIA has 95% of the market. AMD has 5%, and everything else is negligible, so we can move on from that. You know, the context right now with Intel, particularly post-meeting between the CEO and the president yesterday, is that technology companies are zigging with the president, and today Intel's been zagging. You know, it's just not been doing the things that the administration is supportive of, which is ironic because on paper, Intel is America's domestic champion for manufacturing chips. There's been heavy emphasis on TSMC, Taiwan's company, and Samsung Korea's investing billions of dollars to ramp up capacity, particularly in Texas and Arizona. And Intel, hence the change in CEO recently from Pat Gelsinger to Lip-Bu Tan, you know, it just fell behind. It didn't execute. But the story with Lip Bhutan, last Thursday, the president posted on Truth Social he should be fired or he should resign because of historic links to China. Now it seems like they're moving forward together.
The Trump administration is really getting into the weeds on this stuff. The president's really getting into the weeds on this stuff, which I find incredible in so many ways. I still don't understand how you do the export tax effectively.
You're assuming I understand.
Well, I'm hoping you do. I'm assuming you know more than I do, which is usually a correct assumption. Where does the IP sit? How do you tax this stuff if the IP's in, I don't know where it is, or the manufacturing's in Taiwan? Is this something that is viable?
The answer is we don't know, but you raise a good point. Well, hypothetically, where would this semiconductor be manufactured? You know, a tariff or a tax is applied typically at the point of entry or exit from the country. So what this 15% revenue split is being labelled as is an export tax, which is to some extent unprecedented. Is it unprecedented in the context of how Trump does deals and does business? Not necessarily. You know, he has done a number of ad hoc arrangements with different companies. Apple is one we can get into at a later date. But my understanding from a White House official I spoke to last night is that what the president said is true. Jensen Huang went to the president. I want to get an H20 export license. The president said 20%.
He said 15.
Jensen said 15. And they just cut a deal. My understanding is AMD was actually done a little bit more through the Commerce Department, but we don't know what happens next. That's part of the fun of covering technology.
Ed, and you do very well. Thank you very much indeed for stopping by and seeing us here in London. Ed Ludlow, hot-footing it from San Francisco. The next edition of Bloomberg Tech Europe airs this week. The show will be exploring how AI is changing the way we work. 6:30 a.m. London time, Friday, with, there he is, Tom McKenzie. Let's talk a little bit about what we're getting out of Norway this morning. The Sovereign Wealth Fund enjoying its best quarter since 23, returning 6.4% in the second quarter, propelled by stock market gains. Kari Lundgren joins us very briefly to talk about this. Kari, just how did they make that? What was the return pickup, and where did it come from?
Good morning, both of you. In general, it was European stocks. You have to remember that the wealth fund here is largely tracks the index with a little bit of margin, so they will follow what the stock market has done for the first half of the year. European stocks gained 17.8%. Financial firms gained 16.5%, and so yes, and a big contributor was European banks. We will be finding out more, I should add, in the next few minutes because their holdings list just dropped. So we should be adding to that story shortly.
Carrie, we look forward to your coverage there. We'll leave it at that point. We should just mention, of course, you've done a great job in terms of this coverage. Some of this currency impact is also going to be showing up, and we'll keep a very, very close eye on that as these start to unfold. We also are going to be hearing from the head of Norway's Sovereign Wealth Fund, Nicolai Tangen, is going to be joining later this morning on the Bloomberg Brief. We imagine he has a lot to say when it comes to the defense narrative, when it comes to the tech narrative as well, which is one that permeates through this market, not to mention some of the concerns around tariffs and some of that growth risk.
Yeah, and they're being one of the largest holdings of NVIDIA. I know we were just talking about NVIDIA, their relationship with China, their relationship with President Trump, all that hinges on how they export this new technology, their new AI chips, into wider markets.
Okay. All of that still a firm focus as we work our way through the back half of this show. European stocks adding a little bit to the upside this morning. Coming up, we're going to turn back to the US CPI story. Grace Peters is going to be joining us, co-head of global investment strategy at JP Morgan Private Bank. That is all coming up at 26 minutes past the hour. This is Bloomberg.
Close.
With regards to the electric vehicle business, when we talk about the commitment to new models and more importantly, commitment to the infrastructure to support that, what's the plan?
We're starting to see different kinds of hybrids that customers are excited about. E-revs, which go about 100 miles, all electric, but then you could take a 700-mile trip once in a while. Those look really promising for a three-row crossover like Explorer. We're going very low end, super affordable EVs for urban duty cycles and for commercial. We're not going to invest in a lot of the very expensive crossovers for pure EV. We think that's going to be a hybrid business.
What does the supply chain look like specifically for the EV and hybrid business right now?
We've moved out our cycle plans. We've focused on affordable and commercial. We're fortunate we moved 3 or 4 years ago and we could tilt to hybrid and a specific kind of EV. And the supply chain has been able to move with us so far.
Don't miss The Close, live every weekday. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Welcome back to the opening trade. About 30 minutes into today's session, we're starting to see how this market is shaping out. I think it's interesting. On the surface, higher by 0.3%, but take a look at this index level. The outperformance is not coming from the DAX. It's not your defense name that's driving this market higher. It's your luxury names, and that's showing up from the CAC 40. Geopolitics still very much at the center, just not a conversation between the United States and Russia. It's a conversation, Guy, between the United States and China.
More stocks up than down. Markets having a slightly better day. You can probably take that away. 468 up right now. Just want to highlight the volume number. We are mid-August. The volume number is quite light this morning. Just bear that in mind. Maybe people are sitting out waiting for the CPI number to drop a little bit later. Not many 52-week lows today. There's plenty of 52-week highs in the banking sector, though. Let me just show you some of the names that we're watching and what we're seeing around Europe. You've got AP Muller-Maersk also hitting a 52-week high. The shorts that were in that stock certainly being burnt recently. ISS is trading higher as well. But the banks generally are where we are seeing the bulk of the 52-week highs. That's where the story has been for the bulk of this year as well. The banking sector has been the driver of European performance this year. Defence has been obviously there as well. But Banco Sabadell, obviously in the news on the M&A front as well. That stock is up by let's call it 1.7%, Val.
Here's what else you need to know this morning. The U.S. has extended a pause of tariffs on Chinese goods for another 90 days into early November, stabilizing trade ties between the two world's largest economies. Meanwhile, China has urged local companies to avoid using NVIDIA's H20 processors, particularly for government-related purposes. And next, President Donald Trump is downplaying expectations for his upcoming meeting with Russian leader Vladimir Putin as he seeks to end the war in Ukraine. European leaders and Ukrainian President Zelensky will hold a call with Trump tomorrow ahead of the U.S. president's meeting on Friday. And lastly, Britain's jobs market appears to be past the worst of a £26 billion tax hike by the Labour government, with payrolls falling only 8,000 in July, the lowest drop since January. Critty?
Valerie, thank you so much. I think it's that kind of jobs data almost that is really keeping everyone on tenterhooks. Let's get a little bit more insight on that. Dan Hansen, Chief UK Economist over at Bloomberg Economics, joins us around the table. Dan, your initial reaction?
I think exactly what Val's just said, a little bit stronger than expected. I think the broad picture here is that we've got a jobs market that is loosening, and I think it's going to continue to loosen through the remainder of this year. I think what the data does today is raise a question about, are we perhaps reaching an inflection point around it? And I think that is what we heard from the Bank of England last week, where the jobs market, if you go back to June, the jobs market looked very weak. We had a big fall in payrolls. That got revised away. And we're now in a world where the jobs market, it is loosening, but it's not loosening at a particularly rapid pace. And as I say, what Val just said there around the national insurance hike, I think there is this risk now that things stabilise, and the bank is very sensitive about inflation. We know that from what we heard last week. So I think if this trend continues, we're going to be asking questions about whether there's going to be a November cut, which at the moment is 50-50 in the market. Yeah. That pricing hasn't changed this morning, because I think this has sort of reaffirmed people's priors, this print. Yeah. But I think if you get more of this stabilisation...
Does the wage data could sort of speak to that as well? Like, wages are still, running at 5%, circa kind of around those sort of levels at the moment? Yeah,
it does. It does speak to that, but it's cooling. And if you look at year-end numbers... You're looking at sort of 3.5, 4, which is much closer to where they need to be. They need to be at about 3 for 2% inflation.
Where do we think inflation is going to be at the end of the year?
About 3.5.
Right.
So that's the challenge. And you've got food inflation that's high. They're to use the Bank of England's word, it's the salient bit of the basket that households look at. That affects their inflation expectations. But if you listen to Bailey in the press conference, he said wage growth is the biggest bit of news we've had since May. And we continue to track below their May forecast. And I think their August forecast looks about right for 3.5%, 3.6% by year end. So if you think there are 5 of them who are itching to cut rates, at the moment, I still think they'll probably be in that camp. The one to watch is Bailey, because if he moves, then it's suddenly 5-4 the other way, and we're on hold.
Dan, I want to tie this into the broader narrative, because you can argue that Canada and the U.S. are both having the same issue, a labor market that's weakening, but inflation above target. Is there any hints that maybe the MPC would act differently than the Fed or the Bank of Canada in this, obviously, the dual mandate approach? Yes. I know not every central bank has a dual mandate, but is there any hint that the Bank of England would act differently?
I mean, I think if you look at it, if you took a step back and looked at all the different central banks, you'd probably say that the Bank of England is quite dovish, actually, given the inflation backdrop. The inflation backdrop is challenging in the UK. We haven't beaten inflation, like, for example, Christine Lagarde uses that term. Mm-hmm. And in the US, of course, there are tariffs. It's a very obvious explanation for why inflation will be rising in the US. In the UK, it's not about tariffs, it's about taxes. And I think the problem, and the historical problem in the UK, is that inflation expectations are very sensitive to the inflation numbers. And if you look at averages of inflation in the UK versus the US, we do run above 2% on average in the UK. I think over the past 10 years, we've had big depreciations in sterling, obviously movements in oil prices. So we're used to slightly higher inflation here in the UK. And I think that actually speaks to being, if you were to be objective, being a slightly more hawkish central bank rather than a more dovish one. But the Bank of England is very keen at the moment, at least, to look through this inflation hump that we're going through in the UK.
Dan, thanks. Really appreciate it.
No problem.
Dan Hanson catching us up on the latest data out of the UK and how that falls into the wider picture. Joining us from Bloomberg Economics. Let's talk about the bigger picture here and what is happening. We've got the CPI print coming out of the United States a little bit later on. We need to fold that into our thinking as well. Joining us now, Grace Peters, co-head of Global Investment Strategy at JP Morgan Private Bank. Good morning.
Good morning.
The bond market is smelling a slowdown. And we're starting to see evidence of that. The equity market is, let's go. Everything looks good. Is there a difference there that I need to worry about? In a kind of balanced portfolio, as I think about how I should be investing right now, how should I be thinking about the world going forward from here? How are you thinking about the world, and what are your clients kind of asking you about that?
Yeah, I think, to me, there is a slowdown ahead. I don't think there's a recession ahead, but we're absolutely seeing growth slow. Yeah. Inflation is going to rise. I think we're going to see a CPI print that's on the hot side today. That's certainly what the market's expecting. And I think that trend will continue through the end of the year before tailing back to around 2.5% next year. Okay. What I think is very important when it comes to equities or indeed credit markets, risk assets at large, is that I don't think that the market and the economy are in any way the same. When we think about corporate earnings season that we've just had second quarter for the US, we saw 10% earnings growth that followed 12% in the first quarter. All of this being at a time when we had lackluster GDP. We now know downward revisions to the labour market. And so you're seeing very clearly this differentiation being drawn out between the market, which is driven by structural trends, predominantly artificial intelligence, and the economy that I think is going to see this more stagflationary backdrop in the second half of the year.
You don't see those converging. There's no kind of... The market can keep doing its own thing. The economy can keep doing its own thing.
I think the market will continue rising. I think there's obviously going to be bouts of equity markets, and I think corporate credit will continue to do well also. There's going to be bouts of volatility. Nothing moves in a straight line. But I think that the earnings backdrop, and of course the balance sheet supporting those earnings and supporting the investments, is pretty robust. So I think investors are going to be continued to be surprised that the pain train broadly lies to the upside, and you're still going to get another 7 to 8% out of equities over the next 12 months, and probably 6% out of corporate credit as well.
All right. Sounds bullish to me. Grace, I want to ask you a question that you kind of touched on there, the difference between the equity market and the real economy. I was reading a piece in the Wall Street Journal by Greg Ip, that guy sent to me while he was on holiday, talking about how AI is just sucking in so much investment, almost to the depreciation of the real economy, maybe the more rate-sensitive sectors. Are you seeing that kind of narrative? Is that any credence to that kind of narrative, that AI can really just suck away growth from the rest of the economy?
No, I don't think it's going to suck away growth from the rest of the economy, but I definitely think that that is where CapEx is oriented at the moment. And actually, very interestingly, what we've just heard from companies through corporate earnings season is that the AI use cases, i.e. the productivity and the margin benefits, it's not just residing in the technology sector anymore. You're starting to see across sectors examples of productivity gains, and actually margins across the market, talking predominantly to the US, positively surprised significantly, which I think is in part because of the AI benefits, also because companies are dealing very well with the tariffs situation. But AI and productivity gains is a huge part of that. So we do think there's a whole AI value chain. Yes, of course, it starts with technology, but the power needs that follow. And then within each sector, there'll be winners and losers. To us, it biases us very much towards large cap when it comes to public equities, because they're the ones with the balance sheets and the ability to invest. And I think in the smaller part of the market, that's where it does become closer to the real economy, and where I think margins will be more at risk and the ability to invest and harness AI will be more limited.
So are you penciling in the equity rally broadening out to other sectors outside of AI based on that view?
Yes, I mean, the equity rally has been reasonably narrow around technology, but let's not forget we've also had industrials, utilities and financial stocks also do very well, and this is not just a US story. So I'd say definitely broaden globally. We do think global diversification is the right way to invest, and yes, by sectors, but still with technology really being the forefront because of the earnings growth, and also share buybacks, which we know are also a central theme when it comes to incremental buys.
The share buybacks is such a crucial theme on the side of the Atlantic as well, especially in the banking sector. You made a key point when it comes to the U.S. resilience story. So much of that is these corporates absorbing the tariff pressure. Can European corporates absorb the tariff pressure the way that American corporates can?
I think it's going to be tougher in Europe to absorb those pressures, but I think you've already seen that below the surface of the market playing out, with some of the consumer-facing companies having had a very tough few months. And as you highlighted before, areas like the banks, which lean into the European domestic story, because the story in Europe is very different now. For many years, we've been talking about European exporters really being where the growth is in sectors, like luxury goods. And that has totally flipped, I think, since we've seen the German fiscal stimulus, where now the exciting story is in Europe is far more domestically focused, and that's why the banks can do well, pretty, as you mentioned, also coupled with the share buyback story that supports European financials and potentially some consolidation potential later down the line as well.
You said that it's kind of been playing underneath the market as well. Why is that kind of margin compression not showing up in the stock price just yet?
Well, for when it comes to European companies, the valuation is so much less to begin with, and I think that when we think about in the US, it is showing up in the in the share price. If you look at earnings momentum, which is in part is driven by the market, you've seen small caps and consumer companies see negative earnings momentum into this quarterly earnings season, and technology and financial see positive earnings momentum. That's driven by margins, and that's reflected in the share prices. When it comes to the European businesses, then I think, look, we've seen ECB rate cuts, which is also helping sentiment and helping margins to some extent as well. And as I say, the valuation of European stocks and the fact that they are under-owned, and there's been a flow story predominantly around the dollar and positioning around dollar overweights that has also really helped European companies. So, you know, we are still preferenced to the US. We think US exceptionalism is diminished, not destroyed, but Europe's still a key global allocation.
Do your clients like this market? Do they like investing in this market? Is it a market that makes them nervous? Are they comfortable with current multiples? I keep reading reports that the humans are worried, that the machines aren't. And I'm just kind of wondering what feedback you're getting the other way in terms of, you talked about the pain trade just a moment ago.
Yes.
How much of a pain trade is this market rising?
So, you know, our clients have held steady through the volatility that we saw in the spring and have been adding to the market since then. Adding to the market in a way that I think no one really feels comfortable, does it? This doesn't feel like a comfortable market. Indeed, our mid-year outlook was entitled Comfortably Uncomfortable for that very reason. But I think, look, our clients, you know, we work very closely with them on having a plan for their wealth. Many of that, you know, leads to the fact that they need to phase into markets, and therefore dips are commonly opportunities to add. And so, you know, when we think about the fundamental backdrop, you know, we have been pretty constructive on the market over the last couple of years, always recommending phase-in plans, recommending to buy on pullbacks, you know, and so I think, you know, comfortably uncomfortable.
Okay. Comfortably uncomfortable. Kind of feels like every day around here. A lot of volatility and a lot of continuation of that volatility. It's interesting that people are still prepared to do that. Changing the mindset of this market, I think, is going to be something that takes
But you look back
quite
in
a long
history,
time.
and there is always a reason not to buy the market.
Yeah.
And that's the equity market or just a 60-40 balanced portfolio. And yet, year after year, you get, you know, price appreciation. And I think this is a well-trodden path with many of our clients.
As long as the elevator doesn't show up.
All right. Grace Peters, co-head of Global Investment Strategy over at JP Morgan Private Bank, walking us through those dynamics in these markets. We thank you so much. Coming up on the program, we're going to talk about the geopolitics a little bit, which very much is having an effect on these markets. President Trump downplaying expectations for a deal with Vladimir Putin, casting it as a, quote, feel-out meeting. Details coming up next. Stick with us. This is Bloomberg.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
This is really a feel-out meeting, a little bit. And President Putin invited me to get involved. He wants to get involved. I believe he wants to get it over with. Now, I've said that a few times, and I've been disappointed.
President Trump there downplaying expectations for his upcoming meeting with Vladimir Putin. We're joined now for more by Bloomberg's Greg Sullivan. Greg, this feels a little bit of like deja vu to me. Does it feel like deja vu to you?
Yeah, there is an element of that. Obviously, here we have President Trump and President Putin about to meet in Alaska on Friday. Throughout Trump's second term, the first half of the year of that term, he has raised the prospect of a potential meeting between these two leaders. Suddenly, he's downplaying expectations for this meeting, and that's hardly surprising here. Trump, on the campaign trail and in the first half of his presidency, has been laser focused on the idea of a ceasefire, and it's unclear whether this meeting will actually produce that ceasefire, so he's sort of trying to manage expectations. That being said, the fact that these two leaders are meeting seems to indicate that there is potentially a way that a deal could be reached, or at least that they see the potential for making progress towards some sort of deal. So that is basically what Trump is trying to do here, is feel out, as he said in his words, what kind of alignment he might have with Putin. Now, he has said that he's willing to walk away, however, if no deal is reached.
Greg, can Vladimir Putin separate US-Russia relations from Ukraine? Can we have a kind of twin track here that relations between the two are not solely about this one subject? And would that be, I'm assuming that would be a win for Vladimir Putin if that's what he's looking for. Is that the objective here, to kind of start to change the narrative around the relationship between these two countries?
Well, in some respects, yes. Putin has long argued that this conflict in Ukraine should be settled between great powers like the U.S. and Russia. He has sought this one-on-one meeting. He believes that Ukrainian interests shouldn't necessarily be first and foremost in settling the war. He wanted this one-on-one meeting with Trump, which he is now getting, so that the great powers can sort of talk about what needs to be done and then mediate the conflict. Obviously, Ukraine doesn't see it that way. Europe is very concerned about that, but that's largely how the Kremlin has viewed it. So in that sense, they're very pleased with this upcoming meeting. Obviously, Trump has also hinted at potential separation, talking a lot about economic cooperation with Russia and trying to end the war. But again, he's campaigned on the ceasefire, so for him, that's still very much an element of this, even as he threatens to walk away if there's not a good deal.
Greg, great stuff. Thank you very much indeed for updating us as we count down to that meeting Friday. Let's talk about the other kind of geopolitical story we're watching. It kind of folds in tariffs, it folds in tech. There's lots of things kind of within this narrative. China urging local companies in China to avoid using NVIDIA's H20 processors, particularly for government-related purposes. The move comes as President Trump signs an executive order extending the US tariff truce with China for 90 days. Let's talk to our trade czar about this. Brendan Murray joining us around the table. Let's start with the extension and kind of work our way into the tech from there. Is this the new normal? Is this just going to keep going and going and going? We keep rolling this over? Or are we now into the period within this next extension that we could see a meeting between Trump and Xi that could ultimately settle kind of what the narrative looks like on a more longer-term basis?
Yeah, I think the end game is a summit between Xi and Trump, but I think the big takeaway from the past 24 hours is that this trade dispute between the U.S. and China really boils down to two things, and that's critical minerals and critical technology. Yep. And both sides are trying to show that they're not reliant on the other. China, with this move on the NVIDIA chips, saying, we should rely more on local producers, sends a signal to the U.S. that you don't really have leverage over us. The U.S. has sent its signals that, China really needs to make sure it maintains the flow of magnets to the U.S. Otherwise, this truce that they've now extended could be destabilized. So I think it is the new normal, new abnormal perhaps. It creates a lot of uncertainty that things can kind of turn south unexpectedly in detriment to the trade relationship between the world's two largest economies.
And Brendan, are you reading this latest move on China to tell local companies not to use NVIDIA's H20 chip? Is this a way to get leverage in the next round of negotiations?
Yeah, I think it's Beijing trying to tell the U.S. that we really don't need you. We have domestic producers that can supply the chips that we need. Now, whether that's true or not, we don't really know. But we know that the Trump administration has given the green light to sell some of these less advanced chips to China, and is now collecting the 15% tax on those that go to the U.S. Treasury. So there is a bit of give and take here between the two sides and these critical materials that both sides control. But it seems like we're going to kick this down the road another 3 months, and in the meantime, we'll have to see how other things like soybean purchases that President Trump tweeted about, how those play out in the course of those discussions.
I mean, there's a long list of some of those sticking points: rare earths, IP, chips, soybeans, as you mentioned. Not to mention, I think some of the visas and some of the foreign entrance questions as well. Brendan, is this the last kind of trade deal that we have to deal with when it comes to the negotiations with the United States? What else are we waiting for in terms of one that would have global ramifications?
Well, all of these deals that President Trump has signed or plans to sign, they're all still in flux. So it's difficult to look at the China situation and go, this is the last one that still needs to be done. We're still waiting on executive orders for the European Union deal, for South Korea, for Japan. All this uncertainty about sectoral tariffs is still out there, and it just shows you that these things are kind of with us for the medium term, rather than they'll be resolved, anytime soon.
You're going to be busy for a while.
Indeed. Bloomberg's Brendan Murray joining us around the table, walking us through that dynamic between China and the United States. Plenty going on in the next 24 hours. We got the German ZEW survey hitting the wires. Plenty of Fed speak, but I have to say the highlight of today has to be that CPI report. How much of the narrative does it change?
Is it going to, like, just to kind of bring it back to what Brendan's talking about, are we going to see tariffs showing up? I think that's the question everybody's working their way through. The expectation is for a slightly higher print than maybe the survey number is suggesting. Kind of how could this change market dynamics? Do I take 50 off if I get a strong print today in terms of the Fed cuts that we're expecting maybe come September? How strong would that number need to be to take a 25 basis point cut from the Fed off in September?
Yeah, and looking at those specific components that did show some tariff-induced inflation last time around, what if they reverse that today or don't show any more tariff-induced inflation that can play really strongly into the hands of the doves who argue that tariff is a one-time price increase? It's not going to continue. It's just going to show up in 1 month's print. So it'll be really interesting to see what kind of narrative comes out of that. I, for one, am going to be also focused on services. We know that services inflation makes up 75% of the CPI basket. So if we do get a surprise on services inflation, can really dwarf any of this tariff-induced inflation.
Can I just flag this NFIB day as well today? That number gives you that survey gives you a pretty good indication of actually what's happening in the real economy. If you want to know where tariffs are showing up as well, some of these small businesses maybe talk about that. They're going to talk about what's happening in the labour market as well. They're going to give you a guide. If we don't trust the data, the headline BLS data, what do we trust? Well, maybe some of these surveys are going to be quite interesting. What the ISM told us a few days ago in terms of the labour market and inflation, interesting. NFIB could provide maybe some of those clues as well. So watch that too. That's coming up later.
We haven't considered the possibility that there's no tariff read-through at all. as it has been for the last couple of months.
But that confuses the market even more, I think.
Well, exactly. It's unclear what that trade looks like. And I imagine on this August Wednesday, Summer Wednesday, where it might just be a little bit more of the same, either calm or chaos in a couple of hours. Lots going on. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
As President Trump extends a trade truce with Beijing and sees an opening for chip sales, China urges local companies to avoid using NVIDIA H20 processors. Meanwhile, the president downplays expectations for his upcoming meeting with Vladimir Putin, casting it as a feel-out meeting. Plus, the UK loses fewer jobs than expected in July, bringing some relief to the Labour government and to the Chancellor, Rachel Reeves. Now, again, a reminder, we are Tuesday in August, so actually trading volumes are pretty thin, but they're still moving on the back of a lot of news. I have to say the news flow is pretty terrific, especially for a Tuesday in August. Now, when you look at U.S. stock futures, look, they're wavering a little bit. I guess a lot of the folks will be on the lead up to the CPI print. That's a little bit later today. Investors remaining attuned to the risk of persistent price pressures and the potential of a stagflationary backdrop. That's according to many people, actually, that are at the moment on the trading floor or preparing to wake up to go on the trading floor. Of course, this report arrives after traders in recent weeks also ramped up expectations for a Fed policy easing this year. The European markets map, so we're away from earnings. Last week, actually, we had about 52 companies reporting almost on a daily basis. Now the focus is really on trade, on inflation. And then we have a bit more of a complication for the UK with the labour market being a bit better than expected. And it makes it difficult for the BOE to choose whether they cut or not, given the focus on growth and, of course, inflation. So for the conversations that matter and the insights you need, let's get started.
makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Beijing has urged local companies to avoid using NVIDIA's H20 processors, complicating the chip makers' attempts to get back billions in lost China revenue. Now, it also comes after the company agreed to an unusual arrangement with the Trump administration to give the U.S. government a 15% cut of the related revenue. Now, the new guidance comes just hours after President Trump signed an executive order extending the tariff truce with China for another 90 days. Now, we're joined by Ed Ludlow, a co-host of Bloomberg Technology. We're lucky to have him in London with such terrific news flow. Brendan Murray, who leads our trade coverage, he, hasn't slept since April 1st, and Mohit Kumar, chief European economist at Jefferies. Mohit, we'll talk about the markets and, of course, all of the implications for all of this. Ed, let's start off with you. I mean, it's unclear, actually, whether... So there seems to be good news about trade. We'll get to that with Brendan. Yeah. But the fact that China's now saying, well, please don't buy these processors for NVIDIA, is it retaliation against the Trump administration?
Well, chronology is important here because this is guidance. It's an advisory, which is quite normal for Chinese authorities, particularly the internet watchdog, to do. And it's happened over the last several weeks, so likely predates the news of 24 hours ago, the deal between the United States and NVIDIA and AMD for that 15% revenue cut. The analyst community certainly thinks that this is a tactic from China as part of the broader negotiation between the United States and China, where, pardon the pun, but chips are a bargaining chip, right? Either China's angling for access to a much more powerful chip beyond the H20, or it's trying to do something with leverage against China. But the kind of state of play that you've got to know is that H20 is not the most powerful chip that's available to Chinese companies. The domestic chip from Huawei is much better anyway, and there's an element of that national champion and national security element as well.
Brendan, what can you tell us about the 90-day reprieve? I mean, it seems like, the markets certainly are relieved on that. Is that for domestic reasons that, they're thinking actually this will hurt U.S. inflation and so complicate, for example, the Fed cutting? Or is it that he really wants to deal with China?
Well, he definitely wants to deal with China. He wants a summit with President Xi. This one really came down, this 3-month pause, this truce really came down to the last couple of hours, and it probably didn't need to. They had resolved most of the issues in Stockholm a few weeks ago. But President Trump likes to keep the other side guessing and wondering if perhaps he'll re-escalate. But he didn't. He pushed the new deadline out to November 10th, and so that leaves the relationship vulnerable to flare-ups of retaliation and using leverage, like Ed was discussing, to restart these higher tariffs. So I think what we're going to see is just some more uncertainty. It's going to get us through kind of the peak shipping season, which will give retailers, importers, manufacturers some sort of sense of stability, but it leaves a cloud of uncertainty hanging over the relationship between the U.S. and China.
Yeah, and Mohit, in general, we are after, of course, August 1st, which was the first deadline. I mean, it was August 1st and then August 7th, and then it got pushed back. But does it feel better in the markets and as a chief economist because you have at least the base is like 10% the new 0% of tariffs? Or do you think that anything could really change at any moment?
There is still a lot of uncertainty. But I would say if you think about the big trading partners, we have some version of a deal with the EU. No. With China, we have some certainty. Okay, not a deal, but at least some backdrop is there. Similarly, with other trading partners like Japan, even with India, some version of deal is shaping up. So I would say uncertainty is reduced. But if you think from a big picture perspective, our view has been that tariffs don't really matter. So from an equity markets perspective, I do not really think tariffs matter. Yes, they create a lot of uncertainty.
Until they matter.
Well, until they matter if we don't have a deal. Yes, totally agree. But as long as we are moving towards the path, and like what Brendan was saying, Trump does want to have deals with the key trading partners. So as long as we are moving in that path, I would say tariffs actually do not matter.
Yeah. It's unclear to me, Ed, and it's really interesting having the technology perspective. Donald Trump is now open to NVIDIA selling Blackwell to China. Yeah. I can't figure out whether he is okay with dealing with China if he can get money back, or whether he's less skeptical than the rest of his cabinet on China.
Yeah, the president actually showed quite interesting command of the subject matter during the press conference yesterday, the specificity of the H20 relative to the other chips that NVIDIA offers. But there's two competing things, right? America's focus with AI hasn't been the model makers. It has not been OpenAI or Anthropic or the software side. it's build, baby, build. And so from that standpoint, exporting the American technology stack, it's a codified policy. It was in the great AI document when I was in DC 2 weeks ago. But this is unprecedented, the idea of an export tax, an ad hoc agreement between a company, its CEO, and the President of the United States. And when I was phoning sources last night, you know, they basically corroborated it's as the President explained. Jensen Huang went to him and said, I want to export the H20 to China. And the President said, OK, I want 20%. And Jensen said, how about 15%? There are people talking about whether this is constitutional or not. But who's going to complain if it's NVIDIA on the other side of the table happy to make the deal?
But Ed, in general, the relationship between the president and a lot of chief executives, again, I mean, Intel had a really hard time over the last 2 weeks with the Intel chief executive because of his closeness to China. They meet in the White House yesterday, and suddenly the president says, actually, he has an amazing story. He's going to talk to the cabinet.
Yes, things change quickly. Yeah, like last Thursday on True Social, the president said that Lip Bhutan should resign because of historic ties to China. Actually, Lip Bhutan has been well known to the American technology industry for 40 years. He was a venture capitalist that did put money into Chinese firms, and he was at a company called Cadence that was investigated because of the flow of technology to China in a military context at one point. But on paper, Intel is like everything the Trump administration is doing in technology right now. A national champion, it wants to manufacture domestically, it wants to move fast and build things. It's just that Intel hasn't really got the program. That was really significant news, and I'll be interested what the market does today, because this president says things and then he does them. That was evidence in the Gulf, for example, which I'm sure you covered. When Jensen Huang was in the Gulf, there was a time it would be unthinkable that we'd have an announcement of billions of dollars of chips going to Saudi and UAE directly. The president just made it happen. Can he make something happen for Intel domestically? His tune has changed, for sure, with Lip Bhutan.
Yeah, and it's unclear whether it's allyship or something, a deal was struck or something like that. Brendan, when you look at, one of my favorite stories actually was Bloomberg writing 5 months ago saying, this could be President Xi's world. Given all of the uncertainty with the U.S., people look to China to kind of be, if not a beacon of stability, a more reliable partner than the U.S., which at the time seemed crazy. But we know that President Lula has also been speaking with President Xi because of what Trump is doing. Are there more trade deals to be done with China?
Yeah, I think what we've seen over the past 24 hours, 48 hours, and even over the past couple of months is that President Trump is dealing with a very different China than he dealt with back in 2018 and 19 when in the lead up to the Phase 1 deal. This is China that has, as President Trump would say, some pretty good cards in its hand, and they're playing it in the view of a lot of analysts very well. So the conversation between Xi and Lula is interesting because Brazil is a big soybean exporter, and what did President Trump tweet about on Sunday? He said, wouldn't it be great if China buys some soybeans? Well, China can get all the soybeans it needs from South America. So I think you're seeing the soybean diplomacy come into this, but we're well beyond the sort of soybean diplomacy game. We're in really a tech war rather than a trade war.
Yeah, and Mohd, you're absolutely right. I mean, for the moment, equities are just ignoring the tariffs, but actually, given the weight of these stories and the importance they have for economies, at some point they'll come home to roost.
Well, let's talk of numbers in terms of importance to economies. Average tariffs end of 24 was around 2.5%. And let's say when the dust settles, we're talking of average tariffs of, let's say, 15, 17%. So that's additional $300 billion of revenues for the US per year. That's exactly the amount that's needed for the big, beautiful bill. So yes, we have tariffs, which are a tax on consumers, but then we are giving back to consumers in the form of a big, beautiful bill. So yes, we can talk of sector rotations, which consumers benefit, which consumers weaken, but US economy as a whole is fine. So tariffs, that's why my view was that yes, they have a lot of uncertainty impact, but from an equity market perspective, shouldn't have a big impact.
Mohd, I mean, the CPI print today is extremely important. If we see a pickup in inflation, I mean, does that hurt consumer? You could always rely on the U.S. consumer so far. At some point, does it weaken?
It does, absolutely. So it depends on how strong the CPI print is. And you used the word earlier, stagflation. I like to use the word slowflation rather than stagflation
because
for US.
Stagflation, people panic. Slowflation, people are a bit cooler about it.
Yes. But also, the reason I say slowflation is I do not see the US economy weakening massively. So again, to put some numbers, unemployment rate can go to 4.5%. Absolutely, that's a weakening of economy. Plotted on a 20-year chart, looks great. We've never had a recession with unemployment less than 6%. So yes, we can have a slowdown in the economy and a sticky inflation, but I think the US economy is still doing fine.
Thanks to tech.
Thanks to tech, I totally agree.
If you strip out tech, is it a little bit more problematic if you strip out the big seven?
Absolutely agree with that. So that's why if I look at Big Seven, if I look at S&P and I compare to Russell 2000, 30% of companies in Russell 2000 are not making money. I do not think they will be making money. So I still think it's a tech story, it's a big cap story, it's not a small cap story. Absolutely agree with that.
When you look at some of the other things, I mean, Elon Musk hasn't been in the news like he used to be, but he is today.
Hasn't he?
Accusing, well, not when he was like in charge of Doge, where it was basically like it was a face-off between Trump and Elon Musk and how many headlines they could get. Elon Musk accusing Apple now of unfavorably or of unfairly favoring OpenAI on the iPhone. What more do we know?
Okay, so Musk has posted several times on X overnight. The core accusation and the claim that he's made is he will litigate in the antitrust context because he believes affirmatively, positively, Apple does some kind of action that keeps OpenAI at the top of the rankings lists on the App Store and suppresses his X and Grok apps. One thing I'd note is that that tirade on X came just an hour after the new version of Grok went on the App Store. Yeah. And at the core of his accusation is that Apple and OpenAI have a technology relationship. OpenAI's models somewhat underpin Siri and are interoperable in that sense. Apple's, I can tell you, the App Store is dictated by volume downloads, velocity of downloads, the number of downloads from the time an app is first listed, and metadata based on the developers and what they write into the app. I don't know whether Elon Musk knows that or not, but he has a history of being litigious in defense or offense of his own companies. Apple has not commented so far.
But it could also just, going after them so that people get angry at Apple. We never really know whether he really thinks there's like a lawsuit case there.
He has threatened legal action in the past and then not acted on it. He's threatened legal action in the past and acted on it. And then Sam Altman, who's the OpenAI CEO, has also weighed in on this on X, basically disagreeing with what Elon Musk says. But, we will not know unless Apple comments or somebody gives us some data. But it's very much, I've launched an app and the downloads aren't what I think they should be. And I'd like to know why. That seems to be Elon Musk's perspective.
When you look at, of course, the other big story this week will be a possible peace deal between Russia and Ukraine. That seems to be really not taken off the table, but Donald Trump saying, "Look, let's minimize expectations." I mean, at some point there was also tariffs, but that weren't imposed against anyone apart from India because they were buying Russian oil. Do we know any more of that, Brendan, as we head into the meeting?
No, I think that's one of the main questions is whether Trump's tariffs on the extra tariffs on India and Brazil will become, whether those are kind of a one-off or whether they work, in the short term, and whether geopolitics becomes part of the equation in the use of tariffs from the White House. So India is under a lot of strain right now. We've got some good reporting on the terminal recently about how the Indian exporters are really getting hit hard. So maybe the pressure comes to bear on Modi to offer some sort of concession that gets them out of those tariffs. But geopolitics are definitely part of the calculus now from the White House.
Yeah, and geopolitics actually for once this week also seem to be helping some of the equities on the back of like lower oil and the fact that they're hoping for a peace deal.
Yeah. So what we're looking at is particularly for Europe, because if we do get a peace deal, and I'm not a geopolitical expert, but any version of peace deal is really good for Europe. It's good for certain sectors like construction, materials, chemicals, even consumer sector, because that's a positive. Lower oil prices, lower agriculture prices help. It's very positive for Eastern Europe. And most of these sectors, when I think about consumers or industrials or materials, they are under-owned. They have underperformed. So any version of peace deal could really be positive for these sectors.
Okay, what a terrific briefing to get us started. Bloomberg's Brendan Murray and Ed Ludlow and Mohit Kumar, Chief European Economist at Jefferies. Now, coming up, trade ties between the world's two largest economies in focus as President Trump extends a pause of tariffs on Chinese goods. We'll be speaking with Yuji from Chatham House. This is Bloomberg.
each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Earnings season is here.
We're deep into earnings season.
A lot of earnings.
We are not short of earnings to bring you.
Bloomberg is first to break the numbers.
Barclays, Stellantis, and AstraZeneca.
Shell, Credit Agricole,
VW, and Puma.
Earnings are coming in bang in line with estimates.
With the smartest insights.
We are trying to focus on what we can control.
Predictability, consistency, and outlook is very important.
We are a European player.
Continuing coverage on Bloomberg. Context changes everything.
Well, returning to one of our top stories, and President Trump has signed an executive order extending the U.S. tariff truce with China for another 90 days. The extension will ease worries of a renewed tariff war that threatens to choke off trade between the world's two largest economies.
We've been dealing very nicely with China, as you probably have heard. They have tremendous tariffs that they're paying to the United States of America. The relationship is very good with President Xi and myself.
Well, joining us for more is Yu Ji, Senior Research Fellow on China in the Asia-Pacific Program at Chatham House. Thank you so much for joining us. First of all, when you look at the truce deadline and the fact that it was extended to November 10th, is this a good sign? Like, what does Donald Trump want from China right now?
Well, Francine, nice to see you here. What Donald Trump wanted with China, obviously, they want to have a grand bargain with Beijing to be able to justify that Donald Trump has dealt with the trade issue quite successfully as what he promised during the presidential election, I think, firstly. Now, secondly, I think China as a market is really large enough for the United States and also for U.S. companies. So I doubt any U.S. companies would be willing to give up. So I think that's the second reason. Now, I think third reason is also politically. Donald Trump wants to show that he is able to manage probably the most consequential bilateral relationship, which is U.S.-China relations. But all this hung into the moment that whether he's able to put up a meeting with Xi Jinping or not later in the year.
So, Xi, when you look at exactly what he needs, there was a little bit of a spanner in the works. Certainly yesterday when we heard that AMD and NVIDIA could pay 15% back to Donald Trump. And we know that he's looking for money also to pay for the big, beautiful bill. I mean, is this more of a money arrangement? So will he be softer on China if he understands that he can get money back from U.S. companies?
Well, it's a kind of typical Donald Trump mentality. He's willing to make a deals and try to find some money somewhere to offset for something else. And that actually played perfectly for China's interest at the same time. That is to say, less talking about money, but not national security. But while we're talking about the chips and semiconductors in here, essentially it's about the security risk. But equally, I think really to what extent, how much China is really willing to buy the H20 NVIDIA chips, that's another entire different question. I mean, earlier this month, the Chinese authority already get in touch with NVIDIA talking about the possible vulnerabilities and backdoor security risks. So I think the Chinese also have their own problems with this deal by itself.
Where do you see the tariffs actually ending up?
Well, I think judging from the pattern that Beijing is doing right now, this seems Beijing taking a stalling negotiation approach. That is to say, delay the deadline as much as possible, which would be able to buy some time for China's own domestic economic rebalancing. And really judging from the trade number, the export number we have seen in July so far, that the Chinese export actually grows 7.2%. So in a way, that does not really necessarily fit into the story that without the United States, that China's export won't grow. So I think really what Beijing is looking at is firstly looking at the alternative market that is able to offset the losses from US and European market, but secondly, also rebalancing its economy.
Give me a sense of actually how China could retaliate. I don't know whether you consider, they basically said that especially for companies, well, not companies, but actually government officials, it's better if they don't use this H20 processors from NVIDIA. Is that retaliation, or will they just be much stronger on rare earths? This is the stuff that, the West really needs.
Well, I think it's both ways. So judging from all the readouts so far, I think both sides has not really mentioned where does the critical mineral export control Beijing is willing to loosen or not. We haven't seen that. So I think it's very firm. That's to say Beijing will continue to play a very hard-nosed approach regarding the export control over critical minerals. So that won't change. Now, secondly, I think Beijing is now drum up this drive with indigenous innovation, which is to say that hoping to be able to use domestic-grown semiconductors that would enable and strengthen China's technology supply chain. So NVIDIA or not, perhaps it's not really the best option for Beijing if it is want to build up a semiconductor supply chain within the country by itself.
Xi, what does it mean for example, soybeans? We know that Donald Trump on social media was really wanted China to quadruple U.S. soybean buying. But would they, if they have Brazil, who's also a partner? We know that President Lula went to see President Xi.
Yeah, I think the two men just had a conversation earlier. Let's put it this way. I think that China today is very different from the first Donald Trump terms, that in terms of negotiation. In the past, Beijing was more inclined to have quick trade deals with the United States. However, I think given where we at the stage where we are now, and China has a very different toolboxes to be able to use. So I think it's less likely that Beijing is willing to agree to purchasing extra soybeans, which Beijing can do so if they decided they want to make some kind of trade-off with the United States. But I think so far, Beijing's mood seems to be quite muted when it comes to the discussion of purchasing extra agricultural products. But obviously, that is perhaps the easiest bargain that is Beijing is willing to make the offer.
Do you think we'll get a meeting between Donald Trump and President Xi, face to face?
Well, I think my watch point would be to see whether the Chinese foreign minister will be able to visit Washington to visit the White House by late September during the UN General Assembly. So if that has been agreed, and that means there's a likely summit happen between Xi and Trump. So I think that's the watch point would be late September.
Gee, I mean, I know it's something that we've also been trying to talk about with the panel. Is President Trump now softer on China than the rest of his cabinet?
Well, I don't think he's really soft on China. What he's really want to do is he wants to get the trade issues sorted, which he considers his only single biggest priority, firstly. I think secondly, there's also the sense that he wants to show himself as being a great leader that is able to communicate with one of the world's second largest economy and also be able to communicate with leaders from all sides. So that is something Donald Trump is looking at optics. That is like a statement, and he's willing to talk to everybody. So that is what he's aiming at. But I think this might change given the midterm election is taking place. We're probably going to see more turmoil on U.S.-China relations in the next year, but not necessarily this year, really judging from what is happening right now on the trade front, but also on this potential summit between Xi and Donald Trump.
Yuji, thanks so much for joining us. That was a senior research fellow on China at Chatham House. Coming up, we talk energy, given presidents, of course, Putin and Trump meet.
definitely in the center of it. And we're looking for how do we spend time and which industries do you invest in? Industries becoming more and more digital or AI enabled that actually adds value to economic growth. And this, we think could be time because you have a strong hardware power and you have a strong software power as we see, and it's accelerating significantly. But a very important, another element, which is changes in demographics. More AI-enabled softwares and applications may improve the people's lives and actually increase productivity in times where demographics are decreasing everywhere around the world. So this, I would say, is a major theme. So digitalization and AI-related technologies, and we think of it technology, but in reality, a lot of the businesses coming up and claiming to be technologies that are actually cannibalizing a lot of traditional businesses.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on.
I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. As President Trump extends a trade truce with Beijing and sees an opening for chip sales, China urges local companies to avoid using NVIDIA H20 processors. Meanwhile, the president downplays expectations for his upcoming meeting with Vladimir Putin, casting it as a feel-out meeting. Plus, the UK loses fewer jobs than expected in July, bringing some relief to the Labour government and the Chancellor, Rachel Reeves. Now, EU leaders and Ukrainian President Volodymyr Zelensky plan to hold a call with U.S. President Donald Trump tomorrow. This comes ahead of his meeting with Vladimir Putin this Friday in Alaska. Now, Trump has been talking down the chances of an agreement being reached when the two men meet.
This is really a feel-out meeting, a little bit. And President Putin invited me to get involved. He wants to get involved. I believe he wants to get it over with. Now, I've said that a few times. And I've been disappointed.
So we're now joined by Stephanie Baker, our senior writer. Stephanie, as always, thank you so much for joining us. Look, we were talking about it yesterday. It's unclear what they can achieve in this short of time. But for the president 2 days before saying, look, it's a feel-out meeting, I mean, what is it?
It's a very odd way to go into a major U.S.-Russia summit that we haven't had for 4 years. A feel-out meeting does indicate to me that people have gotten to him, European leaders, to warn him of the risk of doing this summit, and that I think ultimately, stepping back, I do think that Trump is worried that Russia-Ukraine will mar his legacy. I think he, as we all know, has been eager to get the Nobel Peace Prize. He thought this was going to be over in 24 hours, and it has dawned on him how difficult this is. And going into this meeting, trying to do land swaps, as we discussed yesterday, is going to be incredibly difficult for two leaders to discuss. And I suspect we will get a statement at the end saying they were going to leave it to working level groups to carry on. But I do think he's worried about this marring his legacy, and that Ukraine either falling to the Russians would be bad, which he knows, or remaining at war is also going to be incredibly bad for his presidency and his legacy.
And there were questions, Stephanie, about whether President Trump would speak with EU leaders before or after. We know that there's a phone call tomorrow, so that feels also significant.
Very significant. I think they're really worried that he is going to go into this meeting and come out with some kind of deal that would legitimize Russian territorial gains on the ground. And I think they're trying to present a united front and protect Ukraine's sovereignty, because ultimately it's about European security as well. And I think that will be a very important meeting. And there are people on that call, Alexander Stubb of Finland, Keir Starmer, both leaders who've developed a rapport with Trump. I think they're going to try to convince him of the dangers that Putin will be playing for time, and that Putin lies in the context of these meetings, that he should be aware of that.
Stephanie, why Alaska? I know this is something that we've been asking ourselves. I mean, it's basically putting him on U.S. soil.
Yes, and this is an indicted war criminal under U.S. sanctions being welcomed on U.S. soil. So it is a victory for Putin, just the meeting in and of itself. And I think perhaps they decided that more neutral territory like Dubai or Turkey would present security challenges. I'm not sure, but that's a question that remains to be answered, and maybe we'll find out more.
Stephanie, I also want to ask you, because you're my go-to person for anything Washington and Trump. I mean, there's another show of strength from Donald Trump on deploying the National Guard to Washington. I'm not sure what this is. Is it testing the legality of certain things, or does he really think that crime is too high and he wants to get a hold of it?
I think it's both. You have to question the timing of it. Is he trying to deflect attention from the summit, which he knows may not produce a real agreement, from the Epstein files? It comes amid his increased militarization of U.S. cities. I mean, remember, he sent in the National Guard to L.A. Against Governor Newsom's wishes, and that's being fought out in the court. Now, he's got the legal authority to do this in D.C. because he, as president, he's allowed to order the National Guard into D.C., but crime is at a 30-year low. It's not that there isn't a crime problem in D.C. I've spent a lot of time in D.C. over the past year. There is a homelessness problem, and I think he just wants to position himself as the law and order president.
So interesting, Stephanie. Thank you, as always. Stephanie Baker, they're our senior writer, and a reminder, you can also read more on all of these topics, especially ahead of the summit, in Stephanie's book, Punishing Putin. Now, all traders keeping an eye on two moving stories this week. First, a decision by President Trump to pause tariffs on Chinese goods for another 90 days. And, of course, that key Trump-Putin summit on Friday. Now, we're joined by Aldo Spanier, head of energy strategy at BNP Paribas Markets 360. Aldo, thank you for joining us. I mean, there is quite a lot going on. When you look at, the market, the oil market was seeing it as a positive. The fact that there could be actually a peace agreement in Europe, even as soon as, maybe not this week, but certainly soon. I mean, talk to us about the market dynamics.
Yeah, look, I think it's, if you look at oil specifically, and let's say we have some kind of peace deal between Russia and Ukraine, I think for oil it probably has limited impact physically, in the sense that we've rerouted oil volumes from Russia, but we haven't really cut them. And I think the only way you would see a material impact in oil physically is if Europe takes Russian oil again. And I think that's still a fair way off. I think the upside maybe sits a little bit more into gas markets, where you probably have more of an argument to make. Maybe we see Russian supplies coming back into Europe. I'm not one of the people who think that might happen. But in terms of sentiment, I think you could see, particularly in gas, probably a relatively bearish sentiment coming into the market on a higher than zero probability of gas supplies coming back.
But Aldo, first of all, give me a sense, the price of oil has held up a little bit more than we were expecting, given also what OPEC Plus has done. Why?
Yeah, look, it's quite a few factors. So you're right. So I think H1 stronger than everybody expected, given a pretty bearish macro overlay, OPEC bringing supplies back. I think a few factors are that Chinese stock builds have been really strong, particularly in the first half of the year. They haven't impacted oil prices because oil prices are set in the Atlantic Basin, not in Asia. We've also seen that the OPEC supply increase, which started in Q2, happens to coincide with summer in the Middle East, and that means very high internal demand. So I haven't seen many supplies to market. Non-OPEC supplies, which is the big overhanging issue in the market, is starting to ramp up, but hasn't really ramped up in Q2. That's a Q3, Q4 story. And we've seen very, very, very strong middle distillate cracks, which basically means that every refinery who can make diesel would probably want to run it. Stocks are low and they can do it. Add it all up, it's all bullish. And the question in the market now is, some of these drivers are going to probably turn. Question is when?
So when do you think they turn?
I think give it a month. I think basically right now, I think we're going to start seeing builds in the Atlantic Basin. You need to see stocks come up because stocks are really low. And as long as stocks are low, oil doesn't come up. I think we're starting to see builds. I think we're running into maintenance season in the Atlantic Basin. That's September, October. You will take out a lot of demand just seasonally. And I'm seeing Brazil increase. I'm seeing Gulf of Mexico increase. I'm seeing Guyana increase. I'm giving it another 4 to 5 weeks. So end of September into October, I think you really will start seeing the system lengthen significantly. And that's what we need for oil to come off.
Okay, so Aldo, what does it mean actually for OPEC Plus at that point? I mean, will they have difficult decisions to make?
Yeah, the question is always what's their, if there is one, so what's kind of their internal price mechanism? We started with 90 2 years ago.
Do they have a range?
I'm not. Yeah, they probably have a lower range. I suspect if oil starts to significantly fall below 60, so if we get a 5 handle, I think it's an issue. Then maybe we talk about taking supplies out again. But we've seen how difficult it is within OPEC to get agreement to cut further. So I don't think they'll respond very quickly. I think they understand that the market is lengthening. I think they stopped the increase that they've now announced for September. I think they can't bring more of the voluntary cuts back. I think they take a pause, see how good or how bad it will be in like Q4, Q1, and then reassess in April, like they did this year. In maybe they wanna unwind or take action.
What's China doing? I mean, in terms of, we know that India is buying Russian barrels.
Yes.
How much is China doing the same?
Yeah, less than India. So China's buying at least seaborne, I think 900. So about half, a little bit more than half what India buys. Look, what's interesting in China is that as I said, one of the big surprises was their basically stock building. So it's not like demand has massively increased in China and they need more crude. Right. They really want to build both their commercial and strategic stocks, basically to insulate themselves, I suppose, against further supply issues down the line. That number has been really high. And the interesting thing is, there is still capacity to increase further. So one of the questions in the market as well is okay, can we just see this stock building in China as something that's going to continue at least over the next couple of quarters? If that happens, and I think there's room for it, it kind of puts a bottom in your market.
We know that President Trump wants to drill, baby, drill. What's shale gas looking like in the U.S.? Or what's shale oil actually in the U.S. looking like?
I mean, rigs are coming down. So, yeah, it's always been. So the issue, and we know, the issue between low prices and drill, baby, drill, I mean, those two are kind of difficult. They're mutually exclusive.
Yeah.
I think if you look at, let's say we're in a high 60s Brent, so you're in a mid 60s TI, it's borderline. I think it's hard to see growth at those kind of levels. And I think it's exactly what we're seeing. So at these levels, it's hard to grow because your curve doesn't really give you a lot of support to make significant amounts of money on your oil. What we did see was, and that was actually interesting, during the Middle Eastern spike, you saw a lot of producers in the US shale pad at least hedge part of their production because they were quite underhedged. So they are limitedly price sensitive, but you can see it. Rigs are coming off. I'm seeing a lot of producers saying, this doesn't quite work for us.
Yeah.
So I think you need to see a little bit more upside in crude before you really can become very positive on shale. We're seeing deep water come on. Shenandoah is coming on.
Yeah.
But it's really about shale, and it's quite price sensitive, and I think we're borderline.
Okay, Aldo, thanks so much for joining us. Aldo Spanier, they're head of energy strategy at BNP Paribas Markets 360. Now, Norway's $1.9 trillion sovereign wealth fund has divested from 11 Israeli companies, and it's terminating all contracts with external managers in Israel. The decision follows public outcry over investments linked to the war in Gaza. The fund held stock in some 61 Israeli companies as of the end of June. A reminder, we'll be speaking to Nikolai Tangen, the chief executive of Norges Bank Investment Management. That's just after 10 a.m. UK time. Coming up, the UK loses fewer jobs than expected. We'll discuss what it means for Rachel Reeves and what it means for the Bank of England. That's next, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Now, markets readying for the release of US CPI a little bit later today. It's seen really as a key data point before the Fed's meeting next month. Let's bring in Christina Aquino, Managing Editor for our Markets Live team. There's a lot going on, Christine. First of all, great to have you in London. But what are you looking at in terms of drivers for a potentially hot print?
Well, Francine, I'm keeping my eye on the core services part of the inflation print today. It's, of course, July. And so we're looking at potentially a hotter print because of seasonal trends, right? It's travel season. A lot of people are buying more things for their vacations. And so there is a potential for a bit more of an increase in prices of hotels and cars and services like that. And so that's potentially something that we could be looking at driving that number higher. But then also maybe something that Fed officials might be happy to ignore given the seasonality of it all.
So how could this print actually influence Fed cuts in September?
Yeah, well, I mean, it definitely frames that debate very nicely, Francine, because as we know, markets, of course, are gearing more towards 2 rate cuts by the end of this year. But we have seen an increasingly vocal number of Fed officials calling for more than that, right? 3 rate cuts potentially from Fed's Bowman and Waller are some of the most vocal proponents of that idea. And so there is this divide between what markets are expecting, what some Fed officials are calling for, and I guess what the majority of the Fed board is looking at the moment, which is maybe leaning more towards a restrained pace rather than more rate cuts. And so really, I think what this print would do would either resolve some of that debate or maybe widen those divisions further, depending on how hot or not it goes.
Yeah, Christine, it's also interesting because we have a truce, right, between the U.S. and China. So that deadline got pushed back by November 10th. And I wonder how much that is also to do with possible inflation creeping up and therefore a wider impact on markets.
Yeah, absolutely, Francine. I think some of the euphoria that we're seeing in terms of the knee-jerk reaction in stocks definitely thinking, oh, maybe that inflationary impact from tariffs might be delayed if U.S. and China somehow manage to strike some sort of deal when it comes to trade between them. But then, of course, still people thinking about there is potentially still some inflationary impact coming through, given that I don't expect the tariff levels to be any lower than they currently are, right? It's just a question of, are they going to be as high as some are fearing? And so that's really the question here. And so, yeah, I think there is still some fear of that inflationary pass-through. And that's where the Fed debate really becomes important, is because that's the counterweight to that, right? If we are going to see more rate cuts than expected, then that could be something that offsets that. But stocks are definitely hoping that we get more Fed support, but then there's always that threat of tariffs lingering just around the corner.
Christine, thank you so much. As ever, Christina Aquino, their Managing Editor for our Markets Live team. Now, President Trump has named E.J. Antoni to lead the Bureau of Labor Statistics after firing the previous chief following weak payrolls data in July. Now, Antoni is chief economist of the Conservative Heritage Foundation and has been vocal about his concerns with official jobs data and revisions. The position is subject to Senate confirmation. The Trump administration is also said to have expanded its list of potential new Fed chairs. Officials have told Bloomberg that the central bank's 2 vice chairs, Mickey Bowman and Philip Jefferson, are now under consideration, along with the Dallas Fed president, Lori Logan. It's understood that the Treasury Secretary, Scott Bessent, will interview additional candidates in the coming weeks and then shortlist individuals he recommends to meet with President Trump. Onto the UK, and Britain's jobs markets appears to be past the worst, with a smaller than expected drop in payrolls last month. The data further clouds the Bank of England's decision over whether to carry on cutting interest rates. Now, we're joined by Dan Hansen, Chief UK economist for Bloomberg Economics, and John Stepek, our senior reporter and writer of the Money Distilled newsletter. I'm a big fan of what Dan does, and actually all of your projections, which I care to add, the BOE always says are righter than most, and I'm also a big fan of your newsletter. So no pressure, Dan.
No.
I mean, look, if you look at the jobs data, it was better, but actually it complicates a lot of things for the Bank of England, because again, they have, they look at growth and jobs, and they talked about weaker growth, weaker jobs, but then they have the inflation, so it's unclear what they do next.
Yeah, it is. And I think what was interesting about the August decision is that there was this shift. There was this definite shift in the focus away from jobs and towards inflation and elevated inflation. And over the course of May and June, the bank had been very worried about the jobs market. And what we've had is quite a lot of revisions to show that the scale of the loosening in the jobs market hasn't been so significant. And obviously the data this morning adds to that. The only thing I'd counter it with is wage growth. And actually, one of the interesting things that Andrew Bailey said at the press conference was that wage growth is, or was, the biggest bit of information, or the biggest bit of news, that they had in the run-up to the August decision, because it had undershot their forecast. It is continuing to undershoot their forecast. So I think if you take the data in the round today, it doesn't, as you sort of said at the beginning there, it doesn't solve any of this mystery. We're still in the same place. But I think whatever your prior was before the data dropped this morning, it probably hasn't changed dramatically. No. We've also got a lot of data to come. No one's thinking they're going to cut in September, but November's the one that people are looking at, and possibly, if it's not November, December. I think views probably won't have changed dramatically, but you're right, there is this story now potentially emerging that the jobs market is bottoming out, and that will change their calculus.
I mean, views are also, they had to vote twice. Like, you don't really know what the MPC is thinking at this point. Is that fair or harsh?
I don't think it's harsh. I mean, one thing I would observe over the past, if you go back even over the past, 2-3 years, the thing about the Bank of England compared to, say, the Fed or the ECB, they're happy to surprise. They're happy to surprise markets, and they've done that. They did that in November 2021. They did it in June, memory serves me correctly, 2023. They went for a 50 basis point hike. Everyone thought 25. They paused in September 2023 when everyone thought they were going to hike. They're happy to surprise. So the one to watch over the next 2 to 3 months will be Andrew Bailey, because he is the median voter now. If he switches, you get a 5-4 the other way. So what he says will be the most important element of the communication over the next 3 months or so.
John, and we've all listened to so many, actually, of the Andrew Bailey press conferences, and there's always slightly, he's always been very careful in saying it, but a lot of the uncertainty that he's dealing with is, I guess, domestically made. It's some of the labour policies put in place from that first budget by the Chancellor. Are we over the worst? I mean, there were 2 things that were announced. They came in effect in April. With the jobs numbers getting better, does it mean that, things normalize?
Well, it's tricky because the problem is we've got another very uncertain budget coming up. In a funny kind of way, we've got a repeat of last year. So last year, obviously, the government was elected. They came in, people were feeling upbeat until the next day when they said, oh my goodness, things are terrible. We've got a £22 billion black hole. We need to fix it. That set up a period of sort of mild panic before the actual budget. And then the actual budget ended up kind of being a bit of a punch in the face for business when they put up employer national insurance contributions. So drove up the price of employing people quite drastically. And that was meant to fix everything, and of course it hasn't, because they've had to unwind a load of their welfare kind of reforms. And so we're looking at a sort of equally big black hole coming into this budget. And all the employers know and all the employees know is that something bad's probably going to happen. So you've got that tension there. So, the thing that's miraculous to me, if I'm honest, is that the labour market data is as strong as it is.
Why do you think that is?
I think it's probably because there's actually there's more spending power in the economy. The one thing I think we do forget is that for all the doom and gloom and misery about the public sector debt level, private sector balance sheets are broadly in decent shape. They're in much better shape than they were, obviously, in 2008. Households have deleveraged, kind of businesses are doing okay. So I think there probably is capacity for absorbing the shocks that they've had. But I think that's we're kind of there now. And ideally, maybe the Chancellor would try and drop some hints as to how bad it's going to be, but equally, I don't think she's in a position where she feels able to do that. I mean, we haven't had a budget date set yet, which means it's going to be quite late in the year. And so, you know, maybe she's just got her fingers crossed, hoping that something will turn up.
Something good, which is, I don't know where,
ideally something good,
where anything good would come from. What are you expecting for in the budget?
I mean, I think John's absolutely right there, that the risk over the next sort of, whenever the budget is, between now and that point, we get a rinse repeat of last year where people worry about what's coming, and that this sort of relatively less worse than expected jobs data we got today, things start going back the other way. I mean, my opinion on the budget is that there'll be a black hole of somewhere between 20 to 30 billion pounds that she'll need to fill. Now, the big reason for that is to do with the OBR's forecasts and the fact that they've been very optimistic about the medium-term economic outlook. Chances are they will revise that down, particularly in around productivity growth, which again is this one reason why the jobs market might have held up, is that firms need to employ more people just to service a very weak amount, a small amount of demand, because productivity growth is so weak in the UK. That's another reason why you might argue that jobs market has been more resilient than expected. So she'll have to fill this gap. Where she gets the money from, I think, if it seems very unlikely to me it'd go on business again.
Yeah.
So I think you're looking on individuals, possibly the wealthy, but also with that amount of money that's needed, it's very hard not to pull an income tax, a VAT lever, because they just raise so much more money than these other taxes that have very mobile tax bases, but also don't raise that big amount of money.
We need to talk Oasis, because when do we get to talk Oasis and inflation and GDP? But also we need to talk about house prices. First of all, Oasis. I mean, Oasis is basically like Taylor Swift. I mean, they're giving a boost to this country.
Yes. So the Oasis concerts could boost CPI. I was reading this morning the story by Tom Rees that other economists have estimated it might be, I think, 3 to 4 basis points. So just to put that in context, instead of it being an inflation reading of 3.6, it would be an inflation reading of 3.64.
Yeah.
Now, in the context of all the uncertainty we've got about inflation and the difficulty forecasting it, that's quite a small amount. Nonetheless, it'll make for an interesting story when the data drops.
John's going to start a rendition of Wonderwall. In 20 seconds, house prices, up or down?
It's kind of flat, falling in real terms after inflation. Okay. Frustrating for everyone.
We have to bring the UK show back. We don't have enough time to talk about the UK. Dan Hansen, Chief UK Economist for Bloomberg Economics, and John Stepek, our Senior Reporter. A reminder to sign up to John's daily newsletter, Money Distilled. You won't regret it. It's a fun read. It's a great read. Up next, Bloomberg Brief. I know they'll spend a lot of time talking about CPI, also UK jobs, and of course, everything to do with tech. This is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
For Trump to win, you're never too young to learn AI. That's why he's urging the government for school kids as young as 6 to be taught how to use it.
Within this system, from first grade, they all start with the AI education. They play 4 years, just playing. And then from 5th grade, they start to develop AI by themselves. And STEM and robotics, I see very clearly how Vietnam should be in future. Vietnam just about 100 million people, young people, good education, and latest technology. That's the only way to go. Education not contribute much profit for equity, but from the country point of view, that's most useful contribution, what equity should do. And today we're thinking about every kids, not in cities like Hanoi or Ho Chi Minh City, but kids in the countryside should got the good education. That's what we're going to do now.
So you're leapfrogging.
Yes, exactly.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday. 90 more days, the U.S. and China trade truce has been extended, while Beijing's new guidance on NVIDIA chips complicate the ties. Awaiting CPI, stock futures and treasuries rise as rate cut hopes hang in the balance. And the world's largest wealth fund notches its best quarter since 2023. Don't miss our interview with Norway Wealth Fund CEO Nicolai Tangen later this hour. Sure, okay, stocks, treasuries rising, but come on, barely. We are unchanged this morning. Let's call it what it is. S&P and NASDAQ unmoved. We fell yesterday, just missing out on all-time highs. We're less, though, than 1% away from that. CPI could make or break the trend. Small caps, those outperform. As I mentioned, bonds are little changed today. Why get out and take any risks ahead of CPI? 8:30 a.m. is when we expect that. If we take a look at the bond market, headline CPI, the expectation is for it to come in 0.3%. There's your bond market. As I said, little change, 427.91 on your 10-year yield. Let's look at some of the stocks, though, that are moving this morning. With the look at that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with NVIDIA. After China has been urging local businesses not to use NVIDIA's H20 chip, we are seeing NVIDIA fall less than 0.5%, though. But this comes as mostly what is seen as China trying to protect its domestic chip industry. We had some stocks in Asia, in China, trade limit up on the back of this. So this is a move broadly seen as China trying to protect its growing chip industry. NVIDIA hurt off the back of that, down 0.4%. Let's stay in the tech space and move on to Intel. Bit of a different story here, rallying for a second day in a row, up another 3% in pre-market trade. This comes after the CEO met in the White House with President Donald Trump, and he had some more different rosy things to say about the CEO after calling for his resignation only a few days ago. So Intel stock rebounding for a second day in a row, up 3.5%. Lastly, I want to talk about Big Bear AI. This is a company that uses AI software, that sells AI software to analyze data to businesses. This stock is losing 28% in pre-market trade. Danny, they came in with a big miss in revenue, had guided, or the market had expected a loss of 6 cents per share. They came in with a 71-cent loss per share. This company does have some contracts with some big companies, one of them being the U.S. Army. Danny.
Valerie, thank you very much for those movers. We'll catch up with you later in the hour. Also this hour, a really fantastic lineup you don't want to miss. We're going to count down to the latest inflation print with Paul Donovan of UBS just around the corner, and Priya Misra of JP Morgan later this hour. Plus, we'll be speaking to Norway Wealth Fund CEO Nicolai Tangen on their best quarter in almost 2 years. But first, our top story this morning, truce extended. President Trump signing an executive order to continue deferring steep levies on Chinese goods for a further 90 days into early November. Joining us for the details is Bloomberg's Brendan Murray, who leads our global trade coverage. So, Brendan, another 90 days.
Yeah, exactly. So this takes a bit of uncertainty off the table that's been hovering over the U.S. economy for, the past several weeks. Would President Trump extend the truce, or would they re-escalate? No one really expected them to re-escalate in the aftermath of the global tariffs that President Trump announced last week. They tried the re-escalation in April, and it didn't go well. Financial markets reacted badly to the economic damage that was being done. So we get another 3 months to see if the two sides can work through some of their issues on the path to what President Trump wants, and that's a summit with President Xi Jinping. So we're a long way from that, and President Trump has asked China to purchase soybeans. We haven't heard anything from the Chinese on that front, but where we are now is the old trade war that President Trump started in his first term involved things like Chinese purchases of goods like soybeans, and now we've evolved into what is really a tech war more than a trade war.
Let's get into it, Brendan, because we learned that the U.S. would allow NVIDIA and AMD to sell their most advanced chips to China, assuming the U.S. got 15% of that revenue. But it seems that China is pushing back. What do we understand?
Yeah, so China is sending a message to the U.S. and its tech companies, its chip producers, that we may not need these kinds of chips, and we're going to cast these as a security threat to our own domestic industries and the government in Beijing as well. So this is about trying to show the U.S. that China really has some leverage here with its rare earths versus what the U.S. has, and that are these high-tech chips. So this is about who's got the leverage over who, and China's trying to show that it has just as much leverage as Donald Trump says he has over China.
Brendan, today in America, it's also inflation data, CPI at 8:30 a.m. And there's some questions as to whether tariff inflation has started to seep in. You track global trade very closely. What have you seen in terms of whether companies are done stockpiling and finally importing some of the tariff-affected goods?
Yeah, so it has been hard to see inflationary effects in U.S. economic data over the past couple of months. And as you mentioned, companies stockpiled, so they purchased and imported a lot of goods that didn't have those tariffs applied to them. But there's a real unevenness to this, and you hear big companies say we're adjusting, we'll absorb the costs, and we'll pass on a minimal amount to consumers. Those are the big companies. But what we've seen in our reporting over the past couple of days since the reciprocal tariffs took effect on Thursday is that these bills are coming due to small companies, and small companies are really what drive the U.S. economy. And so we are seeing those strains play out in the small business owners represented by the U.S. Chamber of Commerce and National Retail Federation. They're getting more vocal about how hard it is to withstand the hit of these tariffs. So the thinking is that it's still going to take a couple of months. We're seeing now, we're past the threats of tariffs, and now we're seeing the rubber meet the road on the real economy.
And for what it's worth, 6 a.m., we're going to get NFIB, small business optimism figures. Brendan, thank you so much for joining us. Let's stay on the inflation print at 8:30 a.m. Paul Donovan of UBS writes, quote, hedging this inflation might become more difficult. The spending power of U.S. physical gold buyers was hit by 10% trade taxes. Inflation-protected government bonds offer protection not from inflation, but from what the BLS says inflation is. I'm pleased to say Paul joins us now. He's chief economist at UBS Global Wealth Management. Paul, it speaks to the complication of today's environment. So just how vulnerable are we as a market to stickier inflation?
Well, I think there are vulnerabilities, not so much from the direct effects of President Trump's trade taxes. Those will feed through. We would expect to see the April taxes sort of more or less fully represented in consumer prices by September. The August trade taxes will be hitting U.S. consumers early next year. But the question is the second round effects. Do US manufacturers take advantage of this situation to raise their prices and expand margin? Do we see retailers engaging in profit-led inflation? And there's one or two warning signs that this may be happening. And the more that those second-round effects come through, the stickier the inflation numbers are likely to be.
Do you expect that to happen to the degree it did during COVID, for example, Paul? Can we use that as a corollary of companies starting to rise prices, or is the consumer more resistant to it this time?
Well, I think there is more resistance on the part of consumers simply because consumers don't have the stockpiles of savings that they had 2-3 years ago. Now, that's not to say that consumers don't have any savings. They do, and they will use those to smooth out consumption as real wage growth turns negative early next year. But I don't think that they are going to be as willing to accept the profit-led inflation story. But we've already seen, certain aspects of profit-led inflation come through. The economics professional has spent a lot of time looking at banana prices recently. Globally, banana prices are down. They're up in the States. That's not because of the tariff, even with the trade tax. Banana prices in the States should be down, but because there's a narrative around trade taxes that's allowed consumer retailers to increase prices a bit more. So we are seeing some aspects of this come through already, and I think it will be a bit of a tussle over the next few months between retailers looking to raise prices and consumers less willing to spend.
Paul, it's one of my favorite parlor games. What measure do economists care about? Is it bananas? Is it shampoo? Is it something else? I'm glad you've added to that. Paul, you've also been really out front ahead with this idea that the data has become less reliable because of things like lower response rates. It's taken a new twist, as you know very well, with Trump not claiming that, but claiming politics is behind it. We have a new appointment to the BLS, who's previously the economist, the chief economist at the Heritage Foundation. Does it make the data even more concerning to you, or is it just the same old problems that we're going to continue to need to look through even in today's data of CPI?
Well, we have the same old problems. It's falling response rates. It's polarized politics, which means people give biased answers. We're just missing parts of the new economy. Where in the labor market data is TikTok content creator, for example? And it's the underfunding. The Bureau of Labor Statistics has cut back on the number of prices they measure because they don't have the money to do that. So one question is, will the new appointee, if confirmed, be able to do anything about the underfunding of the Bureau of Labor Statistics? I rather suspect not. But then there's a more serious question about, are they going to introduce a political bias to statistics? So we've got to remember there's 2,000 odd independent statisticians at the Bureau of Labor Statistics who one assumes will resist attempts to politicize them. But if we do end up with even a suspicion of politicized data, then that is going to do damage to the credibility of US statistics. People are going to say, yes, but you don't believe the official numbers. What's really going on is what I think with my gut instinct. And that way lies a very chaotic environment for financial markets.
Paul, have you already started to use a lot of alternative data sources? How are you assessing the current environment, and might you continue to going forward should what you describe happen?
So here's the problem with alternative data sources. We judge the reliability of alternative data sources by comparing them to the official data. And so if the official data is unreliable, what are you using to benchmark the alternative data sources with? So that is very problematic. With some alternative data sources, you're dealing with objective facts. Counting the number of ships outside the port of Los Angeles, that's an objective fact. The interpretation that is put on that, though, is subjective, and that's where the vulnerability comes through. I always suggest that when somebody comes to me and says, what are the 3 key indicators I should be looking at in economics? The answer is always the same. If you're only looking at 3 indicators, you're guaranteed to lose money. because you can't judge the world now through a very narrow lens. What we need to do is take a very broad sample of indicators to get a sense of the direction of the economy. Abandon this idea that economic data is precise. It's not. But we can get a sense of the broad direction using a wide number of indicators, and of course using a large number of economists to analyze those indicators.
Paul, I love it. We have just poured cold water all over today's CPI report, which, by the way, is at 8:30 a.m., and you should still tune into Bloomberg to see what those results are. Paul, thank you so much for joining us this morning. Paul Donovan of UBS. Let's get you some other top stories now that are trending on the terminal. President Trump downplayed expectations for Friday's meeting with Russia's Vladimir Putin after speculation that a deal favoring Moscow may get cut.
This is really a feel-out meeting, a little bit. And President Putin invited me to get involved. He wants to get involved. I believe he wants to get it over with. Now, I've said that a few times, and I've been disappointed.
Bloomberg learning that the search for the next Fed chair is expanding to include the committee's two current vice chairs, Michelle Bowman and Philip Jefferson. Two administration officials confirming that Kansas City Fed President Lori Logan is now also under consideration for the role when it's vacated next May. Elsewhere, Elon Musk is suing Apple. The billionaire founder of XAI Holdings is accusing Apple of making it impossible for anyone other than OpenAI to reach the top of the Apple Store charts. Coming up, Nikolai Tangin, the chief executive of Norges Investment Management. That conversation coming up next, one you don't want to miss. Stay with us.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Aqua in Sintra, Portugal, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Norway's sovereign wealth fund enjoyed its best quarter since 2023, returning 6.4% over the past 3 months, thanks to gains within the equity market. I'm pleased to say that joining us now is Norges Bank Investment Management CEO Nikolai Tangin. Nikolai, wonderful to see you this morning. And solid returns here, but the question needs to be asked. With stocks at an all-time high, concerns of sticky inflation and economic weakness, the impact of tariffs, take your pick. Just how sustainable are those levels of returns?
Well, I have to say this is a very strong quarter, and I'm personally quite surprised that markets have done so well. And in particular, the rebound we've had since April, I think it's very, very surprising given everything that's going on in the world.
It's surprising. And so, Nikolai, do you expect it to continue on? To your point, given everything that's going on in the world, just how resilient are we moving forward?
Well, we've been cautious for quite some time, and I think we really have to continue to be cautious. It's interesting because in Europe we have basically had no earnings growth in the first half, but we did have a lot of earnings growth coming out of the US, and in particular the US tech companies. So it's really the earnings growth is really driven from that part of the market. And then of course we've had very strong returns from the financial sector. And so it's been relatively broad within that area.
How does one even be and express that cautiousness in this environment, Nikolai? When bond volatility has continued to pick up, you see metals like gold subject to intraday fluctuations depending on what we hear from the White House regarding tariffs. How does one protect yourself in this more cautionary environment?
No, I think it's really an environment where you need to be very broadly diversified and very long-term in your investment horizon, because it's just like totally impossible to move around your portfolio, in particular when you are the size that we are, based on short-term movements. So the longer term you are and the more broadly diversified you are, I think the better you will cope with this situation.
Well, Nikolai, just given your passive exposure to U.S. stocks, I know this is no fault of your own, but one could definitely argue, maybe you're too exposed to tech. NVIDIA is your largest holding. Does that concern you at all?
Well, the thing is that you could have started to be concerned about this many years ago, and wow, would you have lost out on some huge gains, right? So I think the way we talked about diversification of the portfolio some years ago, where we thought that 1% of the portfolio was a huge holding, I think it's very good that we didn't limit the position size at that stage. Now, when we see what AI is doing to our firm and the way we work, it's just like incredible. We think that last year we increased our productivity by 15%. This year, I think we can increase it even more. We are just using it everywhere now, and it's just fascinating how it improves and makes our work more efficient.
How much is it just increasing efficiency, Nikolai, and also maybe meaning you need less staff?
Well, so for the moment, what we're saying is that, hey, we are not going to cut staff. We are just going to do more. We're going to be just much better at what we're doing. And our goal was always to be the #1 player in using AI in our country and also within the financial sector. So we are not going to lay off any people. We are just going to do everything much better.
I'm sure everyone at Norges Bank is very happy to hear that, for those who are listening in, Nikolai. We're also at this moment, though, where these big tech and, yes, AI players are starting to be more subject to the politics. NVIDIA, AMD having to pay 15% of their China revenue to the U.S., China pushing back, saying don't use H20 chips, the Intel CEO going over to the White House. Does that change at all how you view some of these U.S. companies? The fact that they're getting caught more in the political crosshairs, not just abroad, but where I am in America as well?
Well, the thing is that it's like super interesting because the very close ties between technology and geopolitics. This is something that really exploded like 3 years ago with the advent of ChatGPT. Now, of course, you have AI being built into everything from self-driving cars, medical research, weapons, all these kind of things, right? So the link here between geopolitics and technology is just so strong and so important. So you need to just have a different lens when you analyze markets these days.
Have you hired more geopolitical analysts, Nikolai? How are you handling that?
Well, we try to do even more deep thinking than we did in the past. I think to really have a credible kind of resource center inside, you would need to hire at least 50 people. But we try to listen to the best experts worldwide. And then, of course, as I said at the beginning, to be widely diversified and have a very long-term view so that we really participate in this value creation.
How much of the diversification, Nikolai, is also looking away from the U.S.? Europe stocks gain the most in your portfolio, 17.8% versus just 1.4% for North American stocks. At this point, would you consider an even greater tilt towards Europe?
Well, there is a big currency effect in the results here, and because of the movements in the Norwegian kroner. We have more than half the portfolio in the US and then just under a third in Europe. And so we are really happy with the the geographical diversification we have for the moment.
Well, it goes back to this question, Nikolai, and I know you've been asked it before to start the year, but it's not gone away. This idea that perhaps brand America has been hurt with the political volatility happening in the U.S. Do you think that that's a narrative that could get more legs, that at some point you might need to re-examine just how much of the U.S. you hold?
Well, it's a very interesting question, of course, you're posing here. Uncertainty is generally not very good for stock markets, and it's not very good for companies. And so when we have uncertainty about tariffs and so on, that's not a positive. At the same time, we are seeing, very, very strong developments, strong R&D, strong innovations, and so on coming out of the large U.S. companies. So I would say we are really, really pleased with our holdings, and I feel we are in the right place.
When it comes to your holdings, Nikolai, you also recently divested from 11 Israeli companies. You cut ties with external managers from Israel too. All of that amid pressure before an election happening there. Is there a real risk, though? And critics might look at this and say it opens the door to being used as the fund being used as a political tool. Is that a real risk?
Well, it's a very, very important question because it's important for us not to be political. We are an investment fund. We have one overriding goal, and it is to make money, of course, within the mandate we have from the ministry. Now, we divested from these Israeli companies, not because they were Israeli, but in this case, because we wanted to simplify the portfolio management we did in Israel. So these were companies which were not in the index, and we decided to take home the asset management. We discontinued 3 external relationships with external managers, and then we decided to do it ourselves, just to kind of simplify what we are doing and how we deal with this.
Are you evaluating at all changes to some of your responsible investment strategy as part of this, Nikolai?
Well, we are continuously evaluating this. We also have a separate entity called the Council of Ethics, which is looking into more ethical aspects of our investments. And then in terms of being invested in Israel, that's a political question. It's not a decision that we do. So what we do is to make sure that we invest in Israel in a responsible way.
Hey, Nikolai, we literally only have 1 minute left here, but it's going to be CPI reports in America. Are you gearing up for maybe a more stagflationary environment in what is your largest holding?
Well, we do see that there are some real inflationary pressures. I mean, one thing, it's of course coming from the tariffs. We are seeing some push from various kind of climate situations too, through worse harvests and raw material prices, which are moving up. And so that is why we also think that there is a link between climate risk and financial risk. I do think there is for sure a danger that inflation could be quite persistent here.
Nikolai, wonderful to speak with you this morning. Thank you so much for joining us. That is Nikolai Tangen, CEO of Norges Bank Investment Management. Coming up on the show, JP Morgan's Priya Misra sets the stage ahead of today's big U.S. inflation print. That conversation is coming up next on Bloomberg.
Break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that three-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday. 90 more days, China and the U.S. extend their trade truce, averting higher tariffs for now. New guidance on chips. Beijing urges local companies not to use NVIDIA's H20 processors. And awaiting CPI, stock futures and treasuries little changed as rate cut hopes hang in the balance. So we closed about 0.25% lower yesterday, missing out on an all-time high, basically unchanged for both the S&P and NASDAQ. But why would you want to put any risk on, perhaps, ahead of today's CPI report, 8:30 a.m.? Russell 2000 does outperform for this bond market. Also little change this morning, the expectation for inflation, 0.3% for core. We'll get into that with Michael McKee in just a moment for 27.52 on your 10-year yield. Let's first, though, look at some of the stocks moving pre-market. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with a check on NVIDIA. After China has been urging companies not to use its H20 chip, we're seeing NVIDIA trade just slightly lower in the pre-market, down 0.3%. But this comes days after, Danny, that NVIDIA got those export licenses to begin exporting those chips into China after the Trump administration put a pause back in April. Let's stay in the tech space and move on to Intel. Bit of a different picture here. It sounds like the U.S. president has changed his mind about the CEO after meeting with him in the Oval Office yesterday. Says that the CEO has an amazing story, and this is helping that stock turn around, up 3.3% in pre-market, coming after gains yesterday in the session of around 3% as well. A big departure from Trump's language only a few days ago, calling for the Intel CEO's resignation. Let's move on to earnings. Big Bear AI, this is a enterprise AI software company that helps companies analyze data, came out with some very depressing numbers when it came to revenue, with a 71 cents loss per share, with the estimate was around 6 cents. We're seeing Big Bear AI stock down some 28% in pre-market trade. They have some big contracts, especially when it comes to government contracts with the U.S. Army. Danny.
Valerie, thank you very much for that roundup. Now, we are 3 hours away from the latest inflation print. Let's bring in Bloomberg economics editor Michael McKee, who is awaiting that data. Mike, what you looking out for?
Well, you said just a minute ago that the rate cut hopes ride on this, and ordinarily I'd say that might be a little hyperbole, but in this case it's actually true, because if we get a reasonably decent number, it would enable the Fed to cut rates without worrying about inflation rising. The question is, do we get that number? Let's look at what the forecast is. For headline, we're looking for a 0.2% gain, and for the core, 0.3% gain, which would push up inflation, but only by a tick in each category. The question is, and a lot of economists have put this out overnight, they're thinking that maybe we might see that core rate tick up to 0.4. And if that's the case, we go over 3% of the core, and then you've got a problem for the Fed because inflation looks like it's breaking out. Everybody's going to be looking at the breakdown of what comes from CPI and looking at categories that could be influenced by tariffs. And of course, they've just started to go on. So there is more to come in the months ahead. But this will be very important for the Fed's September meeting.
It'll be important for the Fed September meeting and from whatever truth socials we might get from President Trump. Now, on that, Bloomberg reporting that there's an expanded search now for the Fed chair. Mike, what's our understanding on who is in the candidate list now?
Well, they keep adding people at the Fed. Mickey Bowman and Philip Jefferson, the two vice chairs, getting recognized now, along with Lori Logan, who's the Dallas Fed president and was head of the markets desk at the New York Fed. How serious those are, we don't know. Bloomberg reported last week, of course, that Chris Waller might be the favorite for the job, but apparently Scott Bessent wants to interview a lot of people before he gets there.
Well, one job has been secured, and that's the new head of the BLS. So this CPI report will be the first with E.J. Antoni to be leading the Bureau of Labor Statistics. What do we know about him? What difference could this make, if at all?
Well, I have to mention he won't be in charge for this CPI because he's got to be confirmed by the Senate, and it could be a bit controversial when he gets to his hearings because this is a clearly political choice by the president. He's said a lot of things about the BLS in the past, much of them on X. The BLS data is just a random number generator from the magical world of make-believe. He says the revisions that we saw in the jobs report show a negative bias, and he's questioned the BLS's methodology. He says they need a top-to-bottom BLS review of how they do things. Now, the BLS commissioner doesn't have a lot of influence on a day-to-day collection of statistics, but overall, he could raise questions as we go forward about the BLS's methodology. He and the president saying they want to bring back trust to the numbers, but Wall Street really hasn't lost trust in the numbers. Everybody knows that there are some statistical problems, but it's still seen as the gold standard. The president might be wanting to confuse people so that if we get more bad jobs reports, people will worry about the numbers instead of the bad jobs report.
I was going to say, there's no way that Wall Street is not going to be trading off of today's 8:30 a.m. CPI numbers.
Indeed.
Mike, thank you so much. We look forward to you breaking down the data when it comes out. That is Bloomberg's Michael McKee. Let's continue the conversation now with Priya Misra, portfolio manager at JP Morgan Asset Management. Priya, we'll leave the politics aside for now as much as we possibly can. But you've been writing about this idea that shades of stagflation are starting to show up in the data. Do you expect today to confirm that?
I do, and I think you're going to see it in goods inflation. We started to see it last month. Goods inflation started to pick up. I think you'll see some more of that. And more tariffs have gone into effect. So I don't think this is like the peak of inflation. I think it's going to happen all through the third quarter, fourth quarter. I think you're going to see goods inflation. So beyond that headline number, which we'll be looking at that second place of decimal rather than just 0.3 or 0.4, we'll be looking at services. And I think that's the interesting part. You're seeing the stagflation side on goods. What are we seeing on services? We're seeing service inflation actually largely offset goods inflation. May not offset today because that goods inflation has that tariff impact. But if service inflation continues to decelerate, I think it does a couple of things. It tells us that that stag part of stagflation is still alive, because why is service inflation declining? That a lot of that is discretionary spending. If consumers have to pay more for goods, they're going to cut back on services. We're also seeing it in other data. So as we talk about data quality, let's look at a broad swath of data. We're seeing real personal consumption expenditures for the US. First 6 months of this year, 1%. That was running at 3% last year. So there is a slowing in spending. If you see it in service inflation declining, it tells you that demand side is slowing. Also allows the Fed to look through that tariff inflation. I think that's what every market's looking for, that can the Fed cut rates? And maybe you get a knee-jerk reaction that this number is hot, maybe the Fed doesn't cut. But Chair Powell told us that they might look through tariff-related inflation. I think that's what they'll be looking for. My concern is if service inflation actually doesn't decelerate as much, does the Fed then get a little nervous that what if this inflation is like the 21 inflation? I don't think it is. I do think it's very different today, and inflation is likely to be one-off, this tariff-related inflation. But I think we'll be watching that service side importantly to see that, whether the Fed can look through it or not.
Right, well, it sounds like a Fed mandate that's already in conflict at this very point, Priya. So was it already premature for this market to run up and price something close to 90% odd that we'd get a cut next month?
So we are in the nightmare scenario for any central bank where that dual mandate, particularly for the Fed, is in tension. But here's the thing, I think the starting point was that the Fed was in restrictive territory in terms of monetary policy. So for the market to price in rate cut, beyond the politics of this, I think you listen to Governor Waller, Governor Bowman, they're talking about let's reduce the level of restriction, which is 100, 150 basis points of cuts. I think those cuts are actually fair. Whether it happens in September, October, or December, I think depends crucially on today's CPI, on the next payroll report. But the Fed is in an easing bias. I think the market's pricing that easing bias. What the market's not yet pricing in is move into accommodation. I think if you see growth continue to slow down, if you see that labor data, we go from the low fire, low hire to actually higher fire. I mean, if the firing starts to pick up, if you see claims pick up, I think then the market prices in a lot more cuts. What we're pricing in right now is this idea that it's a tariff-related rise in inflation, soft landing, growth is slowing, but not into recession. So the Fed can just remove that restriction. Chair Powell seemed open to it. He wasn't suggesting September rate cut, but he was open to cutting later this year. The dot plot suggests that as well. I think the market's fair in pricing those cuts in. And that's why they might look through today's any high number, as long as it keeps the narrative alive that this is goods inflation, services is still sort of decelerating.
Well, the argument that Bowman and Waller have been making is surrounding the labor market. But Priya, is there a risk of, some have said the idea that we have less job openings is just because there's less supply, and that's driving it. And a cut isn't going to bring more labor supply into the market. And if anything, it might fuel inflation. Is that a real risk, just given the balance of where we stand in the labor market?
So the labor market's really tricky because, I was talking about the decline in demand. Companies are hiring less, but the supply side is also slowing. And that's why Chair Powell actually said, the labor numbers are slowing, but so is the supply. It remains in balance. And that's why the unemployment rate is not moving up. And so I guess you were asking two questions. Is the labor market weak? I do think it's on edge. I mean, you look at the breadth of hiring, it's slowing. You look at overall demand side is slowing. And so I think the Fed should reduce the level of restriction. Your second question, does it help? Monetary policy works with lags. So it's going to take a while. And if you really need growth to pick up, I think we need to move into accommodative territory. So I'm not very confident that even if the Fed cuts rates, that demand just picks up. Now, we do have some positives out there. If some uncertainty goes away, you do have the one big beautiful bill as some of those policies get into effect for businesses. Is that a positive? Businesses came into this shock with very solid balance sheets. So maybe we can stay in the soft landing. That's our base case scenario. And that's why we're leaning into credit, we're leaning into some high quality spread product. But I think you have to worry about if things are slowing down, these rate cuts will not be enough to get us out of it. And that's why I think owning duration makes sense.
I was going to say, Priya, it feels a little bit crazy to be having this conversation about the labor market weakening, maybe some stagflationary concerns, yet spreads are incredibly tight and stocks are just below all-time highs. Is it a whistling past the graveyard kind of situation that we're in right now? Are we complacent?
I think there's some element of that, but the market's looking at top-down data that's actually, okay, it's showing slowing, but not recession. Bottom-up data, look at company earnings, look at balance sheets. Companies are solid. They're not suggesting that they need to lay off or they need to cut costs. The market's pricing that scenario in. And the hope that there is a Trump put and there is a Fed put. And the Fed is telling you, and I think both sides, if you look at policy actions over the last few months, that put is in the market's mind. I do worry if, there's a non-linearity typically. If things slow down, does it slow down enough where things actually get a lot worse? And then those puts come into effect, but it takes a while to play out. And that's why I think you should think about portfolio construction, owning fixed income. This is why we're getting inflows into fixed income. Equities are doing so well, but why are people buying 5.5%, 6% investment grade corporate debt? It's giving you that cushion where if things slow down, risk premiums rise, those rates can fall a lot more. I think interest rates in a slowdown scenario, have a lot of room to fall. I think that's why people are piling into fixed income along with their equities as a hedge. I think that hedging property is very much alive and well.
Priya, we're going to have to leave it there. Thank you so much for getting in early for us ahead of that data. Priya Misra of JP Morgan, thank you so much. Now, coming up, truce extended, the U.S. pausing higher tariffs on Chinese goods for another 90 days. At least that is one hurdle crossed for this market. We're going to have that conversation coming up next on your Bloomberg Brief.
You missed it on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
We published a story recently about the explosion of robotic companies and innovation in China. I think we said there's something like 50 or 60 robotic startups in China. Are we behind, and should we be concerned about that?
I think as far as the state of innovation, no. Most of those robots aren't built for work, for the things that, which is the entry point for these robots today. They can do some interesting things. A lot of times it's backflips or making coffee or something, but not really useful work. These robots can pick up to 50 pounds on our next generation. So they're great for the education of robotics, getting people interested. But as far as humanoids, they've got to check that safety box before they can come into any of the facilities here. And that's a big bar that we haven't seen much of out of the Chinese robots.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
We've been dealing very nicely with China, as you probably have heard. They have tremendous tariffs that they're paying to the United States of America. The relationship is very good with President Xi and myself.
President Trump touting his relationship with Chinese counterpart Xi Jinping. The U.S. extending a pause of higher tariffs on Chinese goods for another 90 days, stabilizing or at least attempting to stabilize ties between the world's two largest economies. Joining us for more is Bloomberg's Brendan Murray. So, Brendan, another 90 days.
Yeah, exactly. So this gives market participants, the American importers, and others a bit of a relief. This was pretty widely expected that they would extend this truce, and this seems to be the new normal. These 3-month increments where Beijing and Washington will get together and have these talks. Secretary Bessent has led them, and they'll try to maintain this going forward on the road to some sort of deal that President Trump wants to strike with President Xi Jinping, and something similar to the Phase 1 deal that Trump signed with Xi in the first term of Trump's first administration. So we're a long way from that. It took 3 months to kind of get to just an agreement to extend the truce. So it's not like they're making big progress in any heated or negotiations. President Trump wants China to buy more soybeans. We've heard nothing from China on that over the past 36 hours. But the bottom line here is that there is no re-escalation, and the two sides will continue to talk. And as long as they're talking, they're not raising tariffs on each other.
And that, to many, will be a relief. But Brendan, is it enough of a relief for companies in America that bring in goods from China? Is another 90 days enough to give them the certainty to begin that process? Or does can kicking continue to hurt some of corporate America's purchasing plans?
Yeah, I mean, the only thing that's certain in these negotiations and this next 90 days is that tariffs are now a reality rather than a threat. And they're not just on China, on goods from China. They're on, they're on 50% on goods from India, 15% from the European Union. So what we're seeing now is the end of the threats and the impact on the real economy, and whether that leads to inflation or stalling out of investment, we just don't know yet. Commerce Secretary Howard Lutnick has said by the third or fourth quarter of this year, we'll see this roaring Trump economy. Well, we're not too far from that prediction, and nothing about the U.S. economy looks roaring at the moment. In fact, things seem to be slowing.
Brendan, thank you very much for your coverage this morning. That is Bloomberg's Brendan Murray. But let's stay with China and trade. Bloomberg learning that Beijing is urging local companies to avoid using NVIDIA's H20 processors. It comes after the U.S. government cleared NVIDIA to sell advanced semis to China, provided it and AMD shared 15% of those sales with Washington. I'm pleased to say we are joined by Bloomberg Tech host Ed Ludlow, who is in London, so it's up for us. Ed, it is so great to see you this morning. And the rock in a hard place that NVIDIA finds itself in is just increasing with the latest coming out of China. Just how big of a setback might this be for NVIDIA?
Well, there's probably some recalculation of how immediate term NVIDIA's ability to draw revenues from China will be, in part because NVIDIA was really clear when the president was speaking at the White House in response to him confirming the 15% revenue share deal. They haven't shipped any H20s to China so far, essentially, in 2025. The analyst community interprets this as being a tactic from China in the context of the broader negotiations between the two countries, either because they want to push President Trump to open up access further to more performant accelerators that go beyond what H20's capable of, or they want the opposite. They want to safeguard their own domestic champions, being Huawei. But at the end of the day, NVIDIA has not had access to the China market for some time. The reporting we did overnight predates yesterday's event at the White House and press conference at the White House. And it's something that's very normal, particularly for China's internet watchdog to do, caution government and state-backed enterprise entities from using foreign technology if there's a security concern.
We just continue, Ed, to see more involvement from both governments in tech companies. Intel, the latest. We know what Trump said last weekend about calling for the CEO to step down. He put this on Truth Social after meeting with the Intel CEO, Lip-Bu Tan. The meeting was a very interesting one. His success and rise is an amazing story. Ed, how is this relationship evolving, and what does it mean for Intel?
It's evolving quickly. Things have turned around very quickly for Lip-Bu Tan in terms of the president's public commentary about him. On paper, Intel is everything that this administration is pushing for. It is a U.S. company that has been trying, in advance of Trump taking office, they were a great beneficiary of the CHIPS Act under the Biden administration, to bring a larger manufacturing of semiconductor footprint to the country. They have poorly executed on it. That's probably an understatement. And a part of what Lip-Bu Tan has had to do, away from the politics of his background and relationship with China, which was known by the board of directors when they appointed him. It's been known by the semiconductor industry for about 40 years, even if it was a surprise to the president, is to get Intel operationally firing. And, it seems, based on the president's statement on Truth Social, that they will continue talking at cabinet level, and maybe Intel can move as quickly as NVIDIA and AMD have been able to move, and foreign entities like TSMC and Samsung to onshore what is already quite big capacity for them. But having the president in your corner, we know, has been helpful to the tech industry.
Hey, Ed, finally, away from politics, but maybe not that far away from politics, we have this accusation from Elon Musk that Apple was unfairly favoring OpenAI in its App Store over xAI. What is his charge? Is there any validity to it?
Okay, there are several posts on X overnight from Elon Musk. This is a very common occurrence to wake up to. The core of the accusation is that Apple positively or in an affirmative way alters or influences the rankings on top in the App Store. Musk's accusation across several posts is that because Apple has an underlying technology relationship with OpenAI, they use OpenAI's models and also have a distribution agreement, that somehow ChatGPT is getting more favorable treatment than XAI and Grok is getting, as well as the X social media platform. All I can tell you, because Apple's not commenting on the story, is that Apple's top rankings, top free, top paid for apps on the App Store are dictated by an algorithm that takes into account downloads over time, download volume, and also metadata that the developers put into the app's underlying code, making it relevant for search on the App Store. That's as far as we've got, but it's not uncommon for Musk to be litigious in pursuit of either defending or going on the offense for his broad portfolio of companies.
And Ed, aren't you lucky that you're in London, so you get to be awake during Elon Musk's midnight tweets? Ed, thank you so much for joining us. That's Ed Ludlow, and you're watching Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
You're watching Bloomberg Brief with Danny Berger in New York. Let's get you set up for your trading day today. OPEC, they are set to release their monthly oil market report this morning. Then it's the big one, U.S. CPI. That comes in at 8:30 a.m. Eastern time. We'll also get some Fed speak from Barkin and Schmidt. That comes in at 10 and 10:30 a.m. respectively. Two companies to flag in the pre-market, one being NVIDIA. Little change despite the fact that China reportedly, according to our reporting, is telling companies to pull back on their purchasing of H20 processors, despite the fact they reached an agreement with the U.S. government. Meanwhile, Intel, another politics-related story, up 3% after the CEO met with Trump, and the Trump had positive posts about them. All right, that's it for Bloomberg Brief. Surveillance takes things from here.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
We've been calling this environment stagflation light.
You're going to have inflation that is just kind of sticky, but you're not necessarily going to see a big pop.
We're not expecting a reacceleration.
What we should be concerned about is, do we have a persistent uptick in inflation?
It's also quite possible that we'll see a slowly increasing inflation rate.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, it's CPI day, setting the tone for financial markets worldwide. Inflation data just hours away. As the US-China trade truce receives a widely expected 90-day extension, investors are still laser-focused on the potential for further tariff pass-through.
This is what the story is all about today. These two stories are so connected. How much of the on and off, sometimes fluid trade policy of this administration, and even for some countries like China, deals are not just done yet. This is still a negotiating process. How much are tariffs going to be pushed through from corporate America onto consumers?
And to what extent is inventory management delaying the pass-through? And to what extent will we see more in the months to come? And will that derail this Federal Reserve from reducing interest rates by the time they get to September?
Well, this is the big question. We have two CPIs, one today, one more, and another jobs print, and of course, Jackson Hole, before we get the Fed meeting. And now what the market is pricing in, because of the weak labor market, that the Fed is going to be able to cut interest rates. Jonathan, what if we get a hot CPI print today? Does the market just sway completely in the opposite direction?
Big focus on who's going to be the next Fed chair as well. That story's in the mix so far this morning. Our latest reporting indicating the following. The Federal Reserve's two vice chairs, so that's Mickey Bowman, Philip Jefferson, plus Dallas Fed President Lori Logan, under consideration to serve. The list is getting longer, not shorter.
The list is getting longer. I would say about 10 to a dozen names are on this list, and the process is underway. The Treasury Secretary has taken himself out of that list, out of that mix, and he is running the process. What he's going to do is try to hone it down to just a few names to put in front of the president for an interview. The one that really caught my eye was Philip Jefferson, because this was someone that was appointed, remember, by the Biden administration. But I remember the day he was appointed, and Kevin Hassett had said, this is an individual, top economic mind, and if I was in Trump 1.0, this would be someone I would have no problem putting in front of President Trump.
We might have a new BLS chief in the mix as well, so look out for that conversation later on this morning. One single name to look at, NVIDIA. In the pre-market, it's down about 1/3 of 1%, so no big drama here whatsoever. But the latest reporting from the team here at Bloomberg, the Chinese authorities have sent notices to a range of firms discouraging the use of the less advanced semiconductors.
So we've seen in the past China do this. They want to boost national champions. champions in China, as well as that they are a little bit concerned about national security in China from U.S. related chips. What I would say, and we're speaking to Mackenzie Hawkins, the lead author, journalist on this story, the urgency now that Beijing has to tell these firms to look domestically, not the U.S., is coming on the heels of the U.S. saying, well, we're ready to ship them, except for President Trump, you can ship them if you give us 15%.
That stock is down by 0.3%. The broader equity market doing okay, just about unchanged. The calm before the potential storm at 8:30 Eastern Time. Coming up on this programme through the next hour, Keith Lerner of Truist ahead of the latest inflation data. John Lieber of Eurasia Group as China discourages the use of NVIDIA's H20 chips. Plus, we'll catch up with Elias Galu of Bank of America as a record number of investors worry about US valuations. We begin this hour with stock steady as traders await US CPI data out at 8:30 Eastern Time. Keith Lerner of Truist writing the following: we anticipate further consolidation of the recent sharp gains and a reset in sentiment within the confines of an ongoing bull market. Keith joins us now for more. Keith, welcome to the program, sir. Let's start with inflation. What could derail this melt-up that we've witnessed over the past few months?
Yeah, well, great to be with you on CPI day. Listen, maybe a really hot number could be a negative. I think in some ways, though, the market may be able to look through that. I mean, the broader picture is we've had a big rebound. We all know up 28% from the lows. Sentiment has kind of reset somewhat higher, and we're in this digestion phase. And I think as much as we're focusing on just today's CPI print, what you all mentioned earlier will just be as important, if not more important, is that employment report, next month. And then finally, I think the big picture too is, we have all these different topics, but the big picture for the equity markets, it's about profits. And we're seeing a really strong profits season with, the revenue beat rates are above 80%, led by tech, which is beating by about 90% of the companies are beating it as well. And those forward earning estimates for the overall market continue to move higher as we have all these other factors, around it.
Keith, you're talking about revenue. Can we talk about margins just for a moment and factor in the tariffs and how that story might change in the future? Just how are companies absorbing costs at the moment? Are we seeing it through foreign suppliers, domestic companies, or are we seeing that pass through to the end of consumer? And I just wonder in the months to come whether you expect that balance to shift somewhat going into year end.
Yeah, it's hard to get a hard number on that. I think it's a bit of a mix at this point, but the revenue beat rates suggest some of that is being passed through because we're having 80% beat rates from the corporate earnings season. And I also think with the labor market weakening somewhat, I think there's going to be some pushback from consumers if you try to raise prices. So it's a mix, but exactly what that percentage is still an open question and still be to be resolved. But if you go back to the overall equity market, I think what we're seeing, I mean, if you look at the last month, the equal weight index is basically flat. Small caps are still somewhat underperforming. It's all about large caps and tech. Tech and communications are up 5% over the last month. And I would say they have somewhat less exposure to some of these kind of inflationary trends, which are hitting smaller cap and the average stock more.
How challenging, though, is it for corporate America and for earnings if the trade story has been very fluid and we only just got the tariff rates a few weeks ago for certain partners and other partners are still negotiating with the United States?
It's still challenging. We still don't know the rules of engagement, but the way I think about it is tariffs are important. It's not the only thing that matters. We know, looking at the Mag 7, 3 or 4 companies are, basically spending in CapEx $300 or $400 billion. That's almost as much as most estimates on tariffs. There was also some recent analysis done suggesting that buybacks this year are on pace to be above $1 trillion. And we also have to remember that these companies have been battle tested over and over again through the highest inflation we've seen in decades, the fastest rate hike cycle that we've seen, also disruptions in the supply chains. And each time they've come out somewhat stronger, and those earning trends, again, continue to surprise to the upside. So listen, there certainly will be some winners and losers, but I will say I wouldn't underestimate corporations' ability to adapt. And maybe one also last stat, the second quarter earnings season, right, is actually now higher than what it was expected back on Liberation Day. I think that also kind of speaks to this resiliency.
How does this all look for 2026? I'm thinking of the car companies. They all took substantial profit hits. Are they going to have to pass them on to, say, new cars that hit the lot in 2026? How slow could we see this tariff story really hit the inflationary impact for the U.S. consumer?
I think that's right. I think we'll be somewhat of a gradual move up. But, also you think about the economy. I mean, it kind of went to stall speed somewhat if we look at the last 3 months of jobs where, we're around 15,000, I believe. And the job growth this year is about half the growth from last year. So I think you have to deal with that inflation side, but there's also a potential that you actually see a little bit of acceleration in the economy from this, 1.2, 1.3, closer to, 1.82% next year. So I just think there will be offsets. And if you have a little bit more inflation, I think on the margin, as long as it's not a big pop, which is not our expectation, then equities on the margin should be able to be, a little bit of a hedge against that.
Keith, can we just finish on a somewhat controversial topic at the moment, the data itself, and how dependable that economic data is? How much trust do you have in the data, not for this morning, but in the months to come?
I mean, at this point, we all know the response rates have gone down a lot, and that's been that's been something that's happening since after COVID. So, listen, I think the response rate is problematic. That's why you have to look at the breadth of the overall market, and then also take some signals from the actual market itself. So, and I think one thing where we continue to focus is those weekly jobless claims. I think that's still good data to be looking at. One of the key metrics we're looking at, and also the credit market. So, we have to take what we get, and overall, I don't think the picture's changed in the data from 6 months ago until today. The data has been somewhat less reflective of what's happening because of those response rates.
So, Keith, do you see this as a welcome development in the last month or so, that we're actually going to take a look at how this data is produced? Or are you worried about the introduction, maybe injection, of political bias?
How about I say both? I think we can all agree we have technology, AI. I think from my perspective, somebody that looks at data every day, that just having another deep dive into this, is there a better way to do that, is certainly welcome. Of course, if there starts to be some divergence between some private data versus the public data, that will be a concern. But that's really premature to say at this point. But I do certainly welcome a deep dive into this data, and getting things a little bit quicker and more accurate early on would be, I think, a positive.
I think a lot of people would agree with you. Keith, thank you, sir. Keith Lerner there of Truist with the economic data. Coming out a little bit later this morning at 8:30 Eastern time. Look, the 3-month average on payrolls went from solid to stall speed, just like that. This data hasn't been dependable for quite a long time. It's not dependable, even if the effort to be as accurate as possible is highly credible. And it's the credibility factor that's a question here. We know this data is prone to massive revisions, but we accept that, and we're comfortable with it because we believe the process is very credible. Now, whether this development down in Washington enhances that or undermines it remains to be seen, but that's the worry at the moment.
It is a worry at the moment, especially when you have conservative economists saying that this individual is highly partisan. If this individual comes out and says he doesn't believe the own data from the statisticians in his own commission, that is going to put a tremendous amount of questions with the data and whether or not potentially it is being undermined.
That data, the latest, drops at 8:30 Eastern time. Inflation data just around the corner. Equity futures at the moment just about unchanged on the S&P 500. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Yahara Anand. Hey, Yahara.
Good morning, John. The U.S. and China have extended their trade truce for an additional 90 days. President Trump signed an order extending the truce through November 10th. Had it not been extended, U.S. tariffs on Chinese goods would have jumped to at least 54% at midnight. The extension may clear the path for Trump to meet with Chinese President Xi Jinping in late October. Meanwhile, Chinese authorities are discouraging local companies from using NVIDIA's H20 processor, especially for government-related purposes. Sources telling us here at Bloomberg that Chinese officials are worried the chips could have location tracking and remote shutdown capabilities, two things NVIDIA denies. And the Trump administration is said to have expanded its list of potential new Fed chairs. Officials say the central bank's two vice chairs, Michelle Bowman and Philip Jefferson, are now under consideration, along with Dallas Fed President Lori Logan. Treasury Secretary Scott Bessent will interview the additional candidates in the coming weeks. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, China pushing back.
I deal with Jensen, who's a great guy, and NVIDIA. The chip that we're talking about, the H20, it's an old chip. China already has it in a different form.
We'll get into the political controversy surrounding those chips with John Lieber of Eurasia Group, live from New York City this morning. Good morning.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Inflation in focus this morning. The estimate's pretty wide. Let's focus on one print. Month-over-month core CPI, so strip out food, strip out energy. We're looking at a range of estimates this morning, anywhere from 0.1 to 0.4, but the bulk of estimates on Wall Street looking for something around 0.3, the previous read 0.2. That's going to set the tone for markets worldwide. Equity markets shaping up as follows on the S&P 500. Just about unchanged on the S&P, unchanged on the NASDAQ. Just got this tidbit out of London from a colleague, Dan Curtis. The Japanese bond, the 10-year, untraded all day for the first time since 2023. That just speaks to the calm before the potential storm.
Well, definitely. It's calm right now, but what's going to happen at 8:30? We're going calm into the CPI print. The CPI print is so important because the market is so stacked to one side right now. They're looking at the weakness in the labor market. They're thinking the Fed potentially is going to cut 2, maybe 3 times before the end of the year. What happens if we get a hot CPI later today? And what happens if we get another hot CPI print? And Jonathan, even worse, we get 2 hot CPI prints going into the Fed meeting and another weak jobs report. That is what everyone would say, stagflationary fears.
A lot still to play for. That data drops at 8:30 Eastern time. Under surveillance this morning, China pushing back.
I deal with Jensen, who's a great guy, and NVIDIA. The chip that we're talking about, the H20, it's an old chip. China already has it in a different form. The Blackwell is super duper advanced. I wouldn't make a deal with that, although it's possible. But the H20 is obsolete. You know, it's one of those things, but it still has a market.
It's the latest this morning. Chinese authorities urging local companies to avoid using NVIDIA's H20 chip. Sources telling us here at Bloomberg that firms are being discouraged from using the chips, especially for government-related purposes. Joining us now to discuss is John Lieber of Eurasia Group. John, welcome to the program, sir. I just wonder what the end game is here for the Chinese and what ultimately they're trying to achieve.
I think the end game is that the Chinese want to have their own chip, and they don't want to be dependent on the U.S. tech stack. And that's one of the reasons that Trump allowed these H20 exports, was because he bought into the argument that if the U.S. dominates chip technology, and if the Chinese learn to rely on that in their own technology stacks, then it gives the U.S. more power, not less here. And I think the Chinese recognize that argument. It's somewhat valid. And so what they want to do is encourage people not to use the American tech. And they know also how vulnerable they are to things like the foreign direct product rule and the other rules that the U.S. has used to weaponize their own technology supply chain over the past several years. And now that's the long-term game here. I think the H20 is just one part of that. But technological development is going to determine what happens here, not necessarily export controls.
John, when it comes to NVIDIA and AMD selling these chips, getting these export licenses to go back into China, what kind of pushback have you heard in Washington from both individuals who are questioning whether the 15% revenue cash back to the United States is legal and the China hawks as well in the Trump administration?
Yeah, I mean, the 15% revenue take makes it look like to certain people, and I think this is a valid argument, that national security is now for sale. I'm sure a lot of companies would be very happy if they had the opportunity to buy their way out of U.S. regulations that otherwise ban them from doing business. You know, in a way, this is a version of a carbon tax where you're purchasing the right to pollute. But here, you're purchasing the right to undermine America's national security by selling these chips to the Chinese, which a lot of China China hawks in Washington are not happy about, because they believe that this is enabling Chinese technological development. This is contrary to the policy of the Biden administration, and up until last week, the policy of the Trump administration, which was, of course, to deny the Chinese access to these chips. So this is a very controversial move. It's never been done before, as far as we're aware, and Trump's getting a lot of pushback, both from security hawks and also people who argue this is an illegal export tax, which I'm pretty confident they'll find their way around. But this is something new we've never seen before.
Do you think this is a one-off, or we're going to see more policy like this?
That's a good question. I think we don't know yet. I don't think there's a lot of areas where this type of thing is doable, where you've got an export ban that somebody wants to that they're offering the chance to raise some revenue off of. So I'm not sure where else we could see it, but we still have, one of the things that's really surprising to me to remember all the time is there's still 3.5 years left in this administration, and we know Trump loves to do these types of deals. So it wouldn't surprise me to see this show up in other areas. It's just hard to predict which ones yet.
Well, John, let's talk about what we learned from the first term under President Trump. In Trump Volume 1, there was a coherent ideology governing trade policy, whether you liked it or not. I happen to be sympathetic to the concerns they had about reciprocity in a country like China, who'd put barriers to entry up all over the place. John, now I'm struggling with what the framework is exactly this time around. How are you explaining this to people at the moment?
Yeah, I mean, the huge difference between this term and last term is you don't have the strong personality of Robert Lighthizer directing a lot of Trump's trade policies. What you have instead is the strong personality of Donald Trump directing these policies. And Trump is going every which way. And, it's obvious that in some cases, he's motivated to get a deal. We saw that with all these countries pre-August 1st. And in other cases, you see personal relationships starting to sour and take over the ability for the U.S. to cut deals, like what's happening with the U.S. and India right now. I think at the core of it, though, Trump remains a very transactional guy. He's somebody that wants to see higher tariffs, and he's somebody that wants to do deals in order to keep those, in order to get those tariffs. With China, they've been able to leverage their use of rare earths and critical minerals to great effect. The U.S. national security community is in a panic about its ability to build weapons in the United States because of the choke points that China's been using to deny the U.S. those critical minerals. And Trump himself, and that's driving a lot of the China policy right now. So I don't think there's a consistent strain that you can pull through here, but it is worth pointing out that Trump ran on a campaign of higher tariffs, and now the U.S. is getting them with an average effective rate somewhere in the mid to high teens. And that's a huge shift that reflects Trump's own personality and his own policy preferences.
Well, let's just sit on that transactional nature. Nothing new, quite well understood. Where people struggle is what defines whether it's a good transaction or a bad transaction, and what kind of feedback loops is the president sensitive to?
Well, clearly he's sensitive to feedback from the private sector. I mean, the reason that the Liberation Day tariffs were paused in the first place was because of what he called the yippiness in the bond market. So that's one type of feedback. Another type of feedback he's clearly sensitive to is direct feedback from the business community. His meeting with Jensen Huang directly led to the selling of these H20 chips into China. And I also think that he's sensitive to the positive feedback he's getting from the deals that are happening, where his U.S. trading partners aren't putting up any real resistance here. Nobody's retaliating. I think that's an important point, is that he's faced virtually zero retaliation, and that's allowed him to get away with these higher tariffs. And I think going forward, the feedback that might cause him to reverse course would be economic weakness, major complaints from the U.S. business community, big businesses who are going to have the ear of the president. And I think that that means that probably small businesses are getting left out of this because he's not necessarily hearing their voices.
John, when it comes to the trade agreement, we of course have the punting of the negotiations when it comes to China and the United States. You mentioned the victory really of Beijing using those rare earth magnets in lieu of making sure they can loosen up export controls. Would you say Beijing has the leverage going into November?
Not necessarily. I mean, I think you have to be mindful of the fact that China is going to face higher tariffs. They're just comfortable. Their system's prepared for a level of higher tariffs, and they can deal with tariffs in the 30% range, which is where we think tariffs on China are going to end up here. However, I don't want to play down the fact that they have been able to play this critical mineral game very, very well, and the U.S. is obviously very, very sensitive to it. But this is not necessarily a positive story for the Chinese economy either.
When it comes to what the United States wants to see out of China, they're dealing with export controls, they're dealing with rare earths. The president the other day was truthing about soybeans. What else is on the list before potentially Xi and Trump can meet and potentially get to this grand bargain of a deal?
Yeah, I mean, we don't see a grand bargain. We don't think a grand bargain is necessarily the right way to describe this. We're thinking about this as a very transactional deal. So the U.S. is going to raise its tariff levels on Chinese goods. China will make some purchase commitments about market access. They're not going to fundamentally reform their economy, which was, of course, the goal in Trump 1 and the goal of some of the China hawks in this administration. But what they're going to do is make enough promises to buy enough time that they can live with these 30% tariffs and then hope to fight that out in the next presidential term. I'm not at all convinced these tariffs are going down. Even after President Trump's term is over, none of the China tariffs went down after his first term, and these things have a way of being enduring.
John, appreciate the update, the reaction from you, sir. As always, thank you. John Lieber there of Eurasia Group. Most people assume they'll stay and maybe even last beyond this presidency if they stand up to legal regulatory scrutiny in the days, weeks, months to come, and we'll see about that.
It's very true because Donald Trump, the president, is using IEEPA to enact a number of his tariffs, and the issue is that is now, right now, being discussed in courts. I would push back on the one thing, though, that this administration does have, and the U.S. government has. They can use 232, 301. There are different ways to enact a tariff policy, but the whole broad IEEPA sweep potentially could be major pushback from the courts on Trump.
If you're just tuning in, welcome to the program. Two-part story in the last 24 hours. Some of these chip makers, NVIDIA, AMD, securing export licenses into China so long as they give a 15% slice of the revenue back to the government, to the White House, to the Treasury. This is what we're hearing from the Chinese side, according to our reporting. The Chinese authorities have sent notices to a range of firms discouraging the use of those less advanced semiconductors. NVIDIA, slightly softer yesterday, slightly firmer this morning. Not seeing big moves off the back of this story. Up this morning at the pre-market now by 0.2%. Coming up on this program, we'll catch up with Elias Galou of Bank of America as a record number of investors say they're worried about U.S. valuations. Plus, we'll touch base with Yahara with your morning movers, with Intel rising after President Trump changes his tune on the company's CEO. The stock is up by 3.4%. Live from New York, you're watching Bloomberg TV.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to the job.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Slow start to the trading week so far. It's going to get busier later on this morning when inflation data drops. Look at this, going absolutely nowhere on the S&P 500. Likewise on the Nasdaq. Let's lift the lid on the index and get you some morning movers. 3 hours away from the cash open. With those morning movers, here's Yahara. Hey, Yahara.
Hi, John. Intel CEO Lip Bhutan must have hit all the right notes because he is back in President Trump's good graces. And take a look at the stock. It is jumping 3.3%. They met at the White House yesterday, and according to President Trump's social media post, it went well because he called him an amazing man. Quite the contrast to what we heard days ago from President Trump calling for his ouster due to his alleged ties to China. So they left things on a positive note with more talks planned at the cabinet level. So something tells me we may get an announcement from Intel pledging more U.S. investments as the story goes. Next up, we have this stock, Big Bear AI, plunging in the pre-market, down 28% on a massive earnings miss. This is a company that provides AI software to the U.S. Department of Defense, and it says that the government efficiency drive is stalling federal contracts, and for that reason, it slashed its outlook quite dramatically. Very different from what we heard from Palantir, but of course, that company is in a league of its own. And we end on Apple, moving slightly to the downside, down 0.5%, but on some big drama. Elon Musk is accusing the tech giant of favoring OpenAI's ChatGPT in its app store, saying that Apple makes it very difficult, nearly impossible for all other AI apps, including his own, Grok, to reach the top of the App Store. So he is threatening legal action on antitrust grounds. Sam Altman of OpenAI has already hit back, and something tells me, given these billionaires' big personalities, the war of words is not over. John?
Yahara, thank you. That stock is down by about 0.5%. A stock receiving increased scrutiny over the year so far. That's the latest for Apple. On our radar this morning, China telling local companies to avoid using NVIDIA's H20 chips. Sources telling us here at Bloomberg that guidance over the past few weeks has been particularly strong against use of the chips for government-related work.
So after the U.S. said it will resume these sales, allow these sales and the export licenses for these chips to go into China, we saw Beijing starting to raise security concerns. And a lot of this was really socialized through local press. Now, what our reporters here learned, led by Mackenzie Hawkins, that they sent guidance to some of these companies strictly, please avoid these chips. They're worried about security concerns like tracking of location. But also for China, this is about making sure that they could dominate in this space. And they want their firms to use their national champions and not rely on NVIDIA or AMD.
We talked to John Lieber of Eurasia Group about this just moments ago. There is an alternative option, not just that one. Also, they might be pushing for more. Now they know that these companies can secure export licenses if they give a slice of the revenue back to the White House, to the US government. Can they push for more? Can they push for the higher technology chips coming out of these companies?
Potentially. And what did we hear from the president? He said that H20 is not as high, as sophisticated as some of the other chips that are out there. Maybe that is why the president was willing to reverse his own export control we saw in April. What I would say is that for the moment, this story is kind of calm between the rare earth magnets and the export controls between China and Beijing. But now, Jonathan, we have another 90 days of these countries going to be negotiating. What else could we see China want to get out of the United States?
It's a story getting a lot of attention information, but not pushing around the market too much. Nvidia this morning firmer by about 0.2%. Another story getting a lot of attention is this one right here. President Trump's search for the next Fed chair has expanded. Sources telling us here at Bloomberg that the Fed's two vice chairs, Mickey Bowman and Philip Jefferson, are now under consideration for the role, plus the Dallas Fed president, Lori Logan.
So I don't know if you want to call it The Bachelor, The Bachelorette, or Game of Thrones. Obviously, more names are being added to the list. This makes sense. We know about 10 to a dozen names are going to be on the list for the Treasury Secretary to sit down with these individuals. And then once he decides, say there's 3 or 4 names he likes, maybe 2, then he sends a shorter list to the president, and the president will then meet that person. I think the president's #1 question for all these people is very obvious. Are you willing to cut interest rates? Do you want to cut interest rates? Do you see a path to cut interest rates? That's pretty much going to be it. What I found so striking about this, we mentioned it earlier, is Philip Jefferson. This was someone who was appointed by Biden, and then they're willing to take a look at.
Yeah, unlikely that he would get the pick from President Donald Trump, but it's very, very obvious that the Treasury Secretary is worried about the optics and interested in the process. And I think the fact that you cast a net wide and far lends some credibility to the process at a time when a lot of people are asking questions about who might be the Fed chair and what kind of approach they'll take to the job.
Exactly. This is very different than we're seeing what the president do in terms of BLS. He does not want to make, at least the Treasury Secretary is not trying to make the Fed chair this highly partisan political appointee so he can go back and say, look at this search I had. We had Democrats, we had Republicans, we had individuals from Wall Street, individuals who, like Mickey Bowman, have been really one of these individuals talking about Main Street and regional banks. The search was far and wide.
Let's talk about the BLS. You mentioned it. The president naming a new head of the Bureau of Labor Statistics. The president picking Heritage Foundation chief economist E.J. Anthony to lead the agency after firing his former head earlier this month. Anthony, subject, of course, to Senate confirmation. Now, this is a process that typically people wouldn't follow, because who cares about who runs the BLS? You don't even want to think about it. Now a lot of people are going to be following this very, very closely.
And I think it remains to be seen with this particular person on whether or not he will get the nod from the Senate. This is an individual who owned conservative economists. You have the senior fellow at the Conservative American Enterprise Institute describing him as, quote, utterly unqualified, as partisan as it gets. And it seems like he really pitched himself on Steve Bannon's War Room podcast. And he's already put a ton of doubt into the data coming out of BLS. And this is what individuals in the market are concerned about, that this is someone who wants to make the BLS partisan and politicized, even though if you're a market participant, you want that agency independent.
Best case outcome, has his opportunity, a fair hearing, he's heard, and he manages to secure some cross-party support, some bipartisan support, and we move on with life. That's the best case outcome. Unlikely given what's developing in Washington at the moment.
Unlikely, and I would say the best case outcome would be if this individual, if Anthony was able to get to be the commissioner of the BLS, maybe then he can go to Trump and say, please lift your hiring freeze. I would like more statisticians at the BLS, and I would like to make the data more comprehensive and more reliable so that you're not going to see these revisions that you don't like and your truth about.
The data very much in focus this morning. Keep repeating it, but inflation data on deck, 8:30 Eastern time for that data point. Let's turn back to the markets. Bank of America out with its August Global Fund Manager Survey, showing investors are the most bullish since February, with a record 91% calling U.S. stocks overvalued. Joining us now to discuss is Elias Galou of Bank of America. Elias, welcome to the program. Let's just talk about that 91%. So a lot of people seem to think, many, in fact, the overwhelming majority believe the U.S. stocks are overvalued. How many are short? How many are underweight at the moment?
Hey, John. Look, I mean, clearly that's a very important question to our investors and clients, because the valuation and the perception of the global stock market valuation was really a highlight in this month's Global Fund Manager Survey, which was not really a decisive survey, not like the survey that came out in April, which was a clear moment to buy, or the survey from December 2024, which was a great moment to sell the market. But this month, the highlight was really the perception that global equity markets are overvalued. The highest share of investors saying they think the global equity market is overvalued since 1998, when we first started asking this question. The share topped even the highs observed during the internet bubble in 1999-2000, or the everything bubble in 2021. And of course, the perception that global equity markets are very rich, overvalued, is driven by the US equity market, with here as well 91% of FMS participants saying that they think the US equity market is overvalued. Definitely, valuations are very important for long-term equity investors. In fact, that is the one factor that matters when you invest in terms on stocks over the course of a 10-year period. However, this has not been an element that caused major concerns, because investors continue to rotate towards the US equity market. They were very underweight in April. This underweight is being cut progressively, and despite the very high perception of overvaluation, the FMS positioning in terms of US equities remain net underweight, which is really a silver lining for US stocks.
So, Elias, the way you see things is that this negative reservoir of pessimism that we can keep feeding on in the months to come, can we continue to see that grind higher?
I think, this negative reservoir of pessimism is really what emboldens the bulls right now, because when you look at the results from the FMS survey this month, is that the bulls will really focus on the macro pessimism that in fact increased versus where it was in July. Macro sentiment worsened a little bit, but also the bulls will focus on the fact that global equity exposure stands below the historical average. Net 14% of FMS investors said they were overweight the global equity market. The historical average since 2000 is roughly 25%. So based on these two metrics, the bulls will say there is further room to go in terms of positioning. However, there is also some substance to embolden the bear narrative, and in particular the fact that the average FMS cash level remains at a low 3.9%, which historically has been a strong signal to say that global risk assets are toppy, as now is a good time to retreat or hedge your position.
When you look at the pessimism, what has changed since the last few surveys in terms of how individuals are thinking about the uncertainty coming out of Washington?
Look, the uncertainty in terms of the way it is captured by the biggest tail risk in the fund manager has clearly receded, because back in April, if you remember, a global trade war triggering a global recession was by far the biggest tail risk, and in terms of the magnitude, the biggest tail risk ever in the history of the fund manager survey. And this risk has receded, with now less than a third saying that they think trade war and policy uncertainty is the biggest tail risk. What you also need to consider here is the convictions. That really changed over the past few months. I would say that FMS sentiment today is based on three major convictions. Number one, the global economy will dodge a hard landing. Only 5% of them expect a hard landing. The culprit here is the much more accommodative monetary policy they expect next year. One stat that really stood out to me, because you were speaking about the search for the next Fed chair just before our conversation, is the fact that a net majority of FMS participants think that the next Fed chair will actually resort to either QE or yield curve control to alleviate any concern on the US debt sustainability. That's a huge development. The second conviction is really the fact that policy uncertainty has receded via the trade war. And finally, and I would say the most important convictions, relies on AI, and the fact that AI and the Mag 7 will continue to lead this bull market. Long Mag 7 is now back as the most crowded trade. There was a 4-month interruption between long gold and short US dollar, but here you can see that the conviction on AI remains very much intact.
Elias, do you see that high-tech concentration in the US market as a source of stability or of risk? That's a debate we've had to start the week. How do you view things?
Of course, I mean, and this is why this is a concern, because investors, are very much concerned about equity market valuation, mostly because of the tech sector. However, when you look at the positioning on tech, it stands now below the historical average. When you also conciliate the sentiment data from the FMS, which is really the equivalent of soft data, to the hard data that we see in terms of flows, over the past few months, and in fact since Liberation Day, there has been zero net inflows to U.S. equity funds. So there is still room for investors to buy the U.S. equity market and to buy U.S. stocks. And in fact, John, across our Bank of America platforms, last week we saw the 10th largest weekly buying from institutional clients in terms of U.S. single stocks, which shows that the appetite to increase allocation to U.S. equities and to U.S. tech stocks remains very much intact.
It's a hated market, but they keep buying it. Elias, it's good to catch up, as always. Thank you, sir. Elias Galou there of Bank of America with the latest. Let's get the latest on stories elsewhere this morning with your Bloomberg Brief. Here's Yahaira. Hey, Yahaira.
Hi, John. An explosion at a plant operated by U.S. Steel in Pennsylvania has killed at least one person and injured 10. The company says the incident involved coke oven batteries at its Clairton plant. The CEO of U.S. Steel says the firm is working closely with authorities to investigate the exact cause. Meanwhile, President Trump is downplaying expectations for his upcoming meeting with Russian President Vladimir Putin on Friday. Speaking to reporters yesterday, he called it a feel-out meeting and said, quote, "I'm going to be telling him you got to end this war," and that he'll warn him that'll be the end if a deal is not possible. And I mentioned this one earlier. Elon Musk is accusing Apple of favoring OpenAI, saying the company makes it impossible for anyone else to reach the top of the App Store charts. Musk said Apple's behavior is an antitrust violation and stated that xAI will take immediate legal action. That's your Bloomberg Brief. John.
Yahaira, thank you. Up next on the program, inflation data on deck.
We think we're going to see something more in goods inflation. I think that's the consensus also, that more of that's going to bubble through. We have 0.29% month on month on core CPI. Even if you get a 0.4, if it's focused on goods inflation, that's not too concerning for Fed officials.
Up next, we'll catch up with the brilliant Torsten Slok of Apollo, live from New York City. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on.
I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Live from New York City, welcome to the program. Under surveillance this morning, inflation data on deck.
We think we're going to see something more in goods inflation. I think that's the consensus also, that more of that's going to bubble through. We have 0.29% month on month on core CPI. Even if you get a 0.4, if it's focused on goods inflation, that's not too concerning for Fed officials. When you think about the fundamental economics of it, what we should be concerned about is, do we have a persistent uptick in inflation, or does this look more like a one-time rise in the price of certain goods?
So here's the latest this morning. Investors are awaiting inflation data this week, with CPI due out in less than 2 hours' time. Torsten Slok of Apollo writing, the market is clearly expecting rate cuts, but the upside risks to inflation are significant. The stagflation theme in markets is intensifying. Torsten joins us now for more. Torsten, good morning.
Morning.
Let's talk about the Fed's dual mandate. Should both sides of that dual mandate be treated equally?
Well, that's, of course, up to the committee and, importantly, up to the Fed chair. So far, it's very clear that Jay Powell and the committee have been putting a lot of weight on the worry that inflation is not yet at the 2% target. So for that reason, if you think that inflation is now at risk of going up because of tariffs, inflation is going up because of the depreciation of the dollar, all that is creating an impulse on inflation over the next 6 months, where there are some arguments to say, well, we should not be cutting because inflation is under some upward pressure. On the other hand, growth is slowing down, as you know from the employment report. There's some headwinds, of course, not only from tariffs. There's also headwinds coming from student loan payments restarting, especially middle-income households are facing some challenges as a result of that. That means that growth is slowing, which, of course, says the Fed should be cutting. But the current administration at the Fed, if you will, or the FOMC committee, is certainly putting a lot of weight on the inflation worries and the potential for more inflation impulse coming over the next several quarters.
Do you believe that derails some of the impulse to reduce interest rates on the FOMC?
Well, now, as you just talked about, we're expanding the search for who the next Fed chair will be. And, of course, some of these names certainly are more traditional Fed staffers and have been on the FOMC for a very long period. So that does begin to raise questions around, well, what is exactly the intention of the new Fed chair? But the important thing, as usual, is that there are 12 voting members on the FOMC. And even if the Fed chair comes in and says, I think rates should go down, if the other FOMC members say, no, we don't think rates should go down, well, then they will not be cutting, because it is a vote. And we will find out, of course, what the composition of the committee looks like.
Well, Jay Powell told us that the main number to watch is the unemployment rate. With this kind of unemployment rate, should they be cutting?
Well, the market obviously is saying we have 2 cuts this year. So I do think that the dot plot is telling you that the next move is that rates are moving lower. But it's very clear that this whole debate around, when you put it up on the scale in the dual mandate, how much weight do you put on inflation, which is now at risk of going up? How much weight do you put on the unemployment rate, which is at risk of also going up? Well, that becomes a very, very difficult debate, because at the moment, the Fed is currently saying, well, maybe we still worry more about inflation, but if the labor market does deteriorate more meaningfully over the next several months, and there are chances that could happen. We have certainly seen some, of course, bad data, in particular, of course, on the employment report itself, but also the headwinds from, in particular, the consumers in the middle-income household group. High-income households have been doing well for a long time because of asset prices going up. Low-income have been stressed because of interest rates and therefore higher cost of borrowing for them. But the middle-income household now, for the last few months, also facing headwinds, is now also a downside risk to the growth outlook.
How much has this trade story been a headwind? Because in June, you wrote that Donald Trump might have outsmarted all of us when it comes to trade policy, which was welcomed by the White House.
Well, but if you think about the trade deals that Trump has been able to generate, both with Europe and also what he's been doing with Japan, at least when you look at the tariff part of that, that is beyond what most people expected, even when you go back to Liberation Day. So from that perspective, I still think that Trump did manage to get higher levels of tariffs with a lot of different trade partners than what anyone really expected in the beginning of April during Liberation Day discussions.
Let's sit on the data we get later this morning at 8:30 Eastern Time. To what extent do you believe that inventory management has delayed some of the pass-through? And how many more months do we need to see of data before you get comfortable that we've seen the limits of this?
That's exactly right. That's why the census data for the inventory to sales ratio first companies were building inventory as, of course, we saw tariffs come in, and those inventories have now been running down, especially for retailers. And now those inventories are down now to a more normal level. So now we are getting into a situation where companies are pricing goods not so much on whatever is left in the inventory, because there's not much left in the inventory. It really is the new price that includes tariffs, and that's likely why the number this morning, what is most important is not only what's happening on the goods side, where most of the worries are about inflation, but the fact that ISM prices paid for services also showed a very strong uptrend in the latest data, is telling you that for a long time the story was, oh, it's all about goods, services is fine, but the fact that ISM services paid for the last several months have started to move higher is telling you that there is a bigger risk, in particular also with deportations at the same time removing labor from the economy. That means more upside pressure on wages, especially in the sectors where undocumented immigrants are working. That all means that service sector inflation could also be a very important part of the number that comes out here at 8:30.
Are you seeing this show up in inflation expectations? Survey-based inflation expectations of consumers can be very volatile. What are you seeing in markets?
Well, so the one-year ahead swap, meaning what does the market price, and this is people putting real money, betting on what will headline CPI be in 12 months' time, is currently pricing that inflation at this time next year in 12 months' time will be 3.3. That's significantly higher than the Fed's 2% target. So that's also telling you that the market is pricing that inflation expectations have almost become unanchored already. Is that because people think that inflation will be higher on its own, or is it because the expectation now is that the Fed will be cutting, and therefore there will be even more impulse to inflation, not only from tariffs and not only from the dollar depreciation, but also from potentially the cut that's coming from the Fed prematurely?
What do you think it is?
I still think the risk is that the market is beginning in the long end to look a little bit more wobbly when it comes to inflation expectations. Markets are, broadly speaking, especially when you take last week's auctions for treasuries, there was a number of issues with 3-year, 10-year auctions last week where you begin to worry about, well, if we now have on top of the fears that inflation might be moving higher, then rates in particular in the long end could also be moving higher simply because of the significant fiscal issuance and treasury issuance still in the pipeline.
Final question. Do you trust the data?
Well, what's really unique about this discussion in markets at the moment is that the BLS controls both parts of the Fed's dual mandate. They control non-farm payrolls, the employment report, and they also control the CPI and inflation statistics. So that's why, let's take, for example, non-farm payrolls. If non-farm payrolls is really good, the market may say, well, this is not necessarily the right data, this is just done for political reasons, and therefore maybe the conclusion is that the data is not that good. Well, what if non-farm payrolls actually comes out as bad or really bad? Well, then the market will be also concluding, or will be maybe things are actually really a lot worse. So in that sense, credibility is very asymmetric. That means that credibility here really is that it is the case that if the data does come out a lot better, or in this case, say a lot worse, the market will be putting a lens on of beginning to ask questions about, is this the real true data, or is this data that is actually being painted with a different brush? So broadly speaking, I do not believe under any circumstances the BLS staff and their staff, the way they collect the data can be really changed in any way. But it is, of course, a very important debate we're having at the moment when this discussion is, of course, about firing BLS commissioners, suddenly the way it's been done here more recently.
Torsten, it's good to see you. Appreciate your time. Thank you. Torsten Slok there of Apollo. It's the Chinese effect. It's how we treat Chinese data.
Everyone's concerned, even in conservative economic circles, that this individual is just too partisan, and now the whole independent institution is politicized.
We'll see how things change down in Washington. Up next, we'll catch up with Stuart Kaiser of Citi, Michael Zezas of Morgan Stanley, Angela Zena of CFRA, and Elizabeth Economy.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI, entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned
of Wall Street, and particularly Wall Street investors. When they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were gonna probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is gonna get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
In case you missed it, on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
The volatility so far this year is in the headlines. It's not so much in the market.
The market is being very sensitive to who are going to be the winners.
In the US, the tech-heavy, largest companies have been dominating the rally.
I think the market is trying to take a slightly longer-term view. Market returns aren't necessarily going to be blockbuster.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the inflation report in America, live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now. And check out this news at 7 a.m. Eastern Time. This market going absolutely nowhere on the S&P 500, on the NASDAQ, as we await the first big data point of the week. We're looking for CPI at 8:30 Eastern Time. Then it's on to PPI and retail sales later in the week. But the main event is later this morning.
Absolutely. The market basically on hold until they get the data when it comes to inflation. And the big question is how much of the tariff and trade policy story out of Washington is going to now bleed into CPI, which pretty much we've seen the CPI reports kind of shrug it off. A little bit started creeping into the last report. But given the fact that now the tariff policy is pretty much set, barring a few countries that they're still negotiating with, how much are we going to see that impact pricing pressure in the United States?
Payrolls growth has taken a big step down. Will inflation data take a big step up? And will that complicate the Federal Reserve's objective right now in the minds of a lot of people, what they'd like the objective to be, which is to reduce interest rates in September?
Absolutely, and this is their conundrum. So 2 CPI reports, 1 more job report before they meet and able to get what they would call the totality of data. And Torsten Slok brought up a really great point. Immigration policy could also mean that we can have higher wages and wage pressure on the labor part of the story. So what you could potentially see is just inflation becoming much harder to tame. And how difficult is that going to be for this Federal Reserve?
Depends who the Fed chair is. We're casting the net far and wide. The new list of candidates will include Mickey Bowman, Philip Jefferson, 2 vice chairs, and Dallas Fed President Lori Logan under consideration to replace Chairman Powell next year.
And then, of course, you have the 2 Kevins still there. You have, of course, Chris Waller. You have James Bullard as well. The Wall Street Journal reported that name that is being floated out there. So we're looking at a dozen names on this list. The Treasury Secretary is running this entire process. He's the one making the calls. He's the one sitting down with these individuals. And then he's going to give 2 or 3 names to the president to sit down for an interview. And the number one question, Jonathan, is going to be, will you cut interest rates?
Give them some credit, though. These names are highly credible. This list, I think, is a really credible list. Reminds me of the list of the Treasury Secretary nominee. You remember that big race? 6 months ago? How many months? 9 months ago?
Yeah,
Something
absolutely.
like that. Time's flying. When you went through those names, they were all very, very credible. This list reminds me of that. Certainly some very credible figures in the mix.
Very credible and also bipartisan. You have individuals there like Philip Jefferson that was appointed and then also then given a higher job at the Fed under the Biden administration. And I remember when he was appointed and Kevin Hassett said, this is an individual that is very credible, who if I was still working for President Trump and it was Trump 1.0, he would have been on my list, but I have no problem recommending this name to the president.
We'll get into that conversation later on this morning. We'll get into a lot of things with equity futures totally unchanged on the S&P 500. The big focus is on inflation just around the corner. We'll catch up with Stuart Kaiser of Citi as Wall Street braces for that report. Michael Zezas of Morgan Stanley as the search for the next Fed chair is expanding. Plus, we'll speak to Angelo Zeno of CFRA as China is urging firms to avoid using NVIDIA's H20 chip. We begin this hour with stocks flat ahead of today's CPI report. Stuart Kaiser of Citi writing CPI could leave the Fed with dual headaches. The base case is the best case. Modest slowing in the economy, easing inflation, and the Fed cutting back towards neutral. Stuart joins us now for more. Stu, good morning.
Good morning.
Just want to give you some extra space just to build on some of that. Why is the base case the best case?
I think our view would be, if you think of the best case right now is, for most clients, is a slowing but not recessionary economy. Fed gets a couple cuts off in the back half of the year. I think any data that would get you off of those two cuts would probably read negative for equity markets. So I think if you're cutting more than twice, it means the employment data is quite weak. If you're cutting less than twice, it probably means we get an upside surprise in inflation. So at this point, just give us the base case and we'll be pretty happy into year end.
Well, let's look at the data that we're getting later on this morning. Just how high is the bar to derail those two cuts later on this year?
Yeah, it's going to be a little bit of a tricky print. I think Torsten, mentioned earlier that goods inflation is a big part of this. I don't think there's really, at least when I talk to clients, a consensus on what goods inflation is going to be because it's just such a detail underneath the surface. Our economists are at 33 basis points, so if you use that as a bogey, I think if you get anything on goods inflation kind of above that number, significantly above, you probably need numbers that are 0.5 on some of these things to really delay cuts, and so that'd be kind of the bogey here, 0.5 or above.
You say in your note that equity markets can shrug off some tariff-driven inflation. How?
Well, we did it last month.
Right, but not all the tariff rates were set.
Yeah, I think at this point, there's a question of timing and magnitude on when the tariffs actually get into the data. If there's one little mistake I think the Fed made is they said we expect to see this over the summer. And, it could be that you get a small amount of inflation last month and this month, but then later in the year in, October, November, December, based on, inventory, drawdown and stuff like that, you get an additional inflation impulse. So I think for now, if it's modest, the market's going to try to look past this. We did just also get a pretty good earnings season where companies did not call out a ton of inflation pressure, which I think gave, equity markets a little bit more confidence that either A, we're not seeing it yet, or B, corporate America is being able to manage it a little bit.
John has been talking about this, the inventory with the pull forward effect, and at some point that inventory is going to run out. So do you see this being a bigger problem for the equity market going into 2026?
It could be if it starts to get into the margins. I mean, Scott Cronin on our equity team took up his earnings forecast for next year by about 5%, which gives you a sense, on how positive the quarter has been. But yeah, I mean, there is a risk going into next year that the tariff impact's a little bit delayed in terms of the impact, and it does start to kind of eat into equity margins in the U.S. a bit. That's sort of a wait and see at this point. We really just don't know. But yeah, it's a lingering risk from tariffs. And even though the tariff rates are determined, a lot of these deals are 1 or 2 pages of paper, when ultimately they're going to be probably 1,000 pages of paper. So I think
some of them we don't even have the paper. So
there you go. So I do think the details are going to matter a little bit on that.
Yeah, this is a process also. It's not a one-off event. How they absorb costs right now is not how they're going to absorb costs in the months to come. Goldman talked about this. You mentioned the report from Jan Hatzius. Consumers in the US have absorbed an estimated 22% of tariff costs through June. They see the share changing, though, and shifting to 67% in the months to come. How do you anticipate the balance of things will change in the months to come?
It's TBD, I think, at this point. And, the other thing is you also have a big legal process that's going on parallel to this about that. And, if they refund tariffs, who gets them back? So I think it's a good question about, I think if the economy is stronger, corporate America will try to test on pricing a little bit, right? If the economy looks a little bit weaker, you'll probably see it go kind of, into margins a little bit. So I think, it's all sort of context dependent in terms of how strong the economy is, what the details on tariffs are, and how much they feel like they can push through.
Credit to you. You've been super consistent over the last several years, I would say. long, strong until the data starts to break. Can you just define for us the data breaking? Because clearly 2 Fridays ago, people felt like the data was breaking.
Yeah, it's the unemployment rate. I mean, if you really wanted to distill it down a little bit, and I think you need to get that kind of going back up to about 4.5% or above to really, kind of disrupt things. What's interesting is if you look back to last summer, we had 3 consecutive months of sub 100K payrolls, which we're kind of going through again now. And then you triggered the SOM rule at the end of the summer, and the market kind of suffered under the weight of those two things. So I think what you're really going to need, is you need firing to increase. This can't just be about not hiring. It needs to be about actual layoffs, and I think you need to see it get into the unemployment rate and get the number at least above 4.5 to become a real issue.
Well, that's the question. Is the labor market actually slowing, or is it just frozen? No hiring, no firing, because what corporate America has been telling us is that we are putting everything on hold because we are uncertain with policy coming out of this White House.
I think it's exactly that. I think it's an on-hold, frozen kind of labor market. And you see that
So is
continuing.
that bad?
It's I don't know. It's a little bit worse than neutral, I guess. I mean, you would argue, hey, if the labor market's just frozen, does that indicate no growth, or does that indicate we're just kind of settling into a trend or sub-trend growth environment? I think the issue with all of this is, and we have a lot of clients say, oh, we're going to slow down, but we're not going to go into recession. When you get to those transition points, though, the risk-reward really falls apart because you're going to get some data that looks recessionary and some data that doesn't. And the markets are not going to kind of trading that balance. So, yeah, it could be a frozen labor market. It could be you're sort of moving sideways. But when you're moving sideways at a low level, it means you're always kind of, on the precipice. And I think that's going to be the issue the markets deal with in the data, particularly if they have a little bit less faith in the data going forward.
This is not showing up in the index. Let's be clear about that. Close to all-time highs within 1% on the S&P 500 this morning. Do you see it in the internals? Do you see it elsewhere in the equity market?
Definitely. Small cap has underperformed. That's a big part of it. We've seen a lot of hedging in the credit space. A lot of folks not comfortable going down the quality spectrum, both in just terms of earnings reliability, or in terms of kind of balance sheet strength. So I think you see pockets, and the pocket there is quality. When we talk to clients, and this has been our view as well, you want to be long beta, but you want to be playing in sort of that higher quality neighborhood. And I think that's where you're seeing it, is more a preference for large cap, a preference for growth, a preference for higher quality stocks, but also a preference to be in U.S. equity. So you have that kind of balancing act mix going on.
We've seen the divergence between the equal weight S&P 500 and the market cap weighted S&P 500. Is that a divergence to worry about? I keep going back to this theme. We all know that the U.S. equity market is concentrated with big tech. There is a big difference between calling that a source of risk and a source of stability. That arguably over the past few months, based on the earnings we've seen, has been a source of stability. Any reason to believe it becomes a source of risk in the next few months?
I mean, I agree it's been a source of stability. Those Mag 7 stocks are generating earnings in the mid 20% range. So yeah, they are kind of acting as ballast, for the earnings outlook and the market. Where it becomes a risk is you are sort of heavily reliant on that sort of AI CapEx spending theme, sort of supporting the entire market. So it's a risk if those companies need to pull back. You saw a little bit of a shot across the bow there, I think, from some of the semiconductors earnings, where they kind of talked about this CapEx spending is actually starting to negatively impact our earnings outlook, i.e. we're trying to keep up with our neighbors in terms of spending, and that can be a bit of a headwind. So if you've seen it anywhere, it would be in some of the semiconductors, I think, kind of being pressured to spend more than maybe they would like to.
You talked about data reliability, though. I just wonder if the data coming out of these tech firms is going to be more reliable than the data coming out of the BLS in the next few months.
I guess I'm a little bit less suspicious of the BLS data, I think, than the average bear. But clearly, we do audit corporate balance sheets, so I guess, that data is going to be more reliable than the other. It's funny when these questions come up about economic data, and then people actually drill down into what is the sample size and how are the estimates being done. I mean, these are all statistical estimates, right? And so it's easy to kind of throw stones at them, but it doesn't mean they're not reliable.
Just asking questions, Stu. No views at all. Stuart Kaiser of Citi. Good to see you, mate. As always, thanks for dropping by. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara. Hey, Yahara.
Hi, John. The U.S. and China have extended their trade truce for an additional 90 days. President Trump signed an order extending the truce through November 10th. Had the truce not been extended, U.S. tariffs on Chinese goods would have jumped to at least 54% at midnight. The extension may clear the path for Trump to meet with Chinese President Xi Jinping in late October. Meanwhile, President Trump has reversed his criticism of Intel CEO Lip Bhutan after they met at the White House yesterday. Trump described their meeting as very interesting, calling Tan's success and rise an amazing story and said Tan would meet with members of his cabinet in the coming days. And General Motors is renewing its push to develop a driverless car. Sources telling us here at Bloomberg, the automaker is trying to lure back some of its former employees of its now defunct Cruise autonomous vehicle business. This time around, the project would be focused on autonomous cars for personal use rather than a robo-taxi service. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. How many times have we seen this over the past few months? If you get a meeting with the White House, apparently get long the stock.
Absolutely. It's so interesting that this Intel CEO went to that meeting with the president calling for his firing publicly, and now he said he's an amazing guy with an amazing story. So I think for Intel, they're pretty happy with the result of that Oval Office meeting.
Stock is higher this morning in the pre-market by 2.7%. Up next on the program, expanding the search.
Look, in 2019, the president contacted me and said, would you serve? And I said, yes. If the president contacted me and said, I want you to serve, I would do it. If he says, Chris, I want you to do the job, I'll say yes.
Governor Waller might be the front runner, but that list is getting a whole lot longer. We'll catch up with Michael Zies of Morgan Stanley up next.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Check out how sleepy this market is in stocks and bonds so far this morning. Equities down just 0.1% on the S&P. On the Nasdaq, the bond market going absolutely nowhere. 2-year, 10-year, 30-year bond yields. Yields unchanged on a 10-year at 4.29, on 2s at 3.77. Under surveillance this morning, we need to talk about the Federal Reserve expanding the search.
Whoever they choose, you're going to have somebody that has credibility with the markets, or you're going to see inflation expectations spike. You will not get lower interest rates. You will get higher interest rates. Look, in 2019, the president contacted me and said, would you serve? And I said, yes. If the president contacted me and said, I want you to serve, I would do it. If he says, Chris, I want you to do the job, I'll say yes.
So here's the latest this morning. The search for a new Fed chair is getting wider. Sources telling us here at Bloomberg that the Fed's 2 vice chairs, Mickey Bowman and Philip Jefferson, plus Dallas Fed President Laurie Logan, are under consideration to replace Chairman Powell early next year. Bloomberg's Wendy Benjaminson joins us now for more. Wendy, welcome back to the program. What are we learning about the process so far?
Well, our colleague Saleha Mohsen yesterday broke the news that the people you just mentioned are under consideration or being considered by Treasury Secretary Scott Bessent, who is running the search. And that is sort of expanding the universe. That includes Chris Waller, who you just saw there, Kevin Hassett, some other people who might, all be considered for it. All these people are sort of within the normal spectrum of who you might select. And he does have Stephen Moran in place right now, or will be in place soon, to cover Adriana Kugler's term until January. And then presumably any one of these people or any of the other people we've mentioned could replace Jerome Powell next year when his term as chairmanship ends.
Wendy, this is a very credible list. Most people on Wall Street would agree with that. Can we say the same thing about the candidate that might succeed the empty vacant seat at the BLS?
I'm afraid not. As you said, all the candidates for Fed chair, perfectly within normal range, should sail right through the Senate. Now, E.J. Antony, who we're seeing there, will probably also sail through the Senate for confirmation. But no, he is really Steve Bannon's pick to run the Bureau of Labor Statistics, which is the least sexy agency in D.C. It is a place where, PhD economists and statisticians and people who really love numbers, would be there to present jobs data. And this person believes in promoting what Donald Trump wants him to promote, which throws into question some of the key data that everything else is based on.
Wendy, appreciate the input this morning. Thank you. Wendy Benjaminson of Bloomberg in Washington, D.C. Plenty of questions about just how easy that confirmation process is going to be.
Well, first they need to go to the Senate Committee on Health, Education, Labor, and Pensions. And there's individuals on that committee, Republicans, who have gone against the president, who have been vocal. So I'm not sure, and he can't lose a single vote in there. So I'm actually not sure that this is going to be smooth sailing. There might be some hurdles, and this could be very contentious, and potentially this individual might not actually make it to the institution.
We get more economic data from the BLS later on this morning, 8:30 Eastern Time, for inflation data. Joining us around the table is Michael Zezas of Morgan Stanley. Michael, good morning.
Hey, good morning.
It's good to see you. Let's talk about the tariffs so far that are set and how they're influencing inflation outcomes for you and the team. How do you see things at the moment?
Yeah, so as we're at an effective rate of about 16%. That's more or less where we expected to be, but at the end of the year. So we got there a bit faster. Our economists think that the CPI print you're going to see this morning is going to show core about 0.32 month over month, getting you over 3% on an annualized basis. That's the type of thing that would show kind of 2 consecutive times where there's been some inflation acceleration and show some reasonable tariff pass-through. And that's the type of thing that we think helps keep the Fed on hold come September. If we're wrong, right, and you actually don't see that pass-through, that would suggest there's more tension in the system. Companies are eating more of that cost. Perhaps they're the way they're eating that cost is through labor and through layoffs. And so that's the type of thing that gets you to a more dovish posture. So really, I think we're in the zone now where the tariff outcomes, the uncertainty in the near term is kind of reduced, and we're really kind of watching the data to tell us what the actual impact has been.
Well, do you have a good handle on how that 15.1% is being spread across the supply chain?
Not yet. I mean, you have to patch this together, and over time, I don't think we'll really be able to tell this story in the near term. It's probably like a year from now we'll be able to see what companies have said on the record about how they've been able to absorb the costs, and really kind of how some of their suppliers overseas to what extent and in what industries they've absorbed the costs, and then what the pass-through is. So, I mean, clearly there is cost burden sharing across that supply chain. A CPI print like this that sort of accelerates would tell us that most of that is going to be pushed onto the consumer. But again, we just don't really know yet.
We do know that there's going to be 90 more days of this détente between Washington and Beijing. What are you expecting the next talks to look like between these two countries? What will be the focus?
Yeah, I mean, listen, I think the U.S. still has a list of demands that China doesn't seem particularly willing to engage in all that much. I mean, a lot of the tension in the U.S.-China economic relationship, going back to Trump's first term, has really been around the way that China organizes its economy. And the U.S. really wants it to change some fundamental aspects of being a centralized economy. And I think China's going to be very resistant to that. So the sort of narrow arrangement that they've already made, which is effectively a swap of semiconductors for rare earths, with an elevated tariff level from the U.S. on imports, we think we're kind of indefinitely in a position like that. And maybe tariffs are going to go up and down a little bit as the U.S. kind of toggles them to try and nudge negotiations forward. But we don't really think there's much more of a substantive agreement coming.
The US market is a market that any country would want access to. Makes a ton of sense, really powerful, wealthy consumer. Are there any signs in the moment that China is struggling without that access?
Yeah, I mean, there's certainly some, our economists in Asia have kind of pointed out that there's been some weakness there as a result. But on the other hand, I think things like this news where the U.S. is going to have some of the semiconductor companies effectively pay a portion to the U.S. to sell into China, and the market is telling you that it's not particularly concerned about that outcome, i.e. that there's going to be full pass-through. It tells you there's probably sufficient demand on their side and then probably sufficient export capacity on their side, even with these barriers raised up, that none of this is sort of existential for either economy.
Since you brought it up, can we ask you what you thought of that development? Just putting export licenses alongside a share of the revenue for the U.S. government.
Yeah, I mean, it's unprecedented, right? And so there will be, I think, an obvious question of under sort of what legal framework this is permissible. Now, we're told, read the headline, that this is an agreement. So if it's just, sort of a bespoke agreement, then in theory this could stand. And who would actually challenge this in court if this is a voluntary agreement? That's unclear. But of course, there isn't much precedent to this. And it would matter in so much as it would actually change the dynamic of what could be exported. But I think right now the reaction of the market is telling you that it's an extra cost that's willing to be borne.
Does corporate America need to start thinking about this every time a CEO goes and visits the president? Because this was done, according to the Wall Street Journal, really basically a conversation between Jensen Huang and Donald Trump.
Yeah. I mean, I would put it on the menu of any C-suite official who's talking to the president, just to kind of have in mind that this is something that could come up, because what our clients tell us is that engagements with DC, a sort of wide range of options is always discussed. But if you're asking us to set a precedent where now everyone exporting into China is going to have to pay something, I don't think so. I think semiconductors are a very specific issue that goes back over multiple administrations who are trying to be preserving the U.S. technological advantage in this space. Partly because we're trying to win the AI race, as well as other advanced technologies that are deemed critical for the economic security of the U.S.
Well, Beijing basically turned around to the United States when Treasury Secretary Scott Bessent says to his counterpart, we want you to structurally change the dynamic of your economy, and say, well, now you're doing central planning too.
Yeah, I think it's a fair critique, right? And I think that, again, so back to a point about where do these negotiations ultimately go with China, I think the answer is they continue. The discussions continue. You sort of avoid re-escalating to the levels that we saw earlier this year, where we had tariffs above 100%. But these discussions can include toggling of tariffs up and down 30% to 40, 50%, and then kind of a cooling down as you go. But the arrangement, in our view, has been made. It's effectively we're going to continue to trade with tariff barriers on certain things, but the swap of semiconductors for rare earths is kind of what both sides need, and we're going to kind of continue the relationship with that as the baseline.
You said it repeatedly. Last time around, it took 18 months. Going to see a series of 90-day extensions before we get there.
And the Treasury Secretary basically said that to me in July. He said, now we have a cadence where we can basically meet regularly. What I want to know is what is on the list for the next few meetings, and all of this potentially leading up to Xi and Trump meeting.
Michael, it's good to see you. Thanks for dropping by. Michael Caesars there of Morgan Stanley. Up next on the program, Angelo Zeno of CFRA as China pushes back against US chips, plus Yahira with your morning movers as the makers of On Shoes delivers a higher outlook.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Two hours away from the opening bell, 60 minutes away from the inflation report. Equity futures totally unchanged. Said it all morning. It's like the calm before the potential storm. Futures down by not even 0.1% on the S&P. Basically unchanged on the NASDAQ. The S&P within 1% of all-time highs. As we count you down to the opening bell and that inflation data, let's take a beat to get you some morning movers. Here's Yahira. Hey, Yahira.
Hi, John. We start with On Holdings soaring 11%, nearly erasing all of its losses for this year after reporting a surprisingly strong second quarter and lifting its outlook at a time when these footwear makers are under pressure due to tariffs because, like many others, On produces its shoes overseas in places like Vietnam. But it is undeterred, with the CEO saying that consumer energy remains strong and that they actually plan to open new stores globally to keep up with that strong demand. So watch out, Nike. Next up, we have shares of Hanes brand. They are absolutely soaring here, up more than 40% on a possible takeover by Canada's Gildan Activewear. The FT is reporting that the company is in advanced talks to buy the U.S. underwear maker, valuing it at nearly $5 billion, including debt. Hanes has been hurt by tariffs on top of weak sales, but it did report a good second quarter recently, so Gildan thinking that it could help turn things around for this struggling company. And worth noting again, Intel, because it is a new day for this company. Shares are up 2.6% with the CEO back in President Trump's good graces. They met at the White House yesterday, and apparently, according to President Trump's social media post, the meeting went well, with him calling Lip Bhutan an amazing man with an incredible story. Quite the contrast from just days ago when he was asking for him to resign over his alleged ties to China. So they left things on a positive note, and we may see a fresh pledge from Intel on U.S. investments. John?
Yahara, thank you. Appreciate it. Stock is higher by 2.6%. On our radar this morning, China urging local companies to avoid using NVIDIA's H20 chip, particularly for government-related purposes. Sources telling us here at Bloomberg that China aims to shift away from Western chips in favor of local alternatives.
So two things going on here with Beijing. One, they're concerned about some of the potential location tracking, they say, coming out of U.S. chips. You see NVIDIA really pushing back against that. And also, they want to make sure that their own domestic champions are the one that their firms are relying on. What's interesting about this, and according to Mackenzie Hawkins, the lead journalist on this story, after the U.S. said it would resume allowing these sales to go through, you've seen it in Chinese media basically saying stay away from these chips. But now that we've learned they've sent this guidance, there's more urgency from Beijing because the Trump administration told NVIDIA and AMD, go ahead, get those export licenses as long as we get 15% cut.
Hugely controversial 24 hours for this sector. In just a moment, we'll catch up with Angelo Zeno of CFRA to get his views on that. So stay tuned for that. I wanted to squeeze in this story as well, that the president is tapping E.J. Anthony to lead the Bureau of Labor Statistics after firing the former head of the agency. Trump posting on Truth Social that Anthony, who comes from the Heritage Foundation, will ensure that the numbers released are, quote, honest and, quote, accurate.
So the concern is because this individual is highly political and very partisan, and even there's a ton of pushback from conservative economists, The question is, will this undermine the data? Will the data just be seen as political? And I still wonder whether or not he can actually get through the Senate. Libby Cantrell, after the firing of the BLS chief, put out a great note and was talking about the fact that this individual needs to get through a subcommittee, and that on that subcommittee, where they cannot lose a single Republican vote in order to make sure they can advance to a full hearing, there are individuals who have not been afraid to go against this president, voice their concerns, senators like Susan Collins. So potentially this might end up not happening at a very low level in the Senate. This person might not even see a hearing.
I think we've got to draw a distinction between dependable and credible. The data, when it's released, in the minds of a lot of people on Wall Street, isn't dependable because it's revised so much. It's prone to heavy revisions. But the process, the perception of the process on Wall Street is highly credible. And that's what we're talking about this morning, the credibility of the data and whether this will undermine it or enhance it. I think a lot of people on Wall Street share the views that we should have a look at the process, maybe enhance the credibility of that process, and then we can make it maybe more dependable. I think that's a worthwhile pursuit, and we've talked about it endlessly over the last week. With this selection, if it becomes heavily politicized in Washington, particularly the confirmation hearing, it's not going to help things. And you heard from Torsten Slock of Apollo, this stuff is very, very asymmetric. And a simple way of saying that is just look at how we treat Chinese data. Every single month it comes out. We've been doing this for years. When it's good, we say can't be that good. And when it's bad, we say it must be really bad. And you don't want to see that happen with US data releases.
Absolutely not. It undermines the institution, and also it undermines the market confidence of that data. The best case scenario could be if this individual doesn't talk about the data and just runs it as an independent institution, leaves it up to the statisticians, which, by the way, the commissioner only sees the report a day or two before it goes to the president of the United States. And maybe this person, given his close proximity and relationship with President Trump, could actually get the Trump administration to lift the hiring freeze. Maybe they get more statisticians. Maybe they look at AI advancements on how to actually make the data more reliable.
That's what a lot of people would like to see in Washington, that's for sure. That's the latest on the BLS. I wanted to squeeze in this as well. The president downplaying expectation for his upcoming meeting with Vladimir Putin. Trump describing it as a feel-out meeting where he plans to tell Putin to end the war in Ukraine, but says they might leave without reaching an agreement. You'll be there. How high are expectations?
Well, I think the president just really dialed down those expectations. And this is what I said yesterday going into this meeting. My thought process was always, as Trump said, feeling it out. This is basically a beginning of a process. But even if the president is able to say there's not going to be a peace agreement from one meeting when also one party is not there in terms of Volodymyr Zelensky, but if this is a start of a process to hammer out really difficult long-term concerns, especially security concerns, then potentially this is a path to getting to that bigger peace agreement.
That meeting's set to take place this coming Friday going into the weekend, so look out for that. Let's turn back to technology. Sources telling us here at Bloomberg that China is discouraging domestic companies from using NVIDIA's H20 chips. Angelo Zeno covers NVIDIA for CFRA and has a buy rating on the stock. Angelo joins us now for more. Angelo, welcome to the program. So you've talked a lot about getting access to the Chinese market and the extent to which NVIDIA has de-risked their exposure to that story, but we'd just love your initial reaction to the news of the last 24 hours. Truly unprecedented.
Yeah, no, absolutely. It really is unprecedented, and it'll be interesting to kind of see how this kind of changes the dynamics, for the tech industry and the semiconductor industry in the future, as well as potentially other industries. But I would say kind of on the surface, I think this is pretty good for both sides in many respects, especially for a company like NVIDIA. I mean, it does now give them access to the second most important semiconductor market out there. So they are going to get significantly higher revenue. We think the run rate is north of 30 billion at this point in time for this company. But more importantly, the addressable market expansion story, the broadening expansion, customer base expansion story here, greater diversification and what have you. Great for the long-term potential of this company. Access to more developers is a huge key for Jensen Huang here. Half the world's developers are in China, so that's a huge part of the story here for NVIDIA and even an AMD out there. And then we think also it helps kind of potentially slow down the Huawei story, right? I mean, there's been a lot of fear that NVIDIA not being in China would only strengthen Huawei, and by now NVIDIA kind of being able to go back into China and even potentially at some point, rolling out a tempered down version of their Blackwell chip, I think gets developers more, tied to NVIDIA's ecosystem, and hopefully slows down that Huawei story.
Angela, often difficult to get access to decent market data out of China, but I'd love your read on things at the moment, just how you're running the numbers. Can you share with us what you think the market share of Huawei is currently in China? And given that the last 12 months of business for NVIDIA has been highly disrupted, how you think about things looking 12 months out, their share of revenue going forward, and ultimately the kind of slice that the White House can anticipate?
Yeah, those are all great questions, right? And to your point, there's that very limited data there. I think when you think about what we know is, there was basically potentially an $8 billion run rate for NVIDIA just a couple of months ago. And when you think about what Jensen has said is, he viewed the 2026 market as potentially a 50 billion or so addressable market in China next year. And, our view is, Huawei has gotten stronger here over the last couple of months. We do think Huawei, with their next gen chips in 2026, and the fact that China does want to continue to support that local brand, and Huawei being that crown jewel that they are, will, continue to allow them to, gain more share on that side of things. But our view, again, of that $50 billion market, NVIDIA should be able to take at least 30 to 35 billion. And again, that doesn't really assume much higher growth from the current run rate. So we do think there's upside to that, especially if there's a tempered down Blackwell chip that does launch into China here over the next couple of months. And on the AMD side, it's going to be a lot smaller in nature, but we think at least 3 to 5 billion from their perspective. So you could almost kind of back into what Huawei would be on that side of things. But Huawei is going to be kind of a key, story for China here over the next couple of years. And as far as the administration is concerned here, I do think they do want to make sure that, I think their growth agenda really over the next couple of years under the Trump administration is going to be tied to AI. So having access to those developers, what Jensen is kind of throwing into the U.S. administration, I think means a lot to how the relationship between China and the U.S. is going to go here.
Does it basically mean that export licenses are now for sale in the United States?
I think I think when you think about the U.S. administration here, I think they've got a pro-economic agenda more so than anything else out there. So if you're kind of asking me, is there a price for President Trump here? I think under the right situation, I don't want to say he can be bought, but in many respects, I think there is a certain price that can be paid to a certain degree, right? I think there are definitely national security issues tied to semiconductors here. But I think, maybe instead of being 3 to 4 generations behind, if you're potentially only 2 to 3 generations behind or 1 to 2 generations behind, I think there are conversations that can be had with this administration, if the price is right and the trade deal is correct.
So if China is telling its firms to snub the H20, what chip do they want to get their hands on that potentially the Trump administration would have put a price on?
Yeah, listen, I think when you think about the Chinese market here, it is really all about the developers, and the developers continue to be really tied and tethered to NVIDIA's software ecosystem, and that's why it's really important for developers in China to have access to the H20 right now. And again, I think ideally, the H20 is not suited for machine learning. It's great for inferencing, and I think similar when you see a tempered down version of a Blackwell chip. Again, it'll be Blackwell is kind of this inferencing massive platform out there. So I think when you think about the Chinese, when you think about China, they'd love to have that next gen platform, but I don't know if there's kind of a situation out there where they're going to exactly get what they want from the U.S. administration. That is kind of the next latest and greatest chip.
Angelo, appreciate reaction. Thank you, sir. Angelo Zeno there of CFRA on NVIDIA and the developments of the week so far. Let's give an update on developments and stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. The Trump administration is said to have expanded its list of potential replacements for Fed Chair Jay Powell. Sources telling us here at Bloomberg the central bank's 2 vice chairs, Michelle Bowman and Philip Jefferson, are now under consideration, along with Dallas Fed President Lori Logan. Meanwhile, Citi CEO Jane Fraser is in Mexico City for talks with President Claudia Sheinbaum. Sources telling us here at Bloomberg they're discussing a potential public listing of Citi's retail Banamex unit. It's unclear if Sheinbaum is imposing any conditions on the sale or IPO of the unit. And Ford has unveiled a $5 billion plan for a new line of budget electric vehicles, starting with a $30,000 pickup truck set to roll out in 2027. CEO Jim Farley calls it a bet to take on Chinese rivals, warning there are no guarantees in the unpredictable U.S. EV market, which, as we know, has been struggling as of late. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes' time. Up next on the program, dealing with China.
We've been dealing very nicely with China, as you probably have heard. They have tremendous tariffs that they're paying to the United States of America. They've been dealing quite nicely. The relationship is very good with President Xi and myself.
Up next on the program, we'll catch up with Elizabeth Economy of the Hoover Institution. Live from New York City, you're watching Bloomberg TV.
Applications have been received positively both in Kenya and UAE, and we are optimistic that we should be able to open the office in the fourth quarter. We think the Middle East have deep capital sources. It has strong logistics for trade, and it is a strong center for investment. And we are seeing increasingly the global GDP is increasingly becoming overweight in Asia and Middle East. So that linkage with the middle income segments growing in India and China, they will provide a very strong market.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Victor, Idaho, and this is Bloomberg.
Inflation data 42 minutes away. The estimates look like this. Core CPI month over month 0.3%. That's the median. The range is wide, 0.1 to 0.4, and the uncertainty is high. This from Citi just moments ago. Andrew Honhorst expecting the larger and more widespread upside to goods prices not likely until the fall. This is going to take a few months. That's the latest data you can anticipate in about 40 minutes' time. Here's the price action going absolutely nowhere going into it. We're down just 1/10% on the S&P. Similar move on the NASDAQ 100. And the surveillance elsewhere this morning, dealing with China.
China tariff deadline is tonight, but do you plan to extend that?
We'll see what happens. China's been, we've been dealing very nicely with China, as you probably have heard. They have tremendous tariffs that they're paying to the United States of America. And we'll see what happens. They've been dealing quite nicely. The relationship is very good with President Xi and myself.
Here's the latest this morning. President Donald Trump waiting until the 11th hour to extend the China trade truce for another 90 days, saying all elements of the agreement remain the same. Bloomberg's Enda Karen joins us now for more. Enda, welcome back to the program, sir. It's been too long. Please translate the following. They've been dealing quite nicely. The relationship is very good with President Xi and myself. What does that mean, Enda?
Well, it certainly means they've got a new window now for negotiations, Jonathan, on these tariffs. You remember the tariffs, had that pause not gone into effect, you would have been talking about tariffs in the 50-odd% range today. Instead, they're sticking at that 30% area. Obviously, the effective tariff range is much higher, but the broad point is tariffs are on hold for now, a new window for negotiations on all those topics such as export controls, fentanyl, maybe more soybean purchases, and of course excess capacity on the Chinese side. So all these issues are on the table, and on paper at least, you know, taking this at face value, the thinking is it may lead to some kind of agreement in the fall when the two leaders have an opportunity to meet at one of those fall summits, perhaps one in South Korea, for example, and perhaps they can ink a kind of a trade deal there. But as I say, that's the headline take on it. Obviously, under the bonnet, there are a lot of tensions and differences still to be played out on all of this.
Enda Karen, down in Washington, D.C. Let's explore some of those differences. Joining us now, Elizabeth Economy of the Hoover Institution and the former senior advisor for China in the Commerce Department under President Biden. Elizabeth, welcome back to the program. It's good to hear from you. I want to lead on your expertise here and your experience, and something I know you're thinking about at the moment. Are we blurring the lines between national security and trade?
Yeah, I mean, I think that is a question that was clearly raised over the past week or two with President Trump's decision to reverse his administration's earlier decision, April decision, to put the export controls on NVIDIA's H20 chip. You know, typically you put an export control on technology that you believe could contribute to, you know, a country or companies in that country developing military capabilities that will undermine your national security. So that was the decision that the administration made just in April. And then we saw, you know, just earlier this month that the president reversed that decision without any explanation as to why that decision was being reversed. And I think it points to a larger challenge with this administration in that they have not yet articulated a real China strategy. We don't know whether this president considers China to continue to be the greatest long-term strategic threat, which is something that his first administration did put out there as part of a China strategy. That helps an administration set priorities, you know, understand the trade-offs that you're going to make or not make. But without that kind of overarching framework, we don't know, you know, where this president is coming from, where he's going, whether everything is up for negotiation moving forward.
Elizabeth, given your work in the Commerce Department, have you ever seen anything like this? Some corporation able to get their hands on a license because they're willing to give some of the revenue back to the U.S. government?
No, I mean, that was certainly a new twist. But even taking one step back from that, it's a new twist to have the head of the Bureau of Industry and Security, Jeffrey Kessler, go to London to be part of the trade negotiations with China. You know, in the Biden administration, and frankly, in all previous administrations, you would never consider linking export controls with trade negotiations. Export controls deal with broad issues of foreign policy and national security. You know, tying them in some way to trade really makes no sense. But that's what this administration has opened the sort of the door to. So I think it's a bigger problem, even more than just this one-off decision. Is just this new, you know, world that we found ourselves in. And as far as the 15% revenue, you know, the sort of, you know, NVIDIA and AMD having to give 15% of their the revenues from the sale of these chips back to the U.S. government, of course, that only sort of amplifies or reinforces the sense that somehow our national security is up for sale. because, does that mean that all chips moving forward, or even other goods that the United States, sells to China, can all then be subject to some kind of new tax of some sort, and the revenues will have to come back to the U.S. government? It really is fundamentally changing the nature of the interrelationship between national security and trade, and frankly, just trade generally.
There's a number of issues brewing between these two economies. Fentanyl, China continuously buying Russian and Iranian crude, disagreements about U.S. business operations in China. When they sit down, what do you think is the U.S.'s main goal out of this relationship?
I mean, I would have said in the first Trump administration that there was an emphasis placed first on, of course, securing these big purchase agreements that, again, President Trump seems to place as a top priority. He mentioned just yesterday or the day before having China quadruple its purchases of soybeans. Of course, China's already diversified away from the U.S. It gets 70% or more of its soybeans from Brazil now because of the tariffs that the president began, the tariff war that he started when he first came into power. But I think, number one, yes, getting more purchases from the Chinese. But I think also the U.S. wants a secure and stable supply of rare earth elements from China, which are, of course, essential for both our national security and technology industries. And we saw what happened when China put the squeeze on those, earlier, just a month or two ago. Companies in the United States really began to feel the pinch. So I think that's probably the second priority. And then all of the trade adjacent issues that you just mentioned, fentanyl, China's economic support for Russia in its war of aggression against Ukraine, TikTok is still standing out there. But I think those fundamental issues around the Chinese economy, things like China's export of its overcapacity in many areas of core technologies, I think those are going to be very difficult for the Trump administration to make progress on. I don't think they have the leverage that they need, or maybe that they even think they have, to get China to sort of fundamentally change the way that it does business.
We're up against the clock here, but in the 45 seconds we have left, Elizabeth, why has it been so difficult to convince the Chinese they need to rebalance their economy when so many economists agree that it might be good for them?
I think Xi Jinping has a vision of how the Chinese economy should work, which is reliant on exports and heavy investment, investment now into core technologies. And he believes it is working for the Chinese economy and is willing to suppress Chinese consumer demand and Chinese incomes to achieve what he believes will put China in a stronger long-term footing moving forward.
Elizabeth Economy of the Hoover Institution. Elizabeth, thank you. Appreciate it, as always. That final point is so important. Treasury Secretary Scott Bessent has been on top of this now for quite a while. Pushing this economy, this country to rebalance is a big goal of his. It's incredibly difficult to achieve.
Incredibly difficult, and even when the U.S. was pretty much taken off the market for them with those sky-high tariffs, what did we see? We saw their imports, their exports into other economies like the European Union actually go up. They will find a place to dump.
Up next on the program, one story dominates everything in financial markets worldwide. Inflation data on deck. 34 minutes away. We'll catch up with Greg Peters of PGIM Fixed Income, Sucharita Kadali of Forrester, Tiffany Wilding of PIMCO, David Kelly of JP Morgan Asset Management. The third hour of Bloomberg Surveillance. Up next.
Single best investment opportunity you see in the world, regardless of industry or geography. Why? And again, how are you making it available to your clients?
I think there's no question AI is going to impact everything we do. The opportunity to take great companies and use AI is going to transform. Also, the issue of jobs. What do we do with jobs? Because there's no question, you look at things that are customer service oriented, and the AI is so much more efficient. As we look at across all these different opportunities, what we really like is data centers in the U.S. And, the one thing that we know is that AI is just going to create this enormous demand for data and this even growing opportunity for cloud computing. So for us, owning data centers for 20, 30, 50 years, we're going to have a limitation on power in the U.S. There's no question over the next 20 years, the technology will change for chips. It'll become more competitive, and NVIDIA may not be the only major provider. So I think you're going to have a big technology refresh over the next 20 years. But the one thing we know is you're going to need data centers, you're going to need power, you're going to need cooling to support all this growth in the cloud. So we look at them as long-term bonds.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We published a story recently about the explosion of robotic companies and innovation in China. I think we said there's something like 50 or 60 robotic startups in China. Are we behind, and should we be concerned about that?
I think as far as the state of innovation, no. Most of those robots aren't built for work, for the things that, which is the entry point for these robots today. They can do some interesting things. A lot of times it's backflips or making coffee or something, but not really useful work. These robots can pick up to 50 pounds on our next generation. So they're great for the education of robotics, getting people interested. But as far as humanoids, they've got to check that safety box before they can come into any of the facilities here. And that's a big bar that we haven't seen much of out of the Chinese robots.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
We've been calling this environment stagflation light.
You're going to have inflation that is just kind of sticky, but you're not necessarily going to see a big pop.
We're not expecting a reacceleration.
What we should be concerned about is, do we have a persistent uptick in inflation?
It's also quite possible that we'll see a slowly increasing inflation rate.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now. Looking ahead to tomorrow, this just in, Treasury Secretary Scott Bessent in the studio here in New York City tomorrow morning, 7:30 Eastern Time. Get that one on the calendar. Don't miss that and don't miss this. 30 minutes away, inflation data. Here are the expectations. The median guess, 0.3% for core CPI, month over month for headline 0.2. For year over year, we could creep back into the threes going into the Federal Reserve meeting next month in the middle of September. Equities at the moment have been a snooze all morning going into this. Futures unchanged on the S&P, unchanged on the NASDAQ.
This is why the conversation tomorrow with the Treasury Secretary will be so important, depending on what we see from this data. How much of this insight will we get from the data on Trump's tariff policy? Are we finally starting to see the trade policy creep into consumer prices? And this is something, Jonathan, this administration, when they were on the campaign trail, ran on. We will make it a more affordable America. Well, is that going to be true, depending on these numbers we see later this morning?
This will shape a lot of guesses about what the Federal Reserve will and won't do come September. The man in charge of what this might look like next year is the President of the United States. And the man in charge of the list that will land on the President's desk is the Treasury Secretary. And that list to replace Chairman Powell is getting longer. It's not getting shorter.
It's getting a lot longer. There's about a dozen names or so now, I would say, 10 to 12 names on this list. And Talia Mosin, our colleague in Washington, D.C., has added last night 3 more. Michelle Bowman, Philip Jefferson, and Lori Logan. And you've done a really good job this morning pointing out that this list is highly credible, especially when you have the likes of individuals already serving on the FOMC and individuals like Philip Jefferson. This is someone who was appointed and then given a higher title under the Biden administration. So no one can look at this list and say this is not credible. These are highly successful economists and other individuals in this space that could potentially take on from the chair.
This story is going to play out over a number of months. The inflation story as well. Going into it, equities and bonds doing nothing. I've talked about stocks. Bond yields this morning, almost totally unchanged on 10s at 429, on 2s at 377. Coming up this hour, we'll catch up with Greg Peters of PGIM Fixed Income, with risk assets holding steady. We'll speak to Sucharit Gadali of Forrester on the state of the US consumer, plus David Kelly of JP Morgan Asset Management reacting to that inflation data. We begin this hour with stocks little changed as markets await the latest read on inflation. Greg Peters of PGIM Fixed Income writing, higher effective tariffs are now a reality, but their impact on activity and inflation in the US and the rest of the world is still unclear. Greg joins us now for more. Greg, welcome back to the show, sir. It's good to see you. Let's talk about what you and the team are looking for in 27 minutes' time.
Yeah, so I mean, I think we're largely in line with consensus. There's a lot of focus, obviously, on this print. I think the bias is for anything kind of below 0.4 on core is a signal for the Fed to ease in September. Anything above calls that into question. So I think there's a real skew here. But you know what I haven't heard talked about a lot is the shelter component, which is a very large component to the overall CPI. It might not manifest itself in this print, but what I think you'll see over the upcoming months is this push-pull between, yes, you will see inflationary effects of the tariffs, and you're seeing it already, but that's going to be almost completely muted by what's happening on the shelter component side. And so I really don't see inflation getting out of control here, maybe moderately higher, but if anything, I see the bias lower, not higher inflation.
Greg, let's just stay on that theme. It's an important one. The offset that you might get from services inflation. If you're on the FOMC right now, is there good reason then to look through what you might see develop on the good side and put some more weight on developments on the other side?
I think so. I mean, I think that's the story. I mean, it is manifesting itself in payrolls too, and the labor force, right? So what you're seeing is companies have a couple decisions to make, of course, you know, whether they eat the tariff, they lay off workers in order to defend margins, or raise prices, right? And what I think you're seeing is just a cooling in the job market writ large, and I think that's due to tariffs, and I think that should be the focus of the FOMC. And my suspicion is anything other than a really hot print around, you know, CPI will, you know, move them forward as far as the rate cutting cycle is concerned.
Greg, do you have an understanding yet of exactly how the tariffs are impacting consumers? What percentage are they paying if, say, the new average rate is 15%?
I don't think we know, right? This is what makes it so challenging. I know it's a terrible answer to say we don't know, but that's the right one. But I think we'll know more over time, right? We're still in the very early stages. There's been an inventory rebuild. There's been an ever-changing kind of tariffing rate. So I just don't think we know yet. But I do think over time, that cost will be passed on. And once again, it's going to be passed on either through less labor demand or increase in prices. But I'll tell you what we are seeing is that companies that are actually more levered, that have to defend their margins and must pass those price through, they're actually doing so. And companies that have a little more wiggle room, they're trying to buy share, and they're allowing kind of prices to remain fixed here. So over time, I think that'll converge, but that's an interesting development early on, I think.
Well, if you don't know and the Fed doesn't know, how much optimism are they going to have, basically, in September when the meeting rolls around to cut rates?
Well, because I think the focus will be on the labor side, and rightfully so. So you are seeing a cooling around labor, and then ultimately the tariff inflationary impact is a quote-unquote one-time impact, right? So it's not persistent as far as the change is concerned. Yes, that inflation's in the system, but doesn't obviously continue to rise necessarily. So I think the focus will be on labor and the economy more so than the tariffing effect.
So, Greg, I wonder how well received that might be for the rest of the market. If we can start talking about what this could mean for bond yields, if you begin to get a sense, if the broader market begins to get a sense that this Fed will prioritize one side of the dual mandate over the other and begin reducing interest rates with headline inflation maybe back into the 3s, does that unlock higher yields at the long end?
Well, I think it's a curve steeper no matter how you look at it, right? So, you're seeing that play out. I think there's more room for that to go, of course. But yeah, I mean, there's a variety of different reasons why I think back-end yields will remain stickier relative to the front end. Risk/term premium is one measure of that. And that's why I think what's kind of lost in here is that all this focus on the Fed reducing interest rates in order to get mortgage rates down and help the consumer, so on and so forth, that's going to be offset by the term premium effect, right? So you're not going to see the same pass-through into mortgage rates, as an example. And I think it's going to be somewhat of a self-limiting strategy.
We saw an episode of this drama just last year. Greg, you remember that? They cut interest rates by 100 basis points. Of course, that anchors the front end. Long end sold off. Do you see reasons for a repeat then? And what was the lesson from that experience? Is it the same thing all over again?
Yes, I do think, it's the same thing. What's interesting is that I thought the administration was very much attuned to that as well, but I think they've kind of shifted the narrative along the way. But yes, I do think that the bond market is going to reflect these additional risk factors, namely the debt and deficit, mainly the kind of the pushback around foreign, demand. So, all else equal, I don't think you're going to have the same response to the belly of the curve, the back end of the curve, to the front end that you ordinarily would.
Now, Greg, does that lead to tighter financial conditions overall? What would that mean for broader financial conditions?
Well, it should, all else equal, but financial conditions are just incredibly easy right now, which is why it's often hard to make the argument that policy is currently restrictive, right? If you just look at, financial conditions. But I think over time, just that beta effect, or less of a beta effect, where the 2-year will, let's say, rally 100 basis points, and the 10-year will only rally 50, just as an example, I think that'll have an effect over time, and that does hurt consumers over time, which is why it's just incredibly important to show some path around the fiscal side, because I think what the bond market's looking for what is a greater focus on the fiscal. Now, somewhat ironically, the tariff income that's coming in, bond investors are looking at that and they say, wow, this isn't so terrible. But the question is, will that remain in place or not?
Greg, begs the question, just play this out. Let's just think about things. Let's say the courts come out and say these tariffs can't go forward. They vote against them. Let's go with that. Greg, what would that mean for fixed income? What would that mean for bonds? Would bonds rally, or would they sell off?
Well, I think it would just enhance the curve steeper. I think what you would see is just additional kind of movement, or lack of movement, I guess, in the front and back end. That just puts more pressure on the fiscal story and forces the government in ways to how to kind of cut spending. And I think we all know how difficult that is. So yeah, I think that's bad for the bond market, just because those revenues are desperately needed.
Greg Peters, the PGIM Fixed Income. Greg, appreciate the outlook. Greg Peters there, looking ahead to inflation and looking ahead to what might happen if the courts strike down these tariffs.
Well, two things I'd say. It would definitely hurt their talking points, because a lot of the times when they talk about the offset to the one big, beautiful bill is the fact that the CBO does not dynamic score with the tariff money coming in. So that's their first issue. The second, though, I would say is that we might get a knee-jerk market reaction, but then the market would realize the tariffs can stay. They're just going to have to use a different path forward. No more IEEPA. They're going to have to use 232, 301. There are other ways to enact a tariff agenda without using this broad sweeping IEEPA plan.
It gets messier, potentially more volatile. Nothing volatile about this morning so far. That might change in about 20 minutes when inflation data drops. Let's give you an update on stories elsewhere so far this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Chinese authorities are discouraging local companies from using NVIDIA's H20 processor, especially for government-related purposes. Sources telling us here at Bloomberg that Chinese officials are worried the chips could have location tracking capabilities and remote shutdown capabilities. NVIDIA denies that. Sticking with China, Chinese real estate giant Evergrande Group will be delisted from Hong Kong's stock exchange. The move marks the end of an era, with Evergrande at one point being the country's largest developer by sales, but its downfall symbolizing China's sweeping real estate crisis. Shares will be removed on August 25th. And for the Swifties, Taylor Swift has announced her 12th studio album. Swift revealed the new album titled The Life of a Showgirl during a cameo on the New Heights podcast hosted by her boyfriend, Travis Kelce, and his brother, Jason. There are no details on a release date for the album. That's your Bloomberg Brief. John?
Yara, thank you. Appreciate the update. Thank you very much. Up next, the morning calls, plus Sucharita Kodaly, Forrester, with a read on the U.S. consumer ahead of a key inflation print. From New York City, this is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
In case you missed it, on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Number this morning, what is most important is not only what's happening on the good side, where most of the worries are about inflation, but the fact that ISM services paid for the last several months have started to move higher. Service sector inflation could also be a very important part of the number that comes out here at 8:30.
Torsten Stark of Apollo, just absolutely fantastic, joining us on the program a little bit earlier, anticipating the data point we're all looking forward to. 15 minutes away, inflation data in America. Equities trading water into it, unchanged on the S&P, likewise on the Nasdaq 100. That's the price action. Here are some morning calls. First up, Baird, upgrading Starbucks to outperform, citing confidence in its turnaround strategy. Your second call from JP Morgan, raising its price target on Micron to 185, emphasizing strength in pricing. And your third and final call from Loop Capital, upgrading 5 below to buy, highlighting recent merchandise and pricing changes. That stock is up by 1.6%. Let's stick with the consumer. CPI data just minutes away. Sucharita Kodaly covers retail for Forrester and joins us now for more. Sucharita, welcome to the program. Welcome back, I should say. Let's look ahead to this data point in 14 minutes' time. What's the pass-through that you've gauged so far from the tariffs, which are now fixed in many cases, to the consumer?
Well, we haven't seen the tariff impact significantly on consumer spend yet. The consumer spend levels to date seem to be relatively resilient, although the story is varied depending on the kinds of retailers that you're looking at. It does appear that a lot of shoppers are trading down to value merchants, whether it is the dollar channel or it is the mass merchant channel through stores like Walmart,
or even off-price stores like a TJX. So that's certainly what we seem to be seeing, is more of the psychological impact of what could be tighter wallets that shoppers need to have, versus necessarily that they're seeing any inflationary impact of tariff prices being passed on to shoppers.
Are you gauging a much more limited price tolerance this time around compared to, say, the inflation scare coming out of the pandemic?
Well, I think that there's a lot that remains to be seen. It depends on which categories that are going to be facing those higher numbers, where we've seen a number of inflationary issues where we saw them following the pandemic, was in a lot of very prominent shopper-facing items, primarily whether it was gas prices or it was grocery goods, things that you purchase on a regular basis. And when those are higher, there's sticker shock. What we've seen is a number of those goods be more normalized now. We're actually seeing deflation in categories like apparel, which also are extremely consumer facing. And a lot of the inflation numbers now are in utilities, they are in shelter, in home, and it's in categories that are not necessarily that closely tied to the consumer goods that we saw being the biggest issues post-pandemic.
So, Drita, how long will it take to see the entire impact on the supply chain of the tariff rates?
Well, it's still early it's still very early to tell, because there have already been so many preemptive actions that a number of suppliers and merchants and retailers have done. They've done everything from drastic moves like trying to reconfigure their manufacturing bases, to they've front-loaded a lot of inventory earlier in the year. They may be housing some of that in bonded warehouses, or they're managing some of that merchandise in other ways. So they've offset some of the potential impact in that way. I expect by Q4 or even in early 2026, if these tariffs persist, though that's when we'll see more of the impact. But you also have to remember that a lot of this, the tariffs were a threat to try to get negotiating leverage with these other trading partners of the United States. If these other countries come to the table, we may see a lot of these tariff rulings actually being eliminated. So there's still very much, it's a work in progress and TBD what ultimately happens in 2026.
Fluid situation for sure on the trade front. When it comes to front loading, how much is left in inventory for some of those companies that went out and decided to do this?
Well, from the conversations that I've had with merchants, there is enough to take them through Q3 for certain, and even probably for some of their key goods into Q4. You have to remember that in a number of categories, they're highly seasonal. And for some of their best sellers, they have either negotiated deals that can ensure that those prices are going to go, that will hopefully they will remain stable, and they'll have enough inventory to not run out of stock like we saw issues during the pandemic and following the pandemic. So I think that what we'll ultimately see is hopefully no shortages of major demand goods in Q4, but kind of that's certainly a blanket statement, and there's no doubt that there will be here and there retailers and likely certain product categories that
that we may see some shortages. And that may also create some panic buying for some shoppers in some categories in November.
Sucharita, appreciate your time. Sucharita Kadali there of Forrester. Your question, I think, is a really important one. Tariff management has had a dampening effect on pass-through over the past few months. That could change. This is a process that's going to take time, and this is something that Andrew Honhorst of Citi has pointed out, who believes the Federal Reserve is still going to cut interest rates, by the way, but believes the goods inflation will firm up through fall.
And if your inventory is run out, what does that mean later on in the year, especially as we get closer to the holidays and Christmas? That may become politically challenging for this administration.
Mike McKee is going to join us now with a preview. Mike, welcome back to the program, sir. The data 8 minutes away. What are you looking for in just a moment?
Well, we're looking for a couple of things. Obviously, we are looking to see what tariff-influenced price changes we get. We'll look at apparel, electronics, things that are imported that might already have been tariffed, especially things made with steel, like washing machines. But we're also going to be looking, and Torsten Slock brought this up with you guys, at services prices. There's a feeling that a decline we've seen in airfares is going to reverse, and the same will be true with lodging away from home. And motor vehicle insurance, that could push up the CPI faster than it had been expected to rise. And some people are saying, even some economists are saying in our survey, even a 0.4 rise in the core, which would put us at 3.1% year over year. And that would be something that would certainly get the Fed's attention.
And Mike, in some ways, is this data getting harder to forecast?
It is because of the timing of the tariffs. We know the president has threatened tariffs for a long time. The reciprocal tariffs have just gone on, but we don't know what the pharmaceutical tariffs, the semiconductor tariffs, all the other ones that are hanging out there, we don't know when they would be imposed. And so it's going to be a continuing process, and that'll be part of the debate at the Fed, because, of course, you have someone like Chris Waller saying they're a one-off. And yes, in each category they're a one-off, but if the categories keep getting pushed out, then we'll continuously see some inflation effects as the months go by.
And Mike, I'd love your thoughts on another issue. You mentioned Torsten Slock. Torsten also talked about the BLS and the changes that he's anticipated. He pointed out that ultimately they produce the data that governs both sides of the dual mandate at the Federal Reserve. What's your reaction been to developments not just in the last week, but particularly the last 12 hours?
Well, I think that the new BLS commissioner designate, E.J. Antoni, is going to be a quite controversial pick. He will probably get confirmed because Republicans control the Senate, but Democrats will ask some interesting questions. He's tweeted a lot of his criticisms of the BLS, calling them a random number generator from the magical world of make-believe. He's accused them of having a negative bias towards the administration. He's questioned all of their methodology. It would take a lot to change that methodology, but maybe they're just getting started on that, or maybe this is an effort to put somebody in there who will challenge bad numbers and try to get the public to believe that the numbers are wrong rather than the tariffs and other Trump policies are having an effect.
Michael McKee, thank you, sir. Looking forward to you breaking down the inflation numbers in about 5 minutes' time. Just got to put my hands up and concede that I have also on occasion called it a random number generator, and I'm not alone.
On more than one occasion, you've called it a random number generator. When I saw that, and looking back at some of his old tweets, I thought maybe he's watching surveillance and taking that cue from Jonathan. But that gets to the crux of the issue the president has. Why are these revisions, not just this year, also more than 800,000 revisions last year? This is a concern for a lot of people in the market. They want better data. The issue with this individual is that even in conservative economic circles, he is a controversial pick, as Mike was just saying.
I should say, we often say that because it's prone to large revisions and not because we're accusing the BLS of any particular political bias.
Yeah.
Okay, got that out of the way with. Up next, the CPI report. We'll catch up with Tiffany Wilding of PIMCO, David Kelly of JP Morgan Asset Management. The data, 5 minutes away.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Inflation data 25 seconds away. Your scores going into CPI shaping up as follows on the S&P 500, almost totally unchanged. On the Nasdaq 100, firmer by 0.1%. Some outperformance on the Russell. The small caps up by 0.4. In the bond market, 2-year, 10-year, 30-year bond yield shaping up as follows, unchanged as well. This market has been a snooze all morning anticipating this number. The 10-year at 428.49, the 2-year at 377. With your economic data, here's Mike McKee. Good morning, Mike.
Good morning, John. Let's see what we've got here. A rise in the CPI on a month-over-month basis, bang on with consensus up 0.2%. The core is up 0.3%. We'll check that out in terms of 3 digits. On a year-over-year basis, that takes us to 2.7% for headline and to 3.1% for the core on a year-over-year basis. That's more than thought, so this must have been a very high 0.3%. Trying to take a look at some of what we're seeing in terms of the actual changes in the categories, and we'll look here to see some of the ones that come up when we look at tariffs. The tariffs for, I'm looking for apparel up just 0.1%, so not a big deal there. But used cars up 0.5%. New cars were up were flat basically on the month, so apparently auto companies absorbing some of the tariffs there. In terms of services, rent of primary residence up 0.3, owner's equivalent rent up 0.3 for the 3rd month in a row. Medical care services up 0.8. Motor vehicle insurance only up 0.1. There was a thought that might be higher, but look at airline fares. After being down for 3 months in a row, they're up by 4% on the month. So that's one of the reasons that we are seeing that core rate go up. I'll look at more numbers. Let me just note that food prices were flat on the month. And you guys can check the markets and come back and I'll give you some more of these tariff numbers.
Hey, Mike, thank you. Give me some time to break down the details. Just the early reaction. The first move, not always the right move, but this is what it looks like. Equity futures positive now by 0.4%, trading on the fact that we don't have an upside surprise. That's the good news this morning. On the Nasdaq, higher by 0.5. Then outperformance on the Russell continues. In the bond market, unlocking some lower yields at the front end of the curve, down 5 basis points at 371.84. Not the kind of number, at least for the first slug, that derails the Federal Reserve's efforts to cut interest rates maybe as soon as September. With those moves at the front end of the curve, you look at the FX market, euro-dollar, euro stronger, dollar weaker, euro-dollar back to about 116.36.
Bang in line. So there's no real drama, Jonathan, as you would say, when it comes to this number. But we should note that for the first time in 6 months, the monthly core CPI reading failed to undershoot the median forecast. So you do have this question on whether or not does this mean this is an inflection point going forward that potentially we could see a little bit more of hotter prints.
Mike McKee still with us. That number in line for month-over-month CPI headline, stripping out food and energy, month-over-month in line as well at 0.3 versus a 0.3% estimate. Mike, you've had a second look at the numbers. What do you see now?
Well, gasoline played a big role in holding down the overall number because it was down by 2.2%. It has been up a little bit, but the seasonal adjustment for this time of year takes some of that away. As I mentioned, food prices were flat on the month and used vehicles up 0.5%. So you get a little bit of the tariff impact, a little bit left out of it, and apparel prices up just 0.1% on the month. Still looking to get to the electronics portion of this, which we should see some increases as people buy more stuff from Asia, but I'll get back to you on that one in a second.
Mike, thank you, sir. Tiffany Wildiger-Pimpos is going to join us in the meantime. Tiffany, welcome to the program. Is the store still open for a rate cut in September?
Yeah, I mean, I think the CPI was completely in line with expectations. How we've characterized the sort of tariff-related pass-through, the evidence is that it's happening, but it's happening slower than I think many people expected, going back to April when the more dramatic tariff announcements were first implemented or announced. It's happening more slowly, and across industries, you know, it's more uneven. You know, so I think the broader story here that we're still seeing is that it's very concentrated within goods. It's happening slowly, and outside of that, you know, inflationary pressures look very manageable. So I think for a Federal Reserve, that is a very good sign. You know, in addition to that, there's, I would argue, better news in terms of the so-called second round effects with higher prices leading to higher wages and getting more into the inflationary process. We've actually seen inflation expectations from various surveys start to moderate. The University of Michigan survey, which we'll get later this week, the longer-term inflation expectation index for that one had accelerated more, but it's moderated more recently. So I think all of this points to you know, a central bank that can get on with normalizing policy rates back to neutral.
Tiffany, something we've been exploring throughout the whole of this morning, and to be fair, over the last several months, is whether the tariff story is delayed by the fact that we've seen fantastic inventory management from some of the retailers at the moment, and that maybe we haven't seen the full extent of this. When would you get comfortable that we've seen the limits of it all?
Yeah, I mean, I think, like, you know, we expect a good portion of the pass-through over the next several months, but I think the bottom line is that companies have room. It appears that companies have room as a result of still high margins coming out of the pandemic. Companies have room to sort of more slowly pass this on to consumers. And so what that means is that, you know, goods inflation could be a little bit more persistent over time, but you're not necessarily going to have that bigger surge that many people expected as you get that faster price level adjustment this year. So I think for the Fed, I think that's all good news. You know, the other thing that we see when we look at, you know, a range of data, you know, is that companies so far are absorbing, we think, the lion's share of the additional costs of tariffs. And as I mentioned, they can do it. Their margins were elevated post-pandemic. That has remained the case. And so they do have room here, you know, at least the largest companies have room to sort of manage this process. And we think that's what they're doing. You know, the other thing is the tax legislation that was recently passed, the One Big Beautiful Bill, that is, you know, reducing the effective tax rates for a lot of companies, especially those companies that are capital intensive. They invest a lot. They're getting, you know, upfront expensing tax credits, and that will help offset the impact of the tariffs as well. A lot of those tax credits were retroactive for 2025. So all of that just means that companies do have a little bit of flexibility here and can manage the pass-through rate.
So, Tiffany, are you basically saying that because of the One Big Beautiful Bill, companies are able to eat more of the higher tariffs from this administration?
Yeah, I mean, I certainly think that that's the case. You know, now you know, what we estimate in terms of the tax savings in aggregate for 2025 is around you know, 150 billion. The tariff tax collections that are happening, we annualize at about 350 billion. So the tax legislation is not completely offsetting the additional taxes paid by tariffs, but it certainly is in mitigating some of it. And so that's why, you know, we've argued you'll still see, we think, some pass-through of higher tariffs onto prices. You'll get some price adjustment, but we think the risk here is just that it takes longer than many people are expecting. You know, and the inflationary effects of this in the back half of this year are somewhat less. You know, and again, that just sets the Federal Reserve up to, you know, to continues to restart its cutting cycle to get back ultimately to neutral policy rates.
Tiffany Wilding, PIMCO. Tiffany, thank you. It's got to catch up and get your reaction to the inflation report. The numbers just dropping about 8 minutes ago, in line with expectations. Headline month-over-month CPI coming in at 0.2%. The core number, stripping out food and energy, coming in at 0.3, leaving the door open for a rate reduction at the Federal Reserve. Weighing on yields at the front end of the curve, yields down, unlocking higher equity markets this morning as well, up by 0.5% on the S&P 500. That follows the first look at this data. Let's get a second and third look at this data with Mike and McKee. Mike, I know you've got more.
Yeah, John, we're looking to see what the impact of tariffs is, and it's very mixed. We are seeing tariff impacts in certain areas, but in some of the areas you'd think would be showing some more movement, they are not. One thing that stands out is tomatoes, up 3.3%. Remember, the president put a tariff on Mexican imported tomatoes. Coffee prices, and we've got a tariff on Brazil, up 2.3%. From Asia, household furnishings are up 0.7%, but appliances down 2.2%, including washing machines down 1.8%. They had moved up a lot in the last couple of reports. Video and audio equipment up 0.8%, however, while toys are only up 0.2%. So you get some that are up, some that are not. There are obviously some pass-throughs from overall tariffs, but we're not seeing a major increase in every category, at least not yet.
Mike, do you think the head of the BLS can get a job back now? I'm joking. Don't answer that. Michael, thank you. Michael McKee, thank you very much. David Kelly at JP Morgan Asset Management with us around the table. David, good morning.
Morning.
Not going to ask you that question. Just want to ask you the following. When will you be comfortable that we've seen the limits of this? How many more months of data do you need?
Oh, we're just getting started. I mean, what we saw today was plenty of inflation without tariff effects. We didn't have a big increase in new car prices. We didn't have a big increase in apparel prices. But let's look at where we did see an increase. Airline fares have come down a lot because the airline industry was very weak. But if you look at the recent data on people going through TSA checkpoints, it's firmed up. And so domestic airline travel is now back on a positive year-over-year basis. We've got a lot of fiscal stimulus going to kick into the economy early next year. But also in the tariffs, even in July, we saw a lot of money collected, but it still equates to about a tariff rate of about 8%. We think this whole tariff rate is going to go up to about 14.5% measured by that later. So we've got most of this tariff increase still ahead of us in terms of just affecting the data. And then, people say, oh, the retailer's going to eat it. No, they're not. They just wrote the check. So of course it looks like they're eating it. Walmart writes a check, but eventually they're going to pass it on. And yes, they've got good margins, but how do they manage to sustain these margins? Because they're great at figuring out how to stiff consumers, and that's what they'll do. And so this thing will feed through. It's just a matter of a number of months. And inflation's going up, but it's going up very steadily, and it will be above, we think, about 3.5% in CPI by the end of the year.
You've made two important points here. One is that you believe that goods prices will continue to firm through the year ahead, and that you're not going to see an offset from services. Is that right?
That's correct, because what's going to happen is the economy is going to be slower in the second half of this year as this goods inflation feeds through. But the big kicker here that people are not talking about is the huge rush of income tax refunds that's going to kick in at the start of next year. It's going to be like an extra stimulus check. And that, we've seen what happens. You give him as a cookie, he's going to want a glass of milk. You give an American consumer a stimulus check, they will spend it. And you're going to have a surge of spending in the first half of next year with limited supply because of all these tariff and supply chain disruptions. You're going to get a second round of inflation, which is going to sustain inflation well above 3%, which begs the question of, why again is the Fed cutting?
Well, that was
if inflation's heading the wrong way slowly.
That was my next question to you. What does the Fed do with this kind of data?
They should stay on hold. I think there's very little argument that in favor of the Fed cutting rates. Rates are not abnormally high. I don't know why they think 3% is a neutral rate in the long run. It doesn't equate to history before the pandemic. I think something 4.5% is more of a neutral rate anyway. But there is no urgency about cutting rates. Now, I think they will cut rates for political reasons, which is very unfortunate, but I don't think they should based on these data.
As you're talking, traders are actually adding to bets of September Fed rate cut because this basically came in line when it comes to inflation. But why for political reasons when actually we saw a trend, 3 months of not so great unemployment numbers.
Well, yeah, but if you look at the overall mosaic of employment, it's still growing. And remember, we've got a labor supply problem too. And one of the things that Jay Powell pointed out is he's not looking at payroll growth, he's looking at the unemployment rate. If we've got fewer jobs being created, but we've got fewer workers, then you've still got a certain amount of inflationary pressure. You just said that the growth potential of the economy has gone down. Well, they can't do anything about that. So if you're not, this economy is not going to spark a huge surge in unemployment. And I think the basic point is by the end of the year, we think maybe 4.5% unemployment, we think over 3% inflation. They're missing their inflation target by more than unemployment. Therefore, they shouldn't be cutting.
You're just tallying this up, though, but you believe they will be cutting. So you've got a Federal Reserve cutting interest rates at a time when inflation is picking up, and the key phrase you used was second-round effects. You don't believe this is a one-off. You're actually going to see second-round effects in the first half of 26. Yeah. What's your market view on top of that?
Well, so I think the market view is not too bad, because I think for political reasons, I think unfortunately the Fed will cut twice this year, maybe 3 times next year. They'll get going and cutting. It's not going to really change the economy that much. But if you bring bring short rates down enough, it does push extra liquidity into the equity market. And so you could just maintain these bubbly asset markets. I mean, what we've got is a tortoise of an economy and a hare of a market. And we're just giving more sugar to the hare.
That's the stock story. What about the fixed income story for bonds? Because we've had guest after guest come on this program and say, get ready for a steeper yield curve. They go aggressive. At the front end, you're going to see yields lower. At the long end, you're going to see a questionable development.
Well, it's again, it's hard for a tortoise-like economy to generate a really steep yield curve. So, but I think you could see rates move up a bit. I wouldn't be long duration here, because I don't think this economy is going to go into recession. I think by the time the tariffs really hit, we're going to be on the verge of fiscal stimulus because of this income tax refund thing, and that will keep this economy moving forward. And if the economy is moving forward, you've got inflation printing at 3, you shouldn't really have a long bond lower than 4.2.
What do you think inflation is going to peak at in the next 12 months?
I think CPI is going to peak at about 3.5% and then hang there between 3.5% through about June of next year. And then finally it's going to come down again, because this is sugar. These income tax refunds, it's a sugar rush. It's not protein. It will wear off. And then by the end of next year, then I think the economy is finally cooling again. Unless, of course, you get some more stimulus. And that's really the problem, because if the Fed keeps on cutting rates whenever the other side of Washington asks them to, then it enables more and more rounds of fiscal stimulus to always keep this economy a little bit too hot. So it's called inflammation. Doctors don't like it.
David, it's good to hear from you. I'm not sure if markets will like we've got to say this morning either. David Kelly there of JP Morgan Asset Management. Equities are firmer by 0.5, call it 0.6% on the S&P, and bond yields at the front end of the curve initially reacting to this data lower. They stay lower. We're down by 5 basis points on a 2-year at 3.72. The view in this market is that it's not an upside surprise and we can carry on as normal because the Fed's going to come September.
And they're adding to more bets that September is not just on the table. September almost feels like, for some, a done deal. But when David talks, I'm reminded of what Mohamed El-Arian has said as well, that this market inflation picture is likely going to stay around 3%, and maybe the Fed actually, Mohamed's argument was, needs to start targeting a 3% inflation rate, not 2%.
Outperformance on the small caps this morning, the Russell up by 1.25%. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. We start by recapping the latest economic data. Underlying U.S. inflation accelerated in July to the fastest pace since January amid a pickup in services prices. Core CPI rose 0.3% from June, which came in line with expectations, and rose 3.1% compared to a year ago, above the 3% that economists expected. Meanwhile, President Trump has named E.J. Antony to lead the Bureau of Labor Statistics after firing the previous chief following weak July payrolls data. Antony is chief economist of the conservative Heritage Foundation and has been vocal about his concerns with BLS jobs data and revisions. The position is subject to Senate confirmation. And Elon Musk accused Apple of favoring OpenAI, saying the company makes it impossible for anyone else to reach the top of the App Store charts. Musk said Apple's behavior is an antitrust violation and stated that XAI will take immediate legal action. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. Up next, we'll set you up for the day ahead. Plus, Ira Jersey of Bloomberg Intelligence as traders add to bets for a September rate cut following this morning's CPI data from New York City. You're watching Bloomberg TV.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
CPI was completely in line with expectations. How we've characterized the sort of tariff-related pass-through, the evidence is that it's happening, but it's happening slower than I think many people expected. The broader story here that we're still seeing is that it's very concentrated within goods, it's happening slowly, and outside of that, inflationary pressures look very manageable. So I think for a Federal Reserve, that is a very good sign.
That was Tiffany Wilding of PIMCO. Inflation data out just 21 minutes ago, and equities like what they don't see. They like what they don't see, and what we didn't see was an upside surprise. Equity futures positive by 0.6%. That data unlocking this move in the bond market. At the front end of the curve, yields lower on a 2-year bond yield in America right now. The 2-year Treasury yield at the moment down about 4 or 5 basis points to 3.72. With less than 1 hour to go until the opening bell, let's get you some morning movers. Here's Yahara. Hey, Yahara.
Hi, John. The bar was high for one of the year's hottest IPOs, Circle Internet, and it appears it has cleared it, with shares up 11.5% in the pre-market. That's because investors are focusing on its stronger than expected revenue and shrugging off a bigger than expected loss in the second quarter. We'll see if these gains hold given that weak spot and given, as I said, that expectations are sky high, with this stock up 400% from its $31 IPO price. What a jump. Next up, we move on to another stock also rising, soaring 16% on holdings after delivering a surprisingly strong second quarter and lifting its outlook at a time when these footwear makers are under pressure due to tariffs, because like many others, On produces most of its shoes overseas in places like Vietnam, but it is undeterred, with the CEO saying that consumer energy remains high for its shoes. And we end on Tapestry. Shares are up 1.8%. This is a company that reports on Thursday, and ahead of that, Dana Telsey is raising her price target to $125. What Dana is saying that results will be powered by its Coach handbag unit, which she says is resident $300 to $500, not thousands of dollars the way those luxury handbags are. John?
Yahara, appreciate it. Thank you very much. I wouldn't know. You might know.
Coach is actually cool again.
That's accessible.
It's kind of on trend.
Entry-level luxury?
Yes, definitely.
When did it stop being cool?
It was definitely cool when I was in high school, like, in the mid-2000s, but then it became kind of uncool, and now it's, what's old is new again.
There you go. Helpful stuff. Okay, let's get back to the market and the inflation data. Joining us now is Ira Jersey of Bloomberg Intelligence. Ira, welcome to the program, sir. Your reaction to that data from 23 minutes ago?
Yeah, so more or less as expected, but there was certainly a lot of investors that we had spoken to that were worried that we were going to get a slightly hot inflation print, particularly on the core side of things. So more like a 0.4 instead of a rounded down 0.3 as we received. So I think that's one of the reasons why you have this a little bit of a relief rally in the front end of the yield curve.
We've had two different reactions so far this morning, Ira. One reaction is, this is good news, leaves the door open, the Fed's going to cut in September. Another reaction, David Kelly at JP Morgan said, get ready for firmer goods inflation in the months ahead. This ain't over, this process will continue. What's your reaction, and what would you put more weight on this morning?
Well, I think that the goods inflation story is one that will probably linger for at least the rest of the year, because we don't know exactly who's going to pass through the inflation pressures to the consumer, or will that wind up being more of a margins and producer price story. And I think that that's something that we're going to find out tomorrow, right? Will we see higher goods input prices and intermediate goods in the PPI tomorrow? So again, this is not something that's going to go away in terms of core goods. But in terms of the Fed, I think that there is going to be a little relief, and the Federal Reserve could certainly shift toward thinking about cutting because of the softer jobs data that we got a week and a half ago. So I do think that this leaves the door open. Keep in mind, though, we do get another set of inflation data prior to the next meeting. So we have another CPI, another PPI, plus the July PCE deflator. So we still have a lot of data to get through before we are certain what the Fed's going to do in September.
Ira, thanks for the reaction. I know you've got a busy morning ahead of you. Ira Jersey there of Bloomberg Intelligence. Busy morning ahead of us tomorrow. Here's the lineup. Oksana Aronoff of JP Morgan Asset Management, Libby Cantrell of PIMCO, Subhadra Ishapra of SocGen, and then the Treasury Secretary, Scott Besson.
What's so exciting with the Treasury Secretary coming on is he is leading the search, Jonathan, for who could be the next Fed chair.
Looking forward to that conversation tomorrow morning. From New York City, this was Bloomberg Surveillance.
Day 5 at the Cincinnati Open. World number 1 Aryna Sabalenka had to battle the heat and Emma Raducanu on her way to the 4th round. The defending champion closing it out in the deciding set breaker after over 3 hours on court. 7 aces and 51 winners for Sabalenka in the victory. And don't forget, you can watch all the action live daily on Tennis Channel.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. we're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Inline CPI sends futures flying with 30 minutes to go until the official start of trading. I'm Katie Greifeld.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
And coming up, no surprises here. Consumer prices rise in line with most forecasts. 90 more days. President Trump extends a trade truce with China into early November, but Beijing's new guidance on NVIDIA chips may stir up tension once again, Danny.
And we're so relieved that CPI came in line that even with that story, Katie, NVIDIA is heading higher this morning. Some stocks to watch. China is telling companies, as you said, to avoid NVIDIA's H20 chips, especially for government or national security related work after the U.S. lifted its ban. Meanwhile, President Trump's meeting with Intel CEO Lip-Bu Tan appears to have gone well. Tan scoring more tops with members of Trump's cabinet. Katie, those shares taken off up 3 1/3%.
Yeah, what an interesting couple of days for Intel. We'll continue to follow that story, but it's still earnings season, and Circle reported its first earnings since it went public. Now, it lost money in the second quarter, mainly due to IPO-related charges, but reported a 53% jump in revenue. That's being rewarded with an 11% gain pre-market. Danny, this stock up more than 400% since it went public.
100%. Just a slight rally there. Katie, let's get back to one of our top stories and the data this morning, where underlying U.S. inflation accelerated in July to the strongest pace since the start of the year. Let's break down that data with Michael McKee, Bloomberg's international economics and policy correspondent. Mike, what did we get?
Well, we got a few surprises underneath the hood, but no surprise in, well, except for core year over year in the headline numbers, because as you mentioned, we got a 0.3% gain and not anything that's going to concern anybody on the headline. A lot of that was gasoline, the 0.2 gain there. Gasoline was down 2.2%. Core up 0.3%, but it was a strong 0.3. Services prices were up by 0.4, so it pushes the headline core to 3.1%. The Fed is going to be watching that certainly into September. We'll see what we get when we get the August numbers for this. Goods and services both rising. Service prices kind of making people a little bit nervous. They were up, as I mentioned, 0.4%, and they're up by about 0.3, a little more than 0.3 for the year-over-year number. Goods prices rising again as well. You can see the little white lines there on the right side of the graph showing that goods prices are now rising. But the real question is what moved, and did tariffs have an effect? And they sort of did. Take a look at what was in the numbers. Airline fares were up 4% in total, and the gasoline prices I mentioned down 2.2%. But tomatoes, President put a tariff on Mexican tomatoes, so tomatoes up 3.3%. Appliances last month were up big because of the tariffs on steel, but this time they're down 0.2%. We buy a lot of furniture from Asia. Furniture and other household furnishings up 0.7%. So we are seeing some tariff impacts. Katie, I know you're worried about coffee. 2.3% rise. Tariffs on Brazil.
There you go. There you have it. I am curious, Mike, when you parse the different sectors trying to find the impact of tariffs, how much is that pull forward effect sort of distorting things here? Because we saw that across industries at the start of this year.
It's starting to fade some because companies have now used up their inventories. So we're just on the cusp of what's going to happen. We're going to have to watch this for a few more months because, as I say, the inventories have been worn down now, and companies will have to pay whatever they're going to have to pay for replacements. And at the same time, we're just getting the tariffs imposed in many areas, and there are more to come. So the question is going to be, how fast do they come, the pharmaceuticals, the semiconductors, and everything else, and how fast did that show up in the data?
All right, a lot to look forward to. Then that is Bloomberg's Mike McKee breaking down that economic inflation data that we got at 8:30 a.m. Clearly, the market likes it. Futures really extending their rally after we saw those numbers hit. Let's talk about trade, though, because President Trump extended a pause of higher tariffs on Chinese goods for another 90 days, taking us into early November. Here to explain is Bloomberg's global trade editor, Brendan Murray. So 90 days pause from the U.S. China said in a similar statement that it would extend its own suspension as well. What's going to happen between now and early November?
Well, the two sides are going to continue talking and trying to maintain the stability that they've managed to achieve so far. We're going to see most likely a regular series of discussions, the way Scott Bessent has led the U.S. delegation in talks with his Chinese counterparts, most recently in Stockholm. So they've gotten to a place where they believe that things have stabilized and they can start making progress toward ultimately what President Trump wants is a big trade deal and a summit with President Xi. And we're many months from that, but where we've now got some sort of process set up to accomplish what the U.S. hopes to accomplish. Of course, China is playing a much stronger hand this time around than they played in Trump's first term, and they have control over critical minerals. And they most recently have indicated that they don't really need these U.S. Semiconductors that the Trump administration has signed off on the exports of. So it's a changed dynamic, but one that at least investors for the time being can breathe a bit of sigh of relief to say for the next 3 months at least, it looks like things are going to be kind of in some sort of ceasefire when it comes to tariffs.
To that point, Brendan, of China having a strong hand, prior trade deals that the U.S. reached with other nations, it was the U.S. that came in with a strong hand, and other countries basically bowing down to what America had asked of them. What does that mean about this timeline for China, and how long it will actually take to not just kick the can, but get a deal done if China does have that strong hand?
Well, it's just, I think it changes the dynamic, really. The President Trump tweeted just 36 hours ago or so about wouldn't it be great if China bought more soybeans? And, you know, these are kind of like 2019 things, and China is now has got a much more sophisticated and complicated negotiating tactic with President Trump, rather than just, you know, we'll buy some more soybeans and other agricultural goods to appease the White House. So these other countries, Japan, South Korea, and the European Union still don't have their executive orders, so they don't really have in writing what they've agreed to in a handshake so far. Those will still have to come, and as Mike McKee suggested, you know, these tariffs are still kind of rolling in, and they only really kicked in at a higher rate 5 days ago. So the dynamics and how they play out into the economy are really only getting started.
Brendan, thank you very much for your coverage this morning. That is Bloomberg's Brendan Murray. Now let's stay with China. Beijing is urging local companies to avoid using NVIDIA's H20 chips. The guidance is not an outright ban, rather a discouragement, particularly for government-related purposes. However, the information out with their own report this morning saying that China has demanded companies to halt NVIDIA chip orders over security concerns. You're seeing NVIDIA raise some of its gains pre-market on that report. Joining us for more is Bloomberg Tech co-host Ed Ludlow. Ed, we don't have this information match at the moment, but from what we do understand with how China is approaching NVIDIA and other high processors, just how big of a hit are they taking, even if the U.S. is allowing them to sell chips into China?
Well, there's an issue of chronology because, as Bloomberg reported, notices were sent by Chinese authorities in recent weeks, which would predate the news of 24 hours ago when the president confirmed he had reached a deal for revenue sharing 15% with NVIDIA for the H20 going to China. This is quite normal behavior across Chinese authorities and the internet watchdogs in particular to say to government entities and state-backed enterprises, do not use foreign technology if there is a security concern. The issue that the street's going to be looking at this morning is probably a little bit of rethink and remodeling on how the most bullish forecasts look of NVIDIA starting to book revenue again from China. A lot of the analyst community look at this and then the 90-day extension and see it as a negotiating tactic from China, either because they want access to the higher performance chips that NVIDIA is not allowed to send to China based on current US rules, or the opposite. They're trying to protect their domestic champions that are increasingly gaining ground in this space. Huawei has chips that are better than the H20. But I would note that, you know, there has been a move lower since that information report. The initial pre-market spike was very much in line with CPI. So there's some noise there in the market.
So you can see NVIDIA shares pretty much unchanged now on the morning. Traders deciding what to do with these reports. And I do want to move on and talk a little bit about Intel here. I think if you look at the 5-day chart of Intel, it's really amazing. You can see when exactly President Trump took aim at Lip-Bu-Tan, and you can see, of course, the reaction now that they seem to be back in good graces after Lip-Bu-Tan visited the White House yesterday. It really speaks to how much Intel needs to curry favor with this administration, how much they're relying basically on having a good relationship with President Trump.
Yeah, last Thursday on Truth Social, President Trump called for Lip-Bu-Tan to resign because of historic ties to China. Those ties, by the way, are well documented in the technology industry. It's been known about for a long time. And Intel's board of directors knew about them as well when they appointed him CEO. The thing is that on paper, what Intel wants to achieve as an American company that's trying to grow its manufacturing footprint in this country, it's highly analogous with the AI strategy of the administration. That is what they are focused on. Things that are tangible, can be invested in and built quickly. And, you know, the reporting is that he will continue to meet with other cabinet members. Intel has just not been there in the race. You know, they have not been put at that level that NVIDIA or even AMD have from how the president communicates to champion those companies in leading America's AI efforts.
Yeah, absolutely. That has been the narrative dogging Intel for well over a year now. Ed, I know you'll have much more on Bloomberg Tech. That is at 11 a.m. That is Bloomberg Tech co-host Ed Ludlow. Meanwhile, let's get back to these broader equity markets in reaction to that CPI data that we got at 8:30 this morning. Coming in as expected, Danny, and you can see how that is being greeted by the bulls right now. The S&P 500 higher by about 0.4%. Similar story when you take a look at the NASDAQ 100, and that two-year yield falling as people recalibrate their Fed bets.
It was definitely a bond market that was prepared for an uglier and a hotter number. So in line is good enough, perhaps going forward. The worry is that services inflation didn't come in as much as expected, and that's supposed to offset any goods inflation coming from tariffs. So one, maybe flying the ointment that might cap some of the rally from here.
Absolutely, but at least for right now, folks seem pretty happy. Better than feared, as you said.
Definitely. Well, coming up, we're going to talk earnings. Circle extending gains, even though it reported a loss in its first earnings since the IPO. We're going to have details for you next on Bloomberg Open Interest.
In case you missed it, on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
In case you missed it on the close.
with regards to the electric vehicle business. When we talk about the commitment to new models and, more importantly, commitment to the infrastructure to support that, what's the plan?
We're starting to see different kinds of hybrids that customers are excited about. E-revs, which go about 100 miles, all electric, but then you could take a 700-mile trip once in a while. Those look really promising for a three-row crossover like Explorer. We're going very low end, super affordable EVs for urban duty cycles and for commercial. We're not going to invest in a lot of the very expensive crossovers for pure EV. We think that's going to be a hybrid business.
What does the supply chain look like specifically for the EV and hybrid business right now?
We've moved out our cycle plans. We've focused on affordable and commercial. We're fortunate we moved 3 or 4 years ago, and we could tilt to hybrid and a specific kind of EV. And the supply chain has been able to move with us so far.
Don't miss The Close, live every weekday.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Let's get you some high interest stories, a look at what's making headlines around the world. Shares of Hanes brand, they are jumping in the pre-market, up 37.5%. A report that Gildan is closing in on a $5 billion deal to buy the underwear maker. The FT reporting that the deal may be agreed to by the end of the week. Negotiations, though, they are not yet final. Sinclair shares, those are also jumping this morning, up just under 19.5%. It launched a strategic review of its broadcast business. It announced that it's considering also a separation of its ventures unit. On Holding, that's also rallying this morning, up nearly 17%. It raised its full-year outlook. The Roger Federer-backed company reported better than expected earnings, had strong demand, and sees revenue growing more than 30% on a constant currency basis this financial year. Katie, I should admit my bias. I have 2 pairs of On Holding, so yeah, you're welcome, On.
They're hot. They're trendy. I'm more of a hoka gal, but we can get into that.
House divided.
There you go. We'll get into that in the commercial break. Let's talk a little bit about Circle shares. They're surging despite posting a one-time quarterly loss. Traders optimistic after revenue jumped more than 50% in its first earnings report since it went public. Remember, it IPO'd at $31 a share on June 4th. That certainly feels like a long time ago. Bloomberg's Bailey Lipschutz joins us now. So, okay, they had that one-time loss. It was revenue rising 53% that has traders psyched this morning.
That and the fact that there's still that scarcity value. This is still one of the better performing new companies, up about 6x from where it priced at its IPO. Katie, and beating expectations really kind of on the top and bottom line. The big question, though, is the fundamentals of the business, and we were talking about that. This is a company that benefits from shorter dated treasuries. That's where they're holding their cash, and is basically, if we do see 3 rate cuts, as investors are increasingly betting on, that could dent kind of their outlook, but the big question is, what does that mean for crypto?
I think it's fascinating, and this is really where TradFi and whatever this is really intersect. The fact that it does hold a ton of those short-term bills, as you say. So if that's the case, you get these earnings on the same day that you get CPI that people are looking to as really cementing in the idea that we're going to get a September rate cut, really not affecting the stock at all, up 14%.
No, not at all. And the one thing that we did talk to a few analysts about before earnings was this debate. If we do see the Fed cut 3 times, what does that mean for a company like Circle? And if you want to take the bullish view on the entire crypto space, well, maybe there's more leverage. Maybe there's more demand for crypto assets. Maybe there's more demand for DeFi assets, and that could actually benefit Circle. But again, that is kind of bulls talking their book to an extent.
And should say the Circle CEO is going to be on BTech at 11:30, so one to watch out for. Bailey, another hot IPO that we're going to get the earnings for is CoreWeave. How high is the bar after we heard from all the hyperscalers and the amount of spending they're doing on AI?
I think it's quite high. This is a stock that's up about 250%. We are seeing it under a bit of pressure this morning, so this is going to be a closely watched report. The big question, especially with some of these newer companies in these hot spaces like AI and computing, is what does management say on the earnings call? How do they address some of the tougher questions? Because this is a stock that's hotly debated, not only by the buy side, but by the sell side. 16 holds, 5 buys, and 3 sells. Average price target implies a 16% sell-off. So there's a lot of debate around if this company deserves its current multiple and where it's trading at. And one thing to also keep an eye on, as analysts have called out, lockup is expiring later this week. So that's going to open up about 80% of shares available for trading. That's going to be key.
Yeah, that's interesting that we're getting this report on a Tuesday afternoon. As you mentioned, the lockup expires on Thursday. How does that usually go? What does it usually look like when we see that lockup ending?
It can get choppy. The big thing with a number of these companies, this is a hedge fund hotel, if you will, as some of the skeptics put when they were going public. The big thing is a lot of the long-term investors, as bankers and investors will say, need to play fair. You don't want to see a rush to the exits. That only hurts each other. So the big thing is going to be, do we see some slow selling? What does that actually look like? We will likely see some filings on Friday if we are seeing investors going towards the exit. So it can increase volatility. But again, you have a hot stock in a hot area with a lockup expiring.
Maybe
Fireworks.
take some profit?
Exactly.
I was going to say, they're sitting on some pretty paper profits, so maybe they want to make that real. Bailey, thank you so much for joining us. That is Bailey Lipschultz. Coming up on the show, Nuveen's Chief Investment Officer, Sarah Malik, on the CPI print and potential frothiness in markets. Stay with us for that conversation. This is Bloomberg Open Interest.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Up-to-the-minute news whenever and wherever it happens. I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
The bulls will say there is further room to go in terms of positioning. However, there is also some substance to embolden the bear narrative, and in particular the fact that the average FMS cash level remains at a low 3.9%, which historically has been a strong signal to say that global risk assets are toppy, as now is a good time to retreat or hedge your position.
That was Bank of America's Elias Gallo following their survey showing that a record number of investors see stocks as overvalued. Nuveen's CIO and head of equities and fixed income, Sarah Malik, joins us now to discuss. And Sarah, I would love to hear you weigh in on this debate because, yes, okay, U.S. stocks look expensive, but then you compare that to what we're seeing in the economy, what we're seeing in underlying corporate America right now, and there's a real debate to be had.
What you think of U.S. stocks depends on two factors, and that's technology and also earnings growth. So let's start with the latter. Earnings growth is very strong for the second quarter. We came into this quarter expecting almost 5% earnings growth from consensus. We're going to end the quarter at about over 10% earnings growth year over year. That's positive for the U.S. economy. And secondarily, it's been led by technology stocks and that continued investment in artificial intelligence. And if you're bullish on tech and their earnings growth, tech earnings has accounted for almost 2/3 of earnings in the recent history. We are bullish on technology and the continued spending in artificial intelligence. So I think that is supportive for a stock market, which I agree is trading at a worrying premium.
Sarah, there has long been this expectation that tech dominance, and especially advancements in AI, would at some point mean a broadening out of the rally as other companies adopt tech. When, and if ever, does that play out?
We've certainly not seen the broadening of the rally to small caps or even cyclicals at this point. And I agree, you would expect to see that start to play out given the strength of the economy. But as I said, earnings have really been driven by tech stocks. So we've not seen the earnings growth to support these companies. And with the economy showing some signs of slowing, with employment missing numbers last month, that again bodes well for technology stocks, which have their own structural growth drivers. So that is a challenge where you're seeing this continued imbalance where technology is leading the way and just about everything else is getting left behind.
Well, I think it's the 5th time that I've mentioned this stat from Goldman, but I think it really encapsulates what we're seeing and what you're saying, that you think about the second quarter, you had the Magnificent Seven grow their earnings by 26%. That number was just 4% for the rest of the S&P 500. Sarah, what is it going to take to finally see earnings broaden out in a consistent way? Is it rate cuts? Is it something else?
Aggressive rate cuts. Now, given the CPI number today, odds are on the table for a rate cut in September, but whether we get 25 or 50 basis points, the question after that will be, where do we go from here? So are we going to get aggressive rate cuts that stimulate this economy even further from a manufacturing and cyclical point of view? I think that's unclear. Now, the good news for cyclicals, though, is manufacturing is coming back to the United States. One positive call we've had outside of tech is infrastructure. Not only is that a play on a resumption of more manufacturing in the U.S., but it's also a derivative tech play with AI data centers and the need for building those in the U.S. So you can find areas outside of tech that sort of are on both sides, a play on a stronger economy and also a play on artificial intelligence, and that's infrastructure.
Sarah, literally just a minute here, but for those who've said that this market is too concentrated, that it's starting to look like a bubble, what would you say to that?
Well, I've been in the industry for 30 years, and technology has made this market look concentrated for almost a decade now. So I would be careful of just trading in and out of the markets based on valuation, because that can be very painful. I was a small cap growth portfolio manager in the late 90s, so I lived through that period where markets and tech looked expensive. What they have going this time that they didn't have in the late 90s is that earnings growth. In the late 90s, we had a lot of companies out there that were public that were unprofitable. If you look at the tech leaders today, that's Microsoft, NVIDIA, Broadcom. These companies have very strong sales and earnings growth. And so I think that is what is different this time around.
It's an important point. We're talking about big, mature companies, Sarah. We're just getting started. You're sticking with us through the opening bell, which is up next. Don't go anywhere. This is Open Interest, and you can see it's setting up to be a green open. This is Bloomberg.
is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
All right, we are moments away from the official start of the cash trade on this Tuesday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. We have green on the screen behind me. An interesting setup, too, after we got those inflation figures at 8:30 a.m. for the month of July, coming in line with estimates, maybe a hair higher when it comes to annualized core, but no one seems to be worried about that at this moment. The S&P 500 rising in the pre-market. It's actually the small caps that are outperforming today as you see those treasury yields come down, especially at the front end. Traders saying that September looks like a lot for a Fed rate cut. You can see the bells ringing behind me as we officially welcome in the start of trade today. And there are some things to keep an eye on under the surface. One of them is China telling companies to avoid NVIDIA's H20 chips, especially for government or national security related work. That's after the U.S. lifted its ban. Meanwhile, you have President Trump's meeting with Intel CEO Lip-Bu Tan appearing to have gone well, with Tan scoring talks with more members of Trump's cabinet. And you can see that those shares are rising right now. NVIDIA maybe a little bit less.
I've got to look for you, Katie, on those. Maybe the reason NVIDIA is rising less, indeed it was in the red in the pre-market, was the fact that we had this report from the information that China was outright asking companies to stop importing them. You mentioned Intel up 2%. Katie, let's also get a look at Circle this morning because it reported its first earnings since going public. It lost money in the second quarter. That was mainly due to IPO-related charges, but it reported a 53% jump in revenue. And Katie, those shares are up nearly, just under, I should say, 14%.
And we're back now with Nuveen's CIO and head of equities and fixed income, Sarah Malik. So a really interesting setup here. Sarah, I want to go back to that trade discussion because you do have China and the U.S. extending that 90-day pause. At the same time, you do have those issues percolating under the surface when it comes to NVIDIA's chips in particular. We think about the discussions of trade talks across the world, it feels like, but how important specifically is that U.S.-China relationship and making sure that it stays open?
U.S.-China relationship is crucial, I think, in terms of trade talks, and that, I think, has always been one of the main areas of focus for this administration. Part of this NVIDIA is negotiations that will be ongoing. I think a bit of relief for the markets that we get a 90-day delay here. But overall, what we see in terms of tariffs is up to about 15% tariffs across the board outside of the U.S. And if you calculate those numbers in terms of how they affect GDP and inflation, they should be a drag on GDP of about 1.5% or so, and a bump to inflation perhaps of 1% over time. Of course, we are not seeing that show up dramatically in the inflation numbers yet. That would get you quite close to a recession. So it'll be interesting to see how this plays out over time with the impact of tariffs.
To your point, Sarah, they're not showing up in the inflation numbers yet. It's worth just taking stock of where we are in the market because some of the gains in Treasury petered out. Indeed, only the 2-year yield is gaining, but now less than 2 basis points. Sarah, part of the data we got this morning was services inflation that continued to look hotter than expected. It was supposed to be services coming down to offset some of the core goods inflation rather. Does that give you pause if other elements, non-tariff related elements, look more stubborn?
Short-term good news for the markets is investors expected CPI to come in today hotter than expected. So that's the positive and why markets are looking to open up. Now, the shift, exactly as you pointed out, from goods to services is the issue. In the past, we saw some pickup in goods inflation last month with toys stronger than expected, sporting goods being strong. Services had not seen a pickup in inflation. Now, today, of course, what we see is that inflation creeping over and spilling over from goods into services. And that is an issue for the consumer in terms of, is the consumer now starting to make tougher choices because of the impact of tariffs? We'll see how that plays out from here. Of course, as you noted earlier, on holdings, it's not spilling over to athletic shoes at this point because that number was very strong from them. But I think consumers are making tougher choices when it comes to experiences, how much they're going to pay for airfares and hotel rates going forward.
Absolutely. I mean, that seems to be the anecdotal evidence that's out there. Not seeing it in the numbers yet, but that could change in the months to come. Let's talk a little bit more explicitly about what's going on in the bond market, because you see a reaction to these numbers. The 2-year yield down about 2 basis points or so. You take a look at what the 10-year yield is doing. It's been percolating in a really interesting range over the past few weeks. It had felt like we were glued to 4.5%. That seems to have reset a little bit lower. Now we're hanging out between 4.20 and 4.30 on your benchmark. Where do you think we go over the course of 2025?
10-year yields likely remain about range bound. We've come a long way from where we were when we saw the spikes during Liberation Day 1.0. But bond markets have been calmer about inflation and the outlook for the U.S. economy going forward. We see an incremental slowing for the economy. We started to see that with payrolls last month, which came in at 73,000. And the Fed rate cut for September, whether we get 0, 25, or 50, we're in the camp of 25 with upside to maybe a 50 basis point rate cut. That would depend on how do non-farm payrolls look for August. Do they come in again sub 100,000, and are they disappointing? How does the next CPI number look? The Fed has stated that they would look at inflation related to tariffs as a one-time bump. So I think that's what the bond market is counting on. Now, looking within fixed income, there's an area that we like, which is preferred securities. And you're talking about what do we like outside of technology? Preferred securities and fixed income are backed by the strong fundamentals of U.S. banks, which are in good shape. So areas like preferred securities and also municipal bonds, where fundamentals are also strong, are attractive areas within that segment.
Sarah, even though there's attractiveness in bonds, to your point, we saw a whole host of weak auctions across the curve last week. How much of that is due just to lower yields, less attractive following the payrolls report, versus some really serious challenges for the bond market around things like Fed independence and a growing deficit?
Those are issues that have been bubbling up. The growing deficit has been something that investors have been thinking about for quite a while. High interest rates, of course, even more problematic for the deficit. So I see that as a structural medium-term to longer-term issue that the U.S. needs to think about and how to deal with it. In terms of looking at the Fed independence, there's been some volatility around that for equities as well as for bonds. I think the Fed will stay independent, and we'll soon find out what's going on with the next Fed chair nomination. So those are issues for the bond market, but I think generally U.S. safe haven status remains intact now that we've gotten our arms around what's going on with tariffs, and the economy is slowly decelerating, but not at a rate where a recession is imminent. Those are all positives for the bond market, and why we've seen Treasury yields move to a more stable base versus what we saw in April.
Well, to your point on figuring out who the next Fed chair is, it just feels like that potential list continues to get longer. We heard from Jim Bullard on CNBC this morning saying that I'll accept Fed chair job if we accept Fed independence. So a lot of question marks there. But Sarah, before we let you go, I do want to ask, What is your preferred haven in this market? We're talking about the bond market. It feels like treasuries in particular have been a bit of an unreliable hedge. I don't know if gold near record highs is trading as that hedge, or whether you see somewhere else as your preferred form of protection here.
I like areas which have their own structural growth drivers that can remain resilient in any kind of environment, including a recession. So I talked about infrastructure earlier. Infrastructure not only has the positive of manufacturing coming back home, but the components of infrastructure tend to be utilities and waste management. We still turn on our lights and take out our garbage during a recession, so it tends to be more resilient, and it has that growth upside from artificial intelligence and data center growth. Second area we like is an income providing area within equities, dividend growers. These companies tend to increase their dividend over time, so they have very strong cash flows and balance sheets. Again, more resilient on the downside, but also able historically to capture much of the upside of markets.
All right, Sarah, great to spend some time with you this morning. That is Sarah Malik of Nuveen. Meanwhile, let's get a check on the stock market right now. You're just about 8 minutes into the Tuesday trade, and you can see we have some pretty good breadth on this rally. The S&P 500 higher by about 0.6%. You have more than 400 names in the green right now, and you can see it's Meta, Microsoft leading the way higher. Apple and Alphabet, Amazon also putting up a fight as well. That is leading to some pretty sizable gains when it comes to your benchmark following CPI. But on the downside, this is what you need to keep an eye on. Cardinal Health is up there at the top, reporting pretty poor earnings, or at least not being received well by the market. NVIDIA, you can see trading places here. It's switching around, but NVIDIA erasing its gains. And we did have the information report that China told companies to halt their orders of NVIDIA's chips. That seems to be affecting NVIDIA's sentiment. But let's take a look at the sector level, because as of right now, you have a perfect score, 11 out of 11 in the green. Communication services and financials up top. Your relative underperformers today, energy, consumer staples, and utilities. But Danny, overall, this is a very risk-on market.
It is, despite the fact that bond yields have given up some of their gains, or rather we're looking at a long end that's now pushing higher and only a front end that's coming lower. It is the continued optimism of the equity market versus pessimism of the bond market. Speaking of some of that pessimism, you mentioned it, Katie. Coming up, we're going to discuss China urging companies to avoid NVIDIA's H20 processors. How much does that complicate Trump's AI chip deal? We're going to have more on that story coming up next on Bloomberg Open Interest.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Victor, Idaho, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back to Open Interest. A quick check on this rally extending right now. The S&P 500 higher by about 0.7%. There's a lot going on with tech, with the chips, which we'll talk about in just a moment. You can see the Nasdaq 100 also rising by about 0.7%. It's the small caps that are stealing the show right now. The Russell 2000 outperforming. It does help that you have yields declining a bit in the wake of CPI, but as Danny pointed out, those gains are starting to dissipate a little bit in the bond market, so we'll see if small caps can hold on to this win. But it's time now for our top calls. Some of the analysts' action in focus this morning. And first up, Baird upgrading Starbucks to outperform, expecting that new leadership will effectively drive its turnaround strategy. Starbucks shares up about 2.5%. Next up, you have Piper Sandler upgrading Chipotle to overweight, seeing limited downside after falling 25% over the past month alone. And finally, you have Argus downgrading Union Pacific to hold. The analysts anticipating export challenges due to tariffs. Shares pretty much unchanged, maybe a little bit higher, Danny.
Well, speaking of tariffs and trade, Katie, back to one of our top stories this morning, and it is around tech, with China urging local companies to avoid using NVIDIA's H20 chips. Now, that guidance, it is not a ban, but a discouragement, particularly for government-related purposes. Joining us now is Bloomberg Tech co-host Caroline Hyde. And Caroline, it seems the information adding to some reporting here, but what do we understand about the current state of China and allowing their companies to order these chips?
Well, exactly the risk that Jensen Huang, the CEO of NVIDIA, has been trying to tell the market time and time again, trying to tell the government time and time again. If you limit our ability to sell our high-performance chips into China, and indeed if you curtail the performance of the chips, of course they've asked them again and again to make them less and less useful and powerful, so that's why you've got the H20, which Trump himself calls obsolete. If you do that, you will spark innovation in China, and they will outcompete us. They will start to lean in on Huawei's Ascend Accelerator program. You will start to see the ByteDances and some of the other key giants, the Tencents, the Alibabas, go to local domestic production rather than NVIDIA and AMD. And here we have it. We are reporting that already we look like the government is leaning on these big tech giants to try and perhaps pull back from their dependency, particularly around government-related use cases. But the information is also going a step further, saying it's not just leaning and saying and nudging, it's actually demanding that these big tech giants don't buy the H20. This is, of course, exactly what had been perhaps thought through by some of the leaders in chip makers here in the US.
Well, you touched on what I've been wondering about, because we've been talking about the US government's perspective, we've been talking about China's perspective, but this must be enormously frustrating for CEO Jensen Huang. I mean, you think just about the money that he's losing by not having access to the Chinese market, but then that existential fear that you bring up that maybe they're going to get left behind, that you're going to see some of their Chinese competitors really step up their game.
And look, this is the paradox, and probably one that the US government, of course, had thought through. If we keep making these CEOs, Lisa Su and Jensen Huang, play a game of ping pong instead of focusing in on innovation and in sales, when probably you're going to spark an issue here. And of course, that's exactly what's happened. They are losing a ton of money. Now, we understand, of course, we estimate, Bloomberg estimates about $7 billion worth of H20 chips go from NVIDIA per quarter to China. And of course, that's a nice little earner if you're able to make 15% cut on that. But in so doing, you're hearing that the Chinese pushback is there, that they don't want $7 billion worth. And in fact, they want every company to be trying to avoid these sorts of business deals with US giants. They don't want it in their overall tech stack. And also, there have been some fears they've been articulating. They worry about security, efficiency. And meanwhile, all of this has been going on. Huawei has been busy trying to innovate, getting money from the Chinese government, a special tech fund. There is a lot of concentration going on China to try and outcompete. And here lies the paradox. Yes, you try and curtail, you're going to have an issue.
One of the interesting things, though, is Jensen Huang had made a concerted effort to appeal to the Chinese. On Trump's inauguration, he wasn't at the White House, he was in China. So we see this effort from tech CEOs to try to play politics.
Yeah.
Karen, we have to talk about what happened with Lip Bhutan of the Intel CEO yesterday. It seems that Trump has had a bit of a 180 after meeting with the Intel executive.
And that's always what everyone prepares themselves with President Trump. And indeed, Lip Bhutan has done what was necessary in terms of actually deciding to go to the White House, and what he declared would be trying to restate misinformation in the market about his relationship with Cadence, where he used to be the CEO, and what had been done with Chinese institutions, and indeed how some of his own investments that he's made with his venture firm into Chinese stars in the chip sector. SMIC, he was actually on the board of that company. All of this was known, but it suddenly sparked worry amongst lawmakers, and again from the administration itself, where they called for his own ouster, for him to remove himself. He's managed to persuade President Trump, with some warm tones coming from President Trump, saying what a success story he's had as someone who has come as an immigrant from Malaysia, built himself as a US citizen, and managed to become the CEO of an incredibly integral company. Now he has to go back next week, talk with cabinet members, we understand, for President Trump. What then of the innovation that's going to happen here in the United States thanks to Intel? What then of manufacturing? What then of some of the access to $8.5 billion of the CHIPS Act money?
Looking forward to see how those conversations shape up. Of course, Intel, an American icon, but definitely feels like it's been on the decline. That is Bloomberg Tech co-host Caroline Hyde. Now, we do have some breaking news. That is President Trump saying that he is considering suing Fed Chair Jerome Powell over his handling of reconstruction of the Federal Reserve's buildings. Michael McKee, he is Bloomberg's international economics and policy correspondent. He joins us now. Specifically, Mike, he says that he is considering allowing a major lawsuit against Powell to proceed because of the horrible and grossly incompetent job he has done in managing the construction of those buildings. What do we know so far?
We don't know anything. This seems to be another effort by the president to flood the zone, as they say, just come up with all kinds of distractions to keep people not thinking about some of the other things they don't like about his administration. There wouldn't seem to be any way to sue Jay Powell for this. First of all, you'd have to have somebody who could have standing. In other words, somebody who could claim they were harmed by whatever the Fed chairman did or did not do. And then it would have to be proven that Jay Powell did something wrong. The fact that a building is over budget, I think any of us who have had home repairs done know about things going over budget when you're doing construction. So I don't think there's really going to be any lawsuit. Remember that his whole MO is threaten to sue or sue people, and he loses almost all those cases, but settles them or something. It's just what he does to try to intimidate people. I find this tweet interesting, though, because not only is he insulting Jay Powell by going back to the too late thing, he's now insulting Steve Mnuchin, his Treasury Secretary, in his first term, calling him Maniuchin, something like that. I don't know how he pronounces it, and I don't know what that's supposed to mean.
I think that might be an attempt at a phonetic spelling at Mnuchin. That is literally my only guess. But to your point, Mike, he's criticizing his former Treasury Secretary for picking Powell. It seems like his current Treasury Secretary right now is leading the search for who will replace Powell. How is that search shaping up? And I mean, you got to look at this, Mike, and say, is he maybe taking a second thought about letting someone else lead the search for who becomes the next Fed chair?
No, I think this is very typical Trump. It's not my fault. I didn't have anything to do with this Fed chair. It's Steve Mnuchin's fault. Now, the interesting thing is 2 years from now, whoever is Fed chair, we'll see if he likes that Fed chair or if he blames Scott Bessent. And what nickname will he give Scott Bessent?
I think it's Scotty B, right?
Well, now because he likes him.
Right, if it turns negative, Scotty F,
if it turns
maybe,
negative.
I don't know.
I mean, the bottom line is he says Powell needs to lower the rate now. Obviously, the Fed chair can't lower the rate by himself, and there's no Fed meeting until September 17th. So it's, in that sense, it's kind of meaningless.
Fair enough. All right, Mike, thanks for keeping us up to date on that. That is Bloomberg's Michael McKee. For what it's worth, 30-year yields at highs of the session up just over 3 basis points. You are watching Bloomberg Open Interest.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Welcome back to Open Interest. Let's take a check at this market right now. The S&P 500 still higher, but gains actually coming in a little bit after we heard from President Trump that he's considering allowing a major lawsuit against Fed Chair Jerome Powell. The Nasdaq 100 also coming in up about 0.3%. It's still the Russell 2000 that is leading the way. We'll have to see how that develops. Let's take a look at some of the individual gainers right now. You do have some good news in the form of Meta. You have Circle higher as well. They reported earnings. Those were well received. NVIDIA has been sort of treading water here. It's now a little bit lower, of course. It is firmly in the crosshairs of U.S. and China trade negotiations. Hims & Hers Health down about 4%, and then Celanese Corp down 21%, Danny.
Some other movers that we are watching this morning, Katie, worth pointing out pot stocks, if we can get a look at those, because why not? Trump saying yesterday that he might consider reclassifying marijuana, putting it at a lower schedule. You can see Tilray there up 13%. This market acting like the federal government's going to legalize it should, again, just worth note, it will still be illegal. It will just be at a lower classification of illegal.
Just like a little bit less illegal. What
Right.
I find interesting is that, I mean, people have been getting behind pot stocks for a while now. There's been a lot of false dawns here when it comes to how they'll be treated legally. But if you take a look at where the money is going, ETF that I like to watch, ticker MSOS, this is the Advisor Shares Pure U.S. Cannabis ETF, not really seeing a ton of inflows. It took in almost $20 million yesterday, but in ETF land, that's pretty much a drop in the bucket. So investors, still a lot of skepticism here, I think it's safe to say.
Does that just speak to who's investing in these pot stocks? If the individuals are going up, is that basically just like the online Wall Street bets are betting and maybe more measured ETF people aren't?
I don't think a lot of institutions are putting big money into
probably
the
right.
marijuana.
I don't think they're allowed to, a lot of them.
But if you are, let us know. In any case, coming up in the next hour, great lineup. Rebecca Patterson joins us to talk CPI and U.S.-China trade relations. Then Marsh McLennan CEO John Doyle joins as well, and Claudia Sahm. This is Open Interest.
break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Despite worries over President Trump's tariffs, consumer prices rose at less than expected 2.7% annually in July. Business analyst Jill Schlesinger.
There was, in addition to energy prices being down, there was some improvement in the cost of shelter, which is up by 3.7% from a year ago. That's down significantly from the peak that we saw a couple of years ago, and a slight improvement from the June reading.
Furniture prices, the cost of tires and pet products all up. So is the Dow. It's ahead 233 in early trading. A Justice Department spokesperson tells CBS News Attorney General Pam Bondi is expected to meet with Washington, D.C. Mayor Muriel Bowser a day after President Trump took control of the local police force. He says he'll send in National Guard troops, too. Correspondent Scott McFarland.
The president has also threatened to expand his crackdown on crime in other U.S. cities. He named Chicago, Baltimore, Los Angeles, New York, and Oakland, but the president doesn't have the same authorities in those cities that he has in D.C. The Democratic mayors and governors in those communities are already pushing back hard on that idea.
We're expecting an update this hour on last week's deadly shooting at CDC headquarters in Atlanta. One police officer was killed by a suspect who professed anti-vaccine views. Now, some agency employees are calling for beefed-up security, including this one, whose voice was disguised to protect their identity.
There has been constant rhetoric that has vilified CDC. He's called CDC a cesspool. He has, quite frankly, dehumanized all of us who work at CDC.
The Uvalde, Texas school district has released records from the deadly school shooting there in 2022 after news organizations, including CBS, sued the district. Correspondent Matt Piper.
The records include emails between top school district officials and also text messages and emails to and from at least 2 school police officers who were on the scene. There's also the personnel file of the former Uvalde Schools Police Chief Pete Arredondo, including texts of his. At 11:40 a.m. that day, a text to him from a district secretary noted someone reported hearing shots outside Robb Elementary. Nearly 400 officers waited more than 70 minutes before confronting the gunman.
The Kodak moment may go away forever.
Don't miss the moment. Keep your camera ready with new Kodak Gold Plus film.
East Eastman Kodak's warned investors it could be forced out of business as it uses up the last of the money from a pension plan to pay down debt and stay afloat. George Eastman launched the company in 1888. It produced the first successful roll film hand camera in the world. This is CBS News. Couple of musicians have resolved their messy split.
A court filing indicates the estranged pop duo Hall & Oates reached a private ending after details of the rift between them went public in court documents after Daryl Hall sued John Oates over a business partnership in 2023. It's not clear when the arbitration ruling was reached or what the outcome was. There's been no comment from attorneys on either side. Hall had accused Oates of blindsiding and betraying him, saying their relationship and his trust in Oates have deteriorated. Oates said he was deeply hurt that Hall was making inflammatory, outlandish, and inaccurate statements about him. Steve Kathan, CBS News.
Police in Spain say rescuers have found the body of an American hiker who'd been missing in the Pyrenees for almost a month. They say Cole Henderson's remains were found more than 650 feet down the north face of Monte Perdido. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well, so head over to youtube.com, search Bloomberg Live Radio, and that's where you'll find us. Norma Linda, Paul Sweeney here with you in New York. Coming up, we're going to check in with Ed Ludlow, Bloomberg Technology co-host, talking about the story coming out of China urging firms not to use NVIDIA's H20 chips. This story just never seems to be ending here. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. He'll give us his thoughts on this inflation print this morning. The CPI print generally in line with expectations, maybe a tid higher on the annualized basis. Maybe we'll see how that looks. Priya Misra, she's going to join us as well, fixed income portfolio manager at J.P. Morgan Asset Management. Get her thoughts on the fixed income market. Then we're going to talk weed. When you want to talk cannabis, you talk to Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst. I think President Trump has some thoughts on the cannabis market in general, and we'll get down to that. But right now, let's kick everything off with Lisa Mateo and a Bloomberg Business Flash. Lisa.
You got it. This Bloomberg Business Flash brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. You can learn more at ibkr.com/around-the-clock. We've got stocks advancing this morning. This after core CPI picks up to the fastest pace since January on an increase in service prices. Core CPI, it increased 0.3% from June on an annual basis, picked up to 3.1%. You have Ellen Dettner and Morgan Stanley Wealth Management, who said in the short-term markets, well, they'll likely embrace these numbers because they should allow the Fed to focus on labor market weakness, keep a September rate cut on the table. But in the longer term, Dettner said because of tariffs, well, we likely haven't seen the end of rising prices. The NASDAQ up 0.2%, but look at the Dow up 0.9%, 393 points. The S&P 500 up 0.4%, 29 points. The two-year yield 3.7.
4.74%. That's down 2 basis points. The yield on the 10-year, 4.30%, and that's up 1 basis point. The Bloomberg Dollar Spot Index, that's down 0.2%. Shares of Intel, they're higher. They're up 2%. CEO Lip Bhutan met with President Trump at the White House, and this is after calling for his resignation. The president now calls Tan's success, quote, amazing, said discussions will continue. And finally, shares of NVIDIA, they're down about 0.6%. Sources saying China urging companies to avoid using NVIDIA's H20 chips. Sources saying it also affects AI accelerators from AMD. It comes as both companies, they just agreed to pay 15% of their China AI chip revenues to the U.S. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Nora and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Norma Linda's sitting in today. Nora, the market likes what it saw, it seems like, on the inflation rate. It's a little bit higher, but I think that there are fears where it could have been even higher. But now, a little tepid, so maybe the Fed can cut.
Absolutely, and I think that we're seeing that really reflected in the trade, in the bond market, people really reassessing what the rate cut expectations are. Really, a lot of people pointing towards September here.
Yep, got the 2-year Treasury yield in about 3 basis points, 3.73%. All right, let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Norma Linda. And we're joined by Bloomberg's Natalia Kenyajevic. Natalia, what are you looking at today?
Let's start with Circle Internet, guys. The ticker is CRCL. The stock is up by 6%. We spoke about preview yesterday, so the company delivered. We saw that results were positive. Adjusted EBITDA came at $126 million. Expectations were for $121. There was also beat in total revenue, which gained 53% on a year-over-year basis. Analysts, of course, highlighted its company's stablecoin USDC, so the circulation outlook was very ambitious, and the company said that there was 61.3 billion USDCs in circulation at the end of this quarter. This is a 90% year-over-year increase. So we do see that demand for stable coins is growing. Still, the company posted a net loss of more than $400 million, and shares rose to $170. The IPO price, as a reminder, was at $31.
Wow, just an amazing rip there for that name. Tilray Brands.
Right, so this is a cannabis story. We do see that Tilray Brands shares, the ticker is TLRY, so shares are up by almost 19%. So this company, as well as other cannabis-linked stocks, are moving higher. We saw that President Donald Trump said that he was considering reclassifying marijuana as a less dangerous drug. So Trump said that he may announce a change in the next few weeks. So right now, cannabis is labeled as a Schedule I drug, basically in the same category as heroin or LSD. Analysts are saying so this potential reclassification could lift the entire market and, of course, help those companies with better access to capital.
Definitely. I mean, looking at shares of Tilray Brands down 25% this year, so it'll be interesting to see whether or not these developments really create a lift for this company and others in the sector here. You're also looking at Venture Global.
Yeah, so this is the energy story, and this is also another IPO story. So the company posted earnings. So on the one hand, shares are up by 2.7%. The ticker is VG. So the company posted higher profit, revenue more than doubled. So revenue rose to $3.1 billion from $1.1 billion. And the company also, of course, saw an increased profit driven by higher LNG sales volumes at one of its facilities. However, keep in mind that the company went public in early 2025, and there was lots of concerns about company's fundamentals, and the stock is still down by more than 50% since its IPO.
Wow.
Yeah, went public January in 2025 is $25 a share. Here we are at $12.70. So come down there. But I don't know. I like the LNG business. There's always demand for gas out there.
Yeah, there's no sells here on the stock. I mean, if you're looking, there's about 8 buys and 8 holds here, 0 sells. So it seems that people feel similarly.
All right, Natalia, thanks so much for joining us there. Natalia Kenyajevic covers all the equities for Bloomberg News. And for more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you get your podcasts. All right, I have to be honest with you. I'm having a hard time keeping up with this whole China, NVIDIA, AMD.
Tell me about it.
The 15% tariffs. Can the chips, are they welcome in China? Are they not? Can they sell them in China? Let's go to Ed Ludlow. He's on top of this stuff. Ed Ludlow, Bloomberg Technology co-host. He's over in London right now. Hey, Ed, what's the latest here? China is, I guess they're urging firms not to use NVIDIA's H20 chip. I thought things were kind of thawing out there.
Yeah, this is fast moving. This is, the only appropriate time of the phrase market whipsaw that I've been able to use to date in this context. The information has reported that China's internet regulator has ordered specific technology companies, Alibaba, Tencent among them, to stop placing orders of NVIDIA's H20. The H20 is the China-specific chip that had performance engineered out of it that was subject to export control. What we knew, by the way, as of Monday morning, was that NVIDIA had not in any recent months shipped any H20s to China anyway. But the problem with this latest report, which has been in the last hour or so, is that it's a much more extreme move by China than what Bloomberg had reported overnight, which was basically an advisory. Chinese authorities had strongly recommended to various Chinese technology companies not to use the H20 in particular, as well as one chip from AMD. But the market's reacting. That's all that matters, right?
Right. So we are seeing shares of NVIDIA down a touch, about 0.8% here. Can you just speak a bit more about what are the implications here for NVIDIA in particular?
Yeah, so the state of play is really important to understand. NVIDIA's H20 chip is not the best chip that a Chinese technology company can buy. Huawei, which is essentially China's domestic champion, has actually several generations of chip that have better performance and power, not just more than the H20, but of NVIDIA's H200 chip, which until very recently was the sort of cutting-edge generation accelerator that many American companies used. They've since moved on to a later generation called Blackwell that's not available in China. The president, as you know, confirmed yesterday, about 24 hours ago, that he had cut a deal, an ad hoc arrangement, a quid pro quo, with both NVIDIA and AMD, where he would allow them to export these China-specific chips with lower power and performance in exchange for 15% of the revenues gained from that market for Chinese AI accelerators. The problem is, what are we interpreting this as? Is China responding in this way because it's a tactic in the broader negotiations between the United States and China of trade overall? That is what the analyst community thinks. Or is China protecting its own domestic industry for AI accelerators, making sure that Chinese tech companies buy a Chinese AI chip? Both are possible. The main conclusion across both is that now Wall Street has to reassess how likely it is that NVIDIA and AMD do business in that market, at least in the near term.
And Ed, I guess if I were an analyst or an investor, I'd be saying, I think I have to factor into my model that the answer would be no, that I can't imagine some of the advanced chips being allowed into China. It just doesn't feel like the political winds are blowing that way at this point.
There are certain sections of Wall Street, the most bullish analysts, that NVIDIA's next quarter coming up is the fiscal second quarter. Some people saw them doing $7 billion of sales in China on the basis that, okay, president said it's cool. Even if you have to pay a 15% so-called export tax, and there are questions about how constitutional that rule would be, which we can get into, sure, it's still better to have 85% access to a market than zero. So everyone was like, they can do this quickly, just turn the tap back on. I would wager, I think I said this yesterday anyway, but 24 hours on, given the news flow, they're probably reassessing their model down and down and down, closer towards zero.
Ed, we of course know that China is a major player here when we think about NVIDIA, but NVIDIA also holds a significant market share in the AI chip sector, about 95%. So tell us a bit how big of a deal this most recent news is, and how does it kind of change how you look ahead of these earnings that we're going to be getting coming soon?
Well, the thing is, and the reason why, Paul and I back and forth over the sell side over the last couple of days is important, is there's been zero business for NVIDIA in China, at least since the turn of the year. They wrote down $5 billion worth of chips that were specifically made for that market, and they haven't sent any of them there. Let's say they're just sitting in a warehouse somewhere. They probably are. However, When you think about the context of AI development, the number of researchers and companies working on models, about half of the world's activity is happening in China. It was an important end market. Will we return?
Ed, great stuff as always. Appreciate the reporting on a fluid situation with the chip makers and China. So are they or are they not going to be doing business going forward in China? Ed Ludlow, Bloomberg Technology co-host, joining us here. Coming up, we're going to check in with Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. Get his thoughts on this inflation print this morning. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. Well, underlying inflation, it accelerated in July, its strongest pace since the start of the year on a pickup in services prices. We have Tiffany Wilding is an economist at PIMCO and spoke on the tariff-related pass-through.
It's happening, but it's happening slower than I think many people expected. Going back to April, when the more dramatic tariff announcements were first implemented or announced, it's happening more slowly, and across industries, it's more uneven.
And that was Tiffany Wilding, economist at PIMCO. We've got stocks on the rise. Look at the Dow up more than 1%, 445 points. The S&P 500 rising 0.6%, 38 points, and the Nasdaq up 0.5%, 123 points. The two-year yield 3.75%. That's down 2 basis points. The yield on the 10-year 4.31%, and that's up 2 basis points. Over to commodities, we have WTI crude $63 a barrel. That's down 0.6%. And over to gold, COMEX gold up down 0.7%, $3,380 an ounce. The Bloomberg Dollar Spot Index off about 0.2%. Shares of stablecoin issuer Circle Internet Group, they're up about 4%. Reported its first earnings as a public company, and revenue rose more than expected. After the close, it's on to CoreWeave and Kava Group. One stock on the move, that's underwear maker Hanes brand. Their shares up 36%. Financial Times reporting Canada's Gildan Activewear close to buying the company. It's a deal that values it at nearly $5 billion, including debt. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Nora and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Nora, Melinda, Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City. And we're also streaming live on YouTube as well. The CPI print came out this morning. James Knightley, chief international economist at ING, is out in the marketplace saying inflation was broadly in line with expectations as tariffs continue to be largely absorbed within profit margins, which he says gives the Fed room to cut interest rates. So that's, I guess, kind of what we're seeing out there in the marketplace. Let's check in with Ira Jersey, chief U.S. interest rate strategist at Bloomberg Intelligence. Ira, what's the bond market telling you today?
Yeah, so we've actually shifted a little bit since we got the inflation print where, yes, we still have lower yields on the front end. And as you said, Paul, the market is pricing for a September rate cut. But the long end now is starting to sell off a little bit. And I think that part of the angst there is over both supply, but also maybe longer term inflation effects kind of being built into the market. Because if the Fed does cut interest rates, then it's possible that over the longer run, we'll get inflation a bit higher than the Fed really wants.
So we saw core CPI pick up at the fastest pace since January, particularly looking at services here. But I mean, of course, we are seeing a market that is charging higher. How are you thinking about this print? Was there anything that stood out to you in particular here?
Yeah, so the two big surprises, and you talk about that core inflation print, and it's really, and if you look at the super core measure, so you take out housing from that core measure, and what you see is that transportation services and medical services were the two big increases. It's a little bit unclear what caused the medical services rise, but that transportation services was interesting because you had energy prices went down, and usually energy prices are one of the big drivers of transportation services. So it wasn't really broad-based. It was only those two subsectors of the core measure that really drove that higher than expected core measure. But it was very incremental, and like Paul mentioned in the open, core goods really did not move very much, and you'd expect that to be the place where tariffs would really show up in the CPI report.
Neil Dutta over at Renaissance Macro wrote this morning that this data essentially means that the September rate cut is, quote unquote, a lock. Is the market pricing it in like that?
Yep, the market's pricing in a lock, and it's pricing in another cut thereafter. But what it's not pricing yet are 3 cuts, at least not fully priced 3 cuts. And I actually think that if the Fed were to cut in September, that it will just keep going. That it's not going to start and stop. That's not the Fed's modus operandi. If they were to cut, they would be convinced, oh, we need to cut 75 basis points, 100 basis points, or maybe even a little bit more than that, which is our expectation actually by the time the Fed's actually done. So if the Fed cuts 25 in September, I think that means that they'll probably be cutting through at least January and have cut at least 100 basis points, and probably a bit more than that. Because if inflation hovers here, 2.5% plus or minus a little bit, I think the Fed will think that, hey, we can cut all the way down to 2.5%, and that's close to neutral, whereas right now we're restrictive. You even heard Jay Powell mention that a couple of weeks ago at the press conference that, you know, we're still restrictive, so to get to neutral, how far do they need to go? Well, in some people's eyes, you know, like Governor Bowman, for example, she thinks maybe below 3%.
So you mentioned the idea of tariffs here, and of course we did see with this print, core inflation was more so from sticky service prices rather than tariff-affected goods. Is there any sort of expectation that there is still an impact that's yet to be seen from tariffs in terms of how we look forward into some of these reports?
Well, there is in the market, and if you look at inflation, what inflation swaps are pricing right now, they're actually priced for CPI to be above 3% over the next 1 year. So the market at least isn't really thinking that the tariff fear is over. Now, part of that might be an increase in energy prices and some seasonality and things like heating oil, but nonetheless, the market is thinking that, you know, this kind of inflation could be a bit stickier. Keep in mind for the Fed, though, like if we have a headline inflation 2.5% plus or minus on CPI, they look at the PCE measure, and PCE, the PCE deflator, tends to be between 50 and 60 basis points below CPI. So we could actually still be relatively close to the Fed's target, you know, maybe 2.2%, which I don't think is an impediment for them cutting if the labor market remains as weak as the July data that we had 10 days ago suggests.
Ira, thanks so much for joining us. Always appreciate getting a few minutes of your time. Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence, safely ensconced at our BI headquarters down there in Princeton, New Jersey. Let's go to the bond market here. The credit markets, fixed income broadly defined. Again, as Ira's mentioned, we got the 2-year down about 2 basis points, and the 10-year actually up about 2 basis points. So a little bit of steepening there in the yield curve, looking at the 2s, 10s. Priya Misra does this stuff for a living over there at JP Morgan Asset Management, fixed income portfolio manager. Priya, what's your take of the inflation data we got today, and is it enough for the Fed to cut rates, do you believe?
Hi, Paul. Thanks for having me. So I think the report came in largely on top of expectations. You look below the hood or under the hood and you see, okay, goods inflation showed some tariff pass-through. It didn't accelerate, which a lot of people were expecting. I actually think that's yet to come because companies are paying for the tariff. It's just now they're arguing how much do consumers take it versus companies themselves. So I think that's still going to happen. On the service side, the thing I look at the most is housing inflation. That tends to be more, sticky. It tends to be trending. That continued to decelerate. Airfares picked up. So I put all of that together, and inflation, yes, it's above the Fed's target, but it's not worrying enough, I think, for the Fed to hold back from cutting rates. And then you go back 2 weeks, and we had a payroll report that was weak. And the monthly pace of job gains has been much weaker this year. I mean, we're not in the hiring. I mean, hiring is slow. We're not still in the firing mode. But I think that is raising concern from the Fed standpoint. So the market's pricing in a very high chance of a September rate cut. I think it makes sense. I think they're likely to cut rates. We still have the PCE report. We have another payroll report. So there's still more data. They're not going to commit to it. But I think market pricing of the soft landing, what Governor Waller calls good news rate cuts, I think it's fair given the economic data that we have here. So that's what the market's pricing in, that we stay in the soft landing. The Fed can cut, take the restriction out of rates, get rates closer to neutral. And then, I think that's what's reflected in risk assets as well.
So you mentioned that the tariff pass-through has yet to really be seen here. When do you expect that to potentially show up in reports? And if it does, when do you expect the Fed to continue to cut if they do cut in September?
Sure, great question, because if I think the tariff pass-through hasn't yet happened, is that going to be an impediment? So I do think in the next few months, because we're looking at tariff collections from the customs data, you're getting about $30 billion a month that is being collected. And that's actually we estimate that's about a 10% tariff rate. If I look at the trade deals over the last few weeks, the effective tariff rate based on last year's imported goods is closer to 18% actually, depending on exceptions. So I think that tariff revenue is likely to go up. And then companies, it takes a while. They might have had inventory. That is why they didn't raise prices. It takes a while to raise prices. They might have wanted more certainty to know what the tariff number will be like. But I think over the next 6 months, we do expect goods inflation to pick up. Now, your second part of your question, does that impede the Fed? I think the Fed might look through tariff-related inflation. Chair Powell effectively said that as much. As long as service inflation continues to decelerate, and it can happen in a slower pace, but if you don't see service inflation, wages, and inflation expectations ticking back up, or, you see continued deceleration there, I think they look through tariff-related goods inflation. They'll say that's a one-time price shock. That's what economics would tell you. And I think they can continue to cut rates, at least until neutral. Once we get to neutral, I think the bar then rises. At that point, I think you need to have the Fed convinced that they need to take rates into accommodative territory. I don't think the data suggests that right now, but that's, they've got a long way to go. We're 100 to 150 basis points away from neutral. I think that's why the market's pricing in all these cuts, even with the expectation that tariff-related inflation is likely to still show up.
So, Priya, about 30 seconds left here. What's your fixed income call here today in terms of how much credit risk do you want to take?
So we do like high-quality spread product here. I mean, you look at company fundamentals, they're strong. Earnings have been strong. Companies are creative. Once they know what the tariff rate is, they're working through supply chains. So we like high-quality spread product. I also like owning duration against that. Because if the economy slows down a little more, the Fed might cut, but it takes a while for that to show up. I think duration then provides you that hedge. We struggled with cross-asset correlations, but I think duration as a hedge to risk assets is still very much the game in town. So I think own some duration and own high-quality credit, high yield as well as investment grade.
Priya, thanks so much for joining us. Always appreciate getting a few minutes of your time. That's Priya Misra. She's a fixed income portfolio manager over there at JP Morgan Asset Management. I think they're about to move into the new headquarters on Park Avenue, starting, I think, like end of this month, maybe beginning of September. So
beautiful building. Beautiful building,
huge building. Next time folks are in New York, walk down Park Avenue and you'll see it. I think it's around 48th Street or something like that on Park Avenue. Just spectacular. We've watched it be built over the last several years, and I never thought we'd see it finished. It's just extraordinary. So that's Park Avenue. Looking at the market, still green on the screen here, so we'll keep up with that. Coming up, we're going to talk about the cannabis business. President Trump's making some potentially positive comments for that industry. Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst, is going to join us on what it means for the industry potentially, and on individual stocks there. We're talking weed coming up. Why not? Listen to it.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks advancing. This is as an inline inflation reading kind of boosted hopes that the Fed will have room to cut interest rates in September. Federal Reserve Bank of Richmond President Tom Barkin said uncertainty over the direction of the U.S. economy, well, it's decreasing, but it's still not clear whether policymakers should focus more on inflation or strengthening the job market. Fed officials, well, they next gather on September 16th through 17th in Washington. The NASDAQ up 0.6%, 128 points. We have the Dow up 0.8%, 365 points, and the S&P 500 rising 0.5% or 35 points. In the yield space, the 2-year 3.74%. That's down 3 basis points. The yield on the 10-year 4.30%, and that's up 1 basis point. The Bloomberg Dollar Spot Index, that's down about 0.2%. A few companies making news. China Evergrande Group said its Hong Kong stock will be delisted, marking the end of an era for the company. And Elon Musk lashing out against Apple's App Store. He's accusing the iPhone maker of favoring OpenAI over his own artificial intelligence offerings. Apple shares, we'll take a peek over there. They're up about 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is your Bloomberg Business Flash. Paul and Nora.
All right, Lisa Mateo, thank you so much. We appreciate that. Norma, Linda, Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well. Head over to youtube.com and search Bloomberg Live Radio, and that's where you'll find us. I'm looking at the cannabis company Tilray Brands. It's a name we've been talking about a little bit this morning. Stock's up about 9%, 10% here. That's the good news. The bad news is it's down about 25% year to date. And I think it's up on part, looking at some of the Bloomberg reporting here. President Trump made some comments that maybe he'd be open to reclassifying cannabis maybe as a less restrictive drug there or substance. So I want to bring in Ken Shea. He covers all this stuff for Bloomberg Intelligence, Senior Consumer Products Analyst for Bloomberg Intelligence. Ken, talk to us about the comments that President Trump made as it relates to the cannabis industry and how impactful could that be?
Yeah, hi, Paul. Sure. So what I understand is President Trump over the weekend made some comments with regard to marijuana rescheduling in the U.S., a topic that's been very top of mind among this industry for a while. And apparently he said that the administration was going to be looking into it. Now, that's really a long way between that and actual rescheduling. But nevertheless, this beaten down industry and the close observers to it took that as a dose of overdue good news. I mean, these stocks, as you alluded to before, are down, over 50% or so, many of the big ones. So this hint of good news has led to a rally yesterday and today. But, I would advise observers to, temper their enthusiasm because, as I mentioned, it's a long process between looking into it and actual rescheduling it. And it's even further to legalize it, which would really bestow the greatest benefits of all.
So you mentioned how we've seen a lot of these stocks really taking a beating this year. Can you just kind of contextualize here for our listeners what has created this lag?
Yeah, sure. So the market really had turned negative for the last couple of years, actually, with a lack of progress made on federal reform of this industry. Many states have taken it upon themselves to legalize, either at the medical or adult use level. I mean, some 40 states now, talking about a vast majority of states, have now legal cannabis in some form. So a lot of the industry players and the market thought it's just a matter of time that the federal government would retire these really old, the treaties that require cannabis to be a Schedule I drug. And that really puts the handcuffs on this industry to do a lot of good things in terms of business. Consumer product companies in general have the benefits of the economies of scale because they have interstate commerce. They can advertise. They're not hurt by onerous taxes, which these companies are subject to. So a lot of barriers facing this industry still, given their current status. And so it really, prior to these comments over the weekend, I think there's really been a sense of throwing the towel in among investors with this group. And so that's why you're seeing this at the magnification of response to this news today.
So, Ken, if the majority of states have legalized cannabis, What's the problem with the federal government coming around and doing the same?
Well, the biggest thing, Paul, is because there's a treaty that was signed back in the 70s in the Nixon administration that, again, it's part of the anti-drug wars back then. They set this in a stone, basically, and only an act of Congress can change that treaty to no longer include marijuana, cannabis, as a Schedule I drug. So I guess, Congress doesn't seem to be willing to act. I mean, that's the biggest thing, the biggest blockade to legalization. Kind of the shortcut, reclassification under the Controlled Substances Act. A lot of the industry is saying, look, you're putting us at Schedule I, which is the same level as, ecstasy and fentanyl, all these harmful things. And the definition for a Schedule I is there's no proven medical value. Well, that kind of contradicts the own FDA's decision a few years ago when it approved a cannabis drug called Epidiolex, which is used to treat seizures in rare cases, for epilepsy. So clearly there's a medical use, and it doesn't belong as a Schedule I. If it was rescheduled to 3, it would still remain illegal unless that treaties are changed. It could at least alleviate something called 280E in a tax code, which basically says, look, if you're in the drug business, it may be a bad thing, but we still want your taxes. And so they don't allow these companies, these cannabis companies, to deduct ordinary business expenses like rent, salary, marketing. Wow. And so as you can imagine, the taxation hit to these companies is just dramatic. And that's really their biggest problem.
So there was a time back in the early 1920s when cigarettes were illegal. And then, of course, we know now when we look at the industry, the tobacco industry globally, it's a multi-billion-dollar industry. So if we think about cannabis stocks and a lot of these companies here, what's the bull case?
Well, the bull case is that at some point it gets rescheduled or legalized, and that's a long term. You got to remember the market as a discounting mechanism is looking, well into the future. Now, if you're a real bull, you look well into the future. These companies at the gross margin line are very profitable. You're talking about 40, 50, 60% gross margins. That's a pretty good business. But it's when you get below that, they really get hurt, particularly the taxation line. So if you're a bull in this industry, you say, you know what, these are pretty good companies. You need a license to compete, so there's natural barriers to entry. We know there's a demand for this product. It's been around for a long time. So, if they could just get the regulation right, this could be a pretty good business.
Can you also cover the big tobacco companies? How have they been impacted, or may they be impacted with the various tariff discussions that are out there?
Well, the U.S. tobacco industry is really a domestic business. The big guys, Altria, they source virtually all their tobacco domestically for domestic use. So their only exposure to the tariffs is really very small. Some of the materials they use, like their smokeless tobacco cans, tin, metals, things like that, they may, get from suppliers offshore. And there could be indirect problems. I mean, other suppliers could raise prices in a small way for other inputs. But by and large, they can skirt this problem, and it's not really an issue for the U.S. tobacco industry.
Quickly hopping off of that question, I'm going to ask the same of cannabis. Is that more a domestic industry here? Any tariff concerns?
No tariffs concerned. Matter of fact, it's illegal to import cannabis into the U.S. So it would only be to the extent where the vaporizers and the electronic goods and the ancillary products that are used with cannabis are subject to those import tariffs. But the plant itself, there's.
Yeah, and the tobacco stocks have done great. Altria is up 25% this year. So there you go. Ken Shea, Senior Consumer Products Analyst for Bloomberg Intelligence. And yes, that includes the cannabis industry. And Ken was out with some of the first cannabis industry research several years ago on the street. So he is our resident expert on the weed business. I'm looking at, again, Altria, 52-week high here. I mean, how about that? 26% year to date, I guess, as we maybe consider it a tariff-free kind of zone, right. A sector that might be...
Got to find your corners of
exactly
stability.
Right, so there you go. All right, coming up, we're going to check in with Sam Fazeli, Bloomberg Intelligence. He's a director of research over in Europe, but he's also one of the best pharmaceutical analysts in London. This is Bloomberg.
Listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
Norma Linda, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. Head over to youtube.com, search Bloomberg Local Radio, and that's where you'll find us. There you go, easy peasy. Nora, what are you looking at? Because you've got a real job. You write about the markets and everything. So what are you working on these days?
Well, there's really a lot to cover. I mean, I cover real estate stocks. So we've got the residential real estate. You've got home builders in focus, especially as you think about mortgage rates. They're so high. And of course, as we're looking at a lot of the stuff that we're seeing as the read through the CPI print and then a lot of the other prints we've been getting, I mean, it's really been something to really dig into. I mean, as I talk to people, it doesn't really feel like I'm hearing too many people closing on a house right now. But I mean, you are still seeing people out there, especially like in the luxury home builder space. But commercial real estate, of course, that also remains top of mind. And one of the interesting sectors that I'm always looking at is the senior housing space.
Right.
Especially as you think about the senior housing boom, and especially a lot of these boomers potentially being in a lot of those properties. So another space that we're watching really closely
here. The 30-year mortgage still high, 6.77%. All right, it's Tuesday. That means we check in with Sam Fazeli. We get the latest on the world of healthcare. Sam Fazeli is the Director of Research for Global Industries, and he's a Senior Pharmaceuticals Analyst for Bloomberg Intelligence. He is based in our London office. Sam, talk to us about some of the latest advances being made in the treatment of bladder cancer. I understand there's a combination of a couple of companies, different drugs that having some pretty good response rates.
Yeah. Yes, Paul. First, very nice to see you all. Having come back from a holiday, was just about to take a sip of my London tea when I realized I'm on. So, look, we have one of the things that we're excited by in oncology and cancer is that every 2 or 3 years there seems to be yet another big news that genuinely changes the potential outcome for patients with this cancer or that cancer. We've had prostate cancer in the past, breast cancer, etc. And now it's bladder cancer. And to be honest, this combination, Merck's pembrolizumab or Keytruda, plus this drug that was initially in the hands of a biotech company called Seagen, Seattle Genetics in the old days. Then Pfizer's acquired called Padcev, 2 different modes of action, seem to work like magic. They have side effect issues, of course, this is cancer therapy, right? But the patients who can tolerate the agents are showing significant benefit. I mean, to the point that when the first data set for not the surgery group, but the earlier group where you're past surgery, you got metastatic disease, was presented at a conference, they got a standing ovation. I think the speaker had tears in his eyes when he was presenting it. So these are because you change survival by orders of magnitude in these patients. So bladder cancer is an awful cancer, and here we are, another win.
So who are the other major players here outside of Pfizer as it relates specifically to different drugs and whatnot for bladder cancer survival?
Yeah, so there are, this particular one is currently Pfizer, Padcev, and obviously Keytruda from Merck, which is this magic drug that activates your immune system to attack the cancer. But there's others. There are other types of bladder cancer, which are jargon called non-muscle invasive bladder cancer, where a very, what you could say, much lower, although that's not fair because there's a lot of tech going into it, device that you can put inside the bladder, and it releases chemotherapy. And again, that gives a great result in that group of patients. And that's from Johnson & Johnson. It's called TAR-200. That was acquired from a drug development early stage biotech company. So there's that. Then there's new modalities using active viruses that you can put in the bladder. The bladder is a bit special because you can put things in it and it can act on the inside of the cells if the bladder, if the tumor's there. So there's quite a bit going on. And here's one of the ones that we're really, really excited by. And as I said, TAR-200 from Johnson & Johnson.
All right, Sam, who is this guy, Vinay Prasad, over there at the FDA, and do we care about this guy?
Yeah, we do care about this guy because he's actually a well-known hematologist who was brought in by Commissioner McCarry to run one of the 2 major divisions of the FDA called CBER, Center for Biologics Evaluation and Research. And then for some reason, although there seems to be some disagreements as to whether it was pushed out or wasn't pushed out, what was fake news or wasn't fake news, a couple of weeks back, he leaves. And then Macquarie has brought him back. So during the time, the day he left the biotech, some area get away with doing shorter, quicker clinical trials in oncology, etc. He had a very puristic, that's the word, oh, I can't do it. You say it for me. Puritanical. There you go. I got it. Puritanical approach to getting these drugs approved. So now he's back. It doesn't look like the market's reacting in the opposite direction. So that's good. And this is the division that looks after vaccines, blood products, and of course cell therapies and gene therapies, which is, and again, there's a bit of an overlap with other areas. Right. So he has been a controversial person, but I think he's from a science perspective, is solid.
Where'd you go for holiday?
Oh, look, I'm an old man. I just spent an hour and a half drive from my house to the beach. Right? It's like you guys going to Jersey Beach.
That's right.
That's sort of
Jersey Shore. Very
like
good.
Me.
Sam Fazeli, Director of Research for Global Industries and Senior Pharmaceutical Analyst for Bloomberg Intelligence. And his beach, it's in France.
Oh.
So, I mean, that's where he lives.
Can't
He lives
even
in France.
compete.
Exactly. So he's playing it down, but he wants probably, the south of France somewhere. That's
for
where he
sure.
That's how he rolls. I do the Jersey Shore. Sam does, the south of France. That's as it should be. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence, it's going to start right now. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, Norma Linda, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Coming up in this hour, we're going to check in with Anurag Rana, Bloomberg technology analyst. Apparently, Elon Musk had some not so nice things to say about Apple, so we'll get the latest on what's happening there. Eric Schatzker, editorial director for Bloomberg New Economy, he's got a great Bloomberg Business Week story out here. He sat down with Scott Bessent, Treasury Secretary, and really talked trade, deficits, and President Trump's economic plan. Fascinating discussion, fascinating read. We'll talk to Eric here in our studio. Dana Dioria, co-CIO and group president for InvestNet Solutions, to discuss her outlook on the markets. And Michael McKee, you know him, you love him. He does all the economic stuff for Bloomberg. We'll get his thoughts on the inflation data and President Trump naming E.J. Antoni to lead the Bureau of Labor Statistics. What does that mean going forward? We'll get all that breakdown coming up. But first, let's get a Bloomberg Business Flash with Charlie Pellet.
Hi, thank you very much, Paul Sweeney. Stocks higher across the board right now with the Dow, the S&P, NASDAQ all advancing. CPI Tuesday, and the S&P right now climbing by 47 points, 64.20 where we stand. We're looking at a record up 0.7%. The Dow pushing higher by 483, up 1.1%. S&P, by the way, holding very close to session highs on this Tuesday morning, with NASDAQ up 154 right now. That is a gain of 0.7%. The Bloomberg Mag 7 index up 0.5%. Dow Transports, by the way, surging 2.7%. Your 10-year 4.29%, with a 2-year currently yielding 3.75%. Spot gold, little change, down 0.1%. Spot gold down $3 the ounce to $33.39. West Texas Intermediate crude 63.68 a barrel, down 0.4%. And Bitcoin at 119,475, up 0.5%. So what about this morning's CPI report? What does it mean for the Federal Reserve? Priya Misra is portfolio manager at J.P. Morgan Investment Management. She was a guest right here on Bloomberg Intelligence.
The market's pricing in a very high chance of a September rate cut. I think it makes sense. I think they're likely to cut rates. We still have the PCE report. We have another payroll report. So there's still more data. They're not going to commit to it.
J.P. Morgan's Priya Misra, interviewed right here on Bloomberg Intelligence. NVIDIA lower after the information reported that Chinese internet regulator ordered local tech companies, including ByteDance, Alibaba, and Tencent, to suspend their purchases of the company's chips over data security concerns. The information citing sources. On an update for the rest of the market, NVIDIA down 0.1%. So again, recapping here, stocks are higher, S&P up 0.7%, and yes, our coverage of the CPI report will continue right here on Bloomberg Intelligence. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. As Charlie was just reporting, we've got green on the screen across the board. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Norma Linda, and we're joined by Bloomberg's Vildana Heinrich. She joins us here in our Bloomberg Interactive Broker Studio. Vildana, what are you looking at today?
I'm taking a look at some of the cannabis producers. Obviously, one of the big stories this week, but a bunch are rising again today after Monday's pretty big day. And I was taking a look at Tilray Brands, TLRY. It's up some 9% after a 42% gain just yesterday. Wow. Aurora Cannabis, that's ticker ACB, that's plus 1% today after 16% yesterday. We, of course, know that President Donald Trump said earlier this week and has made some comments in the last couple of days or over the last couple of days where he said he was considering reclassifying marijuana as a less dangerous drug. So that's sending shares up much higher. And there's an ETF I was also tracking, MSOS, and that got a small inflow, some $20 million in Monday's session because of this news.
Wow. We were talking to Ken Shea, and Ken Shea, who covers it for Bloomberg Intelligence, and he was like, I don't think this is going to happen. Right. I mean, he was kind of saying there's a long way before we get any federal help here.
So much between that.
And he was even saying these companies were thinking about just selling assets and kind of getting out of the game.
It's definitely a beaten down sector,
Yep.
but some of the ETF tickers are actually really fun to track. There's ticker MJ and there's ticker TOKE, so TOKE, so really good tickers.
I love that. What else are you keeping an eye on? I see Gildan Activewear.
Yeah, that's a Canadian company, but it's said to be in advanced talks to buy U.S. underwear maker. Should I whisper underwear? Sure. Hanes brand, ticker HBI. So we had the Financial Times initially reporting this, but Hanes brand shares are up 28% as we're speaking in today's trading following this news. Shares had lost some 40% this year through Monday. So big day for Hanes brand.
Most definitely. I mean, we're seeing those shares really in focus today, but you're also keeping an eye on Intel. What's going on this week? It's always in the news at this point.
There's something new about Intel every day these days. But shares of Intel, that's ticker INTC, up 3% today as we're speaking. And that's after President Trump said his meeting with the company's CEO Tan, was a very interesting one. So quote unquote, very interesting one. And the president also said that members of his cabinet would continue discussions with Intel CEO in the coming days. Intel put out a statement saying something along those lines as well, commitment to strengthening U.S. technology and manufacturing leadership, that type of thing. But these remarks are a stark reversal from just days earlier when the president called for CEO Tan's resignation and accused him of having conflicts of interest. So lots of people obviously paying attention to this one.
Just got to go to DC, put the charm offensive on, maybe write a check, and you're good to go.
I'd be really good at that.
Exactly. All right, folks, Donna Hyrick, cross-asset reporter, bringing us the news there. For more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. So there you go. Looking at this market, we still got some green on the screen here today. I want to check in with Anurag Rana, Bloomberg Intelligence Technology Analyst. Anurag, I seem to remember something in the zeitgeist, as Tom Keene would say. Elon Musk not real happy with Apple and maybe even vice versa. I'm not sure. What's going on there?
Yeah, if you go back a few years ago, Elon made a big deal about the fee that they have to pay on for, X subscriber, the 30% or so. I mean, there was a visible argument, but, in a few days, he was seen, walking around with Tim Cook in the campus and, the whole thing. I mean, today's complaint was a bit odd because apps on the App Store don't go up just because Apple wants to do it that way. I mean, they go up because users are downloading one app over the other. In fact, the other day, I remember the Perplexity CEO was saying that in India App Store, his app is above ChatGPT and so forth. So, I mean, he's basically complaining that, XAI is not getting the same love as ChatGPT is, which to me is understandable given, where the presence of that is in terms of the ecosystem and the users. So I think that's really, some argument going there. But I think it's just news, frankly. There's not much to it.
I mean, so you mentioned not much to it. So where do you go from here? I mean, what steps forward would he need to make to see any changes here?
He has to go prove the world that his Grok model is better than ChatGPT and their models. They just launched a brand new model, and they have to go figure out whether it's better than that. And he has to go and sell that to either enterprises or the consumer application and become, have the same number of users. I mean, you just can't say that, my product is not doing better because somebody else is not giving it the same amount of love. Even Google's model Gemini doesn't have that level of user base right now. I mean, the first mover advantage is OpenAI and ChatGPT, and the user growth has just been phenomenal, on that end. And there isn't, I don't think I know anybody at this time who's not using ChatGPT on their phone or any other device that they have.
Well, you can look at me. I don't use it. Let's talk about Apple. I see the stock having this nice move here, during the month of August here. Is this a sense that maybe they'll do something to maybe get a little bit more in the game as it relates to AI?
I think we discussed this a few months ago when, the president came out and criticized Tim Cook for building phones in India, and, the stock really took a hit at that point. But I think Tim Cook did the right thing. He announced a big plan. He went to the White House. He, essentially gave President Trump an assurance that he is working very hard to bring whatever he can in the U.S. This was just glass at one point. But I think that really made a huge pivot. The president was extremely complimentary of the stuff that he's doing. So, I mean, since then, you can see stocks been at a tier. So there was danger that, there could be additional surcharge on Apple or anything out there. So you don't want to be against the president at this point. So I think Apple's done a good job of managing that. Now the question is whether iPhone 17 will deliver. We've heard it's got a really cool new phone coming out. So I think things are looking good for Apple from that pen, but I'm still waiting for one particular element, that is the Google case, and whether Apple gets to keep the, partially or somewhat of the payment that it gets from Google.
All right, Anurag, thanks so much for joining us. Anurag Rana, one of our senior technology leaders for Bloomberg Intelligence out there in that burgeoning tech hub of Chicago, Illinois. Next guest had a fascinating story out. Bloomberg Business Week cover story. Treasury Secretary Scott Bessent. The U.S. Treasury Secretary has the ear of an impulsive president, and nervous investors worldwide hope it stays that way. And Eric Schatzker has an exclusive interview. Eric Schatzker, Bloomberg New Economy editorial director, joins us live here in our Bloomberg Interactive Broker studio. Eric, you sat down with Scott Bessent for an extended period of time. What were some of your takeaways there?
Gosh, well, first of all, the man is unbelievably busy.
Yeah, I can imagine.
Spent a day at the Treasury Department with our colleague Dan Flatley, and to observe how much he gets done in the course of a day, including spending an extended amount of time with us, gives you a window into the life of the Treasury Secretary in the Trump administration. And it's important to emphasize in the Trump administration because this particular Treasury Secretary has been given a whole host of responsibilities that go beyond that of the typical Treasury Secretary. We know that the Treasury Secretary in any administration is involved in tax policy, is involved in economic sanctions, is involved in financial regulation and the like. But President Trump has tasked Scott Bessent with trade negotiations, with striking, and not just any old trade negotiations. China, perhaps the most difficult trade negotiation of all. Japan, which was successful. South Korea, which was successful. Indonesia. The list goes on. He's also the acting IRS commissioner. He also crafted the very novel and original deal that the United States struck with Ukraine for a share of that country's mineral resource wealth back in April. These are not, and furthermore, I have to add, he was instrumental in getting the One Big Beautiful Bill through opposition among Republicans in both the House and the Senate in order to meet the president's self-imposed July 4th deadline. So Scott Bessent has taken on way more than your traditional Treasury Secretary does, and much of that is because the president himself has asked him to do so.
And it seems as though a lot of people see Bessent as really having the president's ear here, and this is a really fantastic story, by the way. What was the most surprising element through your conversation with him?
Oh, there's so many surprises. I would say that the thing I didn't fully appreciate, and which he spelled out for us and which others spelled out for us, is the degree to which this is something he sought after, going back many years. Bessent told us that he thought about joining the Trump campaign as early as 2016. But at that time, he just started a new hedge fund, Key Square Group, and he didn't feel like he could abandon his employees or abandon his clients. But what he did do was start to get to know the people close to Trump almost immediately thereafter, starting with Steve Bannon, and subsequently Peter Navarro, Stephen Moore, Kevin Hassett, for example, Trump's close economic advisors, Art Laffer. He went down to see Art Laffer in the South, made a pilgrimage of sorts to get Art Laffer's blessing for his ambitions to become Treasury Secretary. And these he didn't make known to Trump until October of 2023, excuse me, November of 2023. So it was almost a 6-year period in which he was maneuvering to position himself for a shot at Treasury Secretary. And when he saw Trump in that November 2023 meeting at Mar-a-Lago, Trump asked him if he wanted the job, if he was interested in being Fed chair. And Bessent said, no, I have another job in mind.
Very good. The Street, Eric, gives Scott Bessent a fair amount of credit for walking the president back from maybe some of the more difficult tariffs that were initially announced. Is that a valid point? Did Scott Bessent play a big role in walking the president back a little bit? And does he take credit for that, or is he kind of demure?
Bessent insists that his job is not to explain things to the president or to advise the president. It is to present the president with a series of options. Here's path 1, here's path 2, here's path 3. And I will explain to you where we get if we go down 1, if we go down 2, or if we go down 3. And he leaves it ultimately for Trump to make the decision. That's very, I wouldn't say that's unique to this president, but Trump has a very particular view of his role as a decider-in-chief in this administration that is perhaps different from what we saw with Biden or with Obama, or even going back in history to other Republicans like George W. Bush and maybe even Ronald Reagan. So Bessent does not claim credit for being the de-escalationist, but it is clear, talking to people around him and to understanding how the market thinks, market psychology, if you will, which is, you know, one of his areas of expertise, having been a macro hedge fund manager for almost 40 years, that is where it really counts. The market trusts him, and the market, based on its observations, draws these conclusions, rightly or wrongly.
Did he share any concerns he may have about just getting somehow involved in some of the crossfire that happens around President Trump and getting into President Trump's bad graces, or just kind of, I mean, because it's such a perilous, those people that fly close to President Trump historically have done it at their own risk, including the former vice president. So how does he negotiate? Does he even acknowledge that that's a risk?
What I divined from the conversations we had with the Treasury Secretary is that there is a formula for success in the Trump administration, and it means making certain compromises, if you will, with yourself. You can come in with your own ideas, but it is not your job to advance that agenda. So you have to make some compromises. If you don't, and Steven Mnuchin, the former Treasury Secretary, points this out, if you cannot represent the president well, in other words, if you can't get behind what the president wants, the role has no power. What's the point of being in D.C.? What's the point of abandoning a 40-year career in finance where you rose to be one of the most successful hedge fund managers and have, you know, for it all to be worthless, have to have no power? No, you want to be able to wield influence and get things done, and that's very much in the back of Scott Bessent's mind. What's my legacy as Treasury Secretary going to be?
All right, folks, if you really want to get a sense of who Scott Bessent is and his importance to global Wall Street, I really highly recommend you read this piece in Bloomberg Business Week. Eric Chatzker.
Thank you, Paul.
We really appreciate it. He's a Bloomberg New Economy editorial director. You can go check it out, Bloomberg. Absolutely. Looking at the markets here, S&P up 53 points. That's 0.8%. I'll take that. Beats a stick in the eye. NASDAQ up a couple hundred points. That's 1%. So good response to that CPI print. We'll have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Best level of the morning right now on the S&P 500 index. CPI Tuesday stocks pushing higher as an in-line inflation reading bolsters speculation that the Fed will have room to cut interest rates in September, driving stocks higher and short-dated bond yields lower. So here's where we stand. We got the S&P up 53 at a record right now, 64.26. That is a gain of 0.8%. The Dow up 1%, higher by 450 points. NASDAQ also up 1% right now, up 210 points. The Russell 2000 index of small cap shares surging 1.9%, and the Mag 7 index up by 0.9%. Dow Transport's up 2.7%. 10-year 4.29%, with the 2-year 3.73%. We do have right now spot gold up $5 the ounce, up 0.2%, 33.47 the ounce, and West Texas Intermediate crude down 0.5%, 63.66 for a barrel of WTI. This update brought to you by Oracle. Attention growing businesses. Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. On holding shares higher after the Swiss sportswear firm reported beat and raised second quarter results that Citi is describing as a, quote, standout report. Shares right now up by 8.4%. Again, recapping, stocks higher. S&P right now up 52. That is a gain of 0.8%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Norma Linda, Paul Sweeney live here in our Bloomberg Interactive Broker Studio and streaming live on YouTube as well. As Charlie was just reporting, markets moving higher. The CPI print came in, showed a little bit of inflation out there, but I think the market's saying basically not enough that would prevent the Fed from cutting in September. That seems to be the bet. We're getting a move higher in the stock market. We got yields. Got the 10-year Treasury yield. It's up just a little bit here, 3 basis points. Dana Dioria, she is a co-chief investment officer at Envestnet, joining us here. Dana, are you surprised that on a daily basis we seem to be making new highs, despite the fact that, I don't know, some trade uncertainty out there? There might be some economic slowdown. There may be some inflation on the horizon. Are you surprised that stock market's done so well here?
I think we've shown that we have just ability and propensity to keep driving it higher and sort of look past the negatives, because, I mean, let's face it, we went through a period of time where we thought for sure the market, certainly when you looked at the collective wisdom of market, pundits and, just folks who study the markets, it seemed that we were inevitably going to have a bear market after we had the increase in interest rates to fight inflation, and we kind of got past it. Then we have this AI trade that's just, as high as we go with these bulls, the earnings do seem to keep coming forward. And so it doesn't completely shock me. We have a few other good things, right? I mean, we have the indication that, now we've got another reprieve with China on tariffs. It seems to be the case that what was really driving the market crazy in April, Liberation Day, quote unquote, was sort of just a negotiating stance. And so the market has calmed down on that front. So you've got that, you've got the AI trade, you've got earnings keeping up. But your question is very valid. I mean, we are at very high multiples at this point for this market.
Dana, high multiples, we're seeing stocks that continue to charge higher, but where we are seeing some weakness, though, is within the U.S. dollar. Is the dollar still king?
Well, yeah, I mean, it's funny because even that in and of itself can be viewed positively, right, in some respects, and ultimately good for equities. But yeah, I would say, look, it's going to take a lot to move away from the dollar as the reserve currency. You obviously have more efforts along those lines now than you ever have before, and some of that probably bears fruit. But this is a rather inelastic type of situation when it comes to just the use of the dollar as that reserve currency, and the dollar kind of being the bellwether in a lot of respects for economic health. And so I think, while some of that is fraying and you're seeing more diversification maybe in that, it's not as though we're going to move away from that wholesale anytime soon.
I use the IN Go function on the Bloomberg terminal. It gives me a Bloomberg Index browser. I'm looking at the fixed income here across the U.S. Lots of green there. People are making money in fixed income this year. How are you guys playing that?
Yeah, because we're working with retail investors, obviously, and very much, you're talking about many managers across many different portfolio types, but the 60-40 still sort of the big kind of way that most people are accessing capital markets. That 40%, for a long time, paying you nothing. Now you're finally making money on that. I would say to you that for the most part, we recommend try to have diversification across the yield curve. The movements that we see, from time to time don't really change that. Obviously, the Fed has a lot more control over what happens at the short end of the curve than the long end of the curve. So on the short end, certainly we expect, obviously, September now, base case is 100% that we're going to get this rate cut. But at the same time, 10 years, and when you go out further on the curve, they can be impacted by very different things. And so the average investor we maintain is just going to be best off with a diversified approach to that.
And you mentioned diversification. Are there any areas that you're particularly overweight on, any sectors?
So what I would say is that because, again, the average retail investor, number one, a lot of them are indexers now, right? And then number two, even if you're invested in active management, it's hard to it's hard to have too much tracking error to that index, and so for the most part, the majority of investors at this point, because the indexes are so top heavy, they're top heavy, even if it's not an indexed investment per se, right? And so what we sort of recommend is making sure you do diversify into other parts of the market. Not so much because we have a thesis that you need to get away from big tech or the AI trade, but simply because you're already extremely concentrated in that trade just by being in the market or just by being in a standard actively managed solution that really can't afford to have too much of a drift away from the market. And so what does that mean? It means be in small caps. It means be in international, emerging markets as well, try to diversify. And we also, in our market now, certainly in the wealth arena now, you're seeing just more and more penetration of alternatives as well.
Dana, thank you so much for joining us. Always appreciate getting a few minutes of your time. Dana Dioria, she is the co-chief investment officer at InvestNet, joining us from Hartford, Connecticut via that Zoom thing. All right, you don't like the labor statistics you get from your Bureau of Labor Statistics? Well, you can fire the leader, which is what President Trump did there. And then you name someone that you prefer. And President Trump names E.J. Antoni to lead the Bureau of Labor Statistics. What does that mean? I don't know, but Michael McKee knows because that's his remit, as Tom Keene would say. Michael McKee does all the economic stuff for Bloomberg, joining us here in our studio. So, Mike, who is E.J. Antoni, and will he have any impact on the data that gets reported?
The answer to the second question is no. The answer to the first question is he is a economist at the Heritage Foundation, which is a very right-wing organization, and he helped contribute to the Project 2025 outline that the president is following. And he's not someone with a lot of experience, and so there are concerns about whether he's the right person or not. But the biggest thing is he has criticized the BLS quite often, put it that way, and is going to be seen as maybe somebody coming into the BLS as an enemy of the statisticians who are there. So you can see that maybe he'll probably get confirmed, but it won't be a fun process.
Is this a major shakeup here? I'm looking at a headline that just crossed the Bloomberg terminal saying that E.J. Antoni is suggesting suspending the monthly jobs report that's on Fox Business. How much of a shift would this be here?
Well, I don't know whether he would have that power, but that would cause a huge huge uproar on Wall Street, and I'm sure that Mr. Antoni doesn't realize that because the people who have a lot of money on this, they do believe the numbers. And they do trade on the numbers, and as we know, I'm not going to speak ill of ADP in this sense, but their numbers are not predictive. They're their own numbers, and people trade on them one way or another, even if they don't think they're going to tell you what the actual BLS number is going to be. So the idea that you would not have numbers would serve only one purpose, and that would be to hide the performance of the economy under Donald Trump, which is one reason I think that he is appointing this person.
You know, on the one hand, I feel like the data's the data. There's not much he can do to it. But then I remember back to my junior investment banking days when I had to put the pitch book together, and you could manipulate those league tables any way you want to make your firm look more competitive. So data can be manipulated, I guess. What's the feeling in the market as to the authenticity of just government data in general?
There is concern that the data are becoming less scientifically reliable. I mean, they are scientifically valid, but because we've seen a decline in the response rates to a lot of these numbers, that it's getting harder for the statistical agencies to give you the same margin of error that you used to have. And they're having to impute more numbers now because their budgets have been cut and they have a harder time recruiting people to get out and check the prices and to make the phone calls and that sort of thing. Right. So there's been a general concern about that, but not because the statisticians are inaccurate, but because the statistical agencies are being starved of resources at a time when they do need to make some changes, right, because the way people relate to pollsters and people asking questions has changed.
Exactly. All right, Michael McKee, thanks so much. We appreciate that. Michael McKee, International Economics and Policy Correspondent. Here's an interesting red headline crossing the terminal. AI startup Perplexity makes $34.5 billion offer for Google Chrome. This is according to reporting in the Wall Street Journal. That was not on my bingo card.
Not at all.
I mean, A, I didn't know it was up for sale. B, I don't know much about Perplexity as a private company. And boy, that's a big number. But
Massive.
Maybe sensing that the government may be pressuring Google to break up some of its business and let's get in there early. But we will have more reporting on that. But Alphabet, the stock is up about 0.75% today. It's up about 7% on the year, and on a trailing 12-month basis, it's up about 28%, but 25%. It's got a market cap of $2.45 trillion. Does Alphabet. So that is interesting news. Perplexity makes a $34.5 billion offer for Google Chrome, and this is according to the Wall Street Journal. So we'll have more reporting on that, you can be sure, because that kind of gets your attention. All right, folks, coming up later this month, join us for live coverage from Jackson Hole. We'll be on the ground in Wyoming to cover the Kansas City's Fed annual meeting and remarks from Chair Jay Powell. It all starts Wednesday, August 20th, and finishes up with a special edition of Bloomberg Surveillance. Tom Keene, Lisa Bromwitz, and Michael McKee will be at that part of the special on 9 a.m. Friday.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story. Headline right off the Bloomberg Professional Service, AI startup Perplexity is making a $34.5 billion offer for Google Chrome. This, according to the Wall Street Journal. Alphabet shares up now by 1%. But again, repeating the headline, we're watching the story. AI startup Perplexity making a $34.5 billion offer for Google Chrome. Again, this according to the Wall Street Journal. U.S. stocks trading at just about the best level of the morning right now, with the S&P up 52, 64.26, a gain now of 0.8%. Dow Industrials up 429. That is a gain of 1%. NASDAQ also higher by 1%, pushing higher by 210 points. Indeed, records right now for both the NASDAQ Composite Index and the S&P 500 Index. Our Mag 7 Index up 0.9%. Cannot ignore the Dow Transports up 2.8%. 10-year 4.29%, but the 2-year 3.72%. Spot gold up 0.3%. 33.52 the ounce, and West Texas Intermediate crude oil down 1%, 63.33 a barrel. Bottom line here, stocks are pushing higher. How much further can the bull run? That question this morning for Dana Dioria, Co-Chief Investment Officer at Envestnet, who was a guest right here on Bloomberg Intelligence.
We have the indication that, now we've got another reprieve with China on tariffs. It seems to be the case that what was really driving the market crazy in April, Liberation Day, quote unquote, was sort of just a negotiating stance. And so the market has calmed down on that front. So you've got that, you've got the AI trade, you've got earnings keeping up. But I mean, we are at very high multiples at this point for this market.
Dana Dioria of Envestnet. Again, repeating our top story at this hour, the AI startup Perplexity has made a $34.5 billion offer for Google Chrome, this according to the Wall Street Journal. Recapping, stocks higher, S&P up 0.8%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pella, thank you so much. We appreciate that. As always, a Google Chrome story and Perplexity, really fascinating, and in anticipation of what might be a judge's ruling requiring some divestiture of some of Alphabet's assets. So we'll stay on top of that. Another area that, Ed Ludlow, who is our technology dude out there in San Francisco, he's been extolling the virtues of robo-taxis, autonomous vehicles. He's been in them. He's all in on this stuff. And I don't know. I guess we're going there. I don't know. I'm going to check in with the expert on this stuff, Andrew Grant, head of Intelligent Mobility at BNEF. Andrew, thanks so much for joining us here. Where are we with robo-taxis in the U.S., in the rest of the world? Give us just an update here.
Yeah, thanks for having me. So, wouldn't it be a great way to have a way to measure how the progress that we have on the robotaxi side and the self-driving vehicle side? Sometimes it can be quite difficult to monitor the sector, and there's a lot of promises made, and there's a lot happening in the kind of AI black box. And what we try to do is measure things that you can actually see and count. So we've been looking at some real operational statistics that have been coming out from some of the robotaxi companies, and coming up with a way to grade how serious an operation is. Are these projects actually operating on public roads? Are they offering their rides to the general public, or do you need to be on a selective wait list? Are they putting their money where their mouths are and charging a fee for the service? Do they actually have a safety driver in the vehicle, or humans still supervising in the vehicle, or have they pulled that? And are they able to operate in all weather conditions 24 hours a day, 7 days a week? And if they kind of score a 5 out of 5 in our grade, that's a fully functional operational robotaxi service. We count about 8 of those operating in different cities around the world. I should say around the world. At the moment, it's just China and the US.
Okay, so we're seeing China and the US as the two leaders here?
Yeah, at the moment, we have kind of 4 companies that have met those grades. We do have another 16 projects that are kind of 4 out of 5 on our ranking metric there. I should mention that Tesla just gets 2, but a lot of these companies are looking to expand outside their home markets, certainly expanding to places like Singapore, the Middle East, and the UAE, and then of course Europe, which at the moment there's regulations that are kind of preventing a wider spread rollout of robotaxis, but a lot of these companies are targeting 2026 for deployment across a number of European cities.
So who are the leaders here at this early stage?
I mean, really, you're talking about Waymo with the most projects that meet our grading of fully operational robotaxi services. But from the Chinese automakers, the China robotaxi developer side, you're also talking about Baidu, WeRide, Pony AI that are scoring highly on these metrics and looking to expand.
What are some of the regulatory hurdles here? Are there any areas in particular in the United States where it's a bit more open season?
It's a very complex regulatory environment at the moment because you can kind of have these national or federal level ambitions, but really it comes down to not just even state level, but down to city level, where you need to work really closely with a lot of these regulators to deploy these services in a tightly geofenced environment. So you need to be actively, if you're a robotaxi developer, you need to be actively talking to a lot of these regulators and helping them understand what you're trying to do and how you're trying to complement what they want to do on the public transport side or on their transport infrastructure side to make this work and make it a valuable project for both entities. So I always describe the regulatory environment. It's very iterative. You kind of need to tick one box, prove to your regulators how you're doing, and then continue to grow that relationship and kind of build the regulations with them. And a lot of knowledge exchange needs to happen as you progress.
Yeah, I'm just looking at your self-driving vehicle tractor at www.bnaf.com. Have to be a Bloomberg terminal user, I believe.
Yes.
But very, very cool. It's an interactive kind of model showing you where around the world. So what are the gating issues here, Andrew, for fuller and fuller deployment going out over the next several years? Is it regulatory? Is it technology? Is it capital? What are the key drivers for just, I guess, adoption over the next several years?
I mean, we talk a lot about the technology and the regulatory side, and both need to improve, and I think both will. What's probably doesn't get enough attention, and we're starting to see a lot more focus on that at the moment, is just the value chain really starting to take shape. Building a car, building the software and the related hardware that goes into powering a self-driving vehicle, matching the vehicle with users, owning the vehicle. These are all things that have different skill sets from a company perspective. They have different capital requirements, and they have different payback periods. So we're starting to see different roles form in this part of the value chain. You're seeing the many deals that, say, Uber has signed over the last 18 months. They've signed deals with at least 10 different self-driving vehicle developers across the taxi and truck space and the delivery bot space, I should say, as well. And they're really trying to match, put their best foot forward, or to borrow the Jeff Bezos expression, just focus on what makes the beer taste better and really specialize in the different areas. So we're really starting to see a more robust and definitive shape form for the robotaxi value chain.
Andrew, are you expecting any new entrants into this space or any new partnerships potentially?
Definitely on the partnership side, and there could be some new entrants on the robotaxi side of things, but really I think there's a room for many new companies to become involved in the robotaxi value chain, or maybe along vehicle ownership, operation, fleet management, that side of things, where a lot of the robotaxi developers want to remain focused on building out their technology and improving it on that side of things. They seem at the moment quite happy to work with a lot of the ride-hailing companies, your Ubers, Lyfts, and Didis of the world. So there's potentially significant room for companies to come in and actually own and manage and operate these vehicles in localized and distributed environments.
Andrew, thank you so much. Really fascinating stuff. And again, this self-driving vehicle tractor, go to bnef.com. If you're a Bloomberg terminal user, you need to get that for authentication. But you can really see where these things are being deployed and what stage of deployment it is. It's a great, great tool. Andrew Grant and the BNAF folks getting it done over there. Andrew Grant, head of Intelligent Mobility. I'll go with that. This is Bloomberg.
listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
Hey, Norma Linda here. Happy Tuesday here with Paul Sweeney on Bloomberg Intelligence Radio. My head is in the clouds today, or rather space. We're joined here by Bruce Einhorn. He's Bloomberg News editor and space reporter based out of our Princeton, New Jersey office. And he's here to kind of break down what's going on, what's the latest with the space industry. We're looking at shares of AST Space Mobile today. We're looking at the company that's headquartered in Midland, Texas. They build satellites in space so that regular cell phones can connect to space in the same way that they do cell towers here on Earth. Bruce, I want to kind of get an idea of what your main takeaways were from earnings that we saw out last night.
Well, the key thing with AST Space Mobile is they're building out their network of satellites. The goal is they want to have sufficient number of satellites, ultimately around 90 satellites in low Earth orbit to be able to provide service worldwide. At the moment, they only have a handful of satellites up there. So they're in the process of getting those made and then launched. They were pretty optimistic in their assessment yesterday in terms of how quickly they're going to be able to get those satellites up in orbit. They talked about having regular launches next year, and so I think that's one reason that investors seem to be enthusiastic about the company today.
Here's another company that I completely missed on AST Space Mobile. I mean, it's got a market cap of $18.3 billion. The stock's up 11% today, up 140% this year, up 160% on a trailing 12-month basis. So clearly the market likes us here. Bruce, who do they compete with? Because isn't like SpaceX doing the Starlink thing and stuff like that?
Yeah. There you go. They're competing with SpaceX. And that's one of the problems is they're competing against SpaceX because Starlink has a similar service that they're doing with T-Mobile, direct to device. At the same time that AST is competing with SpaceX in that business, they're also relying on SpaceX to get their satellites into orbit. They plan on using SpaceX rockets for some of their launches. They also want to use rockets from Blue Origin, the New Glenn rocket. Blue Origin, I'm sorry, is the company that's backed by Jeff Bezos. That rocket has had some issues. It had its first launch earlier this year. They were hoping to have a second launch in the spring. That didn't happen. We're now just waiting to hear when there's going to be another launch for the New Glenn. That said, the company, AST, seems to be pretty positive that they're going to get the rides to space that they need, whether it's from New Glenn or whether it's from SpaceX.
Well, we saw AST Space Mobile really laying out an ambitious plan here, launching 45 to 60 satellites this year and in 2026. They also said that they received 2 additional early-stage contracts for the U.S. government. But when we look on a broader scale, who's the real leader here? Is it Starlink, or who's getting the most government contracts?
Well, it's in this business in particular, the direct-to-device business. It's still very, very early in this in the development of this business. So while it seems that at the moment Starlink has an edge because they have the satellites up there, and they've started offering some service with T-Mobile, there's still quite a way to go. So there's plenty of room for AST here to catch up. AST, in their comments yesterday, did make the point that they need fewer satellites because their satellites are larger, so they don't need the thousands of satellites that Starlink has. They're talking about fewer than 100.
Who have they partnered with, AST? Who are their partners? Because I would think they would need some telecom partnerships here.
Indeed, yes. And they do have some big names. They have agreements to team up with AT&T, with Verizon, with Vodafone, a lot of other companies around the world. So they do have some big names. They are talking about having some service, what they call intermittent service, so not continuous coverage, but at least beginning to offer service in the U.S. by the end of the year and also in some other countries. And then their goal is sometime next year to have enough satellites up that they can ramp that up to more full-fledged service.
So when we're thinking about the industry more broadly, what is the estimate for when we actually expect to see that there will be no coverage gaps? Because the whole point here for this industry is that they're just trying to eliminate any sort of no signal, so you should be able to get signal whether you're in the ocean or some remote desert, right?
Yes, I think that's a good point that you're making. That is the goal. I think that while some people look at this and think, oh, I'll be able to use satellites for all of my cell phone stuff, all of my mobile devices, and I won't need to have a cellular network at all. I think for the most part, the idea is rather to fill in gaps to make sure that there are no drops in coverage. So with AST, the big question is just how quickly can they get the satellites up? So for the U.S. and their other key markets, they say that they need around 60 satellites. At the pace that they've laid out, they might be able to have those up by next year. We'll see.
Bruce, I know you're a graduate of Princeton University, so I have one critical question that I ask every graduate. Favorite sandwich at Hoagie Haven?
I'm going to disappoint you. I keep kosher, so I can't eat at Hoagie.
Dude, you're crushing me. Hoagie Haven does everything kosher there?
Well, you'll have to talk to my rabbi.
All right, very good about that. Hey, great story, Bruce. Appreciate all the reporting on this AST. Again, another company I miss. Bruce Einhorn, he's the editor and space reporter for Bloomberg News, joining us from our Princeton campus. All right, folks, Bloomberg is now in your dashboard with Apple CarPlay and Android Auto and access to every Bloomberg story. Okay, promo. Which one? There you go. I'm looking at the markets here. We got the S&P 500 up 56 points, 0.9%. The Dow's up 450 points. That's 1%. Bloomberg is now in your dashboard. Oh, no. For listeners in the U.S., a reminder, you can listen to us via satellite radio, Sirius XM, channel 121, access the world's only global audio business network, coast to coast, 24 hours a day. Stay with us. Balance of Power is coming up right now.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Tuesday edition with a big treat right off the top. Conversation with the new commissioner of the Securities and Exchange Commission, Hester Pierce. We'll have analysis immediately following with Nathan Dean at Bloomberg Intelligence. And as core inflation warms up, we learned that this morning in the CPI. We'll review the data with Bloomberg Economics editor Molly Smith. But first, Wall Street in a very good mood following the print here. Maybe there's more to it, including earnings. We start in New York, as always, with Charlie Pellet on the markets. Charlie, how's it look?
Right now, a lot of green on the screen, Joe Matthew. The core consumer price index increased by 0.3% from June, in line with economists' forecasts, and stocks are taking off. In fact, the S&P right now, best level of the session, up 55. That is a gain of just about 0.9%. We've got the Dow up 464, up 1.1%. The Nasdaq Composite Index up 210, up by 1%. 10-year 4.29%, the 2-year 3.73%, and spot gold up 0.2%, 33.48 the ounce. Recapping CPI Tuesday, stocks higher, S&P up 0.9. Balance of Power kicks off now. Back we go to Washington once again. Here he is, Joe Matthew.
All right, Charlie, many thanks to Charlie Pellet. We'll have a more complete readout on the markets and all the headlines driving business today a little bit later on in the hour here. About 20 minutes from now, we'll check in with Charlie at World Headquarters in New York. Thanks for being with us on Bloomberg Radio, on the satellite radio channel 121, and on YouTube if you want to watch the radio on TV. And this would be a good time to do it as we prepare to hear from the new SEC commissioner. Search Bloomberg Business News Live. CPI day. We're going to get into that, as I mentioned, a little bit later on with Molly Smith. The data here raising new questions about the trajectory of inflation. But we first want to hear from the big boss at the SEC, Hester Pierce, now in conversation on Bloomberg Crypto's TV program. Katie Greifeld holding forth in New York. Let's listen live now on Bloomberg.
Allow those retirement accounts to invest in private assets, to invest in crypto, or at least to allow it. How will the SEC approach this? What does that checklist look like?
Katie, it's great to be here. I think we've already started that process of opening the private markets to retail and thinking about ways that we can get them access in a way that's diversified, professionally managed, and consistent with their investing timeframes. And so I think we'll just continue with that work.
Appreciate that context. So as we continue on and as you approach this, talk us through some of the potential risks that you're thinking about, because certainly a lot of folks on Wall Street and elsewhere have been anticipating these rule changes, but there's also a lot of concern too about putting what are risky assets in retirement accounts.
Yes, I mean, I think those are legitimate concerns. What we've seen, of course, is that the public markets are dominated by several large companies, and also companies are waiting longer to go public. And so we're looking for a way for retail to get earlier access to the growth of companies. And so that's really the goal of it. But of course, you want to do it in a way that makes sure that we're not just using retail as a dumping ground for bad assets. So I think it's making sure, again, that there's professional management, that it's done in a way that's careful, and that we're paying attention to the risks associated with it.
A conversation I've been having around this topic is about how this isn't as simple as switching a light switch necessarily, that you're not going to see private assets, you're not going to see crypto in retirement accounts overnight. You said that you've already started this process on your end, you're working through that checklist. What do you see as the timeline here?
Well, I mean, I think even already we have loosened, SEC made restrictions that really were not based in law on the percentage of private assets that could be available in retail accounts. in funds that are available to retail investors. So I think that process has begun. We have a new head of our Division of Investment Management, and he's working closely with the staff and working also with people who have been thinking about how to do this in the private sector. So it's a combination of those things.
All right, well, appreciate the update there. Hope to keep talking about that, but I do want to move on, and I want to talk about tokenization. That obviously another big hot topic of the moment. And when we're talking about everyday investors getting involved with tokenization, what are some of the risks in your view that could potentially come about?
Well, I think there has been a lot of interest in tokenizing securities and other real-world assets, and that's something that really opened up after the SEC changed its perspective on crypto. So we're seeing a lot of interest from traditional financial firms and native crypto firms. And there are different approaches that are being taken to tokenizing. So we will work with people. We're willing to work with people who are taking different approaches. But it's really important that people be very careful about disclosing what the nature of the asset is. When you tokenize something, it's still a security. If you're tokenizing a security, it may be a security with different characteristics, and that's something that needs to be conveyed to investors. And it's also important to be aware of sometimes their trading restrictions or their restrictions on who can access particular types of securities. And so that's something people have to pay attention to.
And that's a point that you've made in the past, that tokenized securities are still securities. You do have some firms, I'm thinking of Robinhood, for example, rolling out tokenized stock trading. I believe that's taken hold in Europe. So, I mean, do you see that as a potential area where you could run into some of these confrontations over firms trying to really regulate and innovate and introduce measures such as that, but potentially coming up against some of these regulations that you're putting in place?
Well, without talking about any particular firm's approach, I think the bottom line is that we encourage firms to come in and talk to us. We expect that there will be some different approaches taken to tokenizing, and we're looking forward to working with folks to try those different models out and see what the market's like, and see whether or not tokenization of equity securities takes hold. I mean, that really will ultimately be up to the market. But what our message is that we're willing to work through different potential models with people.
Well, you said something interesting there. If tokenized equities take hold, and it's a good reminder that this is very nascent, that we're only just seeing the first few attempts at this come about. But should these tokenized real-world assets, should tokenized equities really take off, should we expect a formal pilot program from the SEC for tokenized securities?
I think the pilot program, again, is more likely to look like multiple pilots with different people coming in and trying to do this in different ways. And again, we're not trying to be the picker of winners and losers, but letting the market decide. So really, we expect that there will be multiple options.
I do also want to talk about how you interact with some of the other regulatory bodies in DC. For a lot of folks, it's kind of like alphabet soup. You have the SEC, you also have the CFTC. And I'm wondering how you work with the CFTC on crypto right now, if at all. What does that relationship look like?
We have a good relationship with the CFTC. We've worked with them. I personally have worked with the CFTC over the years on a number of issues, including security-based swaps. And so right now, both agencies are coming off the President's Working Group report recommendations. We're both trying to implement those recommendations, the ones that we can start already, absent market structure legislation. And so we're coordinating with the CFTC on moving forward on those recommendations.
Well, to that point, one of the recommendations was that crypto exchanges and other crypto entities that are registered with the SEC, that they should have to pay transaction fees the same way that traditional brokerages do, for example. Do you agree with that?
I certainly understand that we need to have the fees fall on the people who are benefiting from the revenue of the fees. So I think that as the markets change, those changes should be reflected in fee revenue.
And Commissioner, you also brought up market structure. We know that that crypto market structure bill is working its way through. The sense seems to be on the street that it faces a much tougher go-ahead than the stablecoin bill, for example. I would love to hear your thoughts there.
Well, I don't prognosticate about legislation any more than I do about where the markets might go in terms of which models of tokenization they might embrace. But I do think that the work has been really impressive on the part of the House, and the Senate is now looking at these issues. It's a very complicated piece of legislation to work out, but I think important, and we're happy to work with people in both the House and the Senate on trying to get it to the place where it will help to guide the shaping of the industry.
And just game planning here. Let's say that Congress isn't able to finish this market structure bill by November. What would that mean for the SEC and your approach to regulation?
I think one thing that's important to underscore is that we at the SEC are not waiting for legislation to work. We have a lot of work that we can do under the existing authority that we have, and we think that the President's Working Group report urged us to take those steps. And so we've been working since January on providing guidance about where the securities laws apply, and then where they do apply, helping firms to navigate those rules. And so that's something that we are hard at work on. We're working on rulemaking, and we think that what we do will be consistent with whatever market structure legislation comes out.
And Commissioner, I do want to talk a little bit about Project Crypto. I know that that's put together to help implement the Presidential Working Group's recommendations. How is that project going right now? What does that look like?
I mean, it's going very well. We're working very collaboratively with staff all across the Crypto Task Force is working collaboratively with staff across the building at the SEC. We are meeting with industry and with other interested parties. We're taking written comments as well, and we're putting that together into a package of reforms. As I said, we've already gotten some guidance out the door, but we are hoping to get some proposed rulemaking out the door as well.
Well, Commissioner, we really appreciate you taking the time to speak with us today. That is SEC Commissioner Hester Peirce. Now, coming up next on Bloomberg Crypto, we'll be speaking with...
There you have it from Katie Greifeld. Many thanks, Katie, for the great conversation with the Commissioner of the SEC. I'm Joe Matthew in Washington. Thanks for being with us here on the Tuesday edition on the early side on Balance of Power on Bloomberg Radio. Dial us up if you want to watch the radio on TV. On YouTube, search Bloomberg Business News Live. As we want to keep this conversation fresh with Nathan Dean, our friend at Bloomberg Intelligence, was listening along with you and I, senior U.S. policy analyst. When we consider, Nathan, great to see all the angst that surrounded her predecessor here at the top of the agency. What is the approach that makes her different from Gary Gensler?
Well, Gary Gensler took the approach for when it comes to crypto that 1930s era securities law still applied, and therefore you had to come in and register, and you sort of had to fit your plan within something that hadn't been updated in 90 years. What the SEC is doing right now, on the other hand, is they're saying, look, we now have a new digital asset class, and there needs to be new rules for the road to determine how is this going to operate in today's markets. So, they mentioned in the interview the Clarity Act. This is the bill that's going through Congress. Think of that as like a touchdown, using a football analogy. What the SEC can do on its own gets in the field goal range. So it's not exactly going to get you exactly what you want from the Clarity Act, but what the SEC is doing in terms of clarifying what is a security, what is a commodity, and trying to figure out how firms can operate within today's regulations will certainly be much more beneficial to the Robinhoods and the Coinbases of the world than what we saw under the Gary Gensler era.
So as we try to unravel that, there was an interesting question about working with the CFTC, the extent to which the SEC can even do that without a leadership role at the CFTC. What did you make of her answer?
Well, so I think obviously the SEC and the CFTC are going to have to work together on this because remember, the SEC has authority over securities and the CFTC has authorities over commodities. And Bitcoin has already been deemed by the courts to be a commodity. And I think most of the crypto world wants their assets to be within the CFTC realm. The problem is that we don't have any permanent leadership over the CFTC.
Right.
You know, Brian Quinten's former CFTC commissioner was confirmed. Then the Senate Ag Committee pulled back, due to some reporting that maybe some folks in the crypto space aren't exactly thrilled with this idea of new regulation coming in. So I think for anything to really happen, you need both agencies to be working together, and you need that leadership to be put in place over at the CFTC so they can drive their changes forward in addition to what the SEC is doing, because I think most of the crypto world is interested in what the CFTC will eventually be doing.
Interesting. One of the headlines across the terminal from that conversation, Peirce says, not waiting for legislation to work on crypto. What can the SEC do without it?
So essentially, the SEC can, at a first point, go out there and say, look, we're not going to put you into enforcement violations.
Okay.
The idea of a gotcha violation.
Yeah, sure.
And what Commissioner Peirce was talking about was almost what we call in the regulatory space is principles-based regulation. She talked about pilot programs, and she said, well, we're going to have multiple pilot programs. To me, what that says is that we're just going to test maybe regulatory sandboxes, innovation, but we're going to go out there and we're going to let crypto firms develop what they think is going to be meeting the spirit of the regulation. They'll come to the SEC, and the SEC will say, great, we like this, you can continue with this. We don't like that. Remember, she said in the tokenization piece, securities are still securities,
right,
but you're not going to get hit with the gotcha violation for it. So it's going to be a little bit more innovative for the industry.
Looking at Bitcoin, where are we today as we discuss all of this? Just below $120,000. It's up a little bit less than 1% today. There was a huge development recently that the president signed the executive order to allow 401ks to start using crypto. Wasn't that supposed to be the floodgates moment? How come we're not at $250,000 on this?
Well, because I remember the executive order is just the first start of this process.
So when is that complete?
Well, so the executive order directs the Department of Labor and the SEC to go forth and conduct rulemakings within 180 days.
Okay.
Now, we think the Department of Labor, because remember, they own the retirement account jurisdiction due to ERISA. They're going to put out a proposal, we think, sometime between now, most likely either the beginning of next year. Then it has to go through that comment period.
Okay.
Where I'm going is you're not going to get a finalization on a proposal until mid to late next year.
Wow.
But then even at that point, well, if I'm a 401k fiduciary, do I want to bring in Bitcoin? Do I want to bring in Ethereum? How do I deal with the risk profile of a decentralized asset? I think you're going to see 401ks programs to come in and say, look, we are going to start investing in crypto, but it may not be the floodgates that people were anticipating.
Well, it's really interesting. As a forward-looking mechanism, you would think that they'd start pricing this stuff in, because this is the story we've been hearing for years, right? Once we get these in retirement accounts, once there's an industrial component, this thing goes to the moon. That was the justification for $1 million coin, wasn't it?
Well, I think also a lot of it is the institutional adoption, because look, retail adoption is out there in terms of speculation, but people want to see in the crypto space, they want to see institutional adoption. That usually only would come, I don't think that would come unless the Clarity Act passes.
Understood.
That gives those companies the ability to have their breather and say, look, we can go forth and actually develop strategies on bringing in crypto, but at the end of the day, there's a risk profile. These fiduciaries have to make sure that they're not just investing something that goes to zero. I'm not saying it would, but again, they have to account for the risk profile.
Interesting. So once the legislation passes, then we could see a repricing of the coin, I think is what you're saying, yes?
Well, I think once the legislation passes, the crypto advocates don't really have anything else that they would want from Washington.
Got it.
Now it's up to the market.
Understood. As we spend time with our friend Nathan Dean, I see you're writing about pot again. Trump's remarks point to marijuana status change, but not in second half. What is Nathan talking about? This elusive rescheduling that we've touched on so many times. It had cannabis investors in a tizzy this week, and the president did speak. Well, he was asked about it. He didn't bring it up at the news conference yesterday. Here's President Trump.
We're looking at it. Some people like it. Some people hate it. Some people hate the whole concept of marijuana because if it does bad for the children, it does bad for people that are older than children. But we're looking at reclassification, and we'll make a determination over the next few weeks. Very complicated subject, the subject of marijuana. I've heard great things having to do with medical, and I've had bad things having to do with just about everything else.
Since we're older than children, we can talk about this. Just that moment sent pot stocks on a tizzy. The MJ ETF was up like 27% in a day. Of course, we'd have to do that about 1,000 more times to get back to our high. But has anything changed here in your view? Is getting some lip service, has anything actually changed in terms of policy?
No, I mean, I think that answer was really good at saying, yes, we're going to do something, but maybe we won't.
We won't.
You know, what I'm going with is I think you are going to see an announcement from the White House coming to the DEA saying, look, we are going to move forward with some form of reschedulization, but I think it's going to be under the guise that there needs to be more analysis. That's not exactly what the pot community wants
They've
to
heard
hear.
that before.
Because we do think anecdotally that this DEA is not in line with this move. Terrence Cole, the administrator of the DEA, has a history of anti-marijuana views.
Yeah.
So what I think, to be careful from what we're saying to our clients is, look, I do anticipate you're going to see a positive announcement that will get folks saying, look, reschedulization has happened. But let's remember, we've got 12,000 comment letters to write or to read. We've got a couple more hearings to go through. We've got additional studies and analyses to go through. That can't be done in 2025. And so I don't think this is going to I think this is going to be slow walked. I think they're going to continue to play this process out, and we'll have to get a better idea if they're actually going to do it in the first half of next year.
So it sounds like for investors who've been sitting on these stocks and watching them go down in just a painful process since everyone got their hopes up ahead of the Biden administration, that nothing's about to change anytime soon. If you're going to make money, it's on volatility.
Exactly. I mean, most of these, the reason why these stocks are going up 20-30% is because these are low dollar denomination stocks. I mean, these are $5 and less. My colleague Ken Shea just put a note out just this morning as well, saying, look, the marijuana industry is struggling, and even if you get reschedulization, it's not going to change a lot of parameters from the fact that, there's a lot of issues going on with marijuana at the moment in terms of logistics, in terms of compliance costs, in terms of risks. And even if you get full legalization, which we don't think is in the cards anytime soon, you still are going to have market-sensitive pressures against this industry. So, reschedulization gets you that 20% bounce that, you may want from a speculation perspective. It doesn't get you much more than that.
We get safe banking in the next year. Nobody talks about that
Nobody
anymore.
talks about it.
Wow.
We don't think it's in the cards.
Not in the cards. Incredible. As the president considers the whole concept of marijuana. I think the way he puts that. By the way, somebody told me recently only old people call it pot now. Is that?
I still call it pot, so I must be old.
Nathan Dean, we'll be old together. Bloomberg Intelligence, many thanks, sir. His phone's ringing off the hook. I sit right next to Nathan, and this is, in fact, what people are calling about, well, at least on a day like that. Imagine having Nathan at the other end of the phone. That's why we bring him on every week to talk to us here on Balance of Power. We do want to watch Wall Street. Aside from pot stocks, some movers today on this CPI day, and we're going to get with Molly Smith on the data after that. Charlie Pellet takes a look at the markets in New York for us. He's live at World Headquarters. Hey, Charlie.
Well, hello there, Joe Matthew. And a word, we're higher. S&P 500 index up 57 right now, looking at a gain of just about 0.9%. Dow Industrials up 456. That's an advance of 1%. NASDAQ up 225. NASDAQ Composite Index higher now by 1.1%. S&P topping 6,400, hitting a record today. Russell 2000 Index of small cap shares up now by 2.1%. All of this as an inline inflation reading this morning bolstered speculation that the Fed will have room to cut rates in September. The 10-year at 4.30% with the 2-year currently yielding 3.73%. Spot gold up $4 the ounce at $33.47, up by 0.2%. And West Texas Intermediate crude down 1%. WTI $63.30 for a barrel of West Texas Intermediate crude. Bitcoin, just talking about crypto, right now up 0.8%, just below $120,000. Bitcoin at $119,790. We're keeping an eye on shares of Alphabet. Right now, Perplexity has made a formal offer to acquire Google's Chrome browser for $34.5 billion. This, according to a Perplexity spokesperson. Shares of Alphabet right now, they're up by 1.2%. Recapping, stocks are gaining. S&P at a record 64.30 right now, up 57, up 0.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. Back we go to Washington. Balance of Power continues now. Once again, your host, here he is, Joe Matthew.
All right, Charlie. Many thanks to Charlie Pellet, as ever. He's a big part of this program, and you'll hear from Charlie again in about 15, 20 minutes. We'll take another look at the markets. This is the way we get to talk politics and connect the dots between Washington and Wall Street every day here. And coming up, we will do just that with Molly Smith, Bloomberg economics editor on the data this morning. Speaking of connecting the dots, the most important story today, I'll say it out loud, for anybody on Wall Street or in Washington, is the great work of Dan Flatley and Eric Schatzker, Scott Bessent on tariffs, deficits, and Trump's economic plan. A lot of people have an opportunity to talk to Scott Bessent on TV. I love that, by the way. Look at the cover there if you're with us on YouTube. They gave him his own coin. Is that like a crypto thing? Bessent coin? I digress. This is one of the more important stories when it comes to policy and understanding a man who you hear about and see on a daily basis in these snippets of 9 or 10 minutes. Dan Flatley spent the whole day with him, went around town, saw him behind the scenes, trying to get a sense of how the man operates. Because I think if we've learned one thing, it's that he's got the president's ear, typically the last to talk to the president before he makes a decision on policy, whether it's interest rates, tariffs, or otherwise. Dan Flatley is with us right now, and it's great to see you. The best scent with a C, Matt. That's good. How are you? Thanks for coming over.
Doing well, yeah. Thanks, Joe.
This is a great piece of work, and we were talking off the air. This is one of the most challenging projects that we've really had in this new administration, getting to this Treasury Secretary, who I would argue is a more prominent Treasury Secretary than maybe we've seen since the Clinton administration. What did you learn about Scott Bessent you didn't know?
Well, he's an interesting person to be running the Treasury at this moment. I think that, a lot of the people that I spoke to and Eric and I spoke to pointed out that his experience as a macro investor, as a strategist, as somebody who's an expert on currencies really comes into play if you're trying to reorder the global economic order, if you're trying to implement tariffs, if you're trying to do a lot of the things that the Trump administration is trying to do. So he's very well prepared in that sense. He knows the economics and the strategy inside and out. And he does have, or is viewed to have, I should say, a moderating influence on the president.
Yeah. Is that a fair view after the time you spent with him?
I think that he is a calm, cool, collected person, I think is fair to say. He does not see himself as a moderating influence on the president.
Really?
So the way that he describes his role is that he gives the president options and outcomes. So, you could kind of draw your own conclusions as to how that influences the president. The president, of course, is very against the idea of anyone telling him what to do. There was some reporting earlier this summer about Bessent urging caution on the Federal Reserve, and Trump really pushed back hard on that on social media. And so I think that Bessent is very much reluctant to be seen in that light. And I also think that that's not how he views himself or his role. He views himself, I think he would even hesitate to call himself an advisor or a counselor. He just sort of tells the president, look, if you do this, this is what could likely happen. The one thing that he is known for, or at least what people have emphasized in our reporting, is that he tries to see around corners, quote unquote. And so his value to Trump, or one of the things that he brings to the department, is this idea of trying to basically see around corners, see what the unknown unknowns are, if you will.
Yeah, sure.
Yeah.
Well, I love this breakout quote. It's very easy for the building to run you, he told you. You could be a great manager here and have good bond auctions and get the tax bill done, or you can have bigger goals and leave an imprint. It makes me wonder about Scott Bessent as a manager, but also Scott Bessent as a visionary, because that's the type of talk that could redefine the role.
Yeah, look, I mean, I think it's his role has expanded. He's negotiating trade deals, which is very unusual for a Treasury Secretary.
In a literal sense now, too. He's running the IRS, for crying out loud.
He's got two jobs. He's not only the Treasury Secretary, he's the acting head of the IRS. Obviously, IRS falls under Treasury, but it's unusual to have the Secretary in that role. It was interesting, one of the things, there's a lot in the story, and I would encourage everyone to read it, obviously, but I think one of the things that really comes through is that he is thoughtful. And he is thinking about not just what he needs to do on a day-to-day basis, but what his legacy wants to be, or what he wants his legacy to be, I should say. And one of the things that he said, and you quoted, is that, it's very easy to let the building run you, but I have this list of things that I want to accomplish before I walk out the door. And obviously, he's been thinking about this list of things for a long time. One of them is dollar supremacy. One of them is bank deregulation. One of them is, and maybe the primary one is this idea of, he calls it parallel prosperity. And it's the idea that both Wall Street and Main Street can do well. And one of the things that I think is clear in our conversations with him is that he's very much worried about, if we don't sort of shore up capitalism per se, that people will really lose faith in that system, and that could lead to some dark places. Now, of course, we pushed back on some of his views and asked him, what about the debt and deficit? You came in as a debt hawk, as a deficit hawk.
Yeah.
The one big beautiful bill increases the debt and the deficit over the 10-year time frame. And he has an answer for that, which is economic growth will offset that.
Sure.
We asked him about tariffs and trade and this question of even the BLS, the firing of the BLS supervisor, and he gave us a statement on that. I mean, he's defended all of these moves, of course, and that's his job. And
Yes,
I do think that to a great extent he believes in the mission that he is on there. But, there are differing views. And so I think that we present that in the piece as well, that there is, this is not, it's a bold experiment. It might work, it might not.
Wow.
And he will certainly be one of the figures that is working on it and will be held responsible if it doesn't work.
Did you guys go to Butterworth's or anything?
No, it's a great question. I mean, we did get we were very fortunate to get a lot of time with him. He's very generous with his time. This is one of the few print interviews that he's done since being in office, and so we're certainly appreciative of the time that he spent. I actually got a chance to observe him in this meeting with some folks from South Carolina. Of course, he's from South Carolina himself. And in that meeting, it emerged that his Secret Service code name was Swamp Fox.
What?
Which
Really?
Yes, which
Awesome.
is it's in the story. And it's a reference to a Revolutionary War figure who was from South Carolina.
Great.
And he was very proud of that fact. He let it be known to this group, and they
That's
were all
great.
very appreciative of that. And the other thing that was interesting in that meeting is that he sort of said, people ask me if I want to run for office, and he said, I'm not interested in that. I have one boss, and he's a lot. He might be as much as 5 million voters in South Carolina, but I feel very privileged to be in this position that I'm in. I serve at the pleasure of the president and all of that.
Yeah.
But yeah, I mean, he's got a sense of humor. He's an interesting guy. He's humorous and thoughtful and all of that. But he's the spotlight's going to be on him for quite some time, and it is not a set of policies that are without risk.
Spotlight starting with the cover of Bloomberg Business Week. Dan, thank you so much. Sure. Check this piece out. Dan Flatley and company. Eric Schatzker. Great read. Swamp Fox. I'm Joe Matthew. This is Balance of Power. We have to get to the data. As promised, Molly Smith has been patiently waiting for us at World Headquarters in New York because it's CPI day, and we saw a little warm-up on the core this morning that does not seem to be bothering Wall Street, but maybe that's the whole point. Molly joins us to look under the hood. Molly, what's got your attention here? Is this the beginning of what a lot of people have been predicting in the age of tariffs?
Hey, Joe. Honestly, I think this report threw a few of us for a loop that this really was so much more of a story about services inflation rather than goods. And the good side is what we've all been really carefully monitoring for to see the pass-through of tariffs, which did happen, but to a much lesser degree than what we saw in the June data. So if anything, I think this is now probably pretty concerning for the Fed, who maybe was starting to think that services inflation was getting to be more under control, at least compared to, in the years when inflation was really spiking, it was so much because of services, but had largely been subdued more in recent months when we were focusing on the good side of the equation. So we might now have to really be paying more attention to services again.
Is this a sigh of relief then at the White House? Everybody's been predicting tariff inflation, and we just aren't seeing it yet.
Well, certainly that's how President Trump took it. You saw that he posted on Truth Social after the data saying that, everybody's been wrong about tariffs. They're not causing inflation, specifically called out Goldman Sachs for putting out an incorrect estimate of what he said is incorrect about that. Look, there definitely are signs that tariffs are boosting inflation. It's just a lot more limited than what we thought it was going to be in terms of how severe the impact would be, how lasting it would be, and how broad.
You got PPI tomorrow, right? Or is it
Thursday?
2 days from now? What are you looking for?
Take a beat, Thursday.
Yeah.
Yes, so we have PPI coming up on Thursday. So that's a report on wholesale inflation. And then Friday, retail sales is another big one in the meantime, as well as consumer sentiment. So there's going to be more looks to see how consumers are reacting to tariffs. That's certainly what we're going to be looking for in the retail sales report, since that largely captures spending on goods. Of course, we have all this drama with the BLS in the meantime that Dan had just alluded to beforehand. So that's also keeping us pretty busy.
Yeah, we're going to have to talk about that a little bit more. EJ and Tony, are you guys friends?
Not yet, at least. No,
Okay.
we are not. I wouldn't say we're friends, but maybe getting to know each other, hopefully.
Well, yeah.
At
You're
least
going to be
I've gotten
relying
to
on
know
his
him a
data
lot
quite a
better.
bit.
Sorry?
Absolutely.
Yeah.
You're going to be using his data quite a bit starting right now. Molly Smith, thank you for joining us as always. Molly is at World Headquarters in New York. With our eyes on the CPI, goods inflation more subdued, Molly's going to start worrying about services. How about that? You hear it first from the editor, the person who cranks the data out on the terminal. We'll assemble our panel next. Thanks for being with us here on the Tuesday edition of Balance of Power. Rick Davis and Jeannie Shanzano are on the way in. This day after the president deployed the National Guard to the streets of D.C. We'll go to ground ahead on Bloomberg.
It's 1240 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, and NASDAQ all advancing as an inline inflation reading bolsters speculation that the Fed will have room to cut rates in September. Here's where we stand. S&P right now, best level of the morning, of the afternoon right now, up by 59. That is a gain of 0.9%, 64.33. We've got the Dow up 465, now up 1.1%. Dow Industrials 44,439. While NASDAQ is up 238 for the NASDAQ Composite Index, a gain now of 1.1%. The NASDAQ 100 Index also up 1.1%. The Russell 2000 Index of small cap shares is surging 2.2%. The 10-year, 4.29%, with the 2-year, 3.72%. Spot gold up $7 the ounce, $33.49, up 0.2%. And West Texas Intermediate crude down 1.3%, $63.15 a barrel on WTI. So again, update for the Dow, the S&P, and NASDAQ after this morning's CPI report. David Kelly is Chief Global Strategist at JP Morgan Asset Management.
I think there's very little argument that in favor of the Fed cutting rates. Rates are not abnormally high. I don't know why they think 3% is a neutral rate in the long run. It doesn't equate to history before the pandemic. I think something 4.5% is more of a neutral rate anyway. But there is no urgency about cutting rates. Now, I think they will cut rates for political reasons, which is very unfortunate, but I don't think they should based on these data.
David Kelly of JP Morgan Asset Management interviewed this morning on Bloomberg Surveillance. The dating service provider Match Group has agreed to pay $14 million to resolve FTC charges. Federal Trade Commission says Match online dating misled users about guarantees. Right now, Match up by 2%. Recapping stocks higher. S&P up 0.9%. Balance of power continues right now. Back we go to Washington. Once again, your host is Joe Matthew.
Okay, Charlie, many thanks. We'll get back to Charlie Pellet at the top of the hour for his view on the markets on this Tuesday. Thanks for coming along. It's Balance of Power, live from Washington, where we're still looking, in some neighborhoods at least, for all the uniformed troops and federal police officers. It's not that obvious, I have to tell you. Maybe I'm just in the wrong neighborhood, though the president said it would be in the big tourist areas. Right here I sit in downtown D.C., so it doesn't look like Armageddon. If you're curious about the optics here, I guess there were some arrests overnight. And the Attorney General, Pamela Bondi, on Twitter, writing, I just concluded a productive meeting with D.C. Mayor Bowser at the Department of Justice, the mayor just down the street with the AG. We agreed, she says, there's nothing more important than keeping residents and tourists in Washington, D.C. safe from deadly crime. At President Trump's direction, the Justice Department will work closely with the D.C. city government and D.C. Police Department to make Washington, D.C. safe again. Sounds like a good old collab, more than a federal takeover. We did hear from Mayor Bowser following the president's announcement yesterday. Here she is.
We are American citizens. Our families go to war. We pay taxes and we uphold the responsibilities of citizenship. And while this action today is unsettling and unprecedented, I can't say that given some of the rhetoric of the past, that we're totally surprised.
Well, there you have it. Long in coming here as the president announces that the police department will be under direct federal control and he will deploy the National Guard to the streets of D.C. It seems we haven't seen them quite yet. 800 of those troops are on the way. And there's an interesting leg to this story because if you were with us yesterday, you heard a lot of concern after the president called out Chicago and New York about this being duplicated in other places. The stakes would be different. The rules would be different. Those are, of course, not the federal city, and they don't live under a home rule act. The Washington Post says the Trump administration is now evaluating plans that would establish a so-called domestic civil disturbance quick reaction force. This is not like a domestic incident where you call the police. This would be composed of hundreds of National Guard troops, as they say, tasked with rapidly deploying into American cities. 600 troops on standby at all times so they can deploy in as little as 1 hour. With Minutemen standing by to deal with trouble in our own cities. They would be split into 2 groups of 300, stationed at military bases in Alabama and Arizona. One side of the Mississippi goes to you, the other side goes to the rest. Interesting concept here, just hours after there was an argument about whether this might be extended to other cities. We bring in our political panel for their take on this and a lot more going on today. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us. Jeannie is Senior Democracy Fellow with the Center for the Study of the Presidency and Congress. Rick is partner at Stone Court Capital, a Republican strategist, and great to see you both. Jeannie, is this what you had in mind yesterday when you were talking about other cities? It's one thing to make threats, but to actually create a domestic civil disturbance quick reaction force strikes me as something that you would actually want to use if you have it. What's your view?
Yeah, I mean, I don't think we knew yesterday, and I don't think we still know today where this is going. And we've heard the reports that you're talking about. And the concern, of course, is that Donald Trump may not be able to contain himself to Washington, D.C., where he is legally allowed to do this, but go to other cities in the way that you're talking about. And that's got to be concerning, particularly for conservative Republicans, for whom the idea of a large, strong federal government, energetic, coming to their local communities and telling them what to do and when and controlling is a bridge too far. And to me, there's a lot of reminiscence of Donald Trump with immigration. And that's why I think we need to wait and see how this pans out, because what's happened in that context is he's gone too far for many Americans. It's one thing to close the border to illegal immigration. It's one thing to address the issue of illegal immigration, but it's another to start picking people out of schools and off the streets. And so I think in this case, we might see a similar context of overreach by the president that is going to turn people off, Republicans and Democrats alike.
It's interesting here, Rick. This goes back to the first administration when President Trump, following the murder of George Floyd and a lot of the protests that we saw, wanted to employ active duty combat troops. And it was the then Defense Secretary Mark Esper who talked him into using National Guard troops. Since then, they did actually test this whole idea back then for fear of violence around the election. Split the country in half with the Mississippi. You've got 2 units ready to go, but it was never about quelling violence or, I don't know, fighting crime or however it is that we're qualifying this. Could you see this actually passing muster in the courts? Because it's one thing to use the National Guard here in the federal city. It's different when you start going into other states.
Well, you know, the fundamental aspect of this is, you know, normally when you use military assets, it's under the legal framework of Title 10. It's very clear what you can use them for, what you can't. In this case, evidently this document talks about using Title 32, which is a completely different statute than what is typically employed, much more focused on National Guard. It's a little confounding because you can't use an Arizona National Guardsman in California. They're there for the state that they belong to and under the control of those people in that state. So, yes, the president has the discretion. As Mayor Bowser articulated, I thought, well, yesterday, that he's within his rights to do what he's doing. And, you know, this is why, as a conservative Republican, it's disturbing because, as Jeannie said, if you have the right to do these things, you make use of that right. And Donald Trump has proven in his first term and now a number of times in his second term that he likes the use of military assets, National Guardsmen, and active duty, like he deployed Marines in L.A. To deal with civil disobedience, whether it be violent or not. And so I don't like the idea that these rights are so easily exercised, you know, and I think that it's a dangerous trend. And I'm actually surprised I'm not seeing lots of tweets from conservative Republican senators who would likely feel the same way if this were a Democrat doing this.
Really interesting, Jeannie. Rick points out an important point here. The fact that National Guard members cannot just go from one state to another. You cannot operate in a state other than the one you are in without permission. Could Donald Trump go to red state governors and ask for their help deploying their troops? How does he get around that?
Yeah, I mean, legally, that's what he would have to do. And he's less likely to ask for their help than direct them. And as we're seeing in Texas in a different context with the redistricting, they are prone to go along with it. And I think what is so troubling to so many people about this is that every thinking person wants to address crime. And I give the mayor of Washington, D.C. so much credit for her statements yesterday and today, talking about welcoming more troops, more police officers to help them combat crime and their partnership with federal law enforcement. That said, the most violent day in Washington, D.C. of late was January 6th, when President Trump was in office. And we didn't see him do this on that day in response to that kind of violence against police officers, with police officers and protesters killed. So what is troubling to so many people is President Trump once again seems to want to exercise this force against his political enemies, not against all people exercising violence or engaging in violent behavior. And of course, it's only a few months ago that he comes into office, and his first act is to pardon the over 1,000 people who were convicted of violence in D.C. on January 6th. So that is what is most troubling. If he was serious about combating crime, he would have done it that day as well, because we know he's talked about this back to his first term.
Rick, you talk about the way conservative Republicans may view this. They would have an opportunity to weigh in here when lawmakers get back. The law, the home rule law that we've talked about here governing the way Washington, D.C. is run, allows the president to take control of the city police force for 30 days. We talked about those 48-hour increments. Apparently, there is a total duration of 30 days in which he can do this. Extending beyond that point would require an act of Congress. If Democrats write a bill opposing what the president is doing, or if they're asked by the president and they say no, will Republicans join them?
You know, it's an interesting question, because I don't think there is any dissent that D.C. should be safer, D.C. should be cleaner, there should be a better solution to homelessness. I mean, I think these issues that Donald Trump has pointed out are universally felt around Washington. I mean, we've heard lots of debates in Congress, including withholding federal funds to the district because of policy measures that they believe in Congress don't meet the needs of the community. And so, yeah, I think that there's a general attitude that we need to clean up Washington. And regardless of how it compares to previous years and violent crime versus nonviolent crime and things like that, you can get lost in that debate. At the end of the day, I think you're going to find universal support for the idea of making Washington safer and cleaner.
Interesting, Jeannie. What are your thoughts on that? If a Democrat initiates that legislation, would that be enough for the bill to be DOA? Does a Republican need to start this conversation?
I'm not sure. We may find a few Republicans going along with Democrats, although, as of course, the last 6-7 months, that has not been the case. In this context, maybe. And I agree with Rick. Everybody wants a clean, beautiful, safe Washington, D.C. The problem that Donald Trump has, it's the execution of this. Number one, the overreach I talked about. And number two, is this the best use of federal resources? As many people involved in crime, researching crime will tell you, that the idea that you take federal officials who are not trained to do the work of police officers on the ground in any big city and put them in a big city without training, does that make any sense? This is why some people say if Donald Trump's truly interested, invest more in police training, in police officers in D.C. Why federalize when most people agree that's not the best solution if there is indeed a problem, which again, the statistics don't show. But of course, you can always be safer and cleaner. So why not do that with an investment in the very people and the training of the very people whose job it is to do this, not pulling federal officers and FBI officials off of other jobs and having them do this for political reasons.
All right, Jeannie and Rick Davis, thank you both. They'll be back in our second hour after we have a conversation with Nizar Nakaktor, who's going to be joining us here. Nizar Nakaktor on the president's decision to delay the truce with China by 90 days, also telling companies to avoid NVIDIA and AMD AI chips just after the licenses were approved. We'll have that conversation and also welcome two members of Congress, Tim Burchett from Tennessee, Jake Auchincloss from Massachusetts, all part of Hour 2 of Balance of Power, straight ahead here on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
China rejects the AI olive branch from President Trump. Welcome to the Tuesday edition of Balance of Power here on Bloomberg TV and radio as Beijing tells companies to avoid NVIDIA's AI chips just as the licenses are approved for their sale. We're going to talk about this along with President Trump's decision to extend the China trade truce with Nazak Nakaktar at Wiley. She'll be with us in just a moment. We'll bring you conversations with Republican Congressman Tim Burchett of Tennessee and Democratic Congressman Jake Auchincloss of Massachusetts. And we'll have analysis from Bloomberg Politics contributors Jeannie Shanzano and Rick Davis. It's all after a look at Wall Street on this CPI day. Everybody's in a good mood on Wall Street as we check in with Charlie Pellet at World Headquarters in New York. Charlie?
Thank you very much, Joe Matthew. Not just a good mood, but perhaps the best level of the day right now on the S&P 500 index, up 61. Yes, at a record 64.35 on the S&P 500 index. We're looking at a gain right now of 1%. The Dow up 450. That's an advance of 1%. While the Nasdaq Composite Index is up 253 points for Nasdaq, an advance now of 1.2%. Our Mag 7 index up 1.1%. The Russell 2000 index of small cap shares surging 2.2%. An inline inflation reading bolstered speculation the Fed will have room to cut rates in September. That's driving stocks higher. The 10-year 4.29%, with the 2-year 3.73%. Gold is up $6 the ounce, $33.48, up by about 0.2%. A retreat for West Texas Intermediate crude oil, now down 1%, $63.32 a barrel, and Bitcoin up 0.6% at $119,595 on Bitcoin. The AI startup Perplexity says it has made a formal offer to acquire Google's Chrome browser for $34.5 billion in anticipation of requirements that may be imposed on the search giant in antitrust proceedings. Right now, we do have shares of Alphabet. They're advancing by 1.5%. Again, recapping, stocks are higher. CPI Tuesday with the S&P up now by 1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Balance of Power continues now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, many thanks. Live from New York, the voice of Wall Street and the New York subway, Charlie Pellet. We'll have more on the markets coming up about 20 minutes from now here on Balance of Power. I'm glad you joined us today. The Tuesday edition on Bloomberg TV and radio. A gorgeous day here in Washington, even if it's a bit warm, kind of like the core inflation reading this morning. But we're watching shares of NVIDIA and AMD just like we were at this time yesterday. And nobody could seem to care less about the news from China. They both closed higher yesterday after the 15% story ran. Remember, they would agree to give 15% of revenues from sales of AI chips to China to the U.S. government. Not a thing. Now today we hear the opposite. China's turning course. Stocks are still higher. And it comes against the backdrop of a trade truce, if we can actually call it that, because there are some tariffs in place that the president has continued here with Beijing just yesterday, which would have been the deadline. We got another 90 days, suggesting there could be more time to reach a deal and maybe exercise more deals like these with the chip makers. This is where we want to start our conversation with a familiar guest. Nazak Nakaktar is with us today, National Security Practice Group leader at Wiley, and a voice of experience, as I say, in being a former Assistant Secretary for Industry and Analysis at the International Trade Administration. Great to see you, Nazak. Thanks for coming in. So let's start big picture here. We just bought ourselves another 90 days. Is that enough to actually create a trade deal, or is it just simply an indication that talks are continuing?
You know, it's pretty much an indication of talks are continuing. Trade deals, especially if they're going to be comprehensive, they're incredibly complex. They cover different sectors. They cover different measures with respect to goods within sectors. So 90 days is really an indication of let's continue talks. At the end of the day, I think the consensus is we're probably going to get a very narrow trade deal with China, but really the goal and all eyes are getting some kind of trade deal.
Okay. Does it rely on the president getting in the room with President Xi?
I think at the end of the day, probably these trade deals also have, especially based on which each country is asking for. We're asking for magnets. They're asking for chips. These materials have incredible geopolitical consequences. There's sectors of the economy, really critical sectors of the U.S. economy, that are still not getting magnets that they need from China. And so this isn't going to be resolved unless both country leaders get in a room and hash out what they need from each other.
Yes. Well, it sounds like it. The president had said at one point that we've got a deal up front. The term he used was up front providing of rare earths the batteries that are needed for these critical components. We're getting a sense that that did not happen exactly the way he wanted.
No, I mean, China has repeatedly said, yeah, you'll get it, but China operates on its own time.
Okay.
And just because you get a few doesn't mean all the sectors that were previously getting it from China, for all the end-use applications, are going to get it. Yes, will our auto OEMs get some of the things they need? Absolutely.
Yep.
But we've got still issues with our defense primes that are not getting things. Industrial applications, they're not getting the magnets for their motors. At the end of the day, China is slow walking it, and they're playing games.
Well, you just said it. OEMs are one thing. National security, defense is another. Does that suggest that China has the leverage?
China has a considerable amount of leverage. And I think what I've been trying to sort of educate the community about is that, look, we are making enormous, the United States, correctly so, in critical mineral production and magnet production. We're going to need till 2028 to scale what the U.S. government is heavily investing in. So we really have about 2 years to solve for. And what I've been trying to socialize with the White House is, magnets can be refurbished. There are a lot of countries that use magnets that discard them at the end of the day.
Yes.
And this isn't recycling, but we can recover magnets.
How are you trying to socialize that with the White House?
I mean, it's just education, talking to them about it, talking to them about options. Absolutely. Just a few weeks ago, they had a summit to discuss this with key stakeholders. It's resonating. There's companies who've come in, raised their hand, and said, "We're happy to do this for you, White House, if push comes to shove." So the point is really making sure that we have a strategy in place, and whether we're going to basically cave to China anymore, based on the fact that we're not as vulnerable as we think we are.
Well, I'd love to hear your insights on what's happened in the last 24 hours. A big olive branch to the other side of the world, rebuffed by Beijing. And this is, we could talk about a lot of elements. I'd love your take on this deal that NVIDIA and AMD made as well, to actually give a chunk of proceeds from China sales to the U.S. government. But that was the concern yesterday. Now the concern is, are they going to buy it at all? Beijing is telling Chinese companies, don't buy NVIDIA, don't buy AMD. And this whole arrangement is something that we talked about last evening with Congressman Raja Krishnamurthy, Democrat from Illinois, important as he's ranking member on the House China Select Committee. Here's his take on what we're discussing right now.
We declare our national securities for sale. It's a disastrous dereliction of duty. The first thing that the commander-in-chief and the president needs to do is to protect our country. And so when he basically says that our national securities for sale, that our crown jewels can be obtained through some kind of revenue sharing agreement with the United States government, that is a horrible sign to our adversaries. What are we going to do next? Sell aircraft carriers to the Chinese and the government takes a 20% cut? This is horrible. We should not be engaged in the sale of these H20 chips to the CCP. And the fact that he would even broach the topic of these Blackwell processors potentially being for sale to the Chinese means that they're salivating at the prospect of basically taking those chips, inserting them into their military systems, which would be used against us and our allies, friends, and partners in the Indo-Pacific, and then also used against various minorities in perpetration of human rights abuses. So this is a really, really dark day for our national security.
All right, he just said a lot. So let's unpack a little bit of this. With regard to the arrangement that the White House gets, or the government gets, a 15% take, these licenses have just been approved, and there is an air of whether these were bought and paid for, and whether we're compromising. You just heard the congressman say our national security. How do you respond to that?
I think, first and foremost, what's really important for folks to understand is that when we license chips, we're also licensing the technology, the know-how that goes with it, right? So when on one hand, folks are saying, well, these are sort of lower grade chips, these are still exquisite chips. China has huge market access barriers against the United States. If it can indigenize it, it doesn't want it from us. If it wants it from us, there's a strategic need for it, right? So the transfer of know-how, to me, I think we've got to be very careful about.
Because Huawei has developed a similar chip to the H2.
China's entire semiconductor industry and the industry which is powering their defense capabilities, their military capabilities that they're using right now offensively to terrorize our allies and also aid and abet the Russians and Iran. That has been built, make no mistake, on U.S. technology that we transferred to China. So there are cumulative risks there. But in terms of the 15%, your question,
Yep.
I think this is really in the domain of Congress to decide whether they want these types of transactions to allow the U.S. government to collect revenue. I think when you look at the laws, it seems a little bit the laws are silent on this kind of issue. I think different folks have different interpretations. On one hand, the government can't collect revenue unless Congress authorizes it. On the other hand, they haven't explicitly banned it. So it's really up to Congress to say whether this is permissible or not. But certainly, do we want the National Security Bureau to potentially make money off of sales? Depending on how they use it and depending on how they're exercising judgment, these are all open questions.
Well, I guess so. You wonder if Beijing makes these even more sought after by making them taboo in the process. But in our remaining moment, Nazak, does all this noise that we're talking about right now give you an indication that a trade deal is more elusive, or that we're actually getting down to some business and might arrive at the finish line here with China?
The way that China, so I look at sort of China's behavior.
Yeah.
It's made commitments, it hasn't honored it. It makes commitments, it hasn't honored it. It is asking for more and more and more and not signaling. This is really important to watch. China is not signaling at all that it wants a deal. It's just playing with us. It's drawing down the timeline. I think China is also trying to make the president look bad during this process.
Yeah.
If I were to read China, and I've been doing China for 25 years, studying it,
Yes.
dealing with China and trade, national security, China doesn't want a deal. It's playing us, and it wants the public to see how they're playing
That doesn't
us.
sound like we're ever getting to a deal then. If China doesn't want a deal, there's no deal. If you're Jensen Huang, then you're going to China to try to make the sales pitch for your own chips all over.
This is a chess game, arm move, counter move, but China's going to
Yeah.
extract as much as it can from us without a deal.
I'm so happy you came in. I really appreciate the insights.
My pleasure.
Just the voice that we needed today from Nazak Nakakhtar Wiley. Many thanks for the insights, as always. I want to play this to the panel. Rick Davis and Jeannie Shanzano have thoughts on this. Bloomberg Politics contributors. Rick, of course, partner at Stonecourt Capital. Republican strategist Jeannie is Senior Democracy Fellow at the Center for the Study of the Presidency and Congress. What's your thought on this, Rick? And boy, how quickly the news can change. We were talking yesterday about this new opening in the market for NVIDIA and AMD. Investors felt good about it, even if they were losing 15%. Now China's telling Chinese companies not to buy American. How does this pan out in the end?
Well, it's a kind of a smart play on China's part, as Nazak was saying. They need to build their capability. Nothing builds it like demand, and I'm sure they're feeling vulnerable to manipulation of this market. If Donald Trump can bestow them with the gift of having these for sale in China, he can take it away. And the last thing the Chinese want to do is be at the beck and call of Donald Trump. So honestly, this is a game that's been going on for a long time. Investment from the U.S. investors into China tech has been fueling the Red Army buildup against us. And this is just another example of them taking us to the cleaners.
Taking us to the cleaners. Jeannie, was Nazak onto something? Are the Chinese just trying to embarrass Donald Trump or make him look bad?
I think sure, but I think they're more interested in ensuring their prominence in the economy and the world as we go forward. And, a lot of people are predicting we are facing a China shock 2.0, and it's going to come as a result of their long-term investments in these frontier economies. And they are doing a magnificent job growing in that area, which is why so many national security experts and others, but particularly as we think about national security, have been concerned about Donald Trump's decisions in many areas, particularly as it pertains to chips, but also as it pertains to alienating one of the United States' biggest strengths to combat China, which is our allies. The reality is we are far smaller in terms of a labor force than China. To confront China, we need the support of allies that make us stronger and bigger and better. And as opposed to confronting China, what he is doing is, for some reason, confronting our allies, Canada, Mexico, Switzerland. I mean, the list goes on and on. They turn away from us. It doesn't even matter if they turn to China, which some of them are looking at, but they rob us of an enormous strength. So, I think this is China doing what nations do and what the United States should be doing in this escalating confrontation and competition. But Donald Trump's decisions in many areas suggests that he doesn't quite get it.
Yeah. Well, I'll tell you, as we consider the interactions of the two biggest economies in the world, we wonder if it's possible to gauge the status of the biggest economy, and that is ours. On this CPI day, Rick Davis, we have news from the President of the United States. There's a new leader of the BLS, Bureau of Labor Statistics, remembering he fired the former commissioner about a week ago on Jobs Day when he did not like the numbers, and he thought that there was some political rigging. I think the rigged was the word that he used over and over again. The president has named E.J. Antoni to lead BLS, according to a Truth Social post, writing that he will ensure that the numbers released are honest and accurate. Knowing that Antoni has been very vocal about his concerns with BLS jobs data and revisions, and we'll get into some of the things that he has said, Rick, but a big part of the conversation in financial circles this morning was, can we trust the data? And when you're hearing questions like that on Wall Street, does it mean you've already lost? What do you think of this pick?
Yeah, this was not a pick that you will send a message to the Wall Street community that we're going to make sure these numbers are accurate, regardless of whether they're good or bad. This is a pick that says we'll never have a bad number as long as Donald Trump is going to be president of the United States. And that's something the Congress is going to have to really focus on in their confirmation hearing.
Mm-hmm. So, Jeannie, let's talk a little bit about what Mr. Antoni has said. His comments from a Fox Business News interview are making the rounds today, as he suggests that it would be wise to pause monthly jobs reports, monthly jobs readings over accuracy concerns, instead maybe updating the markets quarterly with jobs data to find more accurate numbers. Is that about to happen?
It absolutely could, if indeed he takes the position, is confirmed, and everything else. The reality is that the Bureau has problems, and the previous commissioner talked about those. Part of those deal with the cuts that they've experienced, the amount of funding they need to get an accurate count. And this is why, if the president was truly concerned about the quality of this data, he may not have fired her, but taken her suggestions and many others seriously. But he didn't do that because he doesn't like the data. He fires her and appoints the new commissioner. And the reality is it doesn't make anybody feel safe that these numbers that we're going to see are politically neutral. And that is a real problem, because let's not forget, states like the United States and all 50 states within it depend on accurate numbers, as do people, to make big decisions. If we can't trust the data are politically neutral, that is going to make decision making that much harder.
The quote from Fox Business, until it's corrected, referring to what he sees as corrupt data, the BLS should suspend issuing the monthly jobs reports, but keep publishing the more accurate, though less timely, quarterly data. Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors, thank you for the analysis. Congressman Jake Auchincloss of Massachusetts weighs in next, only here on Bloomberg.
9:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We've got the S&P 500 index holding close to session highs, looking at a Tuesday gain now of 61 points, with the S&P at a record 64.34, up by 1%. The Dow's also advancing 1%, up 446 points, while the Nasdaq Composite Index is up 1.2%. Nasdaq up now by 255 points. The Russell 2000 index of small cap shares is surging 2.2%. The Bloomberg Mag 7 index up by 1.2%. The 10-year 4.29%, with the 2-year at 3.72%. An inline inflation reading is bolstering speculation that the Fed will have room to cut rates in September. We've got spot gold up $7 the ounce to $33.50, up 0.2%, while West Texas Intermediate crude is down 1.1%, $63.22 for a barrel of WTI. Sources tell Bloomberg Canada's Gildan Activewear is in advanced talks to buy American underwear maker Hanes Brands. The transaction could value Hanes Brands at about $4.5 billion, including debt. Shares of Gildan down 4.8%. Hanes now surging by 26%. And Cardinal Health has announced an agreement to buy Solaris Health in a $1.9 billion deal, the company's largest acquisition in the urology category, and an expansion of its multi-specialty strategy. Shares of Cardinal, they are down now by 6.8%. Recapping stocks higher, S&P advancing by 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. And back we go to Washington. Balance of Power continues. Once again, your host, Joe Matthew.
All right, Charlie. Many thanks to Charlie Pellet updating us on Wall Street. He'll be back in about 20 minutes with his next update here on the Tuesday Trade. We've got breaking news here. It's coming from the White House briefing room. Caroline Leavitt is talking to reporters right now. There's a live look for you on Bloomberg TV and on YouTube. We were just talking about this, the president's pick to run BLS, and his thoughts on what to do with the jobs data coming from that agency. And Tony saying this was, by the way, before he was named to the job by President Trump. Until it is corrected, referring to problems with the data that, of course, led to the firing of the former BLS commissioner. He says, quote, the BLS should suspend issuing the monthly jobs reports, but keep publishing the more accurate, though less timely, quarterly data. He went on to add, major decision makers from Wall Street to D.C. rely on these numbers, and a lack of confidence in the data has far-reaching consequences. Well, some folks do have a lack of confidence in the data, which is how we got here. But the White House is not about to cancel monthly job reports. This is the news. Caroline Leavitt, the press secretary, just now telling reporters the plan is for BLS to continue to put out jobs reports. That part won't change. The terminal just crossing that headline a moment ago. Also, headlines coming from Ukraine. President Zelensky met with reporters a bit earlier today, and it's giving us a little bit more information ahead of the summit on Friday in Alaska when President Trump sits down with Vladimir Putin. This is not going to be easy. Remembering that the idea floated for a truce would include freezing lines in place, effectively giving up the eastern part of Ukraine, the Donbass and Crimea, to Russia. That's what Vladimir Putin was calling for. Not that we even know that it would be in a final deal. President Zelensky sat down with reporters a short time ago saying no, he will not withdraw troops from the Donbass and will not give the Donetsk and Luhansk regions to Russia if it means unlocking a ceasefire. Here's the quote, for Russians, the Donbass is a bridgehead for a future new offensive. Any of territorial issues, he says, cannot be separated from security guarantees. It's where we start our conversation with Congressman Jake Auchincloss, the Democrat from Massachusetts. 4th District is with us now live on Bloomberg TV and radio. It's great to see you, Congressman, as a Marine combat veteran. I know you have very strong feelings about this. When you hear language like this from President Zelensky, it doesn't sound like we are any closer to a deal with Vladimir Putin. Why are we hosting him for peace talks this week?
Good afternoon, and good question. This public fracture underscores why it has been so critical for NATO and Ukraine to collectively define victory in the public imagination as well as most importantly, in the Ukrainian imagination. And I've been saying this for 2 years. I said it to Joe Biden. I'm saying it to Donald Trump. So it's not partisan. It's policy. We need to define victory. And that's 3 things. 1, it's a secure eastern border. 2, it's freedom of navigation in the Black Sea. And 3, it's Ukrainian accession to the European Union. You deliver those 3 things, you have a sovereign, prosperous, democratic Ukraine. That's a victory.
Okay. Does that sound like something that President Trump can accomplish on Friday?
No. What he could accomplish on Friday would be to issue an ultimatum to Vladimir Putin that Putin must release the kidnapped Ukrainian children as a good faith beginning to negotiations. There will be no deal in this summit. But Vladimir Putin's release of Ukrainian children who have been kidnapped and held in captivity, held under false premises, would, I think, be a good faith marker towards what could be productive negotiations around that definition of victory.
Well, there have been a lot of questions about why we're the host nation here, beyond why these talks are even happening at all. Even in the pursuit of peace, typically there are agreements that are made. There's a framework before the 2 leaders sit down at the table, so you don't have any major surprises. The idea of having Vladimir Putin on American soil, presumably, and you can tell me if you know differently, on an American military base, this is going to be somewhere in Alaska, I don't know what the facility will be, has been compared with, for instance, yourself having served in Afghanistan, where you led an infantry patrol, almost like George W. Bush hosting Osama bin Laden for peace talks. Am I going too far with this, Congressman? How do you see it?
You're addressing what is Donald Trump's approach to most foreign policy issues, which is that he's all show horse, no workhorse. He doesn't want to actually do the hard work of mid-level and high-level negotiations between officials that would preface a principles-level meeting between the presidents. He doesn't want to do that work. He wants a photo op. He wants to wine and dine Vladimir Putin because he has always sought Vladimir Putin's approval. It's like this weird fanboy thing that he has. And nothing's going to come of it. And it's going to further erode America's geopolitical standing when we need to be spending that political capital on appropriating Russian frozen assets in Brussels and taking that 300 billion euros and sending it to Ukraine to strengthen their military-industrial complex, on getting Ukraine to join the European Union's Lisbon Treaty's collective defense article, on authorizing Ukraine to use long-range missiles to strike Russia, on tightening oil price caps on Russian exports. All of these things that are geopolitically achievable but intensive, those are the hard work that Donald Trump is not doing that could have actually made a summit productive. Instead, it's going to be, yet another sizzle without the steak.
Well, he did at one point, I think, want to invite or suggested inviting the Taliban to Camp David. What should be the parameters then for this meeting? Should it be on a military base? Should these guys put 2 chairs out on the runway and talk this out? Because if it's nothing more than a photo op, why should he enjoy the hospitality of the United States?
Yeah, I'm not a protocol officer. I'm not getting into the details on that because it doesn't matter, because it's not going to actually achieve the outcomes that we want. The outcome that I want from this poorly conceived summit, the only achievable outcome here would be an ultimatum about releasing the kidnapped Ukrainian children as a beginning, not as a conclusion to negotiations.
Okay, that's a good answer. Congressman, I'd like to ask you, as a former member of the House China Select Committee, about some of the headlines we've been hearing about trade with China. The president has allowed another 90 days for talks to continue, and has now made an arrangement with NVIDIA and AMD, 2 of the most important American companies, never mind important chip makers, to give 15% of their sales of AI chips to China to the U.S. government. It's been called unprecedented. I don't know if you see it that way. I don't know where the money is going. We haven't heard that either. But is that the cost of doing business?
My one question is, how many Trump meme coins does NVIDIA's senior leadership own? Because that kind of deal is so grotesquely inappropriate and contrary, 1, to the interests of NVIDIA, and 2, to American interests, that I just have to question whether they're buying Trump coins on the side. Because we know that the Trump coin allows foreign officials and senior executives at corporations to buy influence with the president anonymously but securely. And I question whether they've bought those Trump coins, because this deal is hugely inappropriate. It basically makes the federal government a co-partner in helping China leapfrog us on AI.
Wow. You could also suggest that the government is now going to be invested in the chip industry. And you could also ask shareholders who bought stock in companies like NVIDIA and AMD if they're comfortable with the government getting 15% of the revenue that they may have factored into the stock price, Congressman. Will there be oversight from Congress here?
There should be. Republicans will say one thing in private and do nothing in public, as is their norm, because this, as I said, is one, I think, a violation of NVIDIA's fiduciary responsibility to shareholders, but also grossly inappropriate for the American public. Why would we be helping to equip China to surpass us in AI? We did the CHIPS Act. We made investments in the semiconductor industry, which I voted for, which was bipartisan, precisely so that we would have the lead. And this deal makes me shudder to consider what a TikTok deal might look like, what an ultimate tariff deal might look like. And again, orbiting around these considerations is who is buying the Trump coin. This is the central issue of corruption of his first year in office. More than half of his net worth is tied up in this coin. We have no idea who owns it. The people who showed up at the White House for this crypto dinner, those are just the ones who want to be seen. The Qataris, the Turks, the Venezuelans, the Chinese, they probably didn't want to be seen. We don't know who's bought him.
Okay, you've brought this up a couple times, and this is serious, Congressman. How do you find out?
Well, Senator Warren and I have asked both the SEC and the Treasury to investigate. They're not. Ultimately, this is going to have to be when Democrats take back control of the House and hopefully the Senate, and we can do subpoenas and investigations without having to be obstructed by the cowardice of congressional Republicans, because congressional Republicans have made clear that they're courtiers, they're not members of Congress, and they don't want to hold them to account for what is the most grotesque example of corruption that this president has yet exhibited. And I understand how high of a bar that is, but I'm standing by it.
Wow. So if Democrats take the House, prepare for an investigation into the Trump coin, I think is what we've learned. Congressman, we've got a minute left. Do you expect a deal with China? We've got another 90 days. Is that enough to do it?
I doubt it in 90 days. Let me say one thing more to the point, though, about this back and forth with China. What he has done is he has bundled in fentanyl, tariffs, TikTok into one giant sort of performative set of negotiations. It's a mistake. There is bipartisan support in Congress and legislation that I've helped draft with Republicans on getting much tougher on China for fentanyl. China exports about 98% of fentanyl precursors. That issue needs to be addressed right now on its own merits, because it's unacceptable that China is directing state-sponsored poisoning of the American public, 70,000 deaths every year from opioid overdoses. Tackle that. Don't tie it into TikTok and tariffs.
It was great to spend some time with you, Congressman, and I appreciate it. I hope your summer's going well. Jake Auchincloss, the Democrat from Massachusetts. We'll talk to Republican Tim Burchett of Tennessee coming up. You don't want to leave, right here on Bloomberg TV and radio.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We have got the S&P 500 index holding close to session highs. CPI Tuesday, the Dow, the S&P, NASDAQ are all advancing as an inline inflation reading bolsters speculation that the Federal Reserve will have room to cut rates in September. Right now, the S&P is up 61. That is a gain of 1%. The Dow also up 1%, higher by 445 points. By the way, the S&P now at 64.34. NASDAQ up 252, up by 1.2%. And to be sure, we're looking at records for both the S&P and NASDAQ. The MAX 7 index up 1.1%. The Russell 2000 index ripping higher now by 2.5%. 10-year 4.29%, with the 2-year 3.72%. Spot gold up 0.2%, 33.49 the ounce, and West Texas Intermediate crude down 1.1%, 63.26 for a barrel of WTI. OPEC, meanwhile, is forecasting a tighter global market than previously projected, citing accelerating demand growth and a slower expansion in rival supplies. Oil majors are gaining today along with the rest of the market. ExxonMobil up by 1%, BP ADRs up by 1%, Chevron up 1.5%. Recapping, S&P holding close to session highs, up 1%, with the S&P at 64.35. That is a record. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back we go to Washington once again. Your host, here he is, Joe Matthew.
Many thanks, Charlie Pellet. Live from New York at World Headquarters. We're live in Washington, D.C. on Bloomberg TV and radio, and glad you're with us here on the Tuesday edition. Our conversation with Congressman Tim Burchett, the Republican from Tennessee, will be with us in just a moment. As we begin here on the cover of the new Business Week magazine, Bloomberg Business Week, with the Scott Bessent coin and the author of this wonderful piece that looks behind the scenes at the Treasury Department. It gives us a little bit more of an idea of what makes Scott Bessent tick when it comes to policy, when it comes to his view of the economy. Dan Flatley and Eric Schatzker share the byline, and Dan's with us right now here in Washington, D.C. Congrats again on this great piece. I wonder if you learn much about Scott Bessent, the man, because this is someone we see a lot more than Treasury secretaries. When you think of Janet Yellen or recent folks who've had that job, maybe a little bit different for Tim Geithner, you go on TV maybe every 6 to 9 months or something like that. Scott Bessent is out there day after day telegraphing to the markets, taking complex questions on trade. Is that just the cadence of this White House, or is that the man who you got to spend so much time with?
Yeah, it's a good question. I mean, it is interesting. I mean, he told us that he was very private before he decided to get into politics. And, you know, he didn't really... He followed the news, and he was very, and he's known, I think, to be a voracious reader. Both the big biography. I talked to somebody who said, you know, I went into his office to talk to him about something, and I left with a brick about Charles de Gaulle. So, you know, he reads a lot. He pays attention to the media. Obviously, for the Trump administration, TV and media appearances are very important.
Right.
I think he has emerged kind of as a spokesperson in many respects for a lot of the economic policies that the Trump administration is undertaking. And he plays that role very well, and I think it's one that he relishes, quite frankly. But it is somewhat at odds, because when you talk to him in person, he's a little bit more sort of, I wouldn't say... he's just reserved, a bit reserved, very gentlemanly, courtly. He's not really a bombastic personality, but he does go on TV a lot. And, you know, we talked a little bit about that. And it was interesting because one of the things that he told us in our interview, which unfortunately didn't make it into the piece just because there wasn't enough space for it, but he does say that he knows he has to be very careful about what he says on TV. And he really worries about that.
Audience of one?
Yeah, I think it's, you know, he's obviously wants to speak to the president's priorities, and when we know that Trump, you know, watches TV. But also he wants to be careful that, you know, if he says, I think there should be an investigation at the Fed. Well, what does he actually mean by that? It's, you know, what he says he meant is that the Fed should do an internal review of its non-monetary policies. What he said on TV a few days before that was a little bit more open to interpretation, and it was reported in various places that he was calling for an investigation of the Fed. So he obviously thinks a lot about that. But what he says is that, we talked a little bit about this earlier, Joe, is that he gives the president options and outcomes, and he manages the narrative. So it's part of his role, and the president has called him soothing and said he's doing a great job and all this stuff, but it's part of his role, and I think he views it as part of his job to sort of talk the president's book, and that's what he does.
Well, it's fascinating, and I want to point everyone to the Terminal and to Bloomberg Business Week. Scott Besson on tariffs, deficits, and Trump's economic plan. Dan and Eric spent hours with him in an exclusive conversation. You'll probably learn a lot from that. Bloomberg Business Week. Many thanks, Dan Flatley, as always. Now covering the Treasury for us here in Washington. I'm Joe Matthew, and glad you're with us on the Tuesday edition of Balance of Power, with a lot to talk about here today as members of Congress enjoy their August recess. There's still a lot of news here in the nation's capital that we want to talk to Tim Burchett about, and he's with us right now, the Republican representing Tennessee's 2nd District, live on Bloomberg TV and radio. Congressman, it's great to have you. Welcome. I know that you had a bit of an injury involving a horse a couple of weeks ago, and I want to start by wishing you well. How's the recovery?
Well, it only hurts when I breathe. My heart beats. I laugh. I sneeze, or anything. If I sneeze, I'm going to have to cut off because I don't want y'all to see me cry.
Oh, God. I hope that means it's going well, Congressman. You, of course, serve on the Foreign Affairs Committee, and I'd like to start there with you at the beginning of what's going to be a very important week for geopolitics. The president is going to be sitting down, as you well know, on Friday with Vladimir Putin in Alaska, talking about the war in Ukraine. Should the United States be the host nation for someone that many see as a pariah on the world stage?
Yeah. He's a third world. To me, he's a thug. The GDP of Russia is somewhere between France and Canada. Everybody knows his history, but we got to get him to the table. And I think I've been with President Trump many times, and nothing is by accident. And it's no accident that he's in Alaska, some of the largest oil reserves. And I believe that's part of his mission in this, is to tell Russia, y'all, your play ball are going to shut y'all down, and with the energy, because we'll have the capabilities of fluctuating markets and doing those things. And I'd rather that than American boys and girls dying in a faraway land that most members of Congress, although some of them are profiting from it, literally, the war pimps and others, but I would rather them have that discussion, or whether it be an economic situation instead of American boys and girls losing their life.
Understood. With that said, should we lower our expectations on what happens Friday? Do you expect a deal, a truce to come from this? The president says he's looking to feel him out. And from what we're understanding from President Zelensky in Ukraine, he's not willing to give up any land.
No, and I understand that. But there's eventually, though, America's going to get tired. We've got over $200 billion, and Zelensky's made some comment about not sure where all the money went, half the money went, or whatever. So America's growing tired of it. The world's growing tired of it. I'm tired of seeing Russians send mercenaries into another country. I'm tired of seeing people snatched off the street in Ukraine to go fight in this war. It needs to be put to an end, and we're growing really tired of it, and it's just not happening. And I have a theory about this. I have a theory of it in America and everywhere else. People sometimes in leadership, you see it in the Middle East some too, they really don't want peace, because if they have peace, then they're not in control. They're not going to be the leaders. And we always have these wartime people, then we throw them out. Case in point in history, Winston Churchill literally saved the world. Saved the world. America got involved, of course, but he was the iron peg out there holding Europe together. And then what happened just shortly after the war was over? They voted him out of office. So, there's a lot going on. And honestly, sir, financially, a lot of people, K Street lobbyists, members of Congress, people's portfolios are profiting from this. Case in point, we sent our missile defense system to Ukraine. We automatically replenished ours in a no-bid, multi-billion-dollar contract. Members of Congress on both sides of the aisle, from what I understand, some of them bought that stock up to 2 weeks prior to Joe Biden issuing that executive order. It's not on Biden, it's on members of Congress that they profited from that because they own stock in those companies. There's a lot going on behind the scenes, and it makes me sick to my core that that young people and old people too are dying, and people are profiting from it.
Well, listen, I hear you, and this is why there's a conversation about stopping insider trading on Capitol Hill, which we could have a whole other conversation about here. I guess when it comes to Russia and Ukraine, though, do you worry that Russia is about to be rewarded for its behavior?
I do, but I think President Trump is a good deal maker. People don't like him. They like him in my district. They like him in Tennessee. You know, they said, oh, you're not going to get that big, beautiful bill out. I was one of those that thought it was a little bigger and a little more beautiful than I thought it needed to be. I was the only non-Freedom Caucus member in the Roosevelt Room meeting with President Trump. I was sitting 2 seats away from him. And, you know, he went around that room and answered every dadgum question. And when he didn't know the answer, he had J.D. Vance there to answer a question. He had his economic guy. He had his military people. He had some people behind him. And he called on them to answer the question, something you don't see a lot in the media. He didn't cuss us. He didn't belittle us. 2 hours he took with us. Answered every dadgum question. And you know what? 4th of July, he was signing that bill. The other one, of course, the recent memory, my friend Senator Haggerty out of Tennessee, he had the cryptocurrency bill. And he called me and said, Tim, you know, we're trying to get this thing done, finished up, and get on the floor, get it to the president by Friday. You think there's any chance? And I said, I have no doubt there's a chance. I was sitting in a room, I was sitting right next to Whip Emmert between Speaker Johnson, and we were talking about it. We had some questions. I fear crypto. I fear all this AI stuff and everything. I fear that you got a bunch of men and women that still listen to 8-track tape players are going to be regulating something they don't have any idea what it's about. The Chinese get ahead of us. And sure enough, President Trump called, started answering questions around the room. And he did it.
Fascinating.
And he got it. It was on, and guess what? It was on his desk by Friday. So you want to discount somebody, discount Tim Burchett, but don't discount Donald J. Trump, because that guy's a deal maker. I don't know. I mean, you know, heck, if he can handle the Teamsters in New York City, I think he can handle Vladimir Putin pretty easily.
Well, I love the story, bringing us in the room, Congressman, and I know that you're close to the president and you support him and that you respect him. You've also been very outspoken in your efforts to have the Jeffrey Epstein files released, and this is something that you'll take back up, I presume, when members return to Washington. There have been a lot of promises from the administration in different forms and from different people about releasing this information. Do you worry about what it means that it has not come out yet?
I worry that it went 4 years under the previous administration. I'm not worried about Trump being on it, because let's be honest, if Trump was on that thing, Biden would have put that stuff out. Here's my first worry. My first worry of the 1,000 young girls who are now adults, some of them have probably taken their own life, that are in there, the innocent ones that were violated by these dirt bags. And anybody that did that to a kid, I hope they're going to be, I'd like to arrange for their meeting in hell pretty quick. Look, I passed some of the toughest laws in the country, ICAC, Internet Crimes Against Children. I passed a death penalty for them. It was ruled unconstitutional for these child molesters. Then the state legislature brought it up, basically the same bill, different court. It's constitutional. I even had a chemical castration bill. Everybody flipped out over it, but it turns out it probably makes a lot of sense. I've held the hands of people that have been molested. Look, I'm a Christian. I'm not a very good one. The Bible talks about how you treat the least amongst you. And on my judgment day, when God asks, how'd you treat the least amongst you? I'm going to say, dadgum, I did everything I could, Lord, because we've got to get to this thing. We've got to nail these people to the wall. We've got to eliminate this. And the number one country in the world for bringing in child porn and all this stuff, United States of America. We've got to clean our act up, brother. And I'm sick about it. We'll go after it. I'm not worried about President Trump being on it. Look, he banned Epstein 15 years ago from Mar-a-Lago, and and before he was suicided, I don't think he committed suicide. I think somebody took him out somehow, but that's just me. So, sorry, I talked too much. I'm emotional about that issue. That's a huge issue for me.
Well, you don't listen. That you just said a lot, Congressman. We only have a minute left. Are you concerned that Ghislaine Maxwell will be pardoned?
No, I'm not. I don't think that's going to happen. I just can't see that. That's why I asked to subpoena her. I caused a lot of hurt feelings, but I think we need to get her in. She might lie, she might not. If she's proven lie, she'll go back to prison for a full term.
Let's talk when you get back to town, because I know the story isn't going away. Tim Burchett, Tennessee's 2nd District Republican Congressman, thank you as always, for joining us on Bloomberg TV and radio. A lot to think about there, following our conversations with Congressman Burchett and Congressman Auchincloss. I'll meet you back here on the late edition of Balance of Power with much more to talk about. That starts at 5 p.m. Eastern Time here on Bloomberg TV and radio. Bloomberg Business Week Daily follows right here. Don't go anywhere. I'll meet you back in a couple of hours. I'm Joe Matthew. This is Bloomberg.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody across Bloomberg platforms. I'm Carol Masser. Tim is out today on assignment in Atlanta. David Gura is in the house here in New York.
Glad to be here.
Good
Filling
to
in
have
for
you.
Tim. Nice to see you.
Nice to see you. On a day where it kind of feels like there's stuff going on, but I don't know, the markets seem to be okay.
Yeah, those inflation data kind of coming in as analysts and economists expected, but still having an effect on the markets today as it kind of makes people come around to the conclusion that September, we're likely to see a cut when the Fed meets
I'm
next time.
guessing Mike McKee's going to say, hold on, everybody.
No doubt.
All right, we're going to get to him in just a moment. We're also going to talk about China's maneuvering because, David, it feels like this new world order feels like the train has left the station, certainly with tariffs. Things are going to be different because of the U.S. actions, and you see China moving a lot.
Yeah, trying to consolidate some of its influence with other members of the BRICS group. And of course, we've seen the tariffs that have been imposed on India and other countries as well. We'll see if that's leading to anything tangible, if it's more bite than anything else.
That's a really good point. And we're going to also talk about alt energy, everybody. We've got Bloom Energy with us. Shares are on a tear. What's interesting in an alt energy world where I feel like the administration's backing off, not necessarily for some of these names.
And of course, like so much tied to AI, artificial intelligence, and the need to fuel all these data centers that are being built across this country and around the world.
I always think what happens when the spending stops.
There you go.
All right, folks, we got a lot coming your way in 60 minutes. Stick around, David and I, here on Bloomberg Business Week Daily. Right now, though, a check on the trades with Charlie Pellet.
Hi, thank you very much. We are on track for a record close on the S&P 500 index. Just under 2 hours to go until that bell clangs on Wall Street with the Dow. The S&P, NASDAQ solidly in the green. S&P topping 6,400, hitting a record now, up 1%. We got the S&P up 66, the Dow up 493, Dow Industrials up 1.1%, NASDAQ also at a record up 1.2%, and the Russell 2000 index of small cap shares surging now by 2.5%. The 10-year CPI Tuesday, 4.29%, the 2-year 3.72%, spot gold up $6 the ounce, 33.49, up 0.2%, and West Texas Intermediate crude down 1.1%. 63.24 for a barrel of WTI. Bitcoin to 119,377. Bitcoin now up by 0.4%. Bottom line here, stocks are at records. AI startup Perplexity says it will make a formal offer to acquire Google's Chrome browser for $34.5 billion in anticipation of requirements that may be imposed on the search giant in antitrust proceedings. A Perplexity spokesperson said the unsolicited bid was sent to Alphabet's Google this morning. Right now, we've got Alphabet shares up by 1.3%. So again, recapping, stocks higher. S&P right now at 64.39, up by 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, along with David Gura. Tim is out on assignment. We'll be back tomorrow. So, hey, we want to talk a little bit about the inflation report because, David, as you mentioned at the top, I mean, it really did feel like investors like what we got, that there wasn't any kind of big surprise here.
Yeah, just to give everyone an update on what we did learn, the core consumer price index, excluding that often volatile food and energy categories, increased by 0.3% from June, from the month before. That's according to the Bureau of Labor Statistics data that was released this morning. Largely in line with what economists were forecasting, Carol, and on an annual basis, it picked up to 3.1%.
It's one of those, whew, okay, yes. Not worse than could have been. All right, let's get more on the release, the outlook for U.S. inflation and really Fed policy. With us is Bloomberg TV and Radio international economics and policy correspondent, of course, our Michael McKee. He's here in studio. And also with us is Poojam Sriram. She's Vice President of U.S. Economics Research over at Barclays. She's joining us from New York City. Welcome, welcome to both of you. So, Mike, for those who maybe, I don't know, slept in on this Tuesday, what do we need to...
Not you, Mike.
It wasn't Mike. What do we need to know about the inflation print this morning?
Well, I think what you want to say is don't count your chickens before they're priced, because there is some evidence of tariff pass-through in these numbers. There's maybe some evidence that Chris Waller's right, that it's a one-time increase, because we saw things that went up in price last month because of tariffs come down. So it may be a one-off, but it may be a continuing one-off that pushes inflation higher, because you saw things like used cars go up 0.5%. New car prices, which had been declining, are now flat, which the president claimed as a victory. But then you look at the profit margins for the automakers in the second quarter, and they were all minuscule or negative because they're absorbing it, and they're not going to continue to do that. So there is no proof that the tariff issue is over in these numbers. And the other aspect of it is
we haven't figured out all the details with some of our big trading partners.
Services prices have gone up.
Yeah.
They went up more than anticipated. So that's something that doesn't have to do with tariffs, but is a concern to economists, and it'll obviously be something the Fed wants to watch.
Could you pick up on that, if you would? I was looking back at a recent note that you wrote before these numbers came out this morning, and you said that while firms intend to raise prices, they've been resorting to other mitigation measures first. What did these data this morning tell you about the way the economy has been reacting, is reacting to the president's trade policies?
Yeah, sure. Great question. The release this morning was, to us, a pretty mixed bag. What was interesting is a lot of the acceleration that we saw in core CPI came from the core services component. Core goods prices were up. Inflation was, on the core goods side, still a 0.2%, very similar to what we saw in June. But really, the increases in prices, they're not as broad-based as one would have expected. Now, to be clear, we think it's too soon for us to conclude that the tariff pass-through is not happening or is more muted. We do think there are a couple of things that could have happened in July, which just made the core goods side of the report look a little softer. One is, if you remember, July was a big promotion period. We did have an Amazon Prime Day event that lasted longer than usual. And we had similar promotions from retailers like Walmart and Target. So it's plausible that we just had, slightly lower looking prices this July than we did last July. And if you look at some of the details within categories, that seems to corroborate with this narrative. But I also will allude to what Mike McKee pointed out earlier. We are seeing signs of early tariff pass-through already in the economy. Within the CPI release itself, we've been flagging for a while that household furnishing prices, for example, are up 3% just year to date. This is very different from how prices historically have behaved. Something very similar can be said about appliances in the US. So I just think tariff effects are in train. And while today's report may not suggest that we are seeing much tariff effects, I just think it's too soon for us to dismiss that effect altogether.
Mike, let me ask you, if I could, about housing. We looked at these data for some indication of those costs as well, and we have for many months now. What is it telling you about the state of the housing market in the U.S. today?
Well, we're not seeing price declines, but certainly the price increases have leveled off. This is the third month in a row that owner's equivalent rent was up 0.3%. And on a year-over-year basis, we see slight declines here in home prices. We're seeing in the more immediate data, the case-shillers and things like that home prices are not rising as fast because at this point, people have given up on selling, it appears. And so they're not raising prices because it's a seller's market. But let's see what happens going forward. The interesting question is going to be, how does the housing market recover? Is a Fed rate cut or two going to be enough? How much does it have to go down before people get out there and start buying again?
One thing I wanted to ask both of you, and Mike, let me start with you first, is that I think I heard it on surveillance this morning, the idea or the concept of it's not just the number and where it goes to, but the percentage of the increase or decrease. So when we think about that, I mean, I know the numbers came in line, but what we've seen in terms of trends in inflation, are we seeing it continue to kind of move down in a significant way, like that percentage change?
If you if you have a Bloomberg, go ahead and put in CPI YOY index GP and graph it. And in the last 2.5, 3 months, the inflation arrow has changed from going down and to the right to going up and to the right. It's not been a huge change yet, and we don't know for sure that that's going to happen or if it's just going to continue to steadily rise. But it definitely shows the inflation trajectory has changed.
All right, so let's cut to the chase. What does this mean for the Fed? Pooja, weigh in on this. I know Mike tends to say, and he's always right about this, that there's a lot more data coming our way before the next Fed meeting. So has this changed anything for Jay Powell and company?
Well, I think not. The Barclays baseline for a while now has been one rate cut and all the way at the end of the year in December. Now we're looking quite out of consensus. admittedly. But we think, there is a lot of data to come. Nothing in this inflation print to us was suggestive of inflation being more muted or the tariff effects are not coming. So we do think that, the next employment report is going to be the big one to watch out for. Also, we're going to hear from Chair Powell at Jackson Hole. And so we think those would be good signals to watch for. But right now, we maintain our call. The Fed is in no rush to cut rates, and we have a call for December.
I believe Mike's getting his cowboy boots
you
ready.
mentioned Jackson Hole, and Mike lights up. You can't see it on the radio.
We're getting ready for it,
For TV and YouTube, you can. But Mike, how are you sort of thinking about the way this influences Fed decision making going forward? The report today, and of course, sort of what this might tell us about the PCE report coming up a little bit later.
Well, I think it puts them in the category of if we get the same numbers that we've gotten, and by that I mean inflation numbers and another round of bad jobs numbers, the Fed might be more inclined to cut. But when you parse who the voters are and what they've said since the last Fed meeting, you got about 2 people who think they should go down, 2 people who think they should not, and 2 people who are undecided. The rest have yet to weigh in. So we will hear more over the next couple of weeks, including from the chair, and we'll see where they are going into September. But again, there's another jobs report and another CPI report and a PCE inflation report. And so there's a lot of information to come that will help decide what's going to happen. The odds are now 96% that they cut in September, but I wouldn't put money into that market right now.
I feel like I've seen this movie before.
Yes.
Expectations that change very quickly on a data point. Michael McKee, thank you so much. Always appreciate it. And of course, Pooja Sriram, Vice President of U.S. Economics Research at Barclays. Hey, coming up later next week, do join us for our live coverage from Jackson Hole. We'll be on the ground in Wyoming. Well, we meaning Mike and team, covering the Kansas City Fed's annual economic policy symposium and highly anticipated remarks from Fed Chair Jay Powell. All happens and starts Wednesday, August 20th, and finishes up with a special edition of Bloomberg Surveillance. Tom Keene, Lisa Bromowitz, and the one and only Mike McKee will all be part of that special starting at 9 a.m. Eastern on Friday. All right, that's our economic stuff. We got to talk a little bit about tech and stuff going on there.
Stuff is happening in markets and business as well. So let's give that reminder that amid all of this eco news, speculation about the Fed and tariff impacts, companies are moving on and investing, doing deals or trying to, and we got that today when AI startup Perplexity said it made a formal offer to acquire Google's Chrome browser for $34.5 billion. I say startup. Maybe startup is diminishing the muscle of this company, but in anticipation of requirements that may be imposed on the search giant in antitrust proceedings. Seth Figgerman joins us now here in studio to talk more about that. Perplexity, talk a bit about why it would do this, what's in it for them, and sort of the opportunity they see here. We had this, of course, court decision when it comes to Google. We're waiting for kind of the final contours of what that decision means. But why is Perplexity out making this offer now?
Yeah, thanks for having me. Perplexity has spent the last couple of years trying to challenge Google in search. It's actually built by a guy who worked at Google or Google DeepMind. And over the last few months, they've been trying to branch into browsers. The idea here is take AI products, AI agents that we and others have been writing about, inject that into the browser that billions of people use every day. And so when you're looking up, where to go on a map or reading a Reddit thread, you have an AI agent that's actually kind of sitting along with you and kind of changing that web experience for you. Why go for Chrome? Well, you can build that up from scratch, which is what they've currently been doing, but you got to fight for every user. Or you can go for a platform that has 3 billion users and just claim that overnight. That said, like you said, a lot of money, long shot bid. They do not have this much money on their own. They're claiming they've lined it up.
What's their latest valuation?
Most recently, we reported $18 billion. They've raised more than $1 billion. Nothing to sneeze at, but what they are bidding here is more than twice what they've been valued at and far more than what they've raised. This is a cash-burning startup like every other AI startup that we covered. They're claiming that they have investment funds that are ready to put forward the amount of money that they said they have bid here, but this is a company that's made pretty bold, long shot bids before, including for TikTok. We've yet to see them, put up or shut up. We've yet to see them do it, but it gets a lot of attention.
So describe the opportunity, the moment they're doing this now. So we had that antitrust loss by Google in that court case in Washington, D.C. We're waiting for Ahmed Mehta, the judge there, to kind of outline more about what's to come next. But Google is in this predicament now where it seems like it's going to have to offload this part of the company. Sort of describe the circumstances that Google is in here and why this has been an opportunity.
Yeah, I think it's safe to say that this is probably the most dynamic and uncertain moment in the browser wars that I've seen in the past decade.
Kind of amazing. Right,
Yeah, I mean, Chrome
here.
has really been the dominant force for more than a decade after it rose ahead of Internet Explorer, and now there's a possibility that they are forced to divest this product. And suddenly you have not just Perplexity, but OpenAI, everyone's favorite AI startup, that are also vying to rethink the browser around AI. Google has already sort of been on the back foot a little bit, catching up on AI and search, but suddenly it might also change its market position with the browser. Google has also been rethinking the browser around AI, and I'm sure they're not alone. There are smaller browser companies that we don't cover every day that are doing this too. But it's a lot of activity, it's a lot of interest, but for the first time in years, it's no longer clear who the front runner will be in a few years from now.
I'm a little confused though, because with all of the chat bots and ChatGPT, right, and even Google understands, right? Alphabet understands kind of what it is facing in terms of what has been its bread and butter, right, in terms of an AI world. So I'm just curious, do they really need this? Can't they come up with a chatbot rather than
Does
buying
Google
a
need it,
browser?
or does Perplexity need it? Perplexity, I think that they are making a bet that
if we're moving towards a ChatGPT or Gemini, right, with Alphabet, like I'm just trying to.
I think that they are making a bet that if they're going to be increasing AI functionality, they want to put that in front of people as they're using the internet every day. And increasingly, the direction that we're seeing these companies move is not just you type in something to a chatbot and gives you a pithy response, but that it'll actually kind of surf the web along with you. It'll do tasks on your behalf. And what better way to do that than plug it into the browser? We'll see if that bet pays off and if it's worth $34.5 billion or whatever it ends up being, but that's the bet.
We'll put a fine point on it. I'm going to ask you to do that in terms of just how much search has changed here, the way that we have experienced and used it, and how AI is reshaping the way that this mechanism works.
Well, look, you can clearly tell from my voice that I'm skeptical of this offer, but if you step back, Perplexity is also a case in point of how much it has changed. If you had said 2 or 3 years ago, we would have a would-be rival to Google that is valued at $18 billion and has raised more than $1 billion and is vying to take Chrome, we would have laughed you out of the room. And all of a sudden, it's still a long shot bid, but it's a testament to the fact that OpenAI, Perplexity, and others are rethinking the day-to-day search experience. It's no longer enough to just have 10 blue links. You expect something more dynamic, sort of a one-stop shop. And that's what these products offer you.
Unsolicited bid, do you expect more? Do you expect this is the start of more?
Certainly if the judge ends up ruling in the way that the government is hoping, then there's no choice. There will be a lot more bids. I don't think this will be one and done. So
Not exactly AOL and Time Warner, right? But
No.
it's like kind of, I don't know. I'm just not quite sure. Anyway, you don't think it's going to happen?
Well, this one I don't know, but there'll be more deals.
All right, Seth, thank you so much. He's Bloomberg News AI editor joining us in studio. Hey, coming up next, President Trump's tariff reorg and its possible impact on relationships being forged by the other global economic might. I am watching China so carefully.
Absolutely, and as somebody who just got back from Brazil, you see the influence that country has in that part of the world and certainly in others as well. Interesting to see how these trade talks play out. Of course, that 90-day pause extended once again to November. We're going to dig into that, what China, India, Brazil, and more are doing here when Bloomberg Business Week continues on Bloomberg Radio and Bloomberg Television.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks continuing to push higher. In fact, best level of the session right now. S&P 500 index at a record. NASDAQ Composite Index at a record. The Dow right now up 518 points for the Dow. That is a gain of 1.2%. The S&P at 6442 now, up 69 points, up 1.1%. NASDAQ Composite Index up 277 for NASDAQ, a gain of 1.3%. The Bloomberg Mag 7 Index up 1.1%. The Russell 2000 Index up by 2.7%. 10-year 4.29% with a 2-year that's currently yielding 3.72%. Spot gold up 0.2%, 33.49 the ounce. And West Texas Intermediate crude now lower by 1.2%, 63.17 for a barrel of WTI. Stocks surging as an inline inflation reading bolsters speculation that the Fed will have room to cut rates in September. Match Group has agreed to pay $14 million to permanently stop misrepresenting guarantees and locking consumers out of paid-for accounts. Also, will simplify Match.com's cancellation processes to resolve Federal Trade Commission charges. Match Group shares, they're up now by 2.2%. Recapping, S&P at a record, up 68, up by 1.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie, thank you very much. David Gura in for Tim Stanovic, who's on assignment with Carol Massar here on Bloomberg Business Week. And we got news yesterday from the White House that President Trump has decided to extend that 90-day pause yet again on those heightened tariffs on China. China very much in focus here in the U.S., of course, as we wait to see sort of what happens with those trade talks, but also playing an incredibly important role around the world. We saw the Brazilian President Lula da Silva speaking with the Chinese leader, exchanging their views on international affairs. President Xi calling for coordinated efforts against unilateralism and protectionism. News today also that India and China set to resume direct flight connections as soon as next month. And we're seeing oil playing a critical role here as the contours of this trade war continue to come into focus. It does feel like, in a way, many parts of the world are moving on and increasingly away from the U.S. Let's get to a roundtable now to understand China's goals here, what they're thinking in terms of the role they're playing in the world. U.S. very clear, of course, about wanting a higher tariff world for those looking to sell into the U.S. Shadad Kazi joins us. He's Chief Operating Officer, Managing Director of the China Beige Book, here with us in studio. And from our bureau in Buenos Aires, Amanda Suniga with us, Geoeconomic Analyst for Latin America at Bloomberg Economics. And Shadad, let me start with you and maybe just give us your sense of how China is thinking about all this. We've had a series of 3 meetings now, Geneva, London, Stockholm. The pause continues here as we get perilously close, I think, to the Christmas holiday, when people are going to be buying a lot of gifts and are going to be very worried if a lot of these tariffs come to pass. How is China thinking about the kind of trajectory of these negotiations with the U.S.?
You know, when the year began, we would have thought that their primary objective was to bring the tariff levels down and negotiate just about trade. But what we've learned is that they are much more concerned about U.S. export controls, because that is ultimately what hurts them far more than even tariffs do, because they have ways to get around the tariffs. And so what they've done is they've used their chokehold on rare earths minerals and magnets and compelled really the administration to relent and roll back U.S. export controls while also bringing down the tariffs. So 2 wins for Xi Jinping in the last several months.
But what kind of relationship do you think he wants with the United States going forward?
Well, he'd love nothing more than to be able to sell as much as possible and be able to import the things they care about most, the most advanced technology, not just chips, but across the board, right? That's in an ideal world. Now, that's probably not what he's getting right away, but he's getting pretty close to it. I don't think he feels a pressure to do anything more. I don't think he feels a pressure today to say, I'm going to pledge like Japan and Europe did, $500 billion worth of investment, or I'm going to pledge to buy all this U.S. agricultural output the way I did in the past. I think they've demonstrated, Xi specifically, we've got a lot of leverage and we don't need to play ball if we don't feel like it.
I do think it's interesting that they want all the high tech, and yet Beijing is urging local companies to avoid using NVIDIA's H20 processors, particularly for government-related purposes. So yes, but there's always caveats. Jimena, come on in on this, because in the meantime, Latin America is watching very closely, I'm sure, and remind us of the relationship that already exists with China across Latin America, and maybe what they hope to even solidify even further.
Thank you, Carol. Yes, Xi and Lula just talked, and they said the relationship is as strong as ever. But so far, the support from China to Brazil seems to have been largely rhetorical, right? They have said, they have shared views on multilateralism and unilateralism on behalf of the U.S., condemning that, and China has been very keen on jumping on this collective criticism of the U.S. But even though Trump's tariffs may be giving BRICS, the bloc that Brazil and China have, along with India, Russia, and other smaller partners, even though Trump tariffs seem to be giving it some mortar, it's still far from operating as a bloc, and it's not really coordinating a response, a collective response to the Trump tariffs.
Jimena, on that note, do you anticipate that's likely to happen? I remember that moment a few months ago when there was the meeting of the BRICS countries. There was this tacit threat that they were going to work more closely together in opposition to what the United States was doing. President Trump clearly irritated, agitated by that, threatened even more punitive sanctions, more tariffs on those BRICS countries as a result of that. What would the catalyst be that would get them to do more than, as you say, just talk about presenting a more united front against the United States?
I think there are two main issues that are blocking a more integrated response, a more coordinated response. One is the very diverse membership of the group in general, and also with respect to the Trump tariffs. They are facing slightly different issues, although they are becoming increasingly closer in the sense that, for example, now Brazil and India are similarly targeted. But, for example, Russia has so far not been targeted with tariffs, although they have other issues with the U.S., of course. But the key thing is that China doesn't really need the bloc as much as the other members of the bloc need China, or would benefit from a coordinated response with China. As Shashank just said, China has a lot of leverage, has demonstrated has a lot of leverage to push back without offering any dramatic concessions as other countries have done. And the U.S. has backed down. So China does not really need to have the collective weight and heft of the BRICS bloc to stand up to Trump. If it did, however, it could really expand its geopolitical clout, and it would mean the BRICS would function more as a bloc. But so far, I think China is very focused on its national interests, and as long as it can stand up to Trump on its own, and it has the leverage to do it, it is unlikely to compromise its national interest to expand the BRICS heft.
We're talking with Jimena Zuniga, geoeconomic analyst for Latin America, out there in our Buenos Aires bureau, and also with us, Shahzad Kazi, Chief Operating Officer, Managing Director, China Beige Book, in studio. All right, so let's shift a little bit to China and India, which I think is kind of interesting. And, just a little headline, as David mentioned, that it looks like India and China set to resume direct flight connections as soon as next month, according to those familiar, as they look to kind of reset their political ties, as the U.S. and India, after years and years of working on improving that relationship, seem to have taken some steps back. China and India, what's China's goal there?
Well, I think, they have an incredibly complex relationship, because whereas they trade
it's not a friendly one.
It is absolutely not. They have very serious national security concerns about each other, more specifically India with regards to China, and of course are constantly having these battles and skirmishes at the border. Long-running problems there. So, I think the trade relationship...
So is any of this real, or is it just for show?
I think it's real to the extent that they want to do business with each other, but it's not. It doesn't go towards anything beyond that. I mean, India. So let's be clear. India does not want to be seen as a country that's going to counterbalance China and all the rest on behalf of the U.S. It wants to be seen as a power in its own merit, on its own right. And by that token, though, still, they also don't want to blow up their business relationship with China. This is far more complex than I think traditional models of geopolitics would suggest.
We were talking about sort of the gap that might be left if the trading relationship is ruined between the United States and China. How confident is China that it could get, yes, the rare earths, the critical minerals exported to other countries if the U.S. isn't able to buy them. I guess what I'm saying is, how sure are they in their ability to pivot to other markets if the U.S. is no longer what it has been?
So they demonstrated, I think, that everybody is desperate for Chinese rare earths. And if you remember, what they did was briefly, they set export controls on more or less everyone so that they could prevent us from transshipping those rare earths right into the U.S. the way, obviously China takes advantage of transshipment. So I don't know if that's really the big concern, because there's such desperation given the chokehold that they have as the sole supplier, really, of most of these things, including some really critical things like samarium, which you need for weapons development, and how dependent we are on that. And by the way, they are not letting that out.
Jimena, I also wonder, if some great deal happens between the U.S. and China after, the delays are done, will Latin America as a whole or specific countries be like, okay, missed opportunity, we're out, because we understand the importance of that U.S.-China relationship, and especially if China gets better terms in terms of tariffs finally?
What do you mean, we are out? Sorry.
Well, meaning that they won't necessarily have such an open door, perhaps, or the conversation lines, between China and Latin America might go away if ultimately the U.S. trade deal and tariff deal that they come together with China is not as onerous as maybe has been put out before, that ultimately U.S. and China come to terms that are good for both sides. So does then China kind of back off again from Latin America?
Yeah, in a way, I think China is very present in Latin America. If you think of it, outside Mexico, who exports 80% of its goods towards the U.S., China is the main market for most of the other biggest economies, including Brazil, Argentina, Chile, Peru. And so I don't think that Latin America can choose between the US and China. For Latin America, the best would be not to have to choose. And for a while, it cultivated positive, pragmatic relationships with both markets that are important, not only in terms of trade, but also in terms of financing and in terms of tourism. Both markets are critical to the region in different respects, depending on the country. If having to choose, a lot of countries would try to push back a lot, not to have to choose. They would continue to trade with China. They would continue to have financial ties, and they would try to push back on the U.S. because China is now almost as important or more important for many of these countries as the U.S. is.
Any last thoughts, just real quickly?
Well, look, China's going to be a big player, which is why I think when Secretary Rubio took over, his big focus initially was supposed to be to push back on China right here in the Western Hemisphere. That feels like years ago at this point, but it's an important objective, I think.
All right. So appreciate both of you.
Yes.
Shahzad Qazi, Chief Operating Officer, Managing Director of China Beige Book, right here in studio, and then out there at our Buenos Aires Bureau for Bloomberg News, Jimena Zuniga, Geoeconomic Analyst for Latin America. All right, coming up, we're going to kind of switch gears, talk a little bit about clean technology companies. David, I don't know if you noticed, but the shares have been on a tear this year.
Yes, absolutely. Again, tethered to AI and the growth that we're seeing there. We're going to talk to the CEO of one of those companies when we come back right here on Bloomberg Business Week, Bloomberg Radio, and Bloomberg Television.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We've got the stock market, S&P, holding close to session highs right now, up 65, trading above 6,400, 64.38 right now. We're looking at a gain of just about 1%, on track for a record close. The Dow up 456, up 1%. NASDAQ also at a record, up 268, up by 1.2%. An inline inflation reading, bolstering speculation that the Fed will have room to cut rates in September. The 10-year, 4.29%, with a 2-year, 3.72%. Spot gold right now up 0.2%, 33.48 the ounce. West Texas Intermediate crude, 63.12 a barrel. WTI down 1.3%. And Bitcoin now up by 0.6% to 119,526 a token. Canada's Gildanwear Activewear is in advanced talks to buy U.S. underwear maker Hanes Brands. That, according to sources, the transaction could value Hanes Brands at almost $5 billion, including debt. It may be agreed to by the end of the week. Right now, shares of Gill Brands, they are down 3.7%. Gildan, I should say. We've got Hanes Brands, that is up. That stock surging now by 27.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. Carol Master, along with David Gore. David in for Tim, who is on assignment today in Atlanta. One thing we like to watch is what's going on in the green space. Green firms, by the way, in the U.S. have found something of a lifeline in artificial intelligence after being bogged down by high interest rates, shrinking funding, and more recently, President Trump's sharp rollback of support. And our own Bloomberg New Energy Finance team, they have recently pointed out that clean tech companies that have inked deals to support data centers have seen their stocks soar this year, outperforming the S&P 500, and that includes the share price of our next guest. We're talking about fuel cell provider Bloom Energy. It is up 76% year to date, today trading at an all-time high, rising another 8.6%. Joining us to talk about the impact of AI and just the business overall is Dr. K.R. Schroeder, founder, chairman, and chief executive officer of Bloom Energy. It's a $9.5 billion market cap company. By the way, he was a former advisor to NASA and so much more. He joins us from San Jose. We could go on and on about your background, but we really want to talk to you. Good to have you here. It's been a while. Talk to us about how AI is specifically impacting and driving growth at your business.
Carol, it's such a pleasure to join you. So this is an amazing time in human history where we have not seen the need for power growth anywhere close to what we are seeing today. Let me put it in perspective. The amount of power that the big hyperscalers are saying they need between now and 2030 is equal to all the power every single family home in the US put together would need. There are about 85 million single family homes, give or take. All the power that they use is going to be needed in addition to the power we have today to just power the AI data centers. That's how large this opportunity is. And very clearly, the old model of centralized power plants with transmission distribution simply cannot meet that demand in a timely fashion. That is the opportunity, and Bloom was purpose-built to provide on-site power for the digital revolution, and we are so happy to be in the right place at the right time.
Well, help us understand how the company works, and you mentioned that on-site power, sort of what that looks like. Of course, there's been so much conversation in recent months about perhaps the need to invest more in nuclear power or fortify the grid, bring more power plants online. How do you see your company as maybe not a substitution for that, but a complement to the kind of growth and development we're likely to see here in the power grid going forward?
I think we're going to need all forms of power in very large quantities going forward to meet our voracious, like energy needs. However, in the short term, if you take 5 to 10 years, natural gas to electricity is going to be the single largest contributor to this additionality. What Bloom does is takes natural gas without burning it, without combustion. We extract the chemical energy in it using a fuel cell and make electricity at the highest efficiency without air pollution without noise in our generators because they're quiet solid state and with very high reliability. For those reasons, if you are in a neighborhood that is going to have a data center, we are your best choice because we don't pollute your air, we don't use water, and we don't make any noise as we generate this reliable power. So you can have the economic advantage that a data center brings to the local community. At the same time, you're not compromising on your health.
So one thing I want to ask you, actually, our Will Wade does, who really covers this space. We were talking about you coming on, and he said, well, wait a minute, let's talk about these fuel cells for data centers. Can fuel cells really work for this? What evidence have you guys seen that it does really work?
So, yeah, that's a great question. And this
Will's
is a
really smart dude. I'm just going to put it out there. He's amazing. But anyway, go ahead.
Absolutely. Look, the issue is we are progressing so fast in our technology at AI speed that some people that have looked at fuel cells 10 years ago and have that notion of who we are don't understand where we are today as a company. We already are powering more than 0.5 gigawatt worth of data center because our total installed capacity for data centers is more than 0.5 gigawatt. So we're not a concept. We are not a PowerPoint. We're actually producing power for these data centers. And this year alone, we have increased our capacity to 1 gigawatt a year. And we announced in our earnings call that by end of next year, we can do 2 gigawatts a year. That's 2 nuclear power plants worth of power coming out of our factory next year. And you know how long it takes to build a nuclear power plant and actually commission it. So we are no longer a concept. We are a mature technology that is affordable and can compete with other technologies that don't have as good attributes as we do.
Sridhar, I wonder if you could talk a bit about your business model. I know that you've announced deals with other companies, most recently with Oracle, of course, a company that I know is investing a lot in its data center infrastructure. Could you, Sridhar, just give us a sense here sort of what those deals look like, what that deal with Oracle is like in particular?
Yeah, David, so our customers, here's what happens. Once we sign a deal with a customer, they either buy the capital equipment from us, and then they also sign up for a service contract. It's a 100% attached rate because we run those units for them and we maintain that and we offer them the promise guarantee of performance. Now, if they don't buy the equipment as CapEx, we create a special purpose vehicle using financing and we simply sell them power just like the utility would, except this is on-site and highly reliable and clean. So either way, when we create a special purpose vehicle, that financial investor in that vehicle gives us the upfront money for our capital, and we also have an annuity revenue coming out of service. So we have 2 streams of revenue, if you want to think about it. Installed capital equipment that gets paid to us when we ship the equipment, a continuous service annuity over the tenure of the contract. That's how we make our money, irrespective of whether the customer actually buys the capital equipment or a third party buys the capital equipment and then charges the monthly rate from the customer.
Hey, KR, I'm curious. I'm looking at one of my favorite functions on the Bloomberg. It's the supply chain function, and I'm looking at your customers. Your biggest is, I think, American Electric Power Company, but I'm also looking at Alphabet, Microsoft, yep, sound familiar. These are some of the hyperscalers. Tell me how they are amping up their business, because they're the ones who are doing the massive, massive AI spend, but it looks like they're a very small part of your business. I'm just curious about what's the conversations you're having with them. Are they ramping up to do more with you? That would be very telling.
Yes, the answer to your question is very simple. In the past, these hyperscalers would spend all their capital equipment just on building the data centers, and they could simply pick up the phone and call the utility company and they would provide the power. No longer is that a reality because the utility does not have the amounts of power that these hyperscalers need. So now, electricity, power, which is what ultimately the data center needs to monetize the data center is a supply chain that comes from the common good called the utility. So they have to own that supply chain, or they have to procure from that supply chain.
Right.
We are very much an integral part of that supply chain, and we are having conversations with all the hyperscalers today. And you've seen the announcement at Oracle. Expect to see similar things coming soon. Our American Electric Power contract was actually for AWS, which is another hyperscaler.
I wonder if you could situate your company and this industry in the moment that